Shall we? Chalo. Let's start with introduction to tax ma. Introduction to tax. First chapter. I will try to cover important points from the viewpoint of examination ma. Nothing but tax rates. Nothing but tax rates applicable for individual, HUF, AOP, BOI, AJP, and special rates applicable, special tax rates applicable. Then I will explain surcharge rates, thereafter marginal relief. Finally, we need to verify rebate under section 87A and HEC, health and education cess at the rate 4%. After completion of discussion relating to rates, I will explain around 7 illustrations ma. 7 illustrations I will explain. Then we can conclude with introduction to tax. The point is, if we go through this much explanation, it is enough for you to answer in the examination if at all there is a situation relating to computation of tax liability. Understood? Okay. Let's start with the tax rates ma. Rates of tax. Now let's verify the applicable tax rates for individual, HUF, AOP, BOI and AJP. That is not AIP. Sorry for that. It is AJP. Yes. My question ma, for these persons, whether slab rate system is applicable or flat rate system is applicable. First of all, tell me what is slab rate system, what is flat rate system. Slab rate system means as our income goes up, the tax rate shall also goes up. That is slab rate system. What do you mean by flat rate system ma? Irrespective of your income status, a fixed rate shall be applied. That will be treated as flat rate system. When it comes to individual HUF, AOP, BOI and AJPs, these are under slab rate system. And even cooperative societies also under special slab rate system. Not this slab rate, but a special slab rate applicable for cooperative societies. Good. When it comes to individual partnership firm, domestic company, foreign company, for them flat rates are applicable. Come again ma, flat rates are applicable. So let's start with individual HUF, AOI, AOP, BOI and AJP who are under slab rate system. And what are the slab rates applicable for them? Let's verify. Up to 2,50,000 nil ma. What do you mean by nil? That means up to 2,50,000 the applicable tax rate is 0%. Nothing but the 2,50,000 shall be treated as basic exemption limit ma. What do you mean by basic exemption limit? Nothing but maximum income not chargeable to tax. The lawmakers introduced the concept called basic exemption limit to avoid the tax burden on poor people and middle class people. To avoid tax burden on poor people and middle class people by not charging from first 1 rupee. That means you earned 1 lakh rupees ma. Whether that 1 lakh rupees subject to levy of income tax? No, because up to 2,50,000 the applicable tax rate is 0%. Means no need to pay tax on up to 2,50,000. Nothing but basic exemption limit. That means they are not charging tax from first 1 rupee up to 2,50,000. They are providing as a basic exemption from levy of income tax. Next slab ma, 2,50,000 to 5 lakhs ma. What is that? 2,50,000 to 5 lakhs. Applicable tax rate is 5%. That means from 2,50,000 1 rupee to 5 lakh rupees, for the total income range you need to apply 5%. Next 5 lakhs to 10 lakhs range, total income range of 5 lakhs to 10 lakhs, you need to apply 20%. Then greater than 10 lakhs, you need to apply 30%. These are the slab rates applicable for individual HUF, AOP, BOI and AJPs. Now, who is the individual subject to this slab rate? Means the individual who is a normal citizen. The individual who is a normal citizen and a non-resident individual. These two individuals are subject to this slab rate system. Here individual is normal citizen and a non-resident individual. Then we are having the concept of senior citizen and we are having the concept of super senior citizen. In case of senior citizen and super senior citizen, this slab rate is not applicable. For them, separate slab rate system is applicable. Separate slab rate system means for them the applicable basic exemption limit is different. The remaining rates will be same. Understood the point, ma? Yes. Now, in case of senior citizen, let's verify what is the applicable slab rate system. In case of normal citizen, what is the amount provided as basic exemption, ma? 2,50,000. Whereas in case of senior citizen, the lawmakers given 3 lakh rupees as a basic exemption, ma. What is that? 3 lakh rupees. That means in the hands of senior citizen, up to 3 lakh rupees, no need to pay tax because the tax rate is 0%. So let's verify. Up to 3 lakhs, basic exemption 0%, that is nil. 3 lakhs to 5 lakhs, ma, 5%. 5 lakhs to 10 lakhs, 20%. Greater than 10 lakhs, 30%. It is applicable for senior citizen. Next, ma, in case of super senior citizen or very senior citizen, for him the applicable basic exemption limit is 5 lakhs. That means up to 5 lakh rupees, the applicable tax rate is 0%. No need to pay any tax, ma. Let's verify. Up to 5 lakhs nil. Then 5 lakhs to 10 lakhs 20%. Greater than 10 lakhs 30%. For whom? Super senior citizen. So these are the various slab rates applicable for normal citizen, senior citizen and super senior citizen. Now I will explain who is normal citizen, who is senior citizen and who is super senior citizen. Let's verify. Normal citizen, aged about less than 60 years, ma. That means up to 59 years. Come again. Up to 59 years, the individual shall be treated as normal citizen. The applicable slab rate system is 2 lakh. Applicable basic exemption limit is 2,50,000. Next, ma, who is senior citizen? If you want to get the status of senior citizen, two conditions required to be satisfied cumulatively. What are those? Let's verify. Must satisfy the following two conditions. First condition, the individual must be aged about 60 years or more and less than 80 years. What is the range of the age, ma? Equal to 60 years or more than 60 years but less than 80 years and he must be resident in India. Second condition is he must be resident in India. That means in case he is non-resident, therefore second condition will not be satisfied. Hence he shall not be given the status of senior citizen. We need to give the status of normal citizen. Understood, ma? That means if he wants to get the status of senior citizen, he must be resident in India. What do you mean by resident? What do you mean by non-resident? I will explain at the time of discussion of second chapter, ma. That is residential status and scope of total income. For the time being, consider he must be resident in India. So tell me, what are the two conditions required to be satisfied cumulatively to get the status of senior citizen, ma? First condition, must be aged about equal to 60 years or more than 60 years but less than 80 years. That means up to 79 years. From 60 years to 79 years must be the age range. And the second condition, must be resident in India. Then he shall be treated as senior citizen. The applicable basic exemption limit is 3 lakhs. Next, ma, super senior citizen. You can guess what is the range of the age. Very simple. He must be, the individual must be aged about 80 years or more, ma. Equal to 80 years or more than 80 years. And there is no upper limit given by the lawmaker because they cannot decide the lifespan of the individual, right? That's why they have given only lower limit. What is that? Minimum limit, minimum 80 years or more than 80 years and he must be resident in India. If these two conditions satisfied cumulatively, then he will be getting the status of super senior citizen, and the applicable basic exemption limit is 5 lakhs ma. Up to 5 lakhs no need to pay any tax because the applicable rate of tax is 0%. Understood ma? Next, one important point I'm going to explain. When it comes to non-resident individual, irrespective of his age, he will always be treated as normal citizen. That means whether that non-resident individual is aged about 20 years or 80 years or 120 years, irrespective of his age, always he will be treated as normal citizen. That means always he will be subject to basic exemption limit of 2,50,000 only. For him we cannot apply 3 lakhs and 5 lakhs because he will not get the status of senior citizen and super senior citizen. Always he will be getting the status of normal citizen only. That means these 3 lakhs BL benefit, 5 lakhs BL benefit we are giving to whom? Only to our residents in India. We are not giving to non-residents in India. Understood the point ma? Yes. Next ma, 5 special incomes and special rates. Now I am going to explain 5 special incomes ma. For these 5 special incomes, 5 special rates are applicable. That means in case these 5 special incomes arising in the hands of these persons means you need to apply these special rates irrespective of normal applicable rate. This point is very important. This statement is very important. In case any of these special incomes arised in the hands of the persons, then we need to apply these special rates irrespective of normal applicable rate. Let's verify. What are those special incomes ma? Five special incomes and applicable special rates. Let's verify. First one ma, long term capital gain under section 112. It will be subject to a special rate of 20%. What is the applicable special rate ma? 20%. Second one, long term capital gain under section 112A. It is subject to a special rate of 10%. It must be applied in excess of rupees 1 lakh. What do you mean by this statement? I will explain at the time of solving the problems. But for the time being, remember, in case of long term capital gain under section 112A, we need to apply 10% special tax rate. That too we need to apply on in excess of 1 lakh rupee. That means up to 1 lakh rupee exemption is available under section 112A. Therefore, we need to apply in excess of 1 lakh rupee. What is there? Verify as a long term capital gain under section 112A. And that we need to apply 10%. Next ma, short term capital gain under section 111A. What is that? Short term capital gain under section 111A. Subject to a special rate of 15%. Next, winnings under section 115BB. You need to remember these sections ma, because in the examination they will give you the section number, then immediately you should get that these are subject to special rates. Understood the point? Winnings under section 115BB, it is subject to a special rate of 30%. Winnings means winning from lottery, winning from card games, winning from bettings. Are you following? Winning from horse races. Are you following? These are called under winnings under section 115BB. Next ma, deemed income under section 115BBE. What is the section ma? 115BBE, deemed income. The applicable special rate is 60%. What is applicable special rate ma? 60%. And to this 60% we need to apply special surcharge rate of 25%. What is the special surcharge rate ma? 25%. I think it is not visible to you. To the 60%, we need to apply a special surcharge of 25% and HEC at the rate 4%. Therefore, the effective rate is 78% for deemed income. What do you mean by deemed income? Nothing but black money. What do you mean by black money ma? Income escaped from assessment, concealed income, undisclosed income shall be treated as deemed income, black money. The applicable section 115 BBE. And what is the applicable tax rate ma? Special tax rate 60%. If you consider special surcharge at the rate 25% and health and education cess at the rate 4%, then it will be around effective rate of 78% ma. How we obtain 78%? I will explain. What is the special rate ma? 60%. On this special rate we need to apply surcharge, special surcharge at the rate 25%. That means this 25% must be applied on 60%. How much ma? 60% into 25%, it is 15%. Then put together it is 75%. To this we need to add HEC at the rate 4%. This 4% we need to apply on 75% ma. 75 into 4%. Around 3% ma. Then the effective rate is 78%. That's how we got effective rate of 78%. Understood the point? So these are the 5 special incomes. In case these special incomes arising in the hands of SSC, then we need to apply these special rates irrespective of normal applicable rate. Irrespective of normal applicable rate ma. Say for example, domestic company is there. What is the applicable flat rate for domestic company? 30%. In case any one of these incomes, any of these special incomes arising in the hands of domestic company, means don't apply the normal applicable rate of 30%. You need to apply these special rates. When it comes to individual, he is subject to slab rate system of 0%, 5%, 20%, 30%. But if these special incomes arises in the hands of that individual, don't apply those normal slab rates, apply these special rates. That is what do you mean by irrespective of applicable normal rate, we need to apply these special rates if at all these special incomes arises in the hands of the SSC. Understood the point ma? So that is regarding special rates. Please tell me, what are the special rates we verified here? Total how many special rates are there? 5 special rates are there. What are those? Long term capital gain under section 112. What is the applicable special rate ma? 20%. Next, long term capital gain under section 112A, 10% in excess of 1 lakh. Then short term capital gain under section 111A, 15%. Winnings under section 115 BBE, 30%. Deemed income under section 115 BBE, 60%. Whereas the effective rate is 78%, which includes special surcharge of 25% and HEC at the rate 4%. Understood the point ma? Good. Next, surcharge. Let's verify the concept called surcharge ma. What do you mean by surcharge? Surcharge is a tax on tax. What is that ma? It is a tax on tax. That means you need to determine tax amount applying applicable normal rates or special rates, whatever the case may be, on the total income, and you need to get the tax on those total income. On the tax you need to apply the surcharge ma. That is what you mean by tax on tax. That means this surcharge is levied on income or a tax amount ma. It is not to be levied on income. It is to be levied on tax ma. That means on income you are levying the tax. On the tax you need to levy the surcharge. That's why we need to call it is a tax on tax. My question, levying of surcharge, that is tax on tax, is fair or unfair ma? Fair or unfair? It is totally fair. Why? Because here the lawmakers levying the surcharge on super rich people. They are not levying on every person. They are levying only on super rich person. How to obtain, how to find out whether that person is super rich or not a super rich person? Depending upon the total income criteria. What is that ma? Depending upon the total income criteria. In case the total income does not exceeds 50 lakhs, that means less than or equal to 50 lakhs the total income, he shall not be treated as super rich. Then surcharge is not applicable. Whereas in case the total income is exceeding 50 lakhs, then he shall be treated as super rich person and we need to apply the surcharge. And from exceeding 50 lakhs, depending upon the various levels of total income, various surcharge rates are applicable. What are those? Let's verify. It is a tax on tax. The lawmakers introduced enhanced surcharge for individual HUF, AOP, BOI and AJP through Finance Act 2019 as follows. That means these enhanced surcharges introduced through which Finance Act ma? 2019. That means applicable from previous year 1920. Let's verify. Total income less than or equal to 50 lakhs, the surcharge rate will be 0% because they shall not be treated as super rich. The applicable surcharge is 0%. In case the total income is exceeding 50 lakhs but less than or equal to 1 crore, then the applicable surcharge is 10%. Third case ma, total income exceeding 1 crore but less than or equal to 2 crore, then 15%. Exceeding 2 crore less than or equal to 5 crore, 25%. Exceeding 5 crore, we need to apply 37%. That is the maximum surcharge rate applicable. So what is the maximum surcharge rate applicable ma? 37%. So tell me what are the various surcharge rates applicable? Total income up to 50 lakhs 0%, greater than 50 lakhs less than or equal to 1 crore 10%, exceeding 1 crore less than or equal to 2 crore 15%, exceeding 2 crore less than or equal to 5 crore 25%, exceeding 5 crore 37%. What is that? Surcharge rate. And these 50 lakhs 1 crore 2 crore is total income range. What is that ma? Total income range. Okay, there is one important point. What is that? Let's verify. Irrespective of the total income level of the SSC, the surcharge on tax on dividend, LTCG under section 112A and STCG under section 111A shall not exceed 15%. What is your understanding regarding that statement ma? Please tell me. What is your understanding? Irrespective of total income level. That means whether the total income is 2 crore or 6 crore or 10 crore or 100 crore or 500 crore. Irrespective of total income level, the maximum surcharge rate applicable on tax on dividend income, LTCG under section 112A, STCG under section 111A is 15%. That means on these three incomes, the surcharge rate of 25% and surcharge rate of 37% shall not be applicable. You should not apply 25-37% of surcharge rates on these three incomes. The maximum rate of surcharge you can apply is 15%. Understood the point ma? Good. Now for your better understanding, I have given this important point in 5 different situations ma. That means if you understood those 5 different situations, it is very easy to apply the surcharge rates and you will get the point when we need to apply maximum 15% and when we need to apply 25% and 37% on other income. Let's verify the analysis. Situation 1. What is situation 1? The total income including these 3 incomes. What are those 3 incomes ma? dividend income, LTCG double one to A, sorry, LTCG double one to A, STCG triple one A. Including these three incomes, the total income range is exceeding 50 lakhs but less than or equal to 1 crore. In such a case, on these three incomes, you need to apply 10% ma, and on remaining total income, you need to apply 10% because the range is 50 lakhs to 1 crore. Next ma, situation 2. The total income including these three incomes exceeded 1 crore but less than or equal to 2 crore. Exceeding 1 crore but less than or equal to 2 crore. Then surcharge rate will be 15% on tax on these three incomes, and remaining total income, tax on remaining total income also we need to apply 15%. Situation 3 ma. If the total income including dividend and LTCG double one to A, STCG triple one A, including these three incomes, the total income is exceeding 2 crore. Then the tax on these three incomes will be subject to a surcharge rate of 15% and tax on other normal income, remaining total income save. Tax on remaining total income, the applicable surcharge rate also 15% because the remaining total income does not exceed 2 crore, but the dividend, LTCG double one to A, STCG triple one A, those exceeded 2 crore, but still you cannot apply 25 and 37% because the maximum rate you can apply is 15%. That's why we applied 15% on these three incomes. When it comes to tax on remaining total income, we are applying 15% because it is not exceeded, remaining total income not exceeded 2 crore. In case the remaining total income exceeded 2 crore, then you can apply 25% or 37%. That comes under situation 4 and situation 5. Comes under situation 4 and situation 5. Let's verify. If the total income excluding these three incomes, the total income excluding these three incomes exceeded 2 crore but less than or equal to 5 crore. In such a case, on tax on these three incomes, maximum rate you can apply 15%. Then on remaining total income, you can apply 25%. On remaining tax on remaining total income, you can apply 25% because the total income excluding these three incomes exceeded 2 crore but less than or equal to 5 crore. Hence 25% will be applicable on tax on remaining total income. Next situation 4. You can guess the situation, sorry, situation 5 you can guess the situation 5. What is that? The total income excluding these three incomes exceeded 5 crore. In such a case, tax on these three incomes, you need to apply 15% surcharge rate, whereas tax on remaining total income, you need to apply 37% because that total income excluding these three incomes exceeded 5 crore. The applicable surcharge rate is 37%. Understood the point, ma? Good. So this is regarding 5 situations. In case in the examination they have given these three incomes along with the remaining total income, other income, then you need to consider under which situation that question falls. Accordingly, you need to apply the surcharge rates. Understood the point? I will explain with the help of illustrations little bit later, but for the time being, understood the point? Yes. Next in case of partnership firm, local authority or cooperative society, the total income is less than or equal to 1 crore, then 0% applicable surcharge. Total income is exceeding 1 crore, we need to apply 12%. In case of domestic company, 3 surcharge rates are applicable depending upon the total income level. If total income does not exceed 1 crore, 0%. Exceeding 1 crore, less than or equal to 10 crore, you need to apply 7%. Exceeding 10 crore, you need to apply 12%. When it comes to foreign company, up to 1 crore, 0%. Exceeding 1 crore, less than or equal to 10 crore, you need to apply 2%. Exceeding 10 crore case, you need to apply 5% rate of surcharge. My question, why lawmakers provided lowest surcharge rates to foreign company when we compare with the domestic company, because that foreign company is already subject to highest normal flat rate 40% and 50%. In case of interest, royalty, fee for technical services paid by the central government, then we need to apply 50% flat rate in the hands of foreign company. For other income, we need to apply 40%. That means already lawmakers provided 40%, 50% highest rates to the foreign company. That's why they have given the reduced surcharge rates of 2% and 5%. In case they have increased the surcharge rates also for foreign company, then no foreign company will do the transaction with Indian companies in India. Are you following? So to encourage these foreign companies, we have given the lower surcharge rates when we compare with the domestic company surcharge rates. Understood the point? Yes. Next, marginal relief. I will explain. What do you mean by marginal relief? Marginal relief is a, first of all, tell me the concept called marginal relief introduced by the lawmakers for the benefit of department or for the benefit of SSC? It is not for the benefit of department, it is for the benefit of SSC, because marginal relief will be allowed as a deduction from the tax liability. If at all you are allowing it as a deduction from the tax liability, that means it is a benefit to the SSC, because your tax liability is getting reduced. Understood? It is not for the benefit of department, it is for the benefit of what? SSC. Chalo. So margin relief has been introduced by the lawmaker for the benefit of SSCs. Now, while the lawmakers introduced the concept called marginal relief, the concept called margin relief introduced by the lawmakers based on the golden principle. One golden principle. What is that golden principle? The additional tax liability should not exceed the additional income. Come again. The additional tax liability should not exceed the additional income. That means, what is the highest tax rate applicable in our country? It is for foreign company. What is applicable? 50% in case of those incomes, interest, royalty, fee for technical services. In case it is happen to be black money, deemed income, then under section 115 BBE they are applying 60%, whereas the effective rate is 78%. My question, is it possible for the lawmakers to increase the tax rate to 90%? Assume for any person, is it possible for the lawmakers to increase the tax rate to 90%? Yes, they are having right. What if they wants to increase to 95%? They are having right. What if they increase it to 100%? Still they are having right. What if they increase it to 105% the tax rate? Obviously they don't have such right. That means maximum they can recover 100% of your income as a tax amount. In the worst case scenario, they can recover 100% of your income as a tax, but not more than that. They don't have the right to levy the tax which is more than your income. Understood the point? So maximum they can recover 100%, but not more than that. That is the golden principle behind introduction of marginal relief. So what is the golden principle? Additional tax liability should not exceed the additional income. In case the additional tax liability exceeded the additional income, then in excess of that additional income, what is there, that additional tax liability, that will be allowed as a marginal relief. Because up to additional income they can recover, 100% of additional income they can recover, but not more than that. That more than that will be allowed as a marginal relief, because they don't have the right to recover more than income. Understood? Let's verify. The concept called, this concept has been introduced by the government on the basis of the following golden principle. The additional tax liability should not exceed the additional income. Very good. Now I have given the formula to determine marginal relief. If you follow this formula, it is very easy for you to determine the marginal relief amount, and that can be reduced from the tax liability, and remaining procedure you need to follow to determine the final tax liability. Understood the point? So this formula is applicable for individual with reference to total income of 50 lakhs. This formula, this format is applicable to the individual who is having a total income of greater than 50 lakhs but less than or equal to 1 crore. Let's verify. Particulars, inner column, outer column. First of all, you need to determine tax liability on total income. Tax liability on total income which is exceeding 50 lakhs but less than or equal to 1 crore. If at all you are determining tax liability on total income of exceeding 50 lakhs means it should be including surcharge. It should be including surcharge at the rate 10%. You need to consider in the outer column. From that you need to less tax liability on 50 lakhs. If at all you are determining tax liability on 50 lakhs, that means not exceeding 50 lakhs, equal to 50 lakhs you are determining tax liability. Therefore, whether it will be subject to surcharge of 10%, not subject to surcharge of 10%. It will be not subject to surcharge of 10%. That means excluding surcharge, because we are determining on 50 lakhs, up to 50 lakhs surcharge is not applicable. Therefore, we need to consider excluding surcharge. We need to compute the tax liability, and consider in the inner column within the brackets, because we need to reduce, right? You need to put within the brackets. Next, less income in excess of 50 lakhs. Whatever it is, income in excess of 50 lakhs, reduce, consider in the inner column, put within the brackets. Then total get into the outer column, and it must be reduced from the tax liability on total income. Then the resulting amount will be marginal relief. Resulting amount will be marginal relief. There are two possibilities with respect to this resulting amount. First possibility, the margin relief computation is resulted into positive. The marginal relief computation is resulted into positive. What is the meaning of resulted into positive? If it is resulted into positive, that means the additional tax liability exceeded the additional income. Resulted into positive means the additional tax liability exceeded the additional income. Therefore, this resulted amount will be provided as a marginal relief from the tax liability. Understood the point? Second situation, this amount, this computation resulted into negative amount. Resulted into negative means the additional tax liability does not exceeded the additional income. The additional tax liability does not exceeded the additional income, therefore not eligible to claim marginal relief. Assessee is not eligible to claim margin relief. In such a case, the marginal relief will be zero. When this computation is resulted into negative. Understood the point? Let's verify. What if the resulting amount is positive? That means the additional tax liability is more than the additional income, hence margin relief will be allowed. Note 2. What if the resulting amount is negative? That means the additional tax liability does not exceed the additional income, hence marginal relief will not be allowed. Margin relief will not be allowed means 0 will be allowed as a marginal relief because the additional tax liability does not exceed the additional income. There is no problem to the lawmaker to recover additional tax which is less than the additional income. Hence the available margin relief is 0 rupees. Understood the point, ma? Yes. Next, format for determination of margin relief with reference to 1 crore, ma. That means greater than 1 crore but less than or equal to 2 crore. Come again, greater than 1 crore but less than or equal to 2 crore. Then same format, tax liability on total income of exceeding 1 crore less than or equal to 2 crore. That means exceeding 1 crore less than or equal to 2 crore means what is the applicable surcharge rate for the total income level, ma? 15%. That means including surcharge at the rate 15%. Consider in the outer column less tax liability on 1 crore. Very important, pay attention. Here we are determining tax liability on 1 crore, ma. If at all we are determining tax liability on 1 crore, it is including surcharge or excluding surcharge. That is the point I need to get from you. Please tell me, if at all we are determining tax liability on 1 crore, it is including surcharge or excluding surcharge? Tell me. It is excluding surcharge at the rate 15%, ma. Why excluding surcharge at the rate 15%? Because we are determining total tax liability on 1 crore. That means not exceeded 1 crore. Hence we cannot apply 15% of surcharge rate. Hence excluding surcharge at the rate 15%. But including surcharge at the rate 10% we need to consider. Why including surcharge at the rate 10%, ma? Because here that we are determining total income on, we are determining tax liability on 1 crore which is exceeding 50 lakhs, ma. Exceeding 50 lakhs means subject to surcharge rate of 10% we need to apply. That means here tax liability on 1 crore within the brackets what we need to consider, excluding surcharge at the rate 15% because the total income not exceeded 1 crore, but including surcharge at the rate 10% because the total income exceeded 50 lakhs you need to consider. Within the inner column within the brackets, ma, then income in excess of 1 crore. In excess of 1 crore, whatever the income you need to consider in the inner column. Total you need to get into the outer column, reduce from the tax liability on total income and you will get the marginal relief. Same discussion. If that is resulted into positive, that means the additional tax liability exceeded the additional income eligible for margin relief. This resulted amount will be provided as a deduction from the tax liability. In case it is resulted into negative, that means the additional tax liability does not exceed the additional income. Therefore, assessee is not eligible to claim margin relief. In such a case, the margin relief will be 0. Understood the point? Yes. Next, ma, rebate under section 87A. What is that? Rebate under section 87A. What do you mean by rebate under section 87A? Again, I am asking, the concept called rebate under section 87A introduced by the lawmaker for the benefit of department or for the benefit of assessees, ma? I would say it is for the benefit of assessee. Why? Because rebate under section 87A will be allowed as a deduction from tax liability again. If at all they are allowing it as a deduction from tax liability, that means the tax liability will get reduced. The tax liability is getting reduced means benefit to the assessee. Understood? But if you want to claim rebate under section 87A, there are two conditions required to be satisfied cumulatively. In case these two conditions has been satisfied cumulatively, comfortably you can claim the benefit of rebate under section 87A. What are the two conditions required to be satisfied cumulatively? First condition, the total income should not exceed 5 lakh rupees. What is the first condition, ma? The total income should not exceed 5 lakhs. That means your total income should be less than 5 lakhs or equal to 5 lakhs to claim the benefit of rebate under section 87A. In case your total income is greater than 5 lakhs, say 5 lakh 1 rupee, you are not eligible to claim the benefit of rebate under section 87A. That is the first condition. Second condition ma, the assessee should be resident individual. The assessee should be resident individual. If these two conditions satisfied cumulatively, then you are eligible to claim rebate under section 87A. The following are the two conditions must be satisfied cumulatively for claiming rebate under section 87A. The total income of the assessee should not exceed 5 lakhs during the previous year. That means less than or equal to 5 lakh. Second condition, the assessee must be resident individual. What is your analysis regarding second condition ma? What is your analysis regarding second condition? Assessee must be resident individual. First observation, this rebate under section 87A is available only to individuals. That is first observation. Available to whom? Only to individual. That means HEF, AOP, BOA, partnership firm, AJP, company. Are you following? They cooperative societies, they are eligible to claim rebate? No, only individuals alone eligible to claim rebate. That too resident individual ma, very important. That means in case that individual is non-resident, then he cannot claim the benefit of rebate under section 87A. That means the lawmakers providing the benefit of rebate under section 87A only to our residents in India. They are not providing to non-resident individuals. Understood the point? So these are the two conditions required to be satisfied cumulatively to claim the benefit of rebate under section 87A. Good. If at all these two conditions satisfied cumulatively, then what is the rebate available to that resident individual? The rebate under section 87A is least of the following. Highest or least ma? Least of the following. Two things we need to consider. First one, 100% of tax liability. Second one, 12,000 rupees, 12,500 rupees ma. What are the two things we need to consider ma? First one, 100% of tax liability. That must be compared with rupees 12,500. Then least will be provided as rebate. Then balance will be tax liability need to pay to the government. Understood the point? So what is the maximum rebate available ma? 12,500 rupees. Say for example, the 100% tax liability is 14,000. Assume the 100% of tax liability is 14,000. Then 12,500 standard amount, whichever is lower means 12,500 will be provided as rebate out of 14,000. Then 1,500 is final tax liability you need to pay to the government. Second case ma. Second case, if the tax liability is 8,000. If the tax liability is 8,000, then 100% of tax liability is 8,000. Then standard amount 12,500. Least means 8,000 will be allowed as a rebate. That means out of 8,000 we need to provide 8,000 as a rebate. Then balance 0 rupees you need to pay to the government as a tax. That means no need to pay any tax to the government. Understood ma? That means your 100% tax liability is less than or equal to 12,500 rupees. Then pura allowed as a rebate. In case your tax liability is greater than 12,500, then maximum 12,500 will be provided as rebate. Then balance you need to pay to the government as a final tax liability. Understood the point ma? Yes. Note, the maximum rebate amount that can be claimed by the assessee is rupees 12,500. Very good. Rebate under section 70A is allowed as a deduction from the tax liability. We verified already. Okay. Note 2. Rebate under section 87A is not available in respect of tax payable at the rate 10% on long-term capital gain under section 112A. Very important point ma, this one. This rebate is available to resident individual. Okay, no problem. But in case that resident individual is having long-term capital gain under section 112A, which is subject to a special rate of 10%, then from the tax liability you should not claim rebate under section 87A. Why ma? Because already we have given the benefit of lowest tax rate of 10%. We have given the benefit of lowest tax rate of 10. And we are charging in excess of 1 lakh alone ma. That means up to 1 lakh rupee exemption also provided. That means small rate of 10% given and exemption up to rupees 1 lakh provided. In excess of 1 lakh alone we are applying 10% special rate. These many benefits has been given, and again you are claiming rebate under section 87A means double benefit to the assessee ma. Huge benefits, number of benefits you are giving to the assessee with respect to the LTCG under section 112A. Therefore the lawmaker says In case this resident individual is having LTCG under section 112A, then from the tax liability you should not claim rebate under section 87A. Understood the point? Yes, very very important point you need to remember. Next ma, finally health and education cess ma. What is the rate ma? 4%. This is the last step in computation of final tax liability. What is the last step in the computation of final tax liability ma? Applying health and education cess at the rate 4%. That means if you applied surcharge, then verify whether that person is eligible for margin relief or not. In case that person is eligible for margin relief, then claim that margin relief. On balance amount you need to apply this HEC at the rate 4%. Second case, in case that person is eligible for rebate under section 87A, the person is eligible for rebate under section 87A, then apply rebate under section 87A and get the balance tax liability, and to that balance tax liability or on that balance tax liability you need to apply HEC at the rate 4% to get the final tax liability which will be payable to the government. Understood the point ma? That means simply say, after claiming margin relief wherever applicable and after claiming rebate under section 87A wherever applicable, you need to apply HEC at the rate 4% as a last step. Then after applying HEC at the rate 4%, you will get the final tax liability which will be paid to the government. Every person who is liable to pay tax is required to pay HEC at the rate 4% ma? Yes, obviously the statement is 100% correct. You are liable to pay 100 rupees tax ma, apply 4%, 4 rupees. Are you following? That means if at all you are liable to pay tax on a mandatory basis, you need to pay HEC at the rate 4%. My question, what is the meaning of health and education cess ma? Why they are levying as a cess at the rate 4%? Please try to answer that question. Why they are leaving it as a cess? Whenever the lawmaker used the word called cess, means this amount must be applied only for that purpose. It should not be applied for any other purpose. Come again ma? Whenever they used the term cess, then this tax amount shall be applied only for that purpose which is specified in the tax, and it should not be applied for any other purpose. That means, say for example, 1000 rupees your tax liability, then 4% you are levying as a cess ma. How much it is? 40 rupees will be levied as a HEC. Now this 40 rupees you need to apply only for health and education in the country. This 40 rupees you cannot apply for what is the defense equipment purchase. You cannot apply for public welfare programs. You should not apply for infrastructure development. You need to apply only for health and education purpose alone. What about 1000 rupees other tax liability ma? That you can apply for any purpose. That you can apply for any purpose, but HEC at the rate 4%, 40 rupees must be applied only for health and education in the country. That is what you mean by HEC at the rate 4%. Whenever they use the term called cess, then it must be applied only for that purpose only. It should not be applied for any other. Should not be applied for any other purpose. Understood the point ma? Yes. That is the discussion relating to health and education cess ma. We successfully completed HEC at the rate 4%. Okay, then let's verify next 115 BAC ma. What is that thing? Section 115 BAC. Alternate tax regime for individual and HUF. The lawmakers introduced alternate tax regime through Finance Act 2020 ma. What is that? Finance Act 2020. The concept called alternate tax regime through introduction of a new section called 115 BAC. Come again, 115 BAC. What is the discussion relating to this concept? In case the individual and HUF wants to opt for 115 BAC, they can go for that. In case they opted for 115 BAC, they are eligible to apply a separate slab rate system. Come again, They are eligible to apply for separate slab rate system. What is the separate slab rate system applicable for individual and HUF who has opted for 115 BAC? Let's verify. Pay attention. The following are the concessional slab rates applicable for individual and HUF on normal income. This concessional slab rate system applicable only on normal income. In case that individual and HUF opted for 115 BAC is having special income like LTCG 112, LTCG 112A, STCG 111A, winnings under section 115 BB, deemed income under section 115 BBE. In such a case, even though they have opted for 115 BAC, still we need to apply those special rates for that special incomes. That means these concessional slab rates are applicable only for normal income, not for special income. For special income, we need to apply those special rates only. Okay, let's verify what are the concessional rates applicable for individual and HUF. Up to 2,50,000 nil, 2,50,000 to 5 lakh. On the difference of rupees 2,50,000, you need to apply 5%. Then 5 to 7,50,000, 10%. 750 to 10 lakhs, 15%. 10 to 12.5 lakh, 20%. 12.5 lakhs to 15 lakhs, 25%. And in excess of 15 lakh, 30% we need to apply. These are the concessional slab rates applicable for individual and HUF who has opted for section 115 BAC. But if you opted for section 115 BAC, you need to satisfy certain conditions. You need to meet certain restrictions. Certain deductions will not be allowed. Certain exemptions will not be allowed to the person, to the individual and HUF who has been opted for 115 BAC. If you satisfy all the conditions specified under section 115 BAC, you can comfortably go for concessional slab rates applicable for those persons, individual and HUF opted under section 115 BAC. Understood, ma? What are those conditions? What are those restrictions? What are the deductions not allowed? What are the exemptions not available? I will explain at the time of discussion of total income. So after completion of up to gross total income, that means after completion of chapter 6A deduction discussion, I will explain 3 to 5 total income problems, ma, depending upon the availability of the time. I will explain 3 to 5 total income problems. Then there I will explain 115 BAC conditions, ma, in brief, not in detail. In brief I will explain. Okay, then chalo, this is the concessional slab rate system applicable. We will discuss at the time of discussion of total income, not now. For the time being, remember what are the rates applicable under section 115 BAC. Okay, ma. Let's get into the illustrations. Successfully we completed what are the tax rates applicable for various persons, what are the surcharge rates applicable, and what is rebate under section 87A, and what is HEC at the rate 4%. We discussed comfortably, and we discussed about marginal relief also. We completed discussion. Okay, let's go for illustration 1, ma. Chalo, I'm going to explain around 7 illustrations, ma, on various situations. So after completion of 7 illustrations, you will be having a better understanding how to determine tax liability. Okay, chalo. Illustration 1. Mr. X has a total income of rupees 12 lakhs for the previous year 21-22, comprising of income from house property and interest on fixed deposit. Tell me the total income is comprising of only house property income and interest on fixed deposit, ma. That means these incomes are normal incomes or special incomes. Obviously normal incomes. It is not LTCG under section 112 or 112A. It is not STCG under section 111A. It is not winnings. It is not deemed income. That means it is what? Normal income. We need to apply normal slab rates. We need to apply normal slab rates. Okay. Compute his tax liability for the assessment year 22-23, assuming that his age is 45 years, 63 years and 82 years. Assume that Mr. X has not opted for the provisions of section 115 BAC. Very good. If he has not opted for provisions of section 115 BAC means we need to apply normal slab rate system. What do you mean by normal slab rate system? Up to 2,50,000 nil in case of normal citizen, I'm explaining, and 2,50,000 to 5 lakh we need to apply 5%. 5 lakhs to 10 lakhs, it is 20%. Greater than 10 lakhs, it is 30%. That slab rate system we need to apply. Okay, ma? First case, what is his age, ma? 45 years. That means he is a normal citizen. Second case, 63 years, ma. That means 60 years or above but less than 80 years. He will be treated as senior citizen. In case of senior citizen, what is the basic exemption limit available? It is 3 lakh rupees, if you remember. Next case, 82 years, ma. That means greater than or equal to 80 years and who is a resident in India. That individual must be resident in India. Then he will be treated as a super senior citizen. Tell me, in case of super senior citizen, what is the basic exemption limit available, ma? It is 5 lakhs. Up to rupees 5 lakhs, 0% tax rate will be available. Understood, ma? Okay, then. Chalo. Let's work out the illustration, ma. First of all, let's verify for 45 years of age. That means he is a normal citizen. Applicable basic exemption limit is 2,50,000. Chalo. Computation of final tax liability in the hands of Mr. X for the previous year 21-22 or assessment year 22-23. Observe the format, ma. How I am determining the total income and tax liability. Apply the same procedure in the examination. Damn sure 100% you will get a maximum marks. Chalo. Particulars amount column. Tax liability on total income. Working note 1. We need to work out that what is that workings in the working note 1. Give working note 1 for that. 1,72,500 will work out, no problem. Add HEC at the rate 4%, ma. 6,900. Then you will get a final tax liability. Okay, now let's go for working note 1. What is working note 1, ma? Determination of tax liability on total income. Working note 1, computation of tax liability on total income. What is the total income, ma? 12 lakhs. And he is a normal citizen, ma, because age is less than 60 years. He is a normal citizen. Tax liability thereon, he is a normal citizen. Okay, then what is the basic exemption limit available in case of normal citizen, ma? Up to 2,50,000 nil. Basic exemption limit, it is nil. Then 2,50,000 to 5 lakhs range total income. What is the difference of 2,50,000 to 5 lakhs, ma? It is 2,50,000. And what is the rate applicable, slab rate applicable for that slab, ma? 5%. Then what is the tax liability? 12,500. Good. The next slab, ma, 5 to 10 lakhs. What is the difference? It is 5 lakhs into what is the rate applicable for that slab? 20%. How much it is? 1 lakh. Then in excess of 10 lakhs, how much income, total income we are having in excess of 10 lakhs, ma? Just 2 lakhs. Into what is the rate applicable for above 10 lakhs, ma? 30%. That is 2 lakhs into 30%. That equal to how much, ma? 60,000. This is the tax liability on total income, 1,72,500. If you add HEC at the rate 4%, you will get a final tax liability. Understood the point? Tell me whether this person is eligible for rebate under section 87A, ma? Obviously not eligible. Why? Because the total income is 12 lakhs. Exceeding 5 lakhs, he is not eligible to claim the benefit of rebate under section 87A. That's why we have not computed the rebate under section 87A, ma. Good. Tell me whether we need to apply surcharge rates, ma, here. Surcharge rates also not applicable. Why? Because the total income not exceeded 50 lakhs. It is just 12 lakhs. No need to apply surcharge also. Okay, ma? Understood. Good. Next, ma. Let's go for, okay, note point. In the present case, Mr. X is aged about 45 years, hence he shall be treated as normal citizen. Therefore, the applicable basic exemption limit is 2,50,000. Very good. You need to give that note point also to grab maximum marks. Yes. Next, ma, part B, solution. Computation of final tax liability in the hands of Mr. X for the previous year 21-22 or assessment year 22-23. Let's verify same format. Particulars amount column. Try to reproduce the same format in the examination also, ma. The tax liability on total income, working note 1. Add HEC at the rate 4%. Then you will get a final tax liability. Okay, then let's work out tax liability on total income. Working note 1, computation of tax liability on total income. Total income equal to 12 lakhs, ma, and tax liability thereon. Tell me what is the status of this Mr. X this person in part B ma, his age is more than 60 years but less than 80 years, right? That means he shall be treated as senior citizen. In case of senior citizen, what is the basic exemption limit available? Up to 3 lakhs. Let's verify. Up to 3 lakhs basic exemption limit, it is nil, the tax liability. Then 3 lakhs to 5 lakhs ma, what is the difference amount? It is 2 lakhs into 5%, that equal to 10,000. Then 5 lakhs to 10 lakhs, the difference is 5 lakhs. Applicable slab rate 20%, that is 1 lakh tax amount. Then in excess of 10 lakhs, how much we are having? 2 lakhs into 30% applicable slab rate, then you will get 60,000 ma. Then what is the tax liability on total income? 1,70,000. So let's consider that 1,70,000 in the amount column. Add HEC at the rate 4% ma, how much? 6,800. Then you will get final tax liability of 1,76,800. Understood the point? Good. Next ma, note point. The note point is relating to senior citizen concept. In the present case, Mr. X is aged about 63 years. Hence, he shall be treated as senior citizen. Therefore, the applicable basic exemption limit is 3 lakhs. Very good. Next ma, part C solution. Computation of final tax liability in the hands of Mr. X for the previous year 21-22 or assessment year 22-23. Okay. Particulars, amount column. Tax liability on total income. Same procedure, working note 1. Then add HEC at the rate 4% ma. Then you will get a final tax liability. Then working note 1, computation of tax liability on total income. Total income equal to 12 lakhs ma. He is aged about greater than 80 years. That means he shall be treated as super senior citizen because he is resident individual also. Two conditions are satisfied. We need to give the status of super senior citizen. In case of super senior citizen, what is the basic exemption limit available ma? It is up to 5 lakhs ma. Up to 5 lakhs it is basic exemption limit. Applicable tax rate is 0%. That means the tax liability will be 0 or nil. Tax liability there on super senior citizen up to rupees 5 lakhs, it is nil. Basic exemption limit, it is nil. Then 5 lakhs to 10 lakhs ma. Tell me, what is the rate applicable for that slab? What is the difference amount? First of all, tell me. It is 5 lakhs into directly 20% we need to apply. How much ma? 1 lakh. Why directly 20%? Why not 5%? Because the 5% slab has been gone within the ambit of basic exemption limit. Instead of 5%, we applied 0% because he is a super senior citizen. To give the maximum benefit to that old person, the lawmakers given 0% rate up to 5%. That means 0% rate up to 5 lakh rupees. That means 5% slab rate is not applicable for them. Good. Next, in excess of 10 lakhs, how much we are having? 2 lakhs into 30%, it is 60,000. Then what is the tax liability on total income? 1,60,000. Consider in the amount column, add HEC at the rate 4%, it is 6,400. Then what is the final tax liability? 1,66,400. That is regarding part C solution ma. Okay, let's verify the note point. In the present case, Mr. X is aged about 82 years. Hence, he shall be treated as super senior citizen. Therefore, the applicable BL is 5 lakhs mark. Tell me, merely aged about 82 years, we are treating him as super senior citizen? No. Second condition also satisfied. What is that? He is resident in India also. If you want, give that point also here. He is aged about 82 years and he is a resident individual. Hence, he shall be treated as super senior citizen. Therefore, the applicable basic exemption limit is 5 lakh rupees. You need to give that. Okay, if you want to give so. Okay, ma. Chalo. Next, illustration 2. Mr. Raghav, aged 26 years and a resident in India ma. He is a resident in India, has a total income of 4,40,000. What is his total income of? 4,40,000, comprising his salary income and interest on bank fixed deposit. That means only normal income is there. Compute his tax liability for the assessment year 22-23. Okay. What is your observation from that illustration 2 ma? Mr. Raghav aged about 26 years. Okay. That means, and he is a resident in India. That means aged about less than 60 years, right? Therefore, we need to treat him as normal citizen. The applicable basic exemption limit is 2,50,000. Good. Next point. He has a total income of 4,40,000 ma. What is your observation from that point? The total income is 4,40,000. That means it does not exceed 5 lakhs. And moreover, he is a resident individual. Two conditions satisfied. Total income not exceeded 5 lakh rupees and he is a resident individual. Two conditions are satisfied ma. That means we need to treat him as a, what is that? Obviously a normal citizen. We need to give the benefit of what? Rebate under section 87A. Rebate under section 87A because two conditions specified under section 87A has been satisfied cumulatively. Let's verify. Computation of final tax liability in the hands of Mr. Raghav for the previous year 21-22 or assessment year 22-23. Particulars, amount column, tax liability on total income, working note 1, 9,500. I will explain little bit later how we got 9,500. Then less rebate under section 87A. He is eligible for rebate ma. Entire 9,500 will be allowed as rebate. Why? I will explain through note point 2. Don't worry. Next. Then what is the tax liability before HEC at the rate 4% ma? Nil. Because out of 9,500 of tax liability, entire 9,500 has been provided as rebate under section 87A. Then what is the balance tax liability before applying HEC at the rate 4% ma? It is nil. Then add HEC at the rate 4%, it is also nil. That means what is the final tax liability ma? 0. Because the entire tax amount provided as rebate under section 87A. Chalo, let's verify working note 1. Computation of tax liability on total income. Total income equal to 4,40,000. Tell me what is the slab rate system applicable up to 2,50,000. That is the basic exemption limit available because he is a normal citizen. Up to 2,50,000 nil. Basic exemption limit it is nil. Then we need to give in excess of 250 ma. Because the total income is just 4,40,000. Therefore, we need to consider in excess of 2,50,000 ma. How much we are having in excess of 2,50,000 ma? It is 1,90,000. What is the slab rate applicable between 250 to 5 lakhs ma? For that range, 5%. Therefore, 1,90,000 into 5%, it is 9,500. Tax liability and total income is 9,500. Now, two conditions are satisfied ma. First condition, the total income is 4,40,000, does not exceed 5 lakhs. Second condition, resident individual. Therefore, he is eligible to go for claim of rebate under section 87A. Now, what is the computation relating to rebate under section 87A ma? List of the following. Two things we need to consider. First one ma, 100% of tax liability. What is 100% of tax liability? 9,500 into 100%, it is 9,500. Second one ma, standard amount of 12,500, whichever is lower. Consider 9,500 or 12,500, whichever is lower means 9,500 will be provided as rebate under section 87A. Let's verify that. In the present case, Mr. Raghav is aged about 26 years, hence he shall be treated as normal citizen. Therefore, the applicable bail is 2,50,000. We know. Note 2. In the present case, Mr. Raghav is a resident individual and the total income does not exceed 5 lakhs. Since both the conditions are satisfied, hence he is eligible to claim rebate under section 87A. Very good. Rebate under section 87A, list of the following. Give computation ma. Standard amount of 12,500 or 100% of tax liability 9,500. Whichever is lower means 9,500 will be allowed as rebate. That means the tax liability will be 0. The final tax liability will be 0. Therefore, rebate under section 87 is 9,500. Okay, ma? Understood? Good. Next, ma. Illustration 3. Let's verify. What if Mr. Raghav is a non-resident Indian? Pay attention here. What if Mr. Raghav is a non-resident Indian, ma? If at all he is non-resident Indian, whether he is eligible to claim rebate under section 87A ma? What is the first condition? The total income should not exceed 5 lakhs. Okay, here it is 4,40,000, does not exceed 5 lakh. First condition is satisfied. Second condition ma, he must be resident individual. The assessee must be resident individual. What is given in this question ma? Mr. Raghav is a non-resident. That means second condition is not satisfied. If at all second condition is not satisfied, since both the conditions require to be satisfied cumulatively to claim the benefit of rebate under section 87A, but second condition is not satisfied, that means what is that? Rebate under section 87A is not available to Mr. Raghav, who is a non-resident Indian. Understood ma? He is not eligible to claim the benefit of rebate under section 87A because the lawmakers giving the benefit of rebate under section 87A only to our resident Indians, not non-resident Indians ma. Who is resident, who is non-resident, I will explain in the next chapter. Residential status and scope of total income, don't worry. Okay then, solution ma. Computation of final tax liability in the hands of Mr. Raghav for the previous year 21-22 or assessment year 22-23. Particulars, amount column, tax liability and total income. Working note 1, 9,500 we already worked out. Less rebate under section 87A note 2, nil because he is not eligible. Then tax liability before HEC at the rate 4%, 9,500. Add HEC at the rate 4% ma, 380. Then what is the final tax liability? 9,880. That HEC 4% we need to add, we need to apply on 9,500 rupees ma, then you will get 380 rupees. Then what is final tax liability? 9,880. Computation on tax liability and total income, same procedure ma, same procedure. Note 1, normal citizen, okay. Note 2, in the present case Mr. Raghav is a non-resident Indian, hence he is not eligible to claim rebate under section 87A even though his total income does not exceed 5 lakh. Very good, nice. Illustration 4 ma, chalo, are you following? Yes, pay attention. Compute the tax liability of Mr. A, aged 42 years, that means normal citizen, having total income of 51 lakh for the assessment year 22-23. What is your observation ma? Total income exceeded rupees 50 lakhs ma. It is 51 lakh, that means exceeded 50 lakh. We need to apply surcharge at the rate 10%. We need to apply surcharge at the rate 10%. At the same time, we need to compute marginal relief also. This problem is on mainly on concept of marginal relief. Pay attention, appearing in the examination multiple times, they given in the examination. Pay attention. Assume that his total income comprises of salary income and income from house property and interest on fixed deposit. That means only normal income is comprised in his total income. Assume that Mr. A has not opted for the provisions of section 115 BAC. Very good. That means we need to apply normal slab rate system, not that alternate concessional slab rate system. Solution ma. Computation of final tax liability in the hands of Mr. A for the previous year 21-22 or assessment year 22-23. Okay. Particulars, amount column. Tax liability and total income. Working note 1, 13,42,500. Pay attention ma. I am giving a detailed procedure for computation of final tax liability when there is an involvement of applying surcharge and claiming marginal relief and applying the concept of HEC at the rate 4%. I am giving a detailed pro forma. Please pay attention and consider the procedure, and it will be easy for you to determine final tax liability. Presentation is very important from the viewpoint of examination to grab maximum marks. Add surcharge at the rate 10%, 1,34,250. Then you will get tax liability before marginal relief ma, 14,76,750. Then less marginal relief. Working note 2 we will determine little bit later. It is 64,250. Then you will get tax liability before HEC at the rate 4%, 14,12,500. Add HEC at the rate 4%, that is 56,500. Then you will get final tax liability of 14,69,000. Understood the point ma? I have given the procedure in first place. Thereafter we will go for verification of working notes ma. First of all, try to understand the procedure. How to determine final tax liability. Remember the format ma. Chalo. Working note 1, computation of tax liability and total income. What is total income? 51 lakh, and he is a normal citizen. That means we need to apply basic exemption limit of rupees 2,50,000. Tax liability thereon, normal citizen up to 2,50,000, BL nil. Then 2,50,000 to 5 lakhs ma. The difference is 2,50,000. Applicable slab rate 5%. Then the tax amount is 12,500. Then 5 lakhs to 10 lakhs, the difference is 5 lakh rupees into 20% slab rate, then 1 lakh tax liability. In excess of 10 lakhs, how much total income we are having ma? What is the total income? 51 lakh. Then in excess of 10 lakh, how much we are having? 41 lakh into applicable slab rate 30% ma, highest rate. Then how much it is? 12,30,000. Then you will get tax liability and total income is 13,42,500. Understood how we determined the tax liability and total income of 51 lakh ma? Good. Successfully completed working note 1. Let's go for working note 2. Very, very important. Pay attention. Determination of marginal relief. I explained a formula. We have already discussed a formula to determine marginal relief ma. Can you get me that formula? What is the formula? What is the procedure to determine marginal relief? First, we need to determine tax liability on total income, including surcharge ma. First, we need to determine tax liability on total income, including surcharge. Consider in the outer column. Less tax liability on 50 lakhs. What is that? Less tax liability on 50 lakhs. Since we are determining tax liability on 50 lakhs, which does not exceed 50 lakhs, that means we need to consider excluding surcharge. Consider in the inner column within the brackets. Then less income in excess of 50 lakhs. How much we are having in excess of 50 lakh? 1 lakh. Because that 1 lakh is the reason for levy of surcharge. If that 1 lakh is not there, no need to apply concept of surcharge. We are applying the concept of surcharge because of that 1 lakh. Hence consider income in excess of 50 lakh, how much it is there. Then consider in the inner column within the brackets. Total you need to get into the outer column. That must be reduced from the tax liability and total income. Then the resulting will be the marginal relief. Resulting will be the marginal relief. Let's verify ma. Chalo. Particulars amount column. Inner column, outer column. Tax liability and total income, including surcharge. How much it is? 14,76,750. How we determine that 14,76,750 ma? In working note 1, we computed tax liability and total income. How much it is? 13,42,500. To that we need to add surcharge at the rate 10% ma. How much 10% of that? 1,34,250. If you add 1,34,250 to that 13,42,500, then you will get tax liability and total income, including surcharge of 10%, comes around 14,76,750. Understood? Good. Less tax liability on 50 lakhs ma. How much tax liability on 50 lakhs? Tell me whether we need to give another working note for that ma? No need. Then determine tax liability on 50 lakh by following working note 1. Up to 2,50,000 nil. 250 to 5 lakh. The difference is 2,50,000 into 5%. It is 12,500. Then 5 lakhs to 10 lakh. Difference is 5 lakh into 20%. Then comes to 1 lakh rupee. In excess of 10 lakh, how much we are having? 40 lakhs only. Why 40 lakhs only? Because we are determining tax liability on 50 lakh. Therefore, in excess of 10 lakh, we are having just 40 lakh. Tell me 40 lakhs into 30%, how much ma? 12 lakhs. That means 12 lakhs plus 1 lakh plus 12,500. How much it is? 13 lakh 12,500. That is tax liability on 50 lakhs. Now tell me, including surcharge or excluding surcharge ma? It is excluding surcharge, because we are determining tax liability on 50 lakhs. Since not exceeded 50 lakh, therefore we should not apply surcharge. That means what is the tax liability on 50 lakhs excluding surcharge of 10%? How much ma? It is 13 lakh 12,500. Understood the point? Then less income in excess of 50 lakhs ma. That is the reason for levy of surcharge at the rate 10%. How much income it is there? In excess of 50 lakhs ma, just 1 lakh. Consider inner column within the brackets. Total you need to add ma, you need to sum up. That must be considered in the outer column and that must be reduced from the tax liability on total income including surcharge. How much it is ma? Marginal relief 64,250. My question, whether this computation resulted into positive or resulted into negative ma? Tell me. This computation just now we worked out, working note 2. This is resulted into positive or negative? See there, it is resulted into positive. What do you mean by resulted into positive? What is the concept we need to apply? What is the treatment we need to give if at all it is resulted into positive ma? First of all, what is the meaning of resulting into positive? If it is resulted into positive, that means the additional tax liability exceeded the additional income. I explained at the time of discussion of margin relief concept. If it is resulted into positive, means the additional tax liability exceeded the additional income. How much it is exceeded? 64,250. That amount shall be provided as a marginal relief. Understood? What if it is resulted into negative ma? If it is resulted into negative, that means additional tax liability does not exceeded the additional income. No need to provide benefit of marginal relief, because the lawmakers can recover up to 100% ma, up to 100% of additional income, but not more than that. In case additional tax liability is more than additional income, then in excess of additional income, what is there that additional tax liability verify, that will be provided as a marginal relief. How much it is in excess of additional income? 64,250. The lawmakers don't have the right to recover that, hence they are providing it as a marginal relief to the SSC. Understood the point? Don't worry, I will explain the alternate procedure for better understanding. Pay attention. In the present case, the resulting amount is positive. That means the additional tax liability exceeds the additional income. Hence, SSC is eligible to claim marginal relief. Don't worry, ma. I will explain in alternate procedure. Let's verify. Alternate procedure to determine marginal relief. Pay attention. For that, we need to verify two concepts: additional income, additional tax liability. What is additional income? What is additional tax liability? Compare both the things. Then you will get how much we need to provide as a marginal relief. Let's verify. What is additional income ma? Tell me. What is additional income? Additional income means the income which is the reason for levy of surcharge. Additional income means the income which is the reason for levy of surcharge. Then how to determine that? 1 lakh ma. How we determine that 1 lakh ma? Please tell me. 51 lakh minus 50 lakhs. Because that 1 lakh is the reason. That additional income is the reason for levy of what? Surcharge. Consider that additional income 1 lakh. Then additional tax liability. Please tell me how to determine additional tax liability. Tell me how we determine additional income. 51 lakh minus 50 lakh. This is how we determine the additional income. Then how to determine additional tax liability ma? Very simple. Tax liability on 51 lakh minus tax liability on 50 lakhs. You will get additional tax liability. Very easy. Come again. Tax liability on 51 lakh including surcharge minus tax liability on 50 lakhs excluding surcharge. Then you will get additional tax liability. No need to work out. Already we worked out in our previous working notes ma. Tax liability on 51 lakh minus tax liability on 50 lakhs. How much it is? 14 lakh 76,750 minus 13 lakh 12,500. How much? 1 lakh 64,250. What is your observation ma? Because of additional income of 1 lakh, we levied surcharge at the rate 10%. Then what is the additional tax liability determined here is 1,64,250 rupees ma. That means for additional income of 1 lakh, how much the lawmakers trying to recover as additional tax liability? 1,64,250. Whether the lawmakers is having any right to recover more than additional income? No. They can recover up to additional income. That means they recover up to 1 lakh ma, not more than that. Then tell me how much it is there. In excess of 1 lakh, 64,250, that will be provided as a marginal relief that we obtained in our working note 2 as a marginal relief. Very simple. Understood the point, ma? Yes. Therefore, the margin relief is 64,250. Remember, up to 1 lakh rupee they can recover, ma. That means 100% of additional income they can recover. But more than that, single NP they cannot recover. More than additional income, single NP they cannot recover. That's why in excess of 1 lakh, what is there as additional tax liability, they're providing as a marginal relief. Remember the point. Next, ma, illustration 5. Are you following? Are you understanding the concepts? Yes. Next, my illustration 5. Compute the tax liability of Mr. B, aged 51 years. 51 years means he is a normal citizen, ma. Less than 60 years. Having total income of 1 crore 1 lakh. Very, very important. Total income is 1 crore 1 lakh, ma. That means exceeding 1 crore, less than or equal to 2 crore. What is the applicable surcharge rate for that range, ma? 15%. How much? 15%. Not 10%. 15%. If you remember. For the assessment year 22-23, assume that his total income comprises of salary income, income from house property, and interest on fixed deposit. That means only normal income is comprising. We need to apply normal slab rate system. No need to apply special rates. Assume that Mr. B has not opted for the provisions of section 115 BAC. If at all he has not opted for 115 BAC, means we should not apply the concessional slab rate. We need to apply the normal slab rate system. Let's work out, ma. Solution, same procedure, but the computation of margin relief will be different. Entire concept, entire previous procedure we need to apply, except determination of margin relief. There we need to do some changes, ma. Computation of final tax liability in the hands of Mr. B for the previous year 21-22 or assessment year 22-23. Okay. Particulars, amount column. Do you remember the procedure, ma? Chalo. Tax liability on total income, working note 1, 28,42,500. Add surcharge at the rate 15%. Ma, why 15%? Please tell me. Because the total income exceeded 1 crore but does not exceed 2 crore. We need to apply 15%. That is 4,26,375. Tax liability before marginal relief 32,68,875. Less margin relief, ma, working note 2, 75,125. We will work out. We will discuss, ma, in working note 2, don't worry. Then tax liability before HEC at the rate 4%, 31,93,750. Add HEC at the rate 4%, it is 1,27,750. Then what is the final tax liability, ma'am? 33,21,500. Understood? Yeah. Okay, let's go for working note 1, ma. Computation of tax liability on total income. Total income is 1 crore 1 lakh. 1 crore 1 lakh, ma. Tax liability thereon, he is a normal citizen, and the basic exemption limit applicable is 2,50,000. Consider up to 2,50,000 it is nil. 250 to 5 lakh it is 12,500. 5 lakhs to 10 lakhs it is 1 lakh. In excess of 10 lakh how much we are having, ma? 91 lakh. In excess of 10 lakh how much we are having? 91 lakh, because the total income is 1 crore 1 lakh. Therefore, in excess of 10 lakh, how much we are having? 91 lakh into 30%. How much, ma? 27,30,000. Tax liability and total income is 28,42,500. If you add all these three things, you will get 28,42,500. Understood? Then working note 2, determination of marginal relief. Very important discussion we are going through. Pay attention. Particulars, inner column, outer column. First one, ma, tax liability on total income. What is total income? 1 crore 1 lakh. On that 1 crore 1 lakh, we are determining tax liability. That means including surcharge, ma. Including surcharge at the rate of 15%. How much? 32,68,875. Good. Less tax liability on 1 crore. Very, very important. Pay attention. Tell me. Here we are determining tax liability on 1 crore. Now, while determining tax liability on 1 crore, we need to apply surcharge. That means that computation of tax liability on 1 crore is including surcharge, ma, or excluding surcharge? Tell me. The computation of tax liability on 1 crore comprises including surcharge or excluding surcharge? Tell me. while determining tax liability on 1 crore, we need to exclude surcharge at the rate 15% ma. Why we need to exclude surcharge at the rate 15%? Because we are determining tax liability on 1 crore. Since it is not exceeded 1 crore, hence we cannot apply surcharge at the rate 15%. But we need to apply surcharge at the rate 10% ma. Why we need to apply surcharge at the rate 10%? Because we are determining tax liability on 1 crore. That means exceeding 50 lakhs but does not exceeds or equal to 1 crore. For that range, what is the applicable surcharge ma? 10%. That means while determining tax liability on 1 crore, we should include surcharge at the rate 10%. Understood the point? Verify. Excluding surcharge at the rate 15% but including surcharge at the rate 10%. Reasons behind that ma. Excluding surcharge at the rate 15% because total income tax we are determining on 1 crore which does not exceeds 1 crore, hence don't apply 15%. But including surcharge at the rate 10% ma. Why? Because it is exceeded 50 lakhs. We are determining on 1 crore. That means exceeded 50 lakhs. Hence we need to apply 10%. Understood? Consider in the inner column ma. Less income in excess of 1 crore. How much we are having? Just 1 lakh. Outer column 31 lakh 93,750. Then you will get a marginal relief of 75,125. Tell me whether it is resulted into positive or negative ma. Positive. That means additional tax liability exceeded the additional income. How much? 75,125. That will be provided as a margin relief because the lawmakers department don't have the right to recover that 75,125 which is exceeding 1 lakh ma. Note, in the present case the resulting amount is positive. That means the additional tax liability exceeds the additional income. Hence SSC is eligible to claim marginal relief. Very good. Alternative procedure to determine margin relief ma. Same procedure. Let's verify additional income and additional tax liability. Okay. What is additional income ma? 1 lakh. How we determine that 1 lakh? 1 crore 1 lakh minus 1 crore. Then how to determine additional tax liability? Very simple. Tax liability on 1 crore 1 lakh minus tax liability on 1 crore. How much ma? It is 1,75,125. Because of additional income of 1 lakh, how much additional tax liability we determined? 1,75,125. Whether lawmakers having any right to recover more than additional income? No. They can recover 100% of additional income. That means up to 1 lakh they can recover, not more than that. How much we are having in excess of 1 lakh ma? 75,125. That will be provided as marginal relief. Understood? Yes. Next ma. Illustration 6. Very important. Pay attention. Mr. Ram, aged 32 years and a resident in India ma. He is a resident in India. That means normal citizen. 32 years age, less than 60 years. Normal applicable basic exemption limit is 2,50,000. The following are his income details for the previous year 21-22 or assessment year 22-23. Long term capital gain under section 1128 25 lakhs. My question ma, that is normal income or special income? That is normal income or special income? Please tell me. Long term capital gain under section 1128. It is special income. What is the applicable special rate ma? 10%. That too we need to apply in excess of 1 lakh. That means out of 25 lakhs we need to provide 1 lakh as exemption. Then remaining 24 lakhs we need to apply 10%. Understood? Good. Short term capital gain under section 1118A 20 lakhs. Again it is special income. We need to apply special rate of 15%. We should not apply normal slab rates for these special incomes ma. Other income 70 lakhs ma. That other income is other than special income. For that other income of 70 lakhs we need to apply, what is that? Slab rate system. But on LTCG 1112A, STCG 1111A, you should not apply slab rate. You need to apply special rate. Compute his tax liability for the assessment year 22-23. Okay. Computation of final tax liability in the hands of Mr. Ram for the previous year 21-22 or assessment year 22-23. Particulars amount column. Tax liability on total income. Working note 1. Okay. Add surcharge ma. Why we added surcharge here? Tell me what is the total income ma? LTCG plus STCG plus other income 25 plus 20 plus 70 1 crore 15 lakhs ma. The total income is 1 crore 50 lakhs, 15 lakhs. That means exceeded 1 crore. We need to apply surcharge at the rate. How much ma? 15%. But here margin relief is not available ma. Even though you determined margin relief by following our procedure, that resulting amount will be negative ma. Will be negative. Therefore, SSC is not eligible to claim margin relief. You need to provide margin relief as 0. Because when it is possible for you to have positive amount in the resulted amount ante, only when your income is having in excess of, that means 51 lakh, 1 crore 1 lakh, 2 crore 1 lakh, 5 crore 1 lakh, like this you are having income, then it is possible to have positive margin relief ma. In case you are having some 75 lakhs, 1 crore 15 lakhs, 2 crore 50 lakhs, 5 crore 70 lakhs, like this you are having total income, then if you determined margin relief, it will be always resulted into negative. That means additional tax liability will not exceed additional income. Hence SSC will not get the benefit of margin relief. He will get the benefit of margin relief only when the total income status is like 51 lakh or 1 crore 1 lakh or 2 crore 1 lakh, like that. Understood the point? Okay. Here he is not eligible for margin relief because the total income is 1 crore 15 lakhs ma. So obviously it will be 0 margin relief. Tax liability before margin relief 0. Even though you determine by following our earlier procedure, it will be resulted into negative ma. That means 0 will be provided as a margin relief. Less, okay, tax liability before HEC at the rate 4% ma, 28 lakh 2375. Add HEC at the rate 4%, then you will get a final tax liability. Okay, this is the procedure to determine final tax liability. Chalo, let's go for working notes ma. Working note 1, computation of total income and tax liability. See, here we need to compute total income, thereafter we need to determine tax liability. Computation of total income. Total income equal to LTCG under section 112A plus STCG under section 111A plus other income, that equal to 25 lakh plus 20 lakh plus 70 lakh, that equal to 1 crore 15 lakhs. Successfully we determined the total income. Now let's go for computation of tax liability. Computation of tax liability and total income. Total income of, what is total income? 1 crore 15 lakhs. Okay. Tax liability thereon, he is a normal citizen. Pay attention ma. Here we need to determine total income of tax liability on total income of 1 crore 15 lakhs ma. Tell me that 1 crore 15 lakhs is comprising only normal income or it is comprising special income also na? Tell me, it comprises only normal income or comprises special income also na? It is comprising special income also. How many special incomes it is having? 2 special incomes we are having. And for those special incomes, we need to apply special applicable rates, applicable special rates. You should not apply normal slab rate system. Therefore, while determining tax liability on total income of 1 crore 15 lakhs, you need to follow a separate procedure to determine the tax liability. Normally, how to determine the tax liability ma? Just by applying normal slab rate system up to 2,50,000 nil, 2.5 lakhs to 5 lakhs and 5 lakhs to 10 lakhs and greater than 10 lakhs. Like this we need to determine when, only when the total income is comprising normal income alone, but it is comprising special income also. Hence we need to follow a separate procedure to determine tax liability. Now pay attention. Tell me, in this total income, how many special incomes we are having ma? In this total income, how many special incomes we are having? 2 special incomes. What are those? LTCG under section 112A, STCG under section 111A. 2 special incomes we are having and 1 normal income. 2 special incomes and 1 normal income. Therefore, this total income will be bifurcated into 3 categories. This total income will be bifurcated into 3 categories. 2 categories for special income, 1 category for normal income. Let's say 3 branches. Let's go for dividing into 3 branches. Total income 1 crore 15 lakhs divided into 3 branches ma. First one, special income 1. What is special income 1? Long term capital gain under section 112A. How much it is? 25 lakh. Then special income 2. What is special income 2 we are having here? STCG under section 111A 20 lakhs. Very good. Then third branch will be for normal income. How much other normal income? 70 lakhs. For that normal income of 70 lakhs, we can apply slab rate system. But for these two special incomes, we need to apply special rates, applicable special rates. Now, for long-term capital gain under section 112A, 25 lakh rupees. What is the special rate applicable? 10%, if you remember. Now, that 10% we need to apply on entire 25 lakhs, or we need to provide any exemption? Tell me. We need to provide exemption. How much, 1 lakh exemption is there. The 10% we need to apply in excess of 1 lakh. That means out of 25 lakhs, 1 lakh the lawmakers provided as exemption. That means the 10% we need to apply on 24 lakhs. Tax liability in excess of 1 lakh. How much, 24 lakhs into applicable special rate, 10%. How much it is? 2,40,000. This is the tax liability on long-term capital gain. This is the tax liability on long-term capital gain. Next, let's go for short-term tax liability on short-term capital gain under section 111A. What is the rate applicable for short-term capital gain under section 111A? 15%. Apply. Tax liability equal to 20 lakhs into 15%. How much, 3 lakhs. Tax liability on short-term capital gain, 3 lakhs. Then come to other income. When it come to other income, please tell me that is normal income. That means we need to apply what? Normal slab rate system. Normal slab rate system. Since he is a normal citizen, hence we need to apply the basic exemption limit of 2,50,000. Let's go for that. Tax liability on other normal income. Okay. Up to 2,50,000 basic exemption limit nil. Then 2.5 lakhs to 5 lakhs. The difference is 2.5 lakhs into 5%, 12,500. Then 5 lakhs to 10 lakhs. Difference is 5 lakhs into 20%, 1 lakh. Greater than 10 lakhs, we are having 60 lakhs income into 30%, 18 lakhs. I'm explaining in a detailed way. It is not possible for you to have any doubts if you concentrated on the lecture, entire lecture. So please concentrate, Not possible to have any doubts, after listening to this class. Chalo. Provided you concentrated throughout the lecture. Tax liability on other normal income. It is 19 lakhs 12,500. We successfully determined tax liability on LTCG, tax liability on STCG, and tax liability on other normal income also. Then we need to add these three things. Then you will get a tax liability on total income. Tax liability on total income equal to 2.4 lakh plus 3 lakh plus 19 lakh 12,500. How much, 24 lakh 52,500. Now my question is, on this directly we need to apply HEC at the rate 4%, or we need to apply surcharge also? We need to apply surcharge also. Why we need to apply surcharge? Because the total income is 1 crore 15 lakhs. That means exceeded 1 crore. We need to apply surcharge at the rate 15%. While applying surcharge, you need to remember one important point. The surcharge rate on tax on LTCG 112A, STCG 111A and dividend income should not exceed 15%. Do you remember? That point I explained under 5 situations. By using 5 situations, I explained that point. Now tell me, this illustration comes under which situation? This illustration comes under which situation out of those 5 situations I explained in our previous session? Please tell me. If you observe, if you remember, the total income including dividend income, here we don't have dividend income, including LTCG under section 112A, STCG under section 111A, exceeding 1 crore but less than or equal to 2 crore, comes under which situation? Situation 2. In such a case, how to determine surcharge rate? The surcharge rate on tax on dividend income LTCG, STCG, 112A, 111A, we need to apply 15%. On tax on other income, we need to apply surcharge at the rate 15% also. On that also we need to apply 15%, because it comes under situation 2. Do you remember situation 2, Verify once. If you don't remember, please go through the situation 2 and come to here and verify the point. Understood? Chalo. Working note to determination of surcharge. In the present case, the total income including LTCG under section 112, STCG under section 111A is 1.15 crore. That is more than 1 crore but less than or equal to 2 crore. Less than 2 crore. Hence, we need to apply surcharge rate 15% on tax on LTCG under section 112 and STCG under section 111A, and surcharge rate 15% on tax on other normal income as well. Good. Surcharge on tax on LTCG under section 111A. What is the tax amount on LTCG under section 111A? Ma? 2,40,000 into applicable surcharge rate 15%. That is 36,000. Then surcharge on tax on STCG under section 111A 45,000. Then surcharge on tax on other normal income also 15%. Then total surcharge ma 3,67,875. Add there and you will get before HEC at the rate 4% and before margin relief. Obviously margin relief will be 0. Then you will get tax liability before HEC at the rate 4%. Add 4% HEC. Then you will get a final tax liability. Understood ma? I explained in our previous concept. Okay. Chalo. Illustration 7. This is the last illustration for our introduction to tax class. Last illustration, pay attention. Here also we need to apply surcharge but different rates. We need to apply surcharge but different rates. Very important, pay attention. Mr. PK, aged 45 years and a resident in India. Okay. The following are his income details for the previous year 21-22 or assessment year 22-23. Long term capital under section 112A 2 lakhs. Short term capital under section 111A 4 lakhs. Dividend income 13 lakhs. We are having dividend income also. That means 2 special incomes and dividend income also we are having in the total income. Other income 3 crore 34 lakhs ma. Other income. Okay. Compute his tax liability for the assessment year 22-23. My question, this comes under which situation ma? Tell me whether we need to apply surcharge rate here. Obviously we need to apply surcharge rate. Why? Because the total income is exceeding what ma? 2 crore. Exceeding 2 crore. If at all total income is exceeding 2 crore, we need to apply what? Surcharge rate. What are the surcharge, applicable surcharge rates here? Tell me under which situation this illustration falls. Out of 5 situations ma? Under which situation this illustration falls? Total income excluding dividend income LTCG 112A, STCG 111A exceeded 2 crore but less than or equal to 5 crore. Then how much we need to apply ma? How much we need to apply? Tell me. What are the surcharge rates applicable? Then tax on these 3 incomes we need to apply surcharge rate 15%. Then tax on other income we need to apply what? 25%, because the range is 2 crores to 5 crore. Let's verify. Solution. Computation of final tax liability in the hands of Mr. PK for the previous year 21-22 or assessment year 22-23. Tax liability and total income, working note 1 will work out. Add surcharge will work out. Tax liability before margin relief, obviously it will be 0. Don't determine, don't try to determine, obviously it will be 0. Tax liability before HEC at the rate 4%, then HEC at the rate 4%. You will get final tax liability. Let's go for workings ma. Working note 1. Computation of total income and tax liability. Computation of total income. How much total income ma? LTCG 112A plus STCG 111A plus dividend income plus other income. 2 plus 4 plus 13 plus 3.34. 3 crore 53 lakhs ma. We need to apply surcharge rates also. Computation of tax liability on total income. Total income is 3.53 crore and he is a normal citizen. Applicable basic exemption limit for normal income is 2,50,000. Are you following? My question. The total income of 3.53 crore comprising of how many special incomes ma? Comprising of how many special incomes? Try to understand my question. The total income of 3.53 crore comprises how many special incomes? 2 special incomes. What are those? LTCG under section 112A, STCG under section 111A. Because dividend income is subject to normal rate only. But While applying surcharge, we need to consider the point. While applying surcharge rate, we need to consider, but it is subject to normal slab rate, dividend income. Try to remember this point. That means how many branches we need to divide? 3 branches. Why 3 branches? 2 branches for special income, 1 branch for normal income. That normal income includes dividend income and other normal income also. Chalo. First branch LTCG under section 1112A 2 lakhs, STCG under section 1111A 4 lakhs. Other normal income, how we determine other normal income? Dividend income plus other normal income, 3 crore 47 lakhs. Then what is the tax rate applicable for LTCG 1112A? 10%, that too in excess of 1 lakh. In excess of 1 lakh, how much we are having? Just 1 lakh. 1 lakh into 10%, it is 10,000. Then what is the tax rate, special rate applicable for STCG under section 1111A? 15%. Apply 4 lakh into 15%, 60,000. Then for other normal income, we need to apply slab rate system. Okay, up to 2,50,000 nil, 250 to 5 lakhs, 12,500, 5 lakhs to 10 lakhs, 1 lakh, greater than 10 lakhs, how much we are having? 3 crore 37 lakh into 30%, 1 crore 1 lakh 10,000. What is the total tax liability on other normal income? 1 crore 2 lakh 22,500. Then what is the total tax liability on total income? We need to add these 3 things. Tax liability on total income 10,000 plus 60,000 plus 1 crore 2 lakh 22,500. How much it is? 1 crore 2 lakh 92,500. And we need to apply surcharge rates here. My question, this situation falls, this illustration falls under which situation out of those 5 situations? Under situation 4. If you observe, the total income excluding these 3 incomes exceeded 2 crore but does not exceed 5 crore because it is 3.53 crore total income. Exceeded 2 crore but does not exceed 5 crore, then you need to apply a surcharge rate of 25% on other normal income excluding these 3 incomes. Then on tax on these 2 special incomes and 1 dividend income, maximum 15% you need to apply. Chalo. That means what is the tax liability on LTCG under section 1112A? 10,000. On this 10,000 you can apply maximum 15%. Whereas tax liability on STCG under section 1111A, on this 60,000 you need to apply maximum 15% of surcharge. When it comes to tax liability on other normal income, this other normal income comprising tax on dividend of 13 lakhs and tax on other normal income of 3 crore 34 lakhs. Here tax on dividend of 13 lakhs, tax on dividend of 13 lakhs, we need to apply surcharge of 15% maximum, whereas tax on other normal income out of these 3,34,000 we need to apply 25% surcharge rate. I will explain, pay attention. Determination of surcharge. In the present case, the total income excluding LTCG 112A, STCG 1111A and dividend is 3.53 crore, that is greater than 2 crore but less than 5 crore. Hence we need to apply surcharge rate 15% on tax on LTCG under section 112A, STCG under section 1111A and dividend, whereas we need to apply surcharge at 25% on tax on other normal income. Pay attention, I have given in a detailed way, pay attention. Surcharge on tax on LTCG under section 112A. How much tax? 10,000 into what is the rate of surcharge? We need to apply maximum 15%. Then surcharge on tax on STCG under section 1111A, 60,000 into 15%, that equal to 9,000. Now we need to apply tax on dividend income. Tax on dividend income of 13 lakhs. If you observe, this 1 crore 2,22,500 is tax liability on total income of 3 crore 47 lakhs, which includes dividend income also. Now what we need to do? So we need to determine what is the tax liability relating to 13 lakhs, determine that on that tax liability we need to apply 15%. Then determine tax liability relating to 3,34,000 other normal income. On the tax liability you need to apply 25% surcharge rate. Then how to determine that? For that you need to do simple mathematic calculation. Simple mathematic calculation. If at all the tax liability is 1,222,500 on total other normal income of 3,47 lakhs, then what is the tax liability on dividend income of 13 lakhs? How much? For that we need to do cross multiplication, a simple mathematical computation. Then you will get the tax liability on dividend income of 13 lakhs. That is 13 lakhs into tax liability on total income including dividend income divided by total other normal income including dividend income. You will get the tax liability at 3,82,976. This is the tax liability on dividend income of 13 lakhs out of total tax liability of 1,02,22,500. On this you need to apply maximum surcharge rate at the rate of 15%. Then on remaining tax liability, how to get remaining tax liability? Total tax liability of 1,02,22,500 minus 3,82,976. Then you will get remaining tax liability. On this remaining tax liability you can apply 25%. Understood the point, ma? Now I explained here. Pay attention. Everything I have given in this slide, ma. Pay attention. Surcharge on tax on dividend income. Note 1. Tax on dividend income 13 lakhs into 1,02,22,500 divided by 3,47 lakh, ma. Then it is 3,82,976. On that 3,82,976 apply 15%. Then surcharge on other normal income. How to determine tax on other normal income? Simple. Tax on other normal income equal to tax liability on total other normal income, that is 1,02,22,500 minus tax on dividend income. Just now we determined 3,85,976. Then you will get tax on other normal income. On that we need to apply 25%, ma. Then it is 24,59,881. The surcharge will be 24,59,881. Then what is the total surcharge, ma? 25,27,827. Consider this and you can determine the final tax liability. Understood? With this we successfully completed discussion relating to introduction to tax. Then in the next session I will explain second chapter, residential status and scope of total income, and I will explain important points out of the entire concept. I will explain important points to the extent possible. I will try to cover 80% of the total concept, ma. Then pay attention to towards the lecture. Then it will be very easy for you to go for examination with the utmost confidence. Okay. Then I will conclude with this. In the next session we will start with the residential status and scope of total income. Understood, ma? Thank you and good day. Shall we? Chalo. Let's start with second chapter, ma. What is the second chapter? Residential status and scope of total income. What is that? Residential status and scope of total income. Very important from the viewpoint of examination. Pay attention, ma. What is the section deals with residential status, ma? Section 6. What is the section deals with scope of total income? Nothing but tax incidence, section 5. These are the two sections we are going to discuss. I will explain the importance of this chapter with the help of one example. Pay attention, ma. Mr. A, who is having business A located at Mumbai and business B located at Singapore. Two businesses is having, one business located in India and second business located at Singapore. Now from Mumbai business is having business income of 50 lakhs and from Singapore business is having business income of rupees 80 lakhs. So Mumbai business income 50 lakhs, Singapore business income 80 lakhs. My question, Obviously, this Mumbai business income will be treated as Indian income, and this is foreign income because the business location is in foreign country. It will be treated as foreign income. My question, ma, what is his tax liability and what is his total income or taxable income? So this is the situation of Mr. A. Please tell me what is his tax liability, what is his total income. Tell me, if you want to determine the tax liability, first of all, what you need to determine, what you need to compute? You need to compute total income or taxable income. Without computing total income or taxable income, it is quite impossible for you to determine tax liability, because tax liabilities completely depends upon total income of SSE. Now the question is, how to compute total income, how to compute taxable income? That is again completely depends upon residential status. Without determination of residential status of any person, it is not possible for you to determine total income, and it is quite impossible for you to determine tax liability. That means tax liabilities depends upon the total income computation. Total income computation is depends upon residential status of that person. Understood? If he is resident and ordinarily resident, then global income will be taxable. What do you mean by global income? Indian income and foreign income. That means his total income will be 50 lakhs plus 80 lakhs. That is 1.3 crore. In case his residential status is resident and ordinarily resident. In case his residential status is non-resident, in such a case, only Indian income alone we need to charge to tax, not foreign income. In that case, his total income will be only 50 lakhs. Indian income of 50 lakhs. 80 lakhs shall not be included in his total income in case his residential status is non-resident. In case he is resident but not ordinarily resident, or but NOR. In such a case, Indian income we need to consider, obviously, plus in addition to that, foreign business income we need to consider only when the business is controlled from India, and foreign professional income we need to consider only when that profession is set up in India. That means Indian income plus foreign business income controlled from India plus foreign professional income set up in India. This we need to consider within the ambit of total income in case he is a resident but not ordinarily resident. In this present situation, in case this foreign Singapore business is controlled from India, in case he is resident but not ordinarily resident, then his total income will be 1.3 crore. Second situation, in case business Singapore business is controlled from Singapore only, that means not controlled in India, from India, then 80 lakhs shall not be included in the hands of resident but not ordinarily resident. Then his business income will be, his total income will be only Indian income 50 lakhs. Understood, ma? This is the importance of determination of residential status, because without determination of residential status, it is quite impossible for you to determine total income and very difficult to determine tax liability. Understood? Let's verify, ma. Chalo. That is the importance of residential status determination, ma. And along with residential status, considering it as a factor 1, another 2 factors also we need to consider, ma. Factor 2, time of receipt of income and time of accrual of income. Sorry, factor 2, place of receipt of income, place of accrual of income. Then factor 3, time of receipt of income and time of accrual of income. These 3 factors decides total income and tax liability. What are the 3 factors, ma? Factor 1, residential status. Factor 2, place of accrual and place of receipt of income. Factor 3, time of accrual and time of receipt of income. One by one I will explain. Pay attention. Obviously I am going brief discussion, ma, but every point I will try to consider. I will try to cover every point. Pay attention. Chalo. Determination of tax liability is completely depends upon the total income, whereas total income determination is purely depends upon the residential status. That means based on the residential status, we need to determine total income, and based on the total income, we need to determine tax liability. If we consider these things as events, event 1, event 2, event 3, if we given the event numbers to these situations, then tell me what is event 1 ma? Determination of residential status is event 1. Then determination of total income is event 2, and determination of tax liability will be event 3, and these must be considered in a sequential way. These are the sequential events must be considered one by one to determine the tax liability. Understood ma? Okay. Next ma. These are the sequential events must be followed to determine the tax liability ma. Okay. Next, we are going to discuss what is the basis for determination of residential status ma. Come again. What is the basis for determination of residential status? For the purpose of discussion regarding basis for determination of residential status, the persons has been bifurcated into two categories ma. Under category 1, we considered individual. Under category 2, subcategory. Under subcategory, we considered company, and second subcategory, we considered all other persons. When it comes to individual, what is the basis for determination of residential status is number of days stayed in India. Tell me what is the basis ma? Number of days stayed in India is the basis for determination of residential status in case of individual. When it comes to company ma, place of effective management, POEM, POEM, place of effective management is the basis for determination of residential status. When it comes to all other persons, who are all other persons here? HUF, partnership firm, AOP, BOI, local authority, municipality, AJP, cooperative societies. These are comes under all other persons. In case of all other persons, the basis is control and management. What is that ma? Control and management is the basis for determination of residential status. That is the thing. Understood? Next ma. Type of residential status. How many types of residential status are there? Total 3 types ma. Total 3 types. Resident and ordinarily resident, resident but not ordinarily resident, and third one is non-resident. These 3 types applicable only for individual and HUF. These 3 types of possible residential status are applicable only for individual and HUF. When it comes to all other persons ma, except individual and HUF, only 2 types are possible. First one resident, second one non-resident. That's it. First one is resident, second one is non-resident. That's it. It is not possible to have resident but not ordinarily resident, resident and ordinarily resident. Not possible for all other persons except individual and HUF. Understood ma? Let's verify. In case of category 1, who are covered under category 1 ma? Individual and HUF. Second category, all other persons. That means other than individual and HUF. When it comes to individual and HUF, there may be a possibility for having the status of resident or non-resident. If that individual and HUF is non-resident, that is end of the story. But in case they are resident, then further you need to verify whether they are resident and ordinarily resident or resident but not ordinarily resident. When we need to go for further verification ma, only when they proved as resident prima facie. In case prima facie they proved as non-resident ma, end of the story. There is no further procedure or determination. Understood the point? So these applicable for individual and HUF. That means in case of individual and HUF, 3 possible status ma. 3 status are possible: ROR, R but NOR, NR. When it comes to category 2 persons other than individual and HUF, only 2 possible status are there: either resident or non-resident. That's it. There is no concept of ROR, R but NOR. So these concepts are applicable only for individual and HUF. Understood? Yes. Next ma. Chalo chalo. First of all, let's verify What is the procedure for determination of residential status in case of individual? Very, very, very important from the viewpoint of examination. Procedure for determination of RS for individual. What is the basis for determination of RS for individual? RS means residential status. What is the basis? Number of days stayed in India. What is that? Number of days stayed in India. That is the basis. While verifying the residential status of an individual, we need to verify 4 conditions. We need to verify 4 conditions to decide RS of an individual. Out of those 4 conditions, 2 conditions are basic conditions and remaining 2 conditions are additional conditions. Come again. 2 conditions are basic conditions, 2 conditions are additional conditions. That means basic condition 1, basic condition 2, additional condition 1, additional condition 2. These 4 conditions we need to verify to decide the residential status of an individual. Let's verify. So how many basic conditions? 2. How many additional conditions? 2. So what is basic condition 1? What is basic condition 2? What is A1? What is A2? Let's verify one by one. Chalo. Before getting into that, let's verify the decision criteria. Let's verify the decision criteria. Thereafter we can go for what is B1, what is B2, what is A1 and what is A2. First of all, let's go for decision criteria. Let's verify the decision criteria. First of all, first we need to verify whether B1 or B2 conditions are satisfied. That is the question we need to verify. What are the possible answers for this question? Either yes or no. Either yes or no. When we can say yes, when we can say no? If at all the question is whether B1 or B2 conditions are satisfied, then the possible answers are either yes or no. When we need to say yes, when we need to say no, please tell me. In case out of those 2 basic conditions, any one condition satisfied, either B1 or B2, any one condition satisfied, then you should say yes, because here both the conditions required to be satisfied. To say yes, no, either of them. B1 satisfied, B2 is not satisfied, then you should say yes only. Second case, B1 not satisfied but B2 satisfied, then you should say what? Yes again. Understood the point? Because out of 2 basic conditions, either of one, any one of them satisfied, you can say yes. Then when you need to say no, both the basic conditions are not satisfied. B1 is not satisfied, B2 also not satisfied, then you should say no. Understood the point? Okay. If it is yes, then either B1 or B2 has been satisfied, you need to say yes. If it is yes, then prima facie that individual shall be treated as resident. Prima facie that individual shall be treated as resident. In case the answer is no, that means B1 is not satisfied, B2 is not satisfied, then the answer will be no. In such a case, prima facie that individual shall be treated as non-resident. Prima facie that individual shall be treated as non-resident. That is end of the discussion, no further verification. In case he is proved as non-resident, no further verification, end of the discussion. In case either of the basic conditions has been satisfied, then it is yes, then he will be treated as resident. Once he is proved as resident, then we need to go for further verification. What is further verification? Verification of additional conditions. What is that, verification of additional conditions. Whether A1 and A2 conditions are satisfied, what are the possible answers, yes or no? What is the second question? Whether A1 additional condition 1 and additional condition 2 are satisfied. That is the second question we need to verify. Then what are the possible outputs, yes or no? When you should say yes, when you should say no, in case additional condition 1 and additional condition 2 both are satisfied cumulatively. Any one of them are cumulatively. Cumulatively, because what is the word used by the lawmaker between them? And. That means both the conditions must be satisfied cumulatively to say yes. In case any one of them not satisfied, both of them not satisfied, then you should say no. Are you following, ma? So tell me when we should say yes, ma. In case additional condition 1, additional condition 2, both has been satisfied cumulatively, then the answer will be yes. In case any one of them or both the additional conditions are not satisfied, then you should say no. In case it is yes, then he will be treated as resident and ordinarily resident, ma. In case it is no, then you should say very good, resident but not ordinarily resident. This is the decision criteria to decide whether he is non-resident or ROR or R but NOR. Understood the point, ma? Good. Next, ma. Now let's verify what is basic condition 1, what is basic condition 2, what is additional condition 1, what is additional condition 2. Chalo. Basic condition 1. He is in India for a minimum period of 182 days or more in the current to previous year. That's it, ma. Very simple. Basic condition 1 is very simple. What is that? He is in India for a minimum period of 182 days or more in the current to previous year. That is, what is that period of stay? Minimum 182 days or more in the current to previous year, ma. What is our current previous year? Previous year 21-22. Start from 1/4/2021, ends with 31st March 2022. During this period, minimum 182 days or more resided in India, then we need to consider basic condition 1 has been satisfied. Understood, ma? Good. Next, ma. Or basic condition 2. What is basic condition 2? Basic condition 2 comprising of two subconditions, ma. Very important, pay attention. Basic condition 2 comprises of two subconditions. In case these two subconditions satisfied cumulatively, we can say that basic condition 2 has been satisfied. Let's verify what are those. Subcondition 1. He is in India for a minimum period of 60 days or more in the current to previous year. What is our current previous year, ma? Previous year 21-22. In this period, minimum how many days he has to stay in India? 60 days or more. Then we can say subcondition 1 has been satisfied. Next, ma, subcondition 2. What is subcondition 2? He has been in India for a period of 365 days or more during the 4 previous years preceding to the current to previous year. Very, very, very important, pay attention. What is subcondition 2, ma? He has been in India for a minimum period of 365 days or more during the 4 previous years preceding to the current to previous year. What is that? I will explain, pay attention. Listen to me. In that basic condition 2, what is subcondition 1, ma? He must be in India. He must be in India for a minimum period of 60 days or more during the in the current to previous year. What is our current to previous year, ma? Previous year 21-22. In this current to previous year, minimum 60 days. That means greater than or equal to 60 days he should reside during the current to previous year 21-22. Then we can say that subcondition 1 has been satisfied. And what is subcondition 2, ma? What is subcondition 2? He has been in India for a minimum period of 365 days or more during the 4 previous years preceding to the current previous year, ma. What is our current previous year? 21-22. Then what are the 4 previous years preceding to this current previous year, ma? That means by leaving current previous year 21-22, verify the 4 preceding previous years. What are the 4 preceding previous years? Please tell me. Previous year 2021, previous year 1920, previous year 1819, and previous year 17, 18. These are the 4 previous years immediately preceding to our current previous year 21, 22. In these 4 previous years preceding to current previous year, minimum 365 days or more he has to reside in India. In such a case, we can say that subcondition 2 also satisfied. In case subcondition 1 and subcondition 2 both the conditions has been satisfied cumulatively, then you can say that basic condition 2 has been satisfied. Understood? To say basic condition 2 has been satisfied, what is the requirement ma? 2 subconditions required to be satisfied cumulatively, and this is the procedure to determine 2 subconditions. Understood the point? Yes. Chalo, let's verify ma. That is regarding basic condition 1 and basic condition 2. Let's revise ma, let's revise. What is basic condition 1? Please tell me. He is in India for a minimum period of 182 days or more in the current previous year, that is 21-22. Completed. What is basic condition 2 ma? It is comprising 2 subconditions. Subcondition 1, he is in India for a minimum period of 60 days or more during in the current previous year, and subcondition 2, he has been in India for a minimum period of 365 days or more during the 4 previous years preceding to the current previous year. How to determine those 4 previous years? I just explained. So this is subcondition 2. In case subcondition 1 and subcondition 2 both are satisfied, then you can say that basic condition 2 has been satisfied. In case any one subcondition not satisfied, then you should not say that basic condition 2 has been satisfied. Understood the point ma? Yes. Next ma, let's verify additional conditions. Let's verify additional conditions. In that additional condition 1 we are going to verify. What is additional condition 1? Very simple. He has been resident in India for a minimum 2 previous years out of 10 previous years preceding to the current previous year. Please verify that additional condition and tell me what it is trying to communicate. Come on. What is additional condition 1 ma? He has been resident in India for minimum 2 previous years, any 2 previous years out of 10 previous years immediately preceding to the current previous year. First question, when we can say that he is resident ma? When we can say that he is resident? Very simple. Either B1 or B2 must be satisfied. Either B1 or B2 has been satisfied for how many years? For any 2 previous years out of 10 previous years preceding to the current previous year. We can say that additional condition 1 has been satisfied. I will explain, pay attention. What is additional condition 1? What is additional condition 1 ma? Please tell me. He has been resident in India for minimum any 2 previous years out of 10 previous years preceding to the current previous year. Resident means either he has to satisfy B1 or B2 in any 2 previous years out of 10 previous years preceding to the current previous year. Understood the point? Now I will explain how to consider those previous years ma. What is our current previous year ma? 21, 22. Then what are the immediately 10 preceding previous years ma? Come on, please tell me. Previous year 2021, previous year 1920, previous year 1819, previous year 1718, previous year 1617, and previous year 1516, previous year 1415, previous year 1314, previous year 1213, previous year 1112. These are the 10 preceding previous years. These are the 10 previous years preceding to the current previous year 21-22. Out of these 10 preceding previous years, any two previous years. What is that? Any two previous years, he has to satisfy either B1 or B2, then he will be treated as resident, then additional condition will be satisfied. Understood the point? This is how to analyze additional condition 1. I hope you understood well. Say for example, previous year 18-19, he is resident. That means B1 or B2 has been satisfied. And previous year 12-13 also, he is resident. That means B1 or B2 has been satisfied. In such a case, can we say that additional condition 1 has been satisfied? Obviously, yes. That means any two previous years out of these 10 preceding previous years, any two previous years satisfied the resident condition, then he will be treated as he will satisfy additional condition 1 to decide his further residential status. Chalo, next ma. That is regarding additional condition 1. Understood? Yes. Next ma, additional condition 2. And what is additional condition 2? He has been in India for a minimum period of 730 days or more during the 7 previous years preceding to the current previous year ma. Shortcut for remembering: 730 days 7 years ma. 730 days 7 years. Come again, tell me what is additional condition 2? He has been in India, that means he has to stay in India for a minimum period of 730 days or more, and equal to 730 days or more than 730 days during the 7 previous years preceding to the current previous year ma. Are you following? That means again same procedure you need to follow. Please tell me, what are the 7 previous years preceding to the current previous year ma? Tell me, what are the 7 previous years preceding to the current previous year? Previous year 14-15 to previous year 20-21. These are the 7 previous years preceding to current previous year. Understood ma? So during this period, minimum how many days ma he has to stay? Either equal to 730 days or more than 730 days satisfied. He stayed in India during these 7 years preceding to the current previous year. Then we can say that additional condition 2 has been satisfied. Understood the point ma? Yes. That is what do you mean by he has been in India for a minimum period of 730 days or more during the 7 previous years preceding to the current previous year. I hope you understood. Chalo. Exceptions ma. We are having 3 exceptions. Under these 3 exceptions, basic condition 2 is not applicable. To determine the residential status of an individual, we need to consider only basic condition 1. There are 3 exceptions covered. For these 3 exceptions, basic condition 2 is not applicable. Only basic condition 1 will be applicable to decide the residential status of an individual. Let's verify. For the following 3 exceptions, B1 alone is applicable. That means B2 is not applicable. That means the individual who covered under these 3 exceptions, he will be treated as resident only when he resided minimum 182 days or more during the current previous year. That is nothing but basic condition 1. In case basic condition 1 has not been satisfied, then don't go for verification of basic condition 2 that is 60 days or more in the current previous year and 365 days or more during the 4 previous years preceding to the current previous year. Don't go for that basic condition 2, because for this individual basic condition 2 is not applicable. Verify basic condition 1 alone. If satisfies, he is resident. Not satisfies, directly he will be treated as non-resident. Understood the point? Yes. In case of an Indian citizen who is leaving India during the current previous year for the purpose of employment outside India, ma. So tell me, who is the individual covered under first exception, ma? He must be resident individual, first condition. Second condition, he should leave during the current he should leave the India during the current previous year for the purpose of employment outside India. That is the second condition. What is the first condition? He must be resident, he must be Indian citizen. Second condition, he should leave India during the current previous year for the purpose of employment outside India. If these two conditions satisfied cumulatively, then for him only B1 alone applicable, B2 is not applicable. Why this benefit of exemption provided, benefit of exception provided? To give the benefit to the individual who is going foreign country for the purpose of employment during the current previous year by not charging global income and charging only Indian income. That's it. Why this exception provided, ma? This exception is for the benefit of department or for the benefit of this individual? For the benefit of this individual, ma, this exception. Because of this exception, global income is not chargeable in the hands of that individual. Only Indian income alone will be taxable, provided his stay is less than 182 days in the current previous year. In case his stay is equal to 182 days or more than 182 days, ma, then obviously he will be satisfying basic condition 1, then he will be treated as resident, and obviously he will satisfy A1 and A2 because so far he resided in India only. In such a case, he will become resident and ordinarily resident. Global income will be taxable, not only Indian income, but he is doing employment in foreign country, that salary income shall also chargeable to tax. Understood, ma? That means to avoid the chargeability of global income, he has to consider his stay must be less than 182 days, ma. If it is equal to or more than 182, then global income will be chargeable to tax. That is Indian income and foreign income. Understood the point? Yes. Okay, ma. Next. Second condition. In case of an Indian citizen, again Indian citizen, ma, because we are giving these benefits to only our Indian citizens, ma. Who is Indian citizen? Who is having place of birth in India? Who is having place of birth in India? We can call him as Indian citizen. Who is leaving India during the current previous year as a crew member of an Indian ship, ma? Let's consider condition wise. First condition, that individual must be citizen of India, Indian citizen. Second condition, ma, he should the individual must be a crew member of an Indian ship which is foreign going. The individual must be a crew member of an Indian ship, ma. He is a crew member of an Indian ship which is foreign going. In such a case, for him only B1 alone applicable, B2 is not applicable to decide the residential status. Again, to avoid charging global income but charging only Indian income. Again, this is for the benefit of SSC, ma, not for the benefit of department. Because rather than charging global income, we are charging only Indian income, ma. Amendment brought out through Finance Act 2015. What this amendment says? Very simple. Tell me, ma, what is the period we need to exclude while determining period of stay, ma? Period of stay, while determining period of stay, we need to exclude the period start from date of joining to date of signing off. Date of joining to date of signing off. This period must be excluded while determining period of stay. Then excluding this period, consider the remaining period, and if it is greater than or equal to 182 days, then he will be treated as resident. Otherwise, he will be treated as non-resident. Only Indian income will be taxable, not global income. Understood the point, ma? In case in the examination, they have given the information relating to Indian citizen who is leaving India during the current previous year as a member of crew member, crew member of Indian ship, then obviously they will provide the information relating to date of joining and date of signing off. Consider that information, exclude that period from the period of stay determination while determining period of stay during the previous year 21-22. Then consider remaining period, then if it is equal to or greater than 182 days, treat him as resident, otherwise he will be treated as non-resident. Chalo. Third exception ma, in case of an Indian citizen or person of Indian origin. What do you mean by, what is the difference between Indian citizen and person of Indian origin ma? In case the individual himself having place of birth in the India, then he will be treated as Indian citizen. Whereas the individual having place of birth outside India, whereas his parents or either of his grandparents are having place of birth in undivided India, then that person, that individual shall be treated as person of Indian origin. Are you following? His place of birth is not in India, but his mother's parents or his father's parents, either of them having place of birth in undivided India. In such a case, we can call him as a person of Indian origin. Chalo. So what is happening here? In case of an Indian citizen or person of Indian origin who is coming to India during the current previous year on a visit, that means he settled abroad ma. After residing for 10 years or 15 years at abroad, now he is coming to India on a visit ma. In such a case, you need to encourage the individuals who is coming to India who settled abroad. Understood the point? You need to encourage them. That's why the lawmakers provided this exception. For this person also, we need to consider B1 alone. B2 is not applicable. Let's verify. Can you get me condition wise ma? Can you get me condition wise? First condition, the individual must be either Indian citizen or person of Indian origin. Second condition, he must come to India during the current previous year on a visit. Whatever it may be the purpose ma, that may be a business purpose or professional purpose or a family trip, whatever it case may be. So he is coming on a visit. Then if these two conditions satisfied cumulatively, then you can say that he covered under third exception. For him B1 alone applicable, B2 is not applicable. Next my amendment, pay attention, very important. This amendment is relating to third exception. This amendment is relating to only third exception ma. What it says? Brought out through Finance Act 2020, in case of an Indian citizen or person of Indian origin who comes to India on a visit during the current previous year shall be treated as resident in India subject to the following conditions. When we can treat him as resident in India? Subject to following of conditions. Satisfaction of those conditions. If such a person having total income other than foreign income, his total income is exceeding 15 lakhs ma, 15, exceeding 15 lakhs in the current to previous year, then B2 will be applicable. Very, very important amendment. Possibility for appearing in the examination. Pay attention. In case of Indian citizen or person of Indian origin who is coming to India during the current previous year on a visit, then what is his total income status ma? Other than foreign income, exceeding 15 lakhs in the current previous year. In such a case, B2 will be applicable with 120 days instead of 60 days. That means under basic condition 2, we are having sub condition 1 called 60 days or more during the current previous year. Instead of 60 days, consider 120 days ma, in sub condition 1, and sub condition 2 is same as above. What is sub condition 2? 365 days or more during the 4 previous years preceding to the current previous year. So what is the only change in the basic condition 2 ma? Only sub condition 1. Instead of 60 days, consider 120 days, double. Then he will be treated as resident in India. Understood ma? That means in case his total income other than foreign income exceeded 15 lakhs, then basic condition 2 will be applicable with one change. Instead of 60 days, consider 120 days ma. Note 1, foreign income means an income which accrues and arises outside India and which is not deemed to accrue or arise in India. In case it is deemed to accrue or arise in India, it will be treated as deemed income. In case accrued outside India, then received outside India, we can call it as foreign income. Note 2, while computing total income, we need to consider income from business controlled in India and profession setup or a profession setup in India. Very important point, ma. Indian income obviously we need to consider while computing 15 lakhs. Along with that, Indian income, we need to consider foreign income also, provided the business is controlled from India. Understood the point? We need to consider foreign income provided the business is controlled from India. And we need to consider professional income, foreign professional income, provided the profession is set up in India. That means Indian income plus foreign business income controlled from India plus foreign professional income set up in India. Put together these three incomes exceeded 15 lakhs, then for him basic condition 2 will be applicable with 120 days in sub condition 1 instead of 60 days. Ma. Understood the point? If such a person having total income other than foreign income does not exceed 15 lakhs, ma, that means these three incomes put together does not exceed 15 lakhs, then B2 will not be applicable. He will be simply covered under third exception. He will be simply covered under third exception. That means when we need to apply this amendment, ma, when we need to apply B2 by applying this amendment only when the Indian income, that is including three incomes, exceeded 15 lakhs during the current previous year. Otherwise don't apply this amendment, ma. Very simple. Next, deemed resident. Simple. The individual who covered in the above discussion, above amendment, will be treated as deemed resident, ma. That's it. Chalo, let's verify. Newly inserted through Finance Act 2020, section 6 subsection 1A. If an individual who is an Indian citizen is having total income other than foreign income exceeding 15 lakhs during the current previous year, then such individual shall be treated as deemed to be resident in India in the current previous year, subject to the following two conditions, ma. He should not be liable to pay tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature, and he should not be resident in India during the current previous year as per section 6 subsection 1. That means he is satisfying B1 or B2, ma. If he is satisfying B1 or B2, that is normal, under normal procedure specified under section 6 subsection 1, then he will be straightforward. Directly we can treat him as a resident, ma. Then there is no question of applying the concept of deemed resident. Whenever you are in a position to apply the concept of resident directly, what is the need of deemed resident? Are you following? Okay. Deemed resident shall always be a resident but not ordinarily resident, ma. So that is the discussion relating to deemed resident. So what is the first condition? He should not pay tax in the foreign country and he should not cover under 6 subsection 1. Then only we can call him as a deemed resident, provided he is having more than 15 lakhs total income in the current previous year. Factor 2, ma. With this we completed factor 1, determination of residence status for an individual. Then let's verify factor 2, ma. What is factor 2? Very simple. Place of receipt and place of accrual of income. What is that? Place of accrual and place of receipt of income. Section 5. Let's verify. There are two types of income, ma. One is Indian income, second one is foreign income. When we need to treat it as Indian income, when we need to treat it as foreign income, we are going to verify. Pay attention. Situation: accrual in India, receipt in India, nature of income. Okay. Situation 1. Place of accrual in India? Yes. Place of receipt in India? No. That means that income having place of accrual in India, but place of receipt outside India. It is not in India. Then tell me what is the nature of income, ma? Tell me what is the nature of income? Place of accrual in India, but place of receipt outside India. What is the nature of income? Obviously, it will be treated as Indian income. That means to treat it as Indian income, either accrual or receipt in India, enough. No need to have both the things in India, ma. No need to have accrual and receipt in India. It is enough to have either of them in India to treat it as Indian income. Remember. Next, situation 2. Accrual in India? No. Receipt in India? Yes. What is the status ma? Obviously Indian income because receipt is in India. Then situation 3, accrued in India? Yes. Receipt in India? Yes. Obviously Indian income ma. Situation 4, you can guess. What is situation 4 ma? Please guess it. Accrual in India? No. Received in India? No. Both are not in India. Can we treat it as Indian income? No. You have to treat it as foreign income. That's it. Understood the point? The term accrue includes deemed to accrue or arise in India. The term receipt includes deemed to be received in India. Section 9 deals with deemed to accrue or arise in India. Section 7 deals with deemed to be received in India. I will explain later, not now. Section 9, Section 7, I will explain later, not now. For the time being, try to remember the term accrue includes deemed to accrue or arise in India. The term receipt includes deemed to be received in India. Tell me ma, when we can call any income as Indian income? Either place of accrual or place of receipt. In India, you can treat it as Indian income. Second case, place of accrual and place of receipt, both are outside India. You need to treat it as foreign income. That's it. Next ma, I will explain the concept called receipt versus remittance ma. The concept called receipt versus remittance, very important, because to decide the nature of any income, the receipt must be in India or accrual must be in India, either of them. There the lawmakers used the word called receipt. Now let's compare the term called receipt along with the remittance. Now tell me, thereafter we will verify whether the remittance is having any relevance in determination of nature of income. I am going to explain. Pay attention. Mr. X working in a foreign company, Dubai. He provided services to that foreign company ma. His employee of that foreign company provided services and received salary ma. Now obviously if at all is providing services in foreign country means what is place of accrual ma? Foreign country only. Is providing services in foreign country, Dubai. That means what is the place of accrual? Dubai. That means place of accrual outside India. You can say that. Now received in Dubai ma. That means credited to the bank account which is located in Dubai. The salary amount credited to the bank account which is located at Dubai. That means received in Dubai. So accrued in Dubai, received in Dubai. What is the status of that income? What is the nature of that income? Foreign income, because both are outside India. Foreign income because both are outside India. Now I will extend this discussion. Pay attention. Mr. X having family members residing in India. Family members are residing in India. Now some unspent portion, say his annual income, annual salary is 1 crore, assume 20 lakhs he spent in Dubai. Now what is unspent portion out of 1 crore ma? If at all he spent 20 lakhs out of 1 crore, 80 lakhs. Now that unspent portion of salary, that is 80 lakhs, he remitted to his family members who are residing in India. He remitted to the family members who are residing in India. My question, if at all he remitted through approved banking channels to India, to his family members, now tell me whether any change in the nature of that income because of this remittance, whether the change occurs to the nature of the income. Please tell me. There will be no change in the nature of that income even though he remitted unspent portion to India. Why? Because what is relevant thing here, what is important thing here? Receipt to decide the status of income, not the remittance. Because the lawmakers used the term called receipt, they have not used the word called remittance ma. That means to decide the nature of income, status of income, whether it is Indian income or foreign income, what we need to consider? What is the place of receipt we need to consider, but we should not consider place of remittance. Place of remittance having no role in deciding status of income. Understood the point? Now what is the meaning of receipt and what is the meaning of remittance ma? First receipt shall be treated as receipt, whereas all subsequent receipts shall be treated as remittance. Single term, single line, one line summary. What is receipt ma? First receipt will be treated as receipt, that is having relevance to decide the nature of income, whereas all subsequent receipts shall be treated as remittance, having no relevance in deciding the status of income. Understood? Say for example, he is doing employment in Dubai only, providing services in Dubai only. That means place of accrual is in Dubai, whereas the salary directly credited to the State Bank of India located at Hyderabad ma. The salary amount 1 crore directly credited to the SBI account, his SBI account located at Hyderabad. In such a case, we need to say that place of receipt is in India, because the first receipt is in India. That means the receipt is in India. Hence, we need to give the status of Indian income. Understood the difference between first thing and second thing? First example and second example. Are you following? So first receipt will be treated as receipt ma. If it is in India, you can call it as Indian income. All subsequent receipts will be treated as remittance, even though that remittance is in India. That will not change the nature or status of income. That is important point I want to communicate. Come on. We are bothered about receipt but not remittance ma. We have to consider receipt but not the remittance. First receipt shall be treated as receipt. All subsequent receipts shall be treated as remittance. That's it. Understood. That is factor 2. Factor 3 ma. Factor 3 is time of accrual and time of receipt of income. What is that? Time of accrual and time of receipt of income. See, time of accrual and time of receipt of income also decides the chargeability for an income. Also decides the chargeability for an income, whether it is to be included in the total income for deciding the tax liability or not to be included. Also depends upon the time of accrual and time of receipt of income. Chalo. Mr. X, employee in X Limited. I will explain with the help of example. Pay attention. Posted in Dubai during the previous year 2001 to previous year 2021, around 21 years he provided services in Dubai ma. That means income earned and received in Dubai. Place of accrual in Dubai, place of receipt in Dubai. For these 20 years or 21 years, that means this income shall be treated as foreign income. Obviously, because both are outside India. Foreign income. Now, during the current previous year 21-22, Mr. X comes back to India ma, for a permanent settlement ma. He comes back to India for permanent settlement in India. He is coming back to India. Now, he is bringing how much ma? 4 crores. Rupees 4 crores brought to India, remitted to India, approved banking channels ma. Are you following? How he is remitted to India ma, through approved banking channels in the current previous year 21-22, not through money laundering. If you remitted through money laundering, it is a crime ma. It is a crime. He is not remitted through money laundering. Through approved banking channels he remitted in the current previous year 21-22. Decide whether that 4 crores is chargeable to tax in India in the current previous year 21-22 or not. My question. That is my question. Please tell me. To charge any income in the current previous year, either time of accrual or time of receipt should be in the current previous year. Very, very important point. Please tell me. Come again, what it says. To charge any income in India in the current previous year, either time of accrual or time of receipt, either of them should be in the current previous year. In case both are in the past previous years, that is not taxable in India in the year of remittance and in subsequent years also. Why? Why lawmaker says not chargeable to tax ma? To encourage those people to bring that foreign income to country, to invest in our country, to what is that, contribute to the economy ma. Are you following? If at all they brought huge foreign income to the country and they're establishing industries in India, means obviously they are creating employment to so many persons ma, and they are contributing to the Indian economy. Are you following? So to encourage those persons, the lawmaker says, I will not charge that 4 crores which you brought to India through approved banking channels. To encourage the persons ma. Understood? To invest in the country, to contribute to the Indian economy. Are you following? Yes. So what is the required thing to charge any income in the current previous year? Either time of accrual or time of receipt should be in the current previous year. In case it was in the past, both are in the past previous years, you are bringing to the India in the current previous year, it is not chargeable to tax, to encourage the people to bring such income to the country. Such amount is not chargeable tax. Since to tax a particular income for a particular previous year, the income either accrues in that particular previous year or received in the particular previous year. That's it ma. That is a pura discussion relating to what? Residential status of an individual, and we verified factor 2 also. What is factor 2 ma? Place of accrual and place of receipt. Factor 3 also we verified, time of accrual and time of receipt. Next ma, let's verify the procedure for determination of residential status of HUF. Come again. Residential status of HUF. Now let's verify the procedure for determination of residential status of an HUF ma. Tell me what is the basis for determination of residential status of an HUF ma? What is the basis? Control and management. Come again. Control and management. Depends upon control and management. We need to decide whether the HUF is ROR or R but NOR or NR. Let's verify ma. Situation 1. If control and management of affairs are wholly or partly situated in India, that is situation 1. Second situation, if control and management of affairs are wholly situated outside India. Are you following? In case control and management is wholly or partly situated in India, straightforward it will be treated as resident in India. What is that? Resident in India. In case control and management wholly situated outside India, you need to treat it as non-resident. What is that ma? Non-resident. In case that HUF is proved as non-resident, that is end of the story. No need to go for further verification. But when we need to go for further verification ma, only when it is proved as a resident. Now under situation 1, we can treat it as resident in India because control and management either wholly or partly located in India. We can give the status of resident. After giving the status of resident in India, further we need to decide whether it is ROR or R but NOR. Come again ma? Whether it is ROR or R but NOR. For that, we need to verify the status of the Karta of the HUF ma. To give the further status, we need to consider the situation of the Karta. In case the Karta of the HUF satisfies both the additional conditions ma. Do you remember A1 and A2? If Karta of the HUF satisfies both the additional conditions, then that HUF shall be treated as resident and ordinarily resident. In case Karta of the HUF has not been satisfied either of the additional conditions or both the additional conditions, then that HUF shall be treated as resident but not ordinarily resident. Are you following? Yes. First of all, to decide whether it is resident or non-resident, it is completely depends upon the control and management ma. Once it is proved as resident, then you need to verify whether it is ROR, R but NOR. Then for that you need to verify the status of the Karta. Depending upon the satisfaction of the additional conditions, we need to decide whether HUF is resident and ordinary resident or resident but not ordinarily resident. Who has to satisfy additional conditions ma? Karta of the HUF. Chalo. Second situation, treated as non-resident ma. First situation, resident in India. If Karta satisfies both additional conditions, then treated as ROR. If he is not satisfying any one of them or both of them, then we can call that HUF as a R but NOR. Understood ma? Very easy. HUF is very easy. Next, determination of residential status of firm AOP and BY. In case of these persons, only two possible status ma. First one is resident, second one is non-resident. That's it. No further verification. Either resident or non-resident. Now tell me, what is the basis for determination of RS for these persons ma? It depends upon the control and management, same as HUF. But only difference is no need to go for further verification after proved it as a resident. Understood? So it is also completely depends upon the control and management, same as HUF. Now tell me, when firm AOP and BY treated as resident, when we need to treat as non-resident ma? Very simple. The control and management wholly or partly situated in India. Second case, wholly situated outside India. In case wholly or partly situated in India, treated as resident in India. That's it. No need to go for further verification. In case it is situated wholly outside India, straightforward you need to treat it as non-resident. Understood ma? Here further verification is not applicable. Next ma, let's go for company. Okay, let's go for local authority AJP. Same concept. Same concept. I'm not going to explain. Just take a look. Done? Okay. Company ma, very important. Residential status of company. Tell me, what is the basis for determination of residential status of a company ma? It is completely depends upon the POEM, place of effective management. What do you mean by place of effective management? The key persons of the company, the place at which the key persons of the company presented to take major commercial decisions. What is place of effective management ma? The place at which key persons presented to take major commercial decisions. I will explain. Pay attention. In case of company, first of all, let's verify for Indian company ma. Indian company, always we need to give the status of resident in India. It is not possible for giving the status of non-resident ma. All Indian companies will be treated as resident in India without any conditions or restrictions. Verification. Next ma, when it comes to foreign company, it is completely depends upon the place of effective management. Completely depends upon the place of effective management. Let's verify. Place of effective management, that is POEM, is in India. Is in India at any time during the current previous year. Whether they are saying throughout the current previous year or at any time. At any time, not throughout the year. That means out of 365 days, even one day the key personnel presented in India to take a major commercial decision, then you can say that place of effective management is in India, that foreign company shall be treated as what? Resident in India for that previous year. Only for that previous year ma, not rest of the life of that company. Only for that previous year it will be getting the status of resident. In case place of effective management is outside India during the entire current previous year, then it will be treated as non-resident. Here it is treated as resident, here it is treated as non-resident. Now I will explain what is POEM. It is a place where key managerial personnel presented to take the major commercial decision ma. My question, normal managerial personnel or key managerial personnel ma? Key managerial personnel. Who are the key managerial personnel? Board of directors, CEO, CFO. Are you following? And chairman of the company. Are you following? These persons will be treated as key managerial personnel, and they have presented in India at any time in India during the current previous year. They have presented. Why? What is the purpose? To take the major commercial decisions. What do you mean by major commercial decision ma? Purchase of raw material, appointing what is that, security guard. Can we treat it as major commercial decision? Those are day-to-day decisions ma. Those are day-to-day decisions. Don't treat them as a major commercial decision. Then what do you mean by major commercial decision? Change of the board of directors, appointment of the managing director, appointment of the CEO, appointment of the CFO, decision relating to amalgamation, decision relating to change in the name of the company. Are you following ma? These are called major commercial decisions. So to take these major commercial decision, the key manager personnel presented in India at any time during the current previous year, then you can say that poem is in India during the current previous year, then that foreign company shall be treated as a resident in India, otherwise non-resident. Simple. Okay ma? That is the discussion relating to residential status of various persons. Chalo. Now let's get into one important topic ma, very important topic. Pay attention. Particulars ROR, R but NOR, NR. Simply we are verifying the chargeability in the hands of ROR, in the hands of R but NOR, in the hands of NR. Let's verify. First my Indian income. When it comes to Indian income, what is the chargeability principle relating to Indian income? Remember, if it is happen to be Indian income, it is taxable in the hands of all the persons including non-resident. There is no exception. If it is Indian income, it will be taxable in the hands of all the persons ma, including non-resident. And when we can treat any income as Indian income? When we can give the status of Indian income ma? Either place of accrual or place of receipt should be in India. Then only you can treat it as Indian income. Both are in India, well and good, Indian income. What if both are outside India ma? Foreign income. Understood the point? Now we are discussing about Indian income. So tell me, what is the treatment for Indian income? It is taxable in the hands of ROR. Yes. Whether it is taxable in the hands of R but NOR? Yes. Is it taxable in the hands of NR? Obviously yes. Because it is Indian income, taxable in the hands of all the persons irrespective of residential status. Taxable, taxable, taxable. Next ma, foreign income. Pay attention. In that foreign income, under that foreign income, we are verifying business income. Now, with respect to that business, first situation controlled from India, second situation controlled from outside India. Try to understand properly. We are verifying foreign income. In that foreign income, we are verifying business income. That means foreign income arising from business. And what is the situation of that business ma? First case controlled from India, second case controlled outside India. Now let's verify. When it comes to foreign business income controlled from India, tell me whether it is taxable in the hands of ROR ma? Obviously it is taxable in the hands of ROR, because one golden principle, remember, I will say, in case of ROR, resident and ordinarily resident, global income will be taxable. What do you mean by global income? Indian income and foreign income. Global income will be taxable in the hands of ROR, golden principle, remember. So foreign income, business income controlled from India, taxable in the hands of ROR for sure. What about resident but not ordinarily resident ma? It is taxable in the hands of resident but not ordinarily resident hands also, because it is controlled from India. Hence lawmaker says, if at all it is controlling from India and your R but NOR, we will charge it to tax. Next ma, what if he is non-resident? What if he is non-resident ma? Please tell me. Not taxable. It is not taxable, remember. Next ma, foreign income, business income controlled from outside India. Controlled from outside India. Then what is the situation in the hands of ROR ma? Obviously taxable. In the hands of R but NOR, not taxable. In the hands of NR, also not taxable. Next, professional income. What is that? Professional income. Foreign income, professional income, two situations. That profession set up in India. Second case, that profession set up outside India. In case of foreign income, professional income set up in India, ROR hands taxable. R but NOR, yes, taxable, because the profession is set up in India. Non-resident, not taxable. What if set up outside India ma? ROR taxable, R but NOR not taxable, NR not taxable. That is regarding professional income. Next ma, foreign other income. What do you mean by foreign other income ma? That means other than business or professional income. Can you get me some examples for foreign other income other than business income or professional income? Yes. We are having house property located at foreign country, ma. We are having house property located at a foreign country. It is not business income. It is not professional income. Then what it is? Comes under other income. You are having fixed deposits in foreign banks, ma. Fixed deposits in foreign banks. Then it is not business income. It is not professional income. It is what? Other income. Are you following? Yes. In case of other income, ROR taxable, R but NOR not taxable, NR not taxable. Good. Next, ma. Income relating to past years and remitted to India in the current previous year. I explained at the time of discussion of factor 3, if you remember. Income relating to past years, that means time of accrual and time of receipt in the past previous years and is remitting to India in the current previous year. It is not taxable in the hands of all the persons including ROR. Even in the hands of ROR, this income is not taxable because the lawmakers giving this benefit to encourage these persons to bring that foreign income to the country and to invest in the India. Understood the point? Yes. Not taxable, not taxable, not taxable. That is regarding scope of total income. Scope of total income, pura discussion. If you understood this discussion, it is very easy for you to solve the problems in the practice material, practice manual. Understood? Yeah. Tell me, ma. In case of ROR, how many taxable situations are there? 6. In case of ROR, 6 taxable situations are there. What are those? Indian income, foreign business income, controlled from India, controlled from outside India, foreign professional income, set up in India, set up outside India, and other income. Pura 6 cases it is taxable in the hands of ROR. In case of R but NOR, how many taxable cases are there? Only 3. What are those? Indian income, foreign business income, controlled from India, foreign professional income, set up in India. That's it. In case of non-resident, only one situation, Indian income alone. All other incomes not taxable in the hands of non-resident. That means in case of ROR, 6 cases, R but NOR 3 cases, NR only 1 case. I hope you understood, ma. Okay. With this knowledge, let's try to work out one illustration, the ICI material. Only one illustration I will explain now. I'm not going to explain every illustration, ma, because it is a marathon class. I don't have much time and I need to explain all these concepts, entire subject in 20 hours. So that's why I'm not going to explain every illustration. So I picked up only one illustration, which is a lengthiest one, which is lengthy one and important from the viewpoint of examination. Chalo, let's verify. Let's verify illustration 8, ma. Compute the total income in the hands of an individual aged 35 years, being a resident and ordinarily resident, resident but not ordinarily resident, and non-resident. Big problem I selected. Illustration 8, pay attention. For the assessment year 22-23. Chalo. Interest on UK development bonds, 50% of interest received in India. First of all, tell me, interest on UK development bonds, ma. That means the place of accrual is outside India. What is place of accrual, ma? Outside India. How can you say that? Because those bonds are UK development bonds. That means investment is outside India. That means place of accrual is outside India. Whereas 50% of interest is received in India. In such a case, received in India means that will be treated as Indian income. What is the treatment for Indian income? Taxable in the hands of all the persons irrespective of residential status, ma. That means out of 10,000, 5,000 will be treated as Indian income, taxable in the hands of all the persons, ma. That means in the hands of ROR, 5,000 taxable, R but NOR, 5,000 taxable, NR, 5,000 taxable. Then what about remaining 5,000, ma? What is the status of remaining 5,000? For the remaining 5,000, place of accrual is outside India and place of receipt also outside India. That means both are outside India. That means remaining 5,000 we need to treat it as foreign income. and it is foreign other income, comes under foreign other income, not business income, not professional income, comes under foreign other income. If you remember our earlier discussion in the table, are you following? So what is the treatment for foreign other income? R over hands taxable, R but NOR not taxable, NR not taxable. That means in the hands of R over 10,000, in the hands of R but NOR 5,000, in the hands of NR 5,000. Next, income from a business in Chennai. Income from a business in Chennai. What is the location of the business in Chennai? That means place of accrual is in India. If at all place of accrual is in India, it is enough to give the status of Indian income. Then there is no need to verify what is place of receipt, because it is enough to have either of them in India to give the status of Indian income. Are you following? So place of business is in India, hence we need to treat it as Indian income. 50% is received in India. There is no relevance for receipt. If at all the place of accrual is in India, blindly you can give the status of Indian income. Enter 20,000. What is the treatment for Indian income? Taxable in the hands of all the persons irrespective of residential status. That means ROR 20,000, R but NOR 20,000, NR 20,000. Understood ma? Next, short-term capital gains on sale of shares of an Indian company received in London. Short-term capital gain on sale of shares ma. Which company? Of an Indian company. If those shares are belongs to Indian company, then that will be treated as place of accrual in India. If at all place of accrual is in India, there is no relevance for place of receipt to decide the status or nature of income. It is enough to have any one of them in India to give the status of Indian income. Here what is having in India ma? Place of accrual is in India, because those shares are belongs to Indian company. Hence we need to treat it as Indian income. The 20,000 we need to treat it as Indian income, taxable in the hands of all the persons irrespective of residential status. That means 20,000, 20,000, 20,000. Next ma, dividend from British company received in London. If at all the dividend is coming from British company, that means the place of accrual is outside India ma, because the shares are belongs to Britain company. Britannia company le Britain company. Are you following? That means place of accrual is outside India. And what is place of receipt ma? In London, outside India only. If at all place of accrual outside India, place of receipt outside India, what it is? Foreign income. Which foreign income ma? Other income. Comes under C part other income. What is the treatment for foreign other income ma? In the hands of ROR, taxable, because global income is taxable, 5,000. In the hands of R but NOR, not taxable. In the hands of NR, not taxable. 5,000 nil. Next ma, long-term capital gain on sale of plant at Germany. What is the location of the plant ma? Germany. That means place of accrual is outside India. 50% of profits are received in India. What is the total profit ma? 40,000. Out of 40,000, what is received in India ma? 50% means 20,000. That means out of 40,000, 20,000 received in India means that 20,000 treated as Indian income. That means taxable in the hands of all the persons irrespective of residential status. That means out of 40,000, 20,000, 20,000, 20,000 taxable. Remaining 20,000. Let's verify the status for remaining 20,000. Don't worry ma, what I am explaining orally is there in the PPT ma. I have given a detailed workings for this explanation. Don't worry regarding copying the thing. Whenever I am explaining through slides, you can pass and copy. Don't worry, you can pass and copy. Now please concentrate on my discussion. Chalo. 20,000 received in India, need to treat it as Indian income, taxable in the hands of all the persons, 20, 20, 20. Next, remaining 20,000 ma. Remaining 20,000, place of accrual outside India, place of receipt also outside India. That means it is a foreign income. Which foreign income? Other income. Foreign income comes under other income. Are you following? Then what is the treatment for the 20,000 which is a foreign income, comes under other income ma? In the hands of ROR, taxable, because global income is taxable. In the hands of R but NOR, not taxable, because it is not foreign business income controlled from India. It is not foreign professional income set up in India. It is foreign other income, not taxable in the hands of R but NOR. In the hands of NR also not taxable. Understood? Because in the hands of NR only Indian income alone taxable. Then remaining 20,000 chargeability ROR taxable 20,000, R but NOR nil, NR nil. Next, that means 40, 20, 20. Next income earned from business in Germany which is controlled from Delhi. Income earned from business in Germany that means location of the business in Germany outside India. That means place of accrual outside India which is controlled from Delhi. Very important that business located outside India controlled from India. Remember this point. Out of 70,000, 40,000 received in India Out of 70,000, 40,000 received in India means 30,000 received outside India. We will verify the situation relating to 30,000 later. Now let's do the analysis for 40,000 received in India. Now if at all 40,000 is received in India, what is the status of that income Indian income? Because received in India enough to give the status of Indian income. Don't consider what is place of accrual. Either of them in India give the status of Indian income. Understood? So 40,000, if at all 40,000 is Indian income, what is the treatment taxable in the hands of all the persons irrespective of residential status. That means 40, 40, 40. We decided the treatment for this 40,000. What about remaining 30,000 Tell me, for 30,000 what is place of accrual? Outside India. Place of receipt? Outside India. That means it is foreign income, comes under business income, business in Germany. And under that business controlled from India controlled from India. The 30,000 status is foreign income, business income controlled from India because controlled in Delhi. Understood? Then in the hands of ROR 30,000 taxable because global income taxable. In the hands of R but NOR, please tell me. In the hands of R but NOR taxable because controlled, business controlled from India, 30,000 taxable. In the hands of non-resident not taxable. That means 70, 70, 40. Next profit from a business in Delhi but managed entirely from London. Come again. Profit from business in Delhi. If at all the location of the business is in India, then the place of accrual is in India If at all place of accrual is in India, then no need to verify from where they are controlling that business and where that income is received. The place of receipt having no relevance, the place of control having no relevance. If at all place of accrual is in India, enough to give the status of Indian income, that 15,000 taxable in the hands of all the persons including non-resident. Very simple. Next income from house property in London deposited in a bank at London brought to India. Are you following? Please pay attention. What is the location of the property London. Are you following? And that means place of accrual is outside India. And what is place of receipt The first receipt, that is the rent amount, is directly deposited into a bank account located at London. That means receipt means first receipt we need to consider, right? So what is the location of that first receipt London. That means place of receipt also outside India. Now subsequently brought to India, that means subsequently remitted to India Whether this remittance is having any relevance to decide the nature of income? Obviously no. Remittance having no role to decide the nature of income. What is having relevance Receipt, nothing but first receipt. What is the location of that first receipt outside India. What is place of accrual? Outside India. Both are outside India. What is the nature? Foreign income. And it is foreign other income, comes under foreign other income. Treatment in the hands of ROR taxable because global income taxable. R but NOR not taxable, NR not taxable. That means 50,000 nil nil. See here they said computed they said computed. That's why again you should not allow standard deduction at the rate 30%. Are you following? Under section 24 class A, if you remember, we need to allow standard deduction at the rate 30% of NAV. Here we should not allow because within the brackets they have given that computed. Computed means after allowing all the deductions which are available, which are applicable. Are you following? How many deductions are there under the head income from house property? Ma? 3 deductions. What are those? Municipal taxes, then standard deduction at the rate 30% and interest on borrowed capital. Are you following? One second, ma. Chalo ma. Tell me, how many deductions we are having under that house property? 3 deductions. First one, municipal taxes. Next, 24 class A. SD at the rate 30% of NAV, 24 class B interest on borrowed capital. Ma. Here we are not allowing any of those deductions because municipal taxes information not available and interest on borrowed capital not available, and even the standard deduction information not available, still you need to provide because that is a standard deduction. For that no need to have any information. But here we are not allowing, ma. Why we are not allowing? Because they said computed. Computed means after allowing all deductions including standard deduction. That's why directly we are considering into the total income computation 50,000. Sorry, it is what? Foreign income, right? It is taxable only in the hands of ROR, that is 50,000. In the hands of R but NOR not taxable because it is other income, and in the hands of non-resident not taxable because it is a foreign income. Next, ma. Interest on debentures in an Indian company received in London. Those debentures belongs to Indian company, ma. That means the place of accrual is in India. Then it is enough to give the status of Indian income, taxable in the hands of all the persons irrespective of residential status, and there is no relevance for place of receipt. Once place of accrual is in India, enough, you can give the status of Indian income. Then 12,000. Next, ma. Fee for technical services rendered in India but received in London. What is the location of providing those technical services, ma? In India. That means place of accrual is in India, enough to give the status of Indian income, taxable in the hands of all the persons. 8,000. Next, ma. Profit from a business in Mumbai managed from London. Now, what is the location of this business, ma? Mumbai. That means in India. Enough to treat it as Indian income because the place of accrual is in India. If at all the business is located in India, then you can say that what? Place of accrual is in India. Then it is enough to give the status of Indian income, taxable in the hands of all the persons irrespective of residential status, ma. There is no relevance for control and place of receipt. Place of control and place of receipt. If at all it is proved as place of accrual in India. Having place of accrual in India. Next, my income from property situated in Nepal received there. What is the location of the property ma? Nepal, outside India. That means place of accrual outside India and place of receipt outside India. That means it is foreign income. Comes under other income. Comes under what ma? Other income. They said computed. That means after allowing all deductions including standard deduction. Again we are not allowing. Now it is foreign income and comes under other income. What is the treatment for this foreign other income ma? Taxable in the hands of ROR. How much ma? 16,000. In the hands of R but NOR not taxable because it is not foreign business income controlled from India. It is not foreign professional income set up in India, hence not taxable in the hands of R but NOR. NRMA also not taxable. Next, past foreign untaxed income brought to India during the previous year. Very important. Do you remember in our table last point? Past foreign untaxed income brought to India during the current previous year. To charge any income in the current previous year in India, either time of accrual or time of receipt should be in the current previous year. Otherwise, not taxable in the hands of all the persons, including resident and ordinary resident. Why this condition given by the lawmaker for charging that income is to encourage the people to bring that foreign amount to country. Understood the point? So, not taxable ma. And there is no relevance for whether it was taxed in foreign country or not taxed in foreign country ma. There is no relevance for that fact. Even though it was not taxed in foreign country, in India we are not going to charge because it is foreign, that is past income, because it is past income and you are bringing to India in the current previous year, not chargeable to tax. 000. Next ma, income from agricultural land in Nepal, that means place of accrual outside India. Received there, that means place of receipt outside India, place of accrual outside India, place of receipt outside India. It is what? Foreign income. And then brought to India. This is called remittance ma. Whether remittance having any relevance in decision making ma? No. That means it is a purely foreign income and comes under other income. Comes under other income. Treatment in the hands of RO taxable, R but NO not taxable, NR not taxable. 18,000 0 0. You may get a doubt here. Sir, it is agricultural income. Can we charge to tax in India? Please tell me. I am getting doubt actually. You tell me. It is, they said agricultural income. I think it is eligible for exemption under section 10 subsection 1 ma. If you remember, the agricultural income from agricultural land located in India alone exempt ma. Under section 10 subsection 1. Not agricultural land located in foreign countries. Are you following? The department is providing exemption only to the agricultural income which is from agricultural land located in India. What is the location of this agricultural land? Nepal. Whether Nepal is in India ma? No. That means it is from foreign agricultural land. It is chargeable to tax. Exemption is not available under section 10 subsection 1. Okay, taxable ma. Next, 18,000 00. Income from profession in Kenya. That means place of accrual outside India, which was set up in India, profession set up in India. Try to remember that chart. Received there, place of accrual outside India, place of receipt outside India, Kenya, but spent in India. That means remittance in India. There is no relevance for remittance here for decision making. So what is the situation here? Place of accrual outside India, place of receipt outside India. That means it is foreign income, comes under professional income, comes under set up in India. Then in the hands of ROR taxable, R but NOR taxable because set up in India that profession, NR not taxable. 5,000 0. Next ma, gift received on the occasion of his wedding. Any gift received on the occasion of marriage ma, it is not taxable, covered under exceptions to section 56 subsection 2 class 10, not taxable under the head IFOS and any other head. Not taxable. 20 nil. Next, interest on savings bank deposit in State Bank India 12,000. If at all that interest is coming from savings bank with what is that State Bank of India, that means place of accrual is in India ma. If at all place of accrual is in India, obviously it will be treated as Indian income, taxable in the hands of all the persons. How much ma? 12. Remember, under section 80 TTA. Do you remember chapter 6 deduction? Under section 80 TTA, 10,000 up to 10,000 deduction is available. Next ma, income from a business in Russia. That means place of accrual outside India, controlled from Russia. Okay, they have not specified regarding receipt, assuming receipt also outside India. Assuming receipt also outside India, place of accrual outside India, it is a foreign income and foreign business income controlled from outside India. Then treatment RO are taxable 20,000, R but NO are not taxable because controlled from outside India and are not taxable. Next, dividend from Reliance Petrol Limited, an Indian company. Yes, place of accrual is in India. It is Indian income, taxable in the hands of all the persons. 5,000, 5,000, 5,000. Agricultural land from a land in Rajasthan. Remember, do you remember our discussion, Agricultural land from a land in Rajasthan. That means it is agricultural income from a land located in India. Exempt under section 10 subsection 1 in the hands of all the persons. Nil, nil, nil. Or exempt, exempt, exempt. That is a discussion, Okay, let's verify the PPT. Chalo, chalo, chalo. Try to copy in your notebook, Pass and copy. A detailed analysis, detailed workings has been provided. Your wish. If you want to copy, you can copy. Otherwise, no need, If you feel it is worth to copy, you can. Determination of taxable income for the previous year 21-22 or assessment year 22-23. Particulars RO R but NO NR. Okay. Interest on UK Development Bank 10.55. Already explained. I am not going to explain again. Income from a business in Chennai 2020-20. Profit on sale of shares of an Indian company 2020-20. Dividend from British company 5 nil nil. Profit on sale of plant at Germany. Okay. Income earned from business in Germany which is controlled from Delhi. Profit from a business in Delhi. Rent from a property in London. Interest on debentures in an Indian company. Pass and copy. Fee for technical services. Profit from a business in Bombay. Income from a property in Pakistan. Past foreign untaxed income not taxable. Income from agricultural land in Nepal. Income from profession in Kenya. Gift received exempt, exempt, exempt. Interest on savings bank deposit in SBI taxable. Income from business in Russia. Put together. Dividend from Reliance Petrol taxable because they withdrawn. CDT or DDT under section 115 was subsection. Now dividend is taxable. Now dividend from domestic company is now taxable. Agricultural income from a land in Rajasthan exempt. Gross total income. Chapter 6 deduction under section 80 TTA 10,000 provide deduction. Total income 342, 208, 173. Copy. Pass and copy. Next. Analysis. Pass and copy. Pass and copy. Okay. I have given this much analysis because at the time of preparation you should not get any doubt. Entire analysis has been given. That is not 56 subsection to class 7, it is 56 subsection to class 10. Sorry for that, it is class 10. When it comes to with reference to working note 20, pay attention. It is not exempt. They have withdrawn the exemption. It is taxable now. It is taxable. They have withdrawn the exemption because they withdrawn CDT, DDT under section 115 was subsection 1. Accordingly, please replace the statement. Not exempt under section 10 subsection 34. Since the lawmakers withdrawn section 10 subsection 34, now the dividend from domestic companies taxable under the head IFOS because The lawmakers withdrawn CDT or DDT under section 115 was subsection 1. Now it is taxable in the hands of receiving shareholder hands. Dividend from domestic company. Agricultural land exempt. That's it, ma. That is regarding discussion relating to residential status and scope of total income. I hope I covered everything which is important from the viewpoint of examination. I hope you understood well. Okay, then in the next session, I will explain income from salary. I will start the head of income called income from salary. Okay, then thank you and good day. Shall we start? Shall let's start with income from salary. My first head of income, we are going to discuss income from salary. I will try to cover 80% of the concepts under the head income from salary. Ma, pay attention. You will surely understand each and every concept in a very detailed way. Don't worry. Okay, then tell me what are the dealing sections with reference to income from salary, ma? What are the dealing sections with reference to income from salary? Section 15 to section 17. We know section 15 deals with charging section, whereas section 16 deals with deductions, ma. How many deductions we are having under section 16, ma? 3 deductions we are having. 16 class 1A standard deduction. If you remember, 16 class 2 entertainment allowance, 16 class 3 professional tax paid. We will discuss little bit later. Then section 17 deals with perquisites or benefits. Chargeability of perquisites or benefits. Okay, ma. Let's start our discussion. Now let's verify the pro forma for computation of income from salary or net salary. There is a format, there is a pro forma for computation of income from salary or net salary. Let's verify, ma. Total 13 items we need to consider. How many items, ma? Total 13 items we need to consider. Then you will get the gross salary if you add those 13 items. From those 13 items, if you reduce 3 deductions, if you reduce 3 deductions under section 16, then you will get income from salary or net salary, which will be chargeable to tax, which will be taken into the total income taxation. Are you following? Chalo. So let's verify what are those 13 items we need to consider to get the gross salary. First one, ma, basic salary. First we need to consider basic salary. Then we need to consider dearness allowance. What is that? Dearness allowance. Then bonus. Then commission. Then taxable value of HRA, house rent allowance. Then taxable value of allowances. Taxable value of perquisites. Taxable value of gratuity. Taxable value of pension. Taxable value of leave salary. Taxable value of retrenchment compensation, taxable value of voluntary retirement scheme compensation, nothing but VRS compensation, taxable value of provident fund. These are the 13 items we need to consider to get the gross salary, ma. Tell me, what are the 13 items we need to consider to get the gross salary? Basic salary, DNS allowance, bonus, commission, HRA, taxable value of allowances, taxable value of perquisites, taxable value of gratuity, taxable value of pension, taxable value of leave salary, taxable value of retrenchment compensation, taxable value of VRS compensation, and taxable value of provident fund. Understood the point? If you add these 13 items, you will get a gross salary. From gross salary, if you reduce 3 deductions, ma, under section 16. What is the section deals with the deductions here? Under section 16, you will get income from salary or net salary, which will be chargeable to tax. How many deductions we are having under section 16, ma? 3 deductions. Class 1 a standard deduction, class 2 entertainment allowance, class 3 professional tax paid. The standard deduction is up to rupees 50,000. How much, ma? Up to rupees 50,000. what is the discussion relating to up to rupees 50,000? I will explain at the time of discussion of standard deduction. Are you following? Yes. So tell me, what is the procedure to determine income from salary or net salary ma? Chalo, tell me. 13 items, add 13 items, less 3 deductions, you will get income from salary or net salary. Very good. Now, verify those 13 items ma. Verify those 13 items. Please tell me your observation. Verify 13 items. Get me know the observation, your observation relating to those 13 items. If you observe, first 7 items will be received by the employee during the time of employment ma. What are those first 7 items? Basic salary, DNS allowance, bonus, commission, HRA, allowance and perquisites. These 7 items, these 7 payments will be received by the employee from the employer during the time of employment. When it comes to remaining 6 items ma, remaining 6 items, gratuity, pension, leave salary, retrenchment compensation, VRS compensation and provident fund. These 6 items will be received by the employee at the time of retirement or leaving the job or after retirement or leaving the job. Are you following? Yes. That is the importance of those 13 items, and that is the analysis relating to those 13 items. Okay. Next. Income from salary. Note point, my income from salary will be taken into the total income computation. Not basic salary alone, not HRA alone, not perquisite alone, not gratuity alone, but income from salary or net salary will be taken into the total income computation. Next observation 1, we just now we verified. The payments covered under 1 to 7 items will be made by the employer to the employee during the time of employment. Observation 2, the payments covered under 18 to 8 to 13 items will be made by the employer to the employee either at the time of retirement or leaving the job or after retirement or leaving the job. We verified. Next there is a condition required to be satisfied for an income to be taxable under the head income from salary. What is the condition? Let's verify. If you want to charge any income under the head income from salary, there should be a relation of employer and employee between the person making the payment and the person receiving the payment to charge any income under the head income from salary ma. So tell me, what should be the relation? Employer and employee. What if the relation is happen to be principal to principal basis ma, not employer and employee, but the relation is principal to principal basis? Then you cannot charge under the head income from salary. You need to charge either under the head PGBP or under the head IFOS. Now tell me, when we can say that the relation is employer and employee and the relation is principal to principal basis, how can we find whether the relation is employer and employee or principal to principal basis? It is very easy. In case the person making the payment is having control over the person receiving the payment. Come again. If the person making the payment is having control over the person receiving the payment, then you should say the relation is employer and employee basis. Then that income will be taxable under the head income from salary ma. What if the person making the payment does not have the control over the person receiving the payment? Then the relation is said to be principal to principal basis. Then you cannot charge under the head income from salary, but you need to charge either under the head PGBP or under the head other sources. Understood the situation ma? So let's verify the condition. There should be a relation of employer and employee between the person making the payment and the person receiving the payment to charge any income under the head income from salary. Are you following? Good. Next let's verify 13 items one by one In pro forma we are having 13 items. If you add those 13 items, you will get gross salary. From gross salary, if you reduce 3 deductions under section 16, then you will get income from salary or net salary, which will be taken into the total income computation. Are you following? Now let's verify those 13 items one by one. Thereafter, we will verify deductions under section 16. Then we can conclude with income from salary head. Pay attention, ma. First of all, let's go for basic salary. Tell me, what do you mean by basic salary? It is a payment made by the employer to the employee towards services provided by the employee. Ma. Come again. It is a payment made by the employer to the employee towards services provided by the employee will be treated as basic salary. And this amount, this basic salary will be a base for determination of retirement benefits, ma, like gratuity, pension, leave salary, retrenchment compensation, VRS compensation, provident fund. So this is the basis for determination of retirement benefits, and also this is the basis for determination of dearness allowance and bonus in some cases also. Are you following? So this is the basic salary definition, ma. So please tell me, what is the tax treatment for basic salary? Basic salary received by the employee will be fully taxable, fully chargeable to tax without providing any exemption. In case in the question they have given any basic salary amount, what you should need to do, ma? You need to fully charge to tax, because no exemption is available for basic salary. Next, ma. Fully taxable. Okay. Next, dearness allowance. Why the employer is making the payment relating to dearness allowance, ma? Why the employer is making the payment of dearness allowance to the employee? It will be paid by the employer to the employee towards inflation. What is that, ma? Towards inflation. There will be two types of DA, ma. DA without specification, DA with specification. What is the difference? I will explain. DA without specification means, in the agreement, in the employment agreement, they will specify that the DA amount will be 10,000 rupees per month, and they will not specify anything. That is what we mean by without specification. In case it is happen to be without specification, the 10,000 rupees per month DA shall not be considered while determining retirement benefits, ma. Shall be considered or shall not be, na? Shall not be considered. Second case, in the employment agreement, they specified that DA 10,000 rupees per month. Out of that, 50% is relating to retirement benefits, ma. They specified that. In such a case, out of 10,000, 5,000 rupees, nothing but 50% of DA 10,000, 5,000 rupees shall be considered while determining the retirement benefits. That is what we mean by DA without specification and DA with specification, like R2 RB. What do you mean by R2 RB, ma? Relating to retirement benefits. Are you following? Now, what is the treatment for dearness allowance? The dearness allowance is fully taxable, whether it is DA without specification or DA R2 RB, irrespective of the fact. Listen to me carefully. Irrespective of the fact, the DA received will be fully chargeable to tax, ma. Come again. What is the tax treatment for dearness allowance? Fully taxable, irrespective of the fact whether it is R2 RB or not R2 RB. Very important. You need to remember. Next, ma. Fully taxable. Bonus, ma. What do you mean by bonus? Why the employer is making the payment of bonus to the employee, ma? Very simple. This payment will be made by the employer to the employee for the purpose of encouraging the employee. For the purpose of encouraging the employee, and depending upon the financial condition of the organization also. Depending upon the financial condition of the organization also. In case the organization experienced huge profits during that financial period, then they will announce bonus to their employees who contributed their efforts in growth of that organization. Are you following? So, depending upon the financial condition, maybe 2 months salary will be paid as bonus, or 6 months salary will be paid as bonus, or if the financial condition is so good, they will pay 1 year salary as a bonus, ma. So that is what we mean by bonus. For the purpose of encouragement of the employee, the employer will make the payment of bonus. So please tell me, what is the tax treatment for bonus, ma? What is the tax treatment for bonus? The bonus received by the employee will be fully taxable without providing any exemption. 1 rupee exemption is, even 1 rupee exemption is not available, fully taxable in the hands of receiving employee. Remember, very important. Next ma, commission. What is the discussion relating to commission? There are two types of commissions ma. First one is sorry, fixed commission. Second one, fluctuating commission. Come again, what are those? First one is fixed commission. Second one is fluctuating commission. What do you mean by fixed commission? In the agreement, they specified that 2000 rupees per month will be paid as a commission ma. Then tell me, if at all they are paying 2000 rupees per month as commission, then what is the nature of that commission ma? Whether we need to treat it as fixed commission or fluctuating commission. We need to treat it as fixed commission, because every month a standard amount will be received by the employee. What is the standard amount ma? 2000 rupees per month. Hence we need to treat it as fixed commission. Whereas what do you mean by fluctuating commission ma? Say for example, in the agreement they specified that 0.1% of the turnover shall be paid as commission to the sales manager. Assume. What is that? 0.1% of the turnover achieved by that particular sales manager will be paid as a commission ma. That means here we are applying the percentage on turnover. That means if turnover increases, the commission amount will increase. On the other hand, turnover decreases, the commission amount will decrease. Now we need to treat it as fluctuating commission, because it is depending upon the turnover or sales of the organization. Normally this commission will be paid to the sales managers ma, to encourage the sales managers to increase the turnover, because if they increase the turnover, they will get huge commission. Otherwise they will not get a commission at all, in case there is no turnover at all from the side of that sales manager. Are you following? So this will be treated as fluctuating commission in case it is given as a percentage of the turnover. Now the point is, what is the tax treatment for commission? That is very important. First we are verifying definition, next we are verifying tax treatment ma. Are you following? So please tell me, what is the tax treatment for commission? Fixed commission fully taxable, fluctuating commission also fully taxable. There is no exemption ma, both are fully chargeable to tax. Verify. Fixed commission fully taxable, commission as a percentage of turnover ma, nothing but fluctuating commission, this is also fully chargeable to tax. No exemption is available so far. So far we verified 4 items ma. What are those 4 items? Basic salary fully taxable, dearness allowance, all cases whether it is R2RB relating to retirement benefits or not R2RB fully taxable. Bonus fully taxable, commission, both commissions, fixed commission fully taxable, fluctuating commission also fully taxable. Next ma. Next what we need to verify ma? What is the next item in the pro forma? Please tell me, verify and tell me what is the next item. Taxable value of HRA. Come again, taxable value of HRA. Let's verify. Now first I will explain what is the definition of the HRA. Thereafter we will verify the tax treatment for HRA. Are you following? Yes. What is the definition for HRA? A fixed amount paid by the employer to the employee to meet the rental expenditure burden of the employee will be regarded as house rent allowance. Come again ma. A fixed amount paid by the employer to the employee to meet the rental expenditure burden of the employee shall be regarded as a house rent allowance. Now why the employer is making the payment of HRA, which is in addition to the salary ma? This will be paid in addition to the salary. Are you following? Not inclusive of salary, but in addition to the salary, the employer is making the payment of HRA. Why? Because the employee is incurring huge rental expenditure burden. Out of that huge rental expenditure burden, some contribution is made by the employer from his part. So so that employee's burden will reduce, then he will not think about shifting the job from this organization to another organization. Are you following? That means to retain the existing employees, the employer is making the payment of HRMA. What happens if at all you retained existing employees? The labor turnover ratio will be reduced. In case the labor turnover ratio has been reduced, then the organization will experience the growth. Understood the point? So the final motive is growth of the organization, development of the organization. So please tell me, what is the definition of the HRMA? A fixed amount paid by the employer to the employee in addition to the salary to meet the rental expenditure burden of the employee shall be regarded as house rent allowance. Very good. Now, what is the treatment for house rent allowance received by the employee? Please tell me, what is the tax treatment for house rent allowance received by the employee? The HRA received by the employee will be partly taxable and partly exempt. Are you following? What is the tax treatment, It will be partly taxable and partly exempt. Why lawmakers are providing partly exemption, In case the lawmakers charged fully, already the employee is incurring the rental expenditure burden. In addition to that, if you charged fully, he has to incur the tax burden also. Are you following? So that's why the lawmaker says that I will not tax, I will not charge fully, I will charge part of that HRA received and partly I will provide it as a exemption. Are you following? Now, what is the section providing exemption for HRA? Please tell me. If at all, first of all tell me, if at all it is partly taxable and partly exempt, what is the pro forma, what is the format to determine taxable value of HRA? Please tell me. If at all it is partly taxable and partly exempt, what is the format to determine taxable value of HRA? First, we need to consider HRA received. What is that, HRA actually received. Less exemption under section. Please tell me the section dealing with exemption providing to HRA 10 subsection 13A. Remember, so many times appeared in the examination, the HRA computation, you have to remember 10 subsection 13A providing exemption to the HRA. So what is the format here? HRA received less exemption under section 10 subsection 13A, then balance will be taxable value of HRA that will be chargeable to tax. Partly taxable and partly exempt under section 10 subsection 13A. What is the format? HR actually received less exemption under section 10 subsection 13A, then you will get a taxable value of HRA. Now tell me, what is the exemption under section 10 subsection 13A? List of the following. The exemption under section 10 subsection 13A is a list of the following. Three things we need to consider. How many things? Three things we need to consider. First one, HRA actually received. What is the first one, HRA actually received. Second one, in case the accommodation is located at CCDM, Chennai, Kolkata, Delhi, Mumbai. If the accommodation is located at Chennai, Kolkata, Delhi, Mumbai, then 50% of salary. Any other area, if it is happened to be any other area, 40% of salary we need to consider under B part. So please tell me, what is B part, If accommodation is located in Chennai, Calcutta, Delhi, Mumbai, then we CCDM. Easy remembrance. I have given the short form as CCDM. If the accommodation is located at CCDM, what do you mean by CCDM? Chennai, Calcutta, Delhi, Mumbai. Then we need to verify, we need to consider 50% of salary. In case of any other area, we need to consider 40% of salary. Next, C part, rent paid minus 10% of salary. Come again, rent paid minus 10% of salary. Least we need to determine. That least will be provided as exemption. Balance will be chargeable to tax. Are you following? Yes. Next, So let's verify. Now tell me, what is exemption under section 10 subsection 13A? List of the following three things we need to consider. First one, HRA actually received. Second one, if the accommodation is located at CCDM, Chennai, Calcutta, Delhi, Mumbai, 50% of salary, any other area, 40% of salary. Last part, C part, rent paid minus 10% of salary. Next, the following are the three cases where HRA received will be fully chargeable to tax without providing any exemption under section 10 subsection 13A. Tell me what is that situation says? There are three situations, there are three cases where the HRA received by the employee will be fully taxable without providing 1 rupee of exemption under section 10 subsection 13A. My question, why lawmaker is providing exemption under section 10 subsection 13A to the employee Because he is already incurring the rental expenditure burden. If we again charge fully, it will be additional burden to the employee. That's why by considering the situation of that employee who don't have the own house, own property, own accommodation facility, they are providing what? Exemption under section 10 subsection 13A by considering the rental expenditure burden of the employee. Now please tell me, considering that fact behind providing the exemption, please tell me what are the possible cases where the HRA received by the employee will be fully taxable without providing any exemption under section 10 subsection 13A Very easy. The employee is not incurring the rental expenditure burden. Simple the employee is not incurring the rental expenditure burden. If at all the employee is not incurring the rental expenditure burden, any need for the lawmakers to provide exemption to that particular employee Obviously no. So tell me, when the employee will not incur any rental expenditure burden Very simple. The employee is residing in his own house. The employee is residing in his own house, but still the employer is making the payment of HRA to the employee. In such a case, without providing any exemption under section 10 subsection 13A, pura HRA received will be fully chargeable to tax. Understood the point? That is the first case What is the second case? The employer is residing in friend's house or relative's house The employee is residing in any other house, in any other premises, but not incurring the rental expenditure burden. That means he is residing in the premises of friends or premises of relatives Therefore, they are not charging anything in return. In such a case, he is not residing in his own house, but is residing in any other premises, but not incurring rental expenditure burden because that house belongs to their friends or relatives. In such a case, the HR received will be fully taxable without providing any exemption under section 10 subsection 13A. Are you following? That is the second case Third case, the rent expenditure does not exceed 10% of salary. Come again. The rental expenditure does not exceed 10% of salary. That means if you consider in the exemption determination last thing, what is the last part? C part, rent paid minus 10% of salary. That means in addition to the 10% of salary, the rent payment alone will be provided as exemption in case it is the least of the following. Are you following So what lawmakers is trying to communicate, if you don't have the minimum burden of 10% of salary, then I will not provide any exemption towards HRA under section 10 subsection 13A. That means to provide exemption under section 10 subsection 13A, minimum percentage should be more than 10% of the salary In case your rental expenditure burden is less than or equal to 10% of salary, then department will not consider it as a rental expenditure burden to the employee. They will not provide any exemption under section 10 subsection 13A, because if you verify the C part, rent paid minus 10% of salary in case rent payment is less than or equal to 10% of salary, then it will be resulted into negative or zero In such a case, what is provided as exemption means 0. That means HR received is fully chargeable to tax. Are you following? Yes. Case 1, employee is residing in his own house, therefore not incurring any rental expenditure burden. Case 2, employee is residing in relative premises or friends premises, therefore not incurring any rental expenditure burden. Next, the rent payment does not exceed 10% of salary. That means the rental expenditure burden is less than or equal to 10% of salary. Very good. Important points How to determine 50% of salary or 40% of salary or 10% of salary? That salary should have the definition What is the salary definition Very, very important. You have to remember. Basic salary, basic plus DA R2RB. Here we need to consider DNS elements only when it is R2RB. That means specified so. In case without specification any DA given in the question, don't consider for the purpose of computation of salary ma. For the purpose of salary definition, don't consider that. So please tell me what is salary definition ma? Basic plus DR to RB plus commission as a percentage of turnover. That means we need to consider only fluctuating commission. Fixed commission should not be considered. Remember. For the purpose of next point ma, for the purpose of determination of exemption under section 10 subsection 13A, the salary shall be considered on due basis ma. What do you mean by salary shall be considered on due basis? That means in case if you received any advance salary, that shall not be considered in the above definition for the purpose of determination of exemption under section 10 subsection 13A. Very important. One line summary, consider on due basis. That means any advance salary received shall be ignored. Next point ma, for the purpose of determination of exemption under section 10 subsection 13A, the salary shall be considered only for the period for which the rental expenditure burden incurred by the employee. What is the meaning of for the period for which the rental expenditure burden incurred by the employee ma? The employer is making the payment of HRA for 12 months ma. For 12 months employer paid HRA to the employee, whereas 8 months that employee resided in relatives premises and not incurred any rental expenditure burden ma. Only 4 months he resided in the rented premises and paid rent to the owner ma. Are you following? In such a case, but he received HRA for 12 months. In such a case, for how many months the exemption will be available means only for the period for which the employee incurred the rental expenditure burden, nothing but 4 months. That means while determining the salary definition, the basic salary shall be multiplied with 4 months, DR to RB shall be multiplied with 4 months, and commission as a percentage of turnover shall be considered only for 4 months ma, nothing but the period for which the rental expenditure burden incurred by the employee. Are you following? Next, for the purpose of claiming exemption under section 10 subsection 13A, salary shall be considered for the period for which HRA is received by the employee. Obviously, during the previous year 21-22, assume the employee received HRA only for 9 months ma. Out of 12 months, he received HRA only for 9 months. In such a case, we need to consider the salary above salary definition for 9 months to determine exemption under section 10 subsection 13A. That is what we mean by for the period for which the HR actually received by the employee. Next ma. That is the discussion relating to HRA ma. Next, let's verify allowances. Let's verify allowances ma. What do you mean by allowance? I will explain definition first of all. It is a fixed amount paid by the employer to the employee in addition to the salary for a specific purpose shall be treated as allowance ma. Come again. A fixed amount paid by the employer to the employee in addition to the salary for a specific purpose shall be treated as allowance ma. The question is, why the employer is making the payment of allowance which is in addition to the salary? Already he is paying salary ma. In addition to that, why he is making the payment of allowance to the employee? The objective is very simple, to retain the existing employees and to reduce the labor turnover ratio. In case the labor turnover ratio is reduced, then the organization will experience the growth or development. That is the only motive behind the payment of allowance ma. Now when we get into the allowance concept, there are 4 parts of allowances ma. How many? 4 parts of allowances, each part having its own tax treatment. Each part of allowances are having its own tax treatment. Let's verify one by one. Part 1 allowances, the allowances covered under part 1 are eligible for exemption ma. The allowances which are covered under part 1 are eligible for exemption under section 10 subsection 14. What is the dealing section ma? 10 subsection 14, eligible for exemption, but the exemption is completely depends upon amount spent for official purpose ma. Come again. It is completely depends upon amount spent for official purpose. In case in the examination the allowances covered under part 1 has been given, then they will provide the information relating to amount spent for official purpose. Also consider that information, provide exemption accordingly, balance will be chargeable to tax. That is the discussion relating to allowances covered under part 1. When it comes to allowances covered under part 2, these allowances are also eligible for exemption. These allowances are also eligible for exemption, but the exemption is completely depends upon the amount specified by income tax department. What is that? Amount specified by income tax department. In case the allowances covered under part 2 provided given in the examination in the question, then you need to remember what is the amount specified by the department. Then up to that amount you need to provide exemption, balance will be chargeable to tax. Next, the allowances covered under part 3 are fully taxable without providing any exemption. Come again, the allowances covered under part 3 will be fully taxable without providing any exemption. In case the allowances covered under part 3 given in the question, what you need to do without providing any exemption, you need to charge fully. Next, the allowances covered under part 4, they are fully exempt. Total 4 allowances we are having under part 4. Remember, very easy. Part 4, 4 allowances. What is the treatment for those 4 allowances? Fully exempt. So come again, what is the tax treatment for 4 allowances covered under 4 parts? Part 1, exemption available depending upon amount spent for official purpose. Part 2, exemption available depending upon amount specified by income tax department. Part 3, fully taxable. Part 4, fully exempt. Now let's verify one by one. What is the dealing section providing exemption? 10 subsection 14. Definition: a fixed amount paid by the employer to the employee in addition to the salary for a specific purpose will be regarded as allowance. Very good. The following are the objects behind making the payment of allowance. Already I explained, to retain the existing employees and to reduce labor turnover ratio. As a result of this, organization will grow. Very good. Next, part 1 allowance. Let's verify. Total 6 allowances covered under part 1. How many allowances? 6 allowances covered under part 1. Let's verify one by one. These are the allowances partly taxable and partly exempt under section 10 subsection 14. Exemption is depends upon amount actually spent for official purpose. Very good. That will provide, the information will provide in the question itself. Don't worry. Now let's verify. Okay, part 2 allowances. These allowances are partly taxable and partly exempt under section 10 subsection 14. And exemption is purely depends upon amount specified by income tax department. Very good. Part 3 allowance, these are fully taxable. Part 4 allowance fully exempt. Chalo. Let's start with part 1 allowances. What is the treatment for part 1 allowances? The exemption is available under section 10 subsection 14, whereas the exemption is depending upon the amount spent for official purpose. Let's verify one by one. First one, transfer or travel allowance. What do you mean by transfer or travel allowance? A fixed amount paid by the employer to the employee towards traveling expenditure of the family members and transportation expenditure of the furniture on the occasion of transfer of employee from one place to another place will be regarded as transfer or travel allowance. That means at the time of transferring the employee from one place to another place, the employer will pay the transfer or travel allowance to incur the expenditure towards shifting the family members as well as shifting the furniture. Then what is the treatment? It will be eligible for exemption under section 10 subsection 14 to the extent amount spent for official purpose. Next, daily allowance. What is the meaning of daily allowance? A fixed amount paid by the employer to the employee in addition to the salary towards food expenditure, traveling expenditure and accommodation expenditure of the employee at a place other than normal place of duty. Come again, at a place other than normal place of duty. What do you mean by that sentence? Say for example, employee's working location is Hyderabad. The employer sent the employee to Mumbai for completion of a particular project work for 10 days. These 10 days, the employee is incurring the food expenditure, traveling expenditure and accommodation expenditure. Who has to pay for the same means the employer, because he is on official duty purpose. Now he is paying to that employee by way of daily allowance. Now what is the treatment for the daily allowance? Exemption is available to the extent amount spent for official purpose. Any savings are there in case that will be chargeable to tax. Next ma, chargeable to tax in the hands of whom? Employee. Yeah. Next, conveyance allowance. What do you mean by conveyance allowance? A fixed amount paid by the employer to the employee towards food expenditure, traveling expenditure within the city. Daily allowance is outside the city ma. When it comes to conveyance allowance, it will be paid within the city. What is the treatment? Same. It will be provided as exemption under section 10 subsection 14 to the extent amount spent for official purpose. Next ma, uniform allowance. What do you mean by uniform allowance? A fixed amount paid by the employer to the employee in addition to the salary towards purchase of uniform. Towards what? Purchase of uniform. Say for example, the company is maintaining uniform to their workers, and to purchase those uniforms, they are paying something to the workers. And even in some companies, they are asking the employees to maintain uniform. Then the company is paying the amount to the employees for purchase of uniform by way of uniform allowance. What is the treatment? It will be eligible for exemption under section 10 subsection 14 to the extent amount spent for official purpose. Next ma, helper allowance. What do you mean by helper allowance? A fixed amount paid by the employer to the employee towards appointing the helper or engaging the helper to complete the project work within the specified time limit prescribed by the employer. Understood the point? The employer handed over some particular project to the employee, and he directed the employee that it must be completed within 10 days ma. To complete that project within 10 days, he has to appoint a certain number of helpers. For that purpose, the employer is paying helper allowance. It will be eligible for exemption to the extent amount spent for official purpose. Any savings are there that will be chargeable to tax as a taxable value of helper allowance. Next ma, research allowance. What do you mean by research allowance? A fixed amount paid by the employer to the employee in addition to the salary for updation of employee. What is that? For updation of employee, for gaining knowledge by the employee. The employer is paying something to the employer. Some amount has been paid by the employer to the employee. That will be treated as research allowance towards updation of employee. So these are the 6 allowances covered under part 1 mass. Tell me the list of the 6 allowances covered under part 1. First one, transfer or travel allowance, daily allowance, conveyance allowance, uniform allowance, helper allowance, research allowance. What is the treatment? It will be eligible for exemption under section 10 subsection 14 to the extent amount spent for official purpose. Any savings are there that will be chargeable to tax. Next ma, let's verify the format to determine taxable value of allowance for part 1 allowances ma. Format for determination of taxable value of allowance. Particulars, amount column. What is the format? First we need to consider, what we need to consider ma? Allowance actually received. Let's verify with the help of transfer allowance ma. Consider transfer allowance is received by the employee. Let's verify format for the transfer allowance. The same format we need to apply for the remaining 5 allowances. Chalo. Transfer allowance received. Consider actually received. Then you need to reduce exemption under section 10 subsection 14. Then you will get a taxable value of allowance. Then how to determine exemption under section 10 subsection 14 ma? It will be list of the following. It will be up to the list of the following. Two things we need to consider. First one, allowance actually received. What is the first one ma? Allowance actually received. Second one, amount spent for official purpose. Amount spent for official purpose. List will be provided as exemption under section 10 subsection 14. Balance will be chargeable to tax. This is the format to determine taxable value of allowance for allowances covered under, what is that? Allowances covered under part 1. Next ma, part 2 allowances. What is the treatment for part 2 allowances ma? For part 2 allowance also exemption is available under section 10 subsection 14, but the exemption is depending upon the amount specified by income tax department. What is that? Amount specified by income tax department. That means in case part 2 allowance has been provided, given in the examination, you have to remember what is exemption given by the department for that particular allowance ma. Then only it is possible for you to determine taxable value of allowance in case of part 2 allowances. Chalo, let's verify one by one. Children education allowance. For every allowance, 2 points we are going to discuss. First point, meaning of that particular allowance. Second point, exemption specified by the, that means amount specified by the department we need to discuss. 2 points for each allowance. Children education allowance. What is the definition? What is the meaning, ma? A fixed amount paid by the employer to the employee towards children. Employees' children education will be treated as children education allowance. Please tell me what is exemption in case of children education allowance or amount specified by the department for providing exemption under section 10 subsection 14, ma. Please tell me. 100 rupees per month per child, maximum 2 children. Remember, what is that? 100 rupees per month per child, maximum 2 children. That means 100 rupees into 2 children into 12 months. How much, ma? 2,400 rupees will be provided as exemption out of actual children education allowance received by the employee. Balance will be chargeable to tax. In short, 100 PMPC max 2C, ma. What is that? 100 PMPC max 2C in short. Next, ma. Children hostel allowance. What do you mean by children hostel allowance? A fixed amount paid by the employer to the employee towards a hostel expenditure of the employee's children will be regarded as children hostel allowance. What is exemption, ma? 300 rupees per month per child, maximum 2 children. Restriction is there on maximum children for claiming exemption. So what is the exemption, ma? 300 rupees per month per child, maximum 2 children. In short, 300 PMPC max 2C. Come again, 300 PMPC max 2C. Next, ma. Tribal area allowance. What do you mean by tribal area allowance? It will be paid to the employees who are working in the tribal area. It will be paid to the employees who are working in the tribal area. What is the exemption, ma? 200 rupees per month per employee. Come again, 200 rupees per month per employee will be provided as exemption under section 10 subsection 14. Balance will be chargeable to tax. Next, ma, underground allowance. What do you mean by underground allowance? It will be paid to the employees who are working under the ground. That means mines, ma, coal mine, etc. So the employees of mining company will get what is that? Underground allowance, because there is a life threat to the workers who are working under the ground. In recognition of that, employer needs to pay underground allowance, ma. So what is exemption available under section 10 subsection 14 when it comes to underground allowance, ma? 800 rupees per month per employee. Remember, what is that? 800 rupees PMPE. PMPE means per month per employee. Next, ma. Transport allowance. What do you mean by transport allowance? A fixed amount paid by the employer to the employee towards commuting between place of residence to place of employment. Come again, ma. Towards, for the purpose of commuting between place of residence to place of employment shall be treated as transport allowance. My question, what is the exemption available in case of transport allowance under section 10 subsection 14, ma? For the purpose of determination of exemption, we need to bifurcate the employees into 2 categories, normal employee and handicapped employee. What is that, ma? Normal employee and handicapped employee. In case of normal employee, there is no exemption, fully taxable. Remember, so many times appeared in the examination. Remember. So earlier there was an exemption of rupees 1600 per month per employee, ma, with respect to the transport allowance received by the normal employee. But through Finance Act 2018, that exemption has been withdrawn. Now there is no exemption relating to the transport allowance for normal employee. It will be fully taxable without providing any exemption. When it comes to handicapped employee, exemption is available up to rupees 3,200 rupees per month per employee. Come again, ma. 3,200 rupees per month per employee. So very important point, remember, transport allowance received by the normal employee fully taxable without providing any exemption. When it comes to handicapped employee, if they specified that employee is handicapped employee in the examination, then what you need to provide? Up to rupees 3,200 rupees per month per employee will be provided as exemption under section 10 subsection 14. Next, ma. Running allowance. What do you mean by running allowance? It is a fixed amount paid by the employees to the employees who are working in the transportation undertaking. Who are working in the transportation undertaking. That means it will be paid to the employees of transportation companies, ma. Running allowance. What is eligible for exemption? What is the exemption specified by the department under section 10 subsection 14? The exemption is list of the following. Two things we need to consider. 70% of allowance received are rupees 10,000 rupees per month. Whichever is lower will be provided as exemption under section 10 subsection 14. Balance will be chargeable to tax. Come again. What is exemption ma? List of the following. Two things we need to consider. First one, 70% of allowance received. Second one, 10,000 rupees per month standard amount, whichever is lower, shall be provided as exemption. Next ma, hill compensatory allowance ma. What do you mean by hill compensatory allowance? It will be paid to the employees who are working in the hilly areas. Who are working on the hilly areas, they will get the hill compensatory allowance from their employer. What is exemption? In case the height of the hill is located at a height of 1000 meters or above, at a height of more than 1000 meters ma, then the exemption will be 300 rupees per month per employee. Second case, in case that area is notified by the central government, the exemption will be 800 rupees per month per employee. In case the hill is located at Jammu and Kashmir, then the exemption will be up to rupees 7,000 rupees per month per employee. So depending upon the situation, either 300 or 800 or 7,000. Let's verify. Exemption under section 10 subsection 14 as follows. If the hill is located at a height of more than 1000 meters from the sea levels, exemption will be up to rupees 300 rupees per month per employee. Next ma, if the area is notified by the central government, exemption will be up to rupees 800 rupees per month per employee. Next ma, if the hill is located at Jammu and Kashmir, exemption will be up to rupees 7,000 per month per employee. Are you following? So these are the 7 allowances covered under part 2 ma. Could you please get me the list of the part 2 allowances? Total 7 allowances we have discussed. Important allowances we have discussed. Can you please get me the list? Children education allowance 100 PMPC max 2C. Good. Children hostel allowance 300 rupees PMPC max 2C. Next ma, tribal area allowance 200 rupees PMPE per month per employee. Then underground allowance 800 rupees per month per employee. Transport allowance ma. What is the exemption for transport allowance? Normal employee, no exemption, fully taxable. Handicapped employee, up to rupees 3,200 per month per employee. And running allowance, list of the following. 70% of allowance received are 10,000 per month, whichever is lower. Then hill compensatory allowance, depending upon the situation, either 300 or 800 or up to rupees 7,000 per month per employee. Next ma. Now let's verify the format to determine taxable value of allowance in case of part 2. Let's verify. Let's take children education allowance as example for this format here. Consider that children education allowance received, consider actual allowance received less exemption under section 10 subsection 14, then you will get taxable value of allowance ma. Then what we need to determine now? Exemption under section 10 subsection 14. The exemption will be up to the list of the following. Two things we need to consider. First one, as usual, children education allowance actually received. Second one ma, amount specified by income tax department. Come again, amount specified by income tax department. Then list will be provided as exemption, balance will be chargeable to tax. This is the treatment, this is the pro forma we need to follow if at all the allowance given in the examination is belongs to part 2. Are you following? Good. Next ma, part 3 allowance. What is the speciality of the part 3 allowance ma? Please tell me. What is the speciality of the part 3 allowance? Part 3 allowance will be fully chargeable to tax without providing any exemption under section 10 subsection 14. Very important. Chalo. Fully taxable. Dearness allowance already we discussed at the time of discussion of pro forma. Dearness allowance, it will be paid towards inflation, compensate the inflation. What is the treatment? Fully taxable, whether the DA is R2RB or not R2RB, relating to retirement benefit or not, the DA received is fully taxable. I have already explained. Next ma, entertainment allowance, it will be paid by the employer to the employee towards refreshment of the customers ma. The chargeability is fully taxable. Next, medical allowance, it will be paid towards medical expenditure of the employee or family members or children, fully taxable. Telephone allowance will be paid towards the telephone expenditure of the employee, fully taxable. Tiffin allowance will be paid towards breakfast and other food expenditure of the employee, fully taxable. Overtime allowance might will be paid to the employees who are working overtime, fully taxable. Night duty allowance will be paid to the employees who are working in the night duties, fully taxable. Warden allowance will be paid to the wardens, will be fully taxable. Then servant allowance will be paid towards maintenance of the servant, fully taxable. Gift allowance, fully taxable. Special allowance, that includes interim allowance, project allowance, non-practicing allowance, fully chargeable to tax. Then transport allowance received by normal employee, fully chargeable to tax. Why it is covered here? Because the chargeability is full. There is no exemption. Hence again we have covered under part 3, which comes under fully taxable. Next city compensatory allowance will be paid towards cost of living in a particular city. Towards cost of living in a particular city will be fully chargeable to tax. These are the 13 allowances covered under part 3 which are fully chargeable to tax. Next part 4 allowance. What is the speciality of the part 4 allowance? Fully exempt from tax. Fully exempt from tax. Under part 4 we are having 4 allowances. Try to remember. First one, the allowance paid by the central government to their employees who are working outside India, who are providing services outside India, nothing but embassy employees. Nothing but Indian embassy employees. The central government is providing any allowances to them fully exempt from tax without providing without charging anything. Next any allowances paid by the UNO to their employees, United Nations Organization paid any allowances to their employees fully exempt from tax. Next sanctuary allowance paid to the judges of High Court and Supreme Court fully exempt from tax. Compensatory allowance paid to the judges of High Court and Supreme Court fully exempt from tax. These are the 4 allowances which are fully exempt. With this, we successfully completed the discussion relating to the allowances. Now, what is pending? Retirement benefits are pending. How many retirement benefits we are going to discuss? Gratuity, pension, leave salary, retrenchment compensation, VRS compensation, provident fund. Total 6 retirement benefits we need to discuss. Let's verify one by one. Chalo. Focus sheets I am not going to explain because the videos relating to the focus sheets, entire focus sheets discussion has already uploaded in the YouTube channel. You can visit and you can watch, no problem. Chalo let's start with first retirement benefit. What is that? Gratuity. Tell me what is very important concepts I am going to explain. Pay attention Gratuity. What is the section providing exemption for gratuity? Section 10 subsection 10. What is that? Section 10 subsection 10. Okay. First of all, let's verify the definition. What do you mean by gratuity? A lump sum amount paid by the employer to the employee at the time of retirement or leaving the job shall be treated as gratuity. Come again. A lump sum amount paid by the employer to the employee at the time of retirement or leaving the job shall be regarded as gratuity. Now, what are the various occasions the gratuity will be received by the employee? There are 2 occasions. Occasion 1, the gratuity amount received by the employee during the time of employment. Occasion 2, the gratuity received by the employee at the time of retirement or leaving the job. Are you following? Tell me, is it possible for the employee to get the gratuity during the time of employment? Obviously, yes. Because the gratuity amount belongs to the employee, he can receive whenever he wants. Understood the point? Even though if there is any requirement during the time of employment, even though he is in the employment, still the employer will pay the gratuity amount to the employee. There is no problem to the employer. Are you following? So what are the 2 occasions for receipt of gratuity? Occasion 1, the gratuity amount received by the employee during the time of employment. Occasion 2, at the time of retirement or leaving the job. Let's verify the tax treatment in each and every occasion. Okay. If at all the gratuity amount is received during the time of employment, please tell me what is the tax treatment? Is it possible to provide exemption under section 10 subsection 10 for gratuity received during the time of employment? The lawmaker says, if you want to claim exemption under section 10 subsection 10 relating to the gratuity amount, it must be received at the time of retirement or leaving the job, but not during the time of employment. Tell me, gratuity is retirement benefit or during the time of employment benefit? It is meant for retirement benefit or during the time of employment benefit? It is a retirement benefit. The lawmaker says, I will provide exemption under section 10 subsection 10 only when the retirement benefit is received as retirement benefit. Come again. Only when the retirement benefit is received as a retirement benefit. That means you must receive at the time of retirement or leaving the job, but not during the time of employment. Therefore, any gratuity received during the time of employment, remember, it is fully chargeable to tax in the hands of both government employees as well as non-government employees. Very important. Even though that employee is government employee, but still chargeable to tax in case that government employee received the gratuity during the time of employment. Very important point. So tell me, one line summary, what is the tax treatment for the gratuity received during the time of employment? Will be fully taxable in the hands of both the government employees as well as non-government employees. Next, what if the gratuity received at the time of retirement or leaving the job? Then we need to verify what is the category of the employee, what is the status of the employee. In case the employees happen to be government employee, the lawmaker says it will be fully exempt from tax under section 10 subsection 10. So the gratuity received by the government employee at the time of retirement or leaving the job will be fully exempt from tax under section 10 subsection 10. Why? The lawmakers are providing full exemption to the government employees receiving gratuity at the time of retirement or leaving the job, in recognition of the past public services provided by them. Come again. In recognition of the past public services provided by them, the lawmakers are providing full exemption. What if it is received by the non-government employees, they are not providing full exemption and they are not charging fully? Partly taxable, partly exempt. Come again, partly taxable, partly exempt. If at all it is partly taxable and partly exempt, what is the format to determine taxable value of gratuity? Particulars, amount column, gratuity actually received, less exemption under section 10 subsection 10, then you will get taxable value of gratuity. That is the format. Now what we have to discuss here, what is the exemption under section 10 subsection 10? How to determine exemption under section 10 subsection 10 we need to discuss. So let's verify how to determine exemption under section 10 subsection 10. The exemption under section 10 subsection 10 is purely depends upon the fact called whether the employee is covered under Payment of Gratuity Act 1972 or not covered under Payment of Gratuity Act 1972. Two facts. In case the employee is covered under Payment of Gratuity Act 1972, the determination procedure is different. The exemption computation procedure is different. In case the employee is not covered under Payment of Gratuity Act 1972, the procedure is different. So first of all, let's verify the procedure for determination of exemption in case of employee covered under Payment of Gratuity Act 1972. The exemption under section 10 subsection 10 is up to the list of the following. Up to the list of the following. Three things we need to consider. How many things, Three things. First one, statutory limit 20 lakhs. Second one, gratuity actually received. Third one, 15 by 26 into last done salary into number of years of service. List of these three things will be provided as exemption. Balance will be chargeable to tax. Come again. You have to remember, you're supposed to remember. Please tell me how to determine exemption in case of employee covered under Payment of Gratuity Act 1972. Please. List of the following three things we need to consider. First one, statutory limit 20 lakhs. Second one, gratuity actually received. Third one, 15 by 26 into last drawn salary into number of years of service. What is last drawn salary? What is number of years of service? I will explain little bit later. First to try to understand how to determine exemption. Next, what if it is not covered under Payment of Gratuity Act 1972? In case it is not covered under Payment of Gratuity Act 1972, the exemption also here also list of the following. Three things we need to consider. First two things is same as above. What is the first two things? First one, statutory limit 20 lakhs. Second one, gratuity actually received. But third one, formula will be changed. What is the revised formula here? Half into 10 months average salary into number of completed years of service. What is that? Half into 10 months average salary into number of completed years of service. How to determine that? What is the meaning? I will explain little bit later. So this is the procedure in case of covered and not covered. So one by one, let's verify covered case and not covered case. Important points. Employee covered under Payment of Gratuity Act 1972. First, let's verify. Before getting into that, please tell me, how can we say that a particular employee is covered or not covered? How to find out the fact whether a particular employee is covered under Payment of Gratuity Act 1972 or not covered? Please tell me. It is purely depends upon the company in which the employee is working. Come again. It is completely depends upon the company in which the employee is working. In case the company is covered under Payment of Gratuity Act 1972, then the employees who are working in that particular company will be treated as employees covered under Payment of Gratuity Act 1972. Second case, in case company is not covered under Payment of Gratuity Act 1972, then the employees who are working in that company will be getting the status of the employees not covered under Payment of Gratuity Act 1972. So it is completely depends upon the organization in which the employees are working. So let's verify one by one. What is the definition for salary in case of covered case? What do you mean by last drawn salary? What are the various elements included in the technical term called last drawn salary? Let's verify. Last drawn salary means basic plus DA, any DA. Basic salary plus DA, any DA. Last drawn basic salary plus last drawn DA, that is any DA. That means whether it is relating to retirement benefits or not relating to retirement benefits, any DA we shall consider. That is what we mean by any DA. Understood the point? Little bit later, I am again explain what do you mean by any DA. Pay attention. Next, that is last drawn salary definition. What is LDS definition? Salary definition here. Last drawn basic plus last drawn DA, any DA. Per month we need to consider last drawn. Number of years of service. What is the meaning of number of years of service? Number of completed years of service plus part of the year in excess of 6 months shall be treated as one full year. Come again. Number of completed years of service. Completed years of service consider plus part of the year in excess of 6 months alone we need to treat as one full year. In case it is less than 6 months or equal to 6 months, don't treat it as one full year. That is what we mean by number of years of service. For better understanding, I have provided examples. Pay attention. Example 1, 30 years 4 months. 30 years 4 months means, consider the definition, apply the definition. Number of completed years of service. How many completed years of service is there? 30 years plus part of the year in excess of 6 months shall be regarded as one full year. Here in excess of 6 months is there or less than 6 months? It is 4 months, means less than 6 months. Hence that shall not be treated as one full year. That means here number of years of service is 30 years only. Next, 30 years 9 months. 30 years fully completed plus 9 months means exceeding 6 months. That shall be treated as one full year. In such a case, it will be treated as 31 years. Are you following? Next, my example 3, last example. 30 years 6 months. 30 years 6 months. Please tell me, it is 30 years or 31 years, 30 or 31? First 30 years we need to consider plus 6 months, Tell me when we need to treat it as one full year. Only when it is in excess of 6 months. That is important. That point is important. In excess of 6 months, here it is equal to 6 months. There is no in excess. Hence that 6 months shall not be treated as one full year. Hence it will be 30 years only. It will be 30 years only. That is the detailed analysis relating to number of years of service. Next, example 4, 30 years 6 months and 1 day. 30 years 6 months and 1 day. Then it is what? 30 years fully completed plus 6 months and 1 day. That means excess of 6 months, right? that shall be treated as 1 full year. In such a case, it will be treated as 31 years. This is the last example. Understood? Analysis. Next ma. Important points relating to not covered under Payment of Gratuity Act. First of all, let's verify how to determine 10 months average salary, because what is the third one? List of the following. In the list of the following, what is the third one ma? Please tell me. Half into 10 months average salary into number of completed years of service. Then how to determine 10 months average salary we need to discuss. So before getting into determination of 10 months average salary, let's verify how to determine 10 months period ma. Once we determine 10 months period, then it is very easy to determine 10 months average salary. So how to determine 10 months period? What is 10 months period we need to consider here? Period of 10 months, a period of 10 months immediately preceding to the month of retirement. What is that? Period of 10 months immediately preceding to the month of retirement. What is that? I will explain with the help of example. Pay attention. Date of retirement is 15th January 2022 ma. 15th January 2022. What is the month of retirement there? January month. Then how to determine 10 months period? Period of 10 months immediately preceding to the month of retirement. That means you need to ignore the month of retirement. By ignoring the month of retirement, preceding 10 months period we need to consider. That means we need to ignore January month. Then what is preceding 10 months period ma? March to December. March to December. Are you following? Next, example 2. Date of retirement 31st December 2021. What we need to ignore here? Month of retirement we need to ignore. What is month of retirement ma? Please tell me. What is month of retirement? December. Ignore. Then February to November. That is the 10 months period. February to November. Next ma. So we successfully discussed regarding 10 months period. Now it is very easy to go for 10 months average salary. How to determine 10 months average salary? Before that, before getting into that, let's verify salary definition. What is salary definition? Basic plus DA R2RB. What is that ma? DA R2RB. Here we need to consider dearness allowance only when it is given in the question that relating to retirement benefit. In case it is not relating to retirement benefit, don't consider the DA here. You need to put 0 there. Understood the point? So basic plus DA R2RB plus commission as a percentage of turnover we need to consider. That means fixed commission must be ignored. Fixed commission must be ignored. We need to consider commission as a percentage of turnover. So tell me, what is the salary definition ma? Basic plus DA R2RB plus commission as a percentage of turnover. This must be considered for the above determined 10 months period. The salary definition must be considered for above determined 10 months period. Then you will get a 10 months average salary. So let's verify the procedure. 10 months average salary equal to 10 months into basic plus DA R2RB plus commission as a percentage of turnover. That is for 1 month ma. The salary definition for 1 month divided by 10. So multiply the 1 month salary definition with 10 months and divide with 10. You will get a 10 months average salary. So that is the discussion to determine 10 months average salary ma. Next, what do you mean by number of completed years of service? Number of completed years of service means number of fully completed years of service. That means out of 365 days, entire 365 days must be completed to treat it as 1 full year. Are you following? Say for example, employee retired after providing service of 30 years, 364 days ma. 30 years, 364 days. Then what do we mean? What is number of completed years of service here? 30 years only. Because the 364 days you cannot treat it as 1 full year. Because what is the meaning of number of completed years of service? Full completed years of service. It is not completed in full because only 364 days completed, not 365. Don't consider it as 1 year. So here that will be 30 years only. That is the meaning of number of completed years of service ma. I hope you understood well. Next, 30 years 4 months, 30 years only. 30 years 9 months, 30 years only. 30 years 11 months, 29 days, 30 years only. Understood? Next, analysis of dearness allowance included in the salary definition under covered case and not covered case ma. Yes. beneficial for you. Pay attention. In case of covered case, what is the last done salary definition? Basic plus DA, any DA. Not covered case, my salary definition, basic plus DA R2RB plus commission as a percentage of turnover. That means covered case DA, any DA, not covered case DA R2RB. Let's verify how to apply. Serial number, particulars, covered case, not covered case. First one ma, DA ma 10,000 rupees, 50% is R2RB, 50% is R2RB. Then for covered case, how much we need to consider? Entire DA received, whether it is R2RB or not R2RB. That is what you mean by any DA ma. That is what you mean by any DA. How much we need to consider? 10,000. When it comes to not covered case, only the DA which is R2RB we need to consider. Out of 10,000, what is R2RB? 5,000 only, 50%. Understood? Next, my second one, 10,000 rupees, 10% of, okay, DA received is 10,000, 10% is R2RB. Then for covered case, it is 10,000, not covered case, 1,000 only, R2RB. Next, ma, DA, 10,000, 100% is R2RB, ma, 100% is R2RB. For covered case, any DA means 10,000, not covered case, DA R2RB means 10,000, pura it is R2RB. Next, ma, DA 10,000, there is no specification. There is no specification. Then for covered case, any DA we need to consider means 10,000. But when it comes to not covered case, we need to consider DA R2RB. There is no R2RB, hence it will be 0, nil. Understood the point? This is how to apply any DA as well as DA R2RB. I hope you understood well. Next, ma, statutory limit. Yes, very important discussion. Pay attention. What is the statutory limit? 20 lakhs. For covered case 20 lakhs, not covered case also 20 lakhs. What is the discussion? The statutory limit of 20 lakhs is the maximum amount available to the employee during his lifetime. It is the maximum amount available to the employee during his lifetime. That means any exemption under section 10 subsection 10 has been obtained in the past, then the exemption obtained in the earlier year shall be reduced from the statutory limit of rupees 20 lakhs, and we need to determine revised statutory limit, and such revised statutory limit shall be considered for the purpose of determination of present exemption under section 10 subsection 10. Understood, ma? Yeah. Tell me, what is the discussion relating to statutory limit? The statutory limit of 20 lakhs is the maximum amount available to the employee during his lifetime. That means the exemption claimed by the employee under section 10 subsection 10 in the earlier previous years must be reduced from the statutory limit of 20 lakhs, and we have to obtain the revised or reduced statutory limit, and such revised or reduced statutory limit shall be considered while determining the present exemption under section 10 subsection 10 in the current previous year. I will explain with the help of example. Say for example, 2 years back, 5 lakhs exemption has been claimed by the employee under section 10 subsection 10. How much? 5 lakh. Then this year, in this particular previous year, 21-22, also retired from another company and received gratuity ma. Then how to determine exemption under section 10 subsection 10? List of the following. First one, statutory limit. How much we need to consider out of 20 lakhs ma? 20 lakhs we should not consider, because out of 20 lakhs already 2 years back 5 lakhs exemption claimed by the employee while retiring from another company, right? Then that 5 lakhs must be reduced from 20 lakhs ma. Then what is the revised statutory limit available? Only 15 lakhs. This is how we need to consider this statement. Understood? So what is the revised statutory limit here? 15 lakhs. Then consider actually received, then go for computation depending upon the covered case or not covered case fact. Then you will get the list of the following as exemption under section 10 subsection 14. Understood? Next ma. Okay, before getting into pension, I would like to explain illustration ma. Let's verify illustration for your better understanding. Of course it will take time, but no problem. Let's verify. Let's verify illustration 4 ma. Mr. Ravi retired on 15th June 2021 after completion of 26 years 8 months of service ma, and received gratuity of 15 lakhs. At the time of retirement his salary was basic salary 50,000 per month, DNS allowance 10,000 per month, 60% of which is for retirement benefit. Out of 10,000, 6,000 is R2RB. Remember, commission 1% of turnover. That means it's a percentage of turnover we need to consider. Turnover in the last 12 months was 1 crore 20 lakhs ma. That means 1,20,000 is the turnover for year ma. Turnover for the year 1,20,000. That means per month turnover is per month commission is 10,000. Bonus 25,000 per annum. Okay. Compute his taxable gratuity. Tell me whether bonus we need to consider in the salary definition. Covered case or not covered case? It is not covered there. But why it is given in the question? Only to confuse the students. Don't get confused. Compute his taxable gratuity assuming he is a private sector employee and covered by the Payment of Gratuity Act 1972. You know how to determine exemption in case of covered case. Second one is not covered case. Third one is government employee. Tell me, if at all he is a government employee and receiving gratuity at the time of retirement, what is the treatment ma? Fully exempt from tax under section 10 subsection 10. Are you following? Chalo, let's go for computation. I will go little bit speed. Try to follow up ma. Illustration 4. He is a non-government employee and covered by the Payment of Gratuity Act. Okay. Determination of taxable value of gratuity. What is the format ma? Gratuity actually received how much? 15 lakhs. Less exemption under section 10 subsection 10. Working note 1. We will get taxable value of gratuity. Keep it empty. We will work out. Then you will get taxable value of gratuity. Next ma. Exemption under section 10 subsection 10 up to the list of the following. Workings and working notes as well as note points are very important. That leads to the better presentation ma, which leads to grabbing maximum marks. Chalo. Exemption under section 10 subsection 10 up to the list of the following. Three things we need to consider. Statutory limit 20 lakhs. Gratuity actually received 15 lakhs. Next ma, 15 by 26 into last done salary into number of years of service. Let's go for that computation. What is the definition of last done salary? Basic plus DA, any DA. What is the last drawn basic ma? 50,000. And what is the total DA? 10,000. Put together 60,000. Successfully determined LDS. Can we go for C-part computation? Yes. 15 by 26 into 60,000 last drawn salary into number of years of service ma? 27 years. They have given that 26 years 8 months ma. In excess of 6 months shall be treated as 1 full year, right? That means 27 years. How much it is? 9,34,615. Then what is taxable value of gratuity ma? 5,65,385. This is covered case. Now let's go for not covered ma. He is a non-government employee and not covered by the Payment of Gratuity Act. Determination of taxable value of gratuity. Gratuity actually received 15 lakhs less exemption under section 10 subsection 10. Working note 2, keep it empty, then you will get a taxable value of gratuity. Then exemption under section 10 subsection 10 up to the list of the following. Three things we need to consider. Statutory limit 15 lakhs. Then gratuity actually received how much ma? 15 lakhs. Then C part ma, half into 10 months average salary into number of completed years of service. Keep it empty. Now let's determine 10 months average salary. 10 months into, what is the salary definition here? Basic plus DA R2RB plus commission as a percentage of turnover divided by 10. That equal to 10 months into, what is the last drawn basic ma? Per month we need to consider. That must be multiplied with 10 months divided by 10. You will get 10 months average salary. What is the last drawn basic ma? Basic per month. How much it is? 50,000. DA R2RB 6,000. Commission per month 10,000. Per annum 1,20,000. That means per month 10,000 divided by 10. Then how much it is? 66,000. Successfully we completed. Let's go for C-part computation. Half into 66,000 into number of completed years of service ma? 26 only. Then how much it is? 8,58,000. Then what is TV of gratuity in case of not covered? 6,42,000. Next ma, government employee. What is the treatment? Fully exempt. Why? Because he is a government employee? No. He is a government employee and receiving gratuity at the time of retirement. In case he is receiving gratuity during the time of employment, even though he is government employee, fully taxable. So we need to consider two facts here. Since Mr. Ravi is a government employee and he is receiving gratuity amount at the time of retirement, hence the gratuity received is fully exempt from tax under section 10 subsection 10. Good. Next ma, let's go for pension discussion. Pension. What is the section providing exemption in case of pension ma? Section 10 subsection 10A. Remember, gratuity section 10 subsection 10, pension 10 subsection 10A. Okay. What do you mean by pension ma? A periodical payment paid by the employer to the employee every month after retirement shall be treated as pension ma. A periodical payment received by the employee from the employer after retirement is known as pension. Now there are two types of pensions. First one is uncommuted pension. Second one is commuted pension. How many types ma? Two types. First one is uncommuted pension. Second one is commuted pension. What is the meaning of uncommuted pension? A fixed amount paid by the employer to the employee every month after retirement. Fixed amount every month after retirement shall be treated as uncommuted pension. What is the treatment for that uncommuted pension ma? Remember, UCP, uncommuted pension received, will be fully taxable in the hands of both government employees as well as non-government employees. Remember, it will be fully taxable in the hands of both the government employees as well as non-government employees. Whereas what do you mean by commuted pension ma? What do you mean by commuted pension? Please tell me. A lump sum amount received by the employee from the employer instead of part or full value of uncommuted pension. Come again. Lump sum amount received by the employee from the employer instead of part or full value of uncommuted pension shall be treated as commuted pension. I will explain with the help of example. Say for example, one person retired from the employment, he is receiving 50,000 per month as pension ma. If at all 50,000 per month is receiving, means it will be treated as uncommuted pension. Then how many years he is going to receive during his lifetime, right? During his lifetime, every month 50,000 he is receiving as a pension ma, uncommuted pension, that will be technically. Now he approached the employer, says that, sir, I am going to receive this 50,000 throughout my life, during my lifetime, but I am having the need of lump sum amount. I need 10 lakh rupees. I am ready to commute 50% of my pension. Out of 50,000, 50% means 25,000 I am ready to commute throughout my life. Instead of paying every month, please give me lump sum amount at once. This is the request made by the employee to the employer ma. Are you following? So instead of giving 25,000 every month, please give me the lump sum amount of 10 lakh rupees. That means he is ready to commute. What is the percentage of commutation ma? 50%, 25,000. So instead of paying 25,000 every month, the employer given lump sum amount of 10 lakh rupees at once. Now after commutation of 50%, what is the remaining UCP received by the employee every month ma? 25,000. Because again the employer will not pay 100%, 50% already commuted, paid as a lump sum. Then remaining 50%, 25,000 he will be receiving during the time of lifetime. Understood the point? That is what we mean by commuted pension. That is the definition of a lump sum amount received by the employee from the employer instead of part or full value of uncommuted pension shall be treated as commuted pension. Okay. What is the tax treatment for CP ma? We need to verify the status of the employee, same as gratuity. Received by the government employee, received by the non-government employee. If it is received by the government employee, same as gratuity, fully exempt from tax under section 10 subsection 10A. Why they are providing full exemption ma? In recognition of the past public services provided by those government employees. When it comes to non-government employee, it is partly exempt and partly taxable. Partly exempt and partly taxable. Then what is the format to determine taxable value of CP ma? How to determine taxable value of commuted pension? CP received less exemption under section 10 subsection 10A. CP received less exemption under section 10 subsection 10A, then you will get a taxable value of CP. Are you following? Now my question is, how to determine exemption under section 10 subsection 10A? It is purely depends upon the fact called whether the employee is in receipt of gratuity or not in receipt of gratuity. What is the fact? Whether the employee is in receipt of gratuity or not in receipt of gratuity. In case the employee is in receipt of gratuity, already gratuity benefit is there, then exemption under section 10 subsection 10A will be 1/3 of full value of commuted pension. Remember, what is exemption under section 10 subsection 10A ma? 1/3 of full value of commuted pension when he is already in receipt of gratuity. In case not in receipt of gratuity ma, then half of the full value of commuted pension. Tell me, 1/3 exemption is highest or half is highest ma? 1/3 is more, half is more. Half is more. So we are giving more exemption to the employee who is not in receipt of gratuity. In case in receipt of gratuity, already gratuity benefit is there, hence we are giving less exemption, 1/3. Try to remember by logic ma, then it will be remembered forever. Okay then. So tell me, what is exemption ma? In case of in receipt of gratuity, less exemption, 1/3 of the full value of commuted pension. Not in receipt of gratuity, then half, more exemption, half of the full value of commuted pension. Next ma. Illustration for your better understanding, I am explaining, pay attention. Mr. K retired from A Limited after providing 30 years of service on 31st March 2021. He is receiving 20,000 per month from 1/4/2021. What is the every month pension received ma? 20,000 per month. That means what is the name for the 20,000 per month? Uncommuted pension, because it is received by the employee every month, fixed amount every month. UCP 20,000. Treatment for 20,000 UCP ma, fully taxable in the hands of both government employees as well as non-government employees. Next ma. On 1/10/2021, Mr. K received 10 lakhs by commuting 50% of UCP. What is the percentage of commutation ma? 50%. That means out of 20,000, 10,000 has been commuted. Instead of that, he received a lump sum amount of 10 lakh rupees. What is the name for the 10 lakh rupees? Commuted pension. What is that? Commuted pension. Treatment ma. Government employee fully exempt, non-government partly exempt, partly taxable. Determine the taxable value of pension in the hands of Mr. K for the previous year 21-22 in the following cases. First case, he is a government employee. Second case, non-government employee and gratuity received. Third case, non-government employee and no gratuity received. Let's verify. Are you following? Yes. He is a government employee ma. Determination of taxable value of pension. Whenever you are determining taxable value of pension, it is comprising of two things ma. First one, UCP chargeable to tax, uncommuted pension chargeable to tax. Second one, taxable value of CP. And these two put together, we need to treat it as taxable value of pension. Let's verify. Particulars amount column, UCP chargeable to tax, UCP chargeable to tax. Working note 1, we will work out, keep it empty. Then taxable value of CP ma. What is that? Taxable value of CP. Working note, sorry, note 1. Government employee, right? Fully exempt. That is given in the note 1. Exempt. Then you will get total taxable value of pension. Now let's work out UCP chargeable to tax. Working note 1 ma. Working note 1. Determination of UCP chargeable to tax. Particulars amount column. UCP received up to the date of commutation. What do you mean by up to the date of commutation ma? 1/4/2021 to 30th September 2021. These 6 months up to the date of commutation, what is the UCP received by the employee? 20,000. 20,000 into 6 months. How much? 1,20,000. Next ma, UCP received after the date of commutation. After commutation, whether the employee is going to receive entire 20,000 ma? Obviously no. 50% already commuted and received a lump sum amount of 10 lakhs. Then after that, how much the employer will pay? Only balance. What is the balance? 50% of 20,000. 10,000 will be received remaining 6 months ma. Are you following? Then 10,000 into 6 months. How much it is? 60,000. Then what is the total UCP chargeable to tax ma? 1,80,000. What is the treatment for this UCP of 1,80,000 in the hands of government employee? Fully taxable UCP in the hands of both government employees as well as non-government employees. Then what is the total taxable value of pension in the hands of government employee? 1,80,000 because CP is fully exempt from tax. Next when it comes to the non-government employee, in receipt of gratuity, not in receipt of gratuity, again and again we are not going to determine UCP. We are using the same 1,80,000. We are giving reference to the same working note 1 because there will be no change in the computation whether he is government employee or non-government employee. Chalo. Note 1, CP received by the government employee is fully exempt from tax. Very good. Next he is a non-government employee and in receipt of gratuity. He is a non-government employee and in receipt of gratuity. Let's determine taxable value of pension. Particulars amount column UCP chargeable to tax. Already we determined working note 1, 1,80,000. Then PV of CP, taxable value of CP. Working note 2, keep it empty, we will work out. Then you will get taxable value of pension. Then what we need to work out? Working note 2, determination of taxable value of CP. Then how to determine? Particulars amount column CP actually received 10 lakhs less exemption under section 10 subsection 10A. Then working note 3, then you will get a taxable value of CP. Now what we need to work out? Working note 3. What is the working note 3? Exemption under section 10 subsection 10A. Please tell me what is exemption under section 10 subsection 10A in case of in receipt of gratuity. Already in receipt of gratuity benefit is there. Lower exemption, how much 1/3 of the full value of commuted pension. 1/3 of the full value of commuted pension. Pay attention. Very important point I am explaining. Listen to me. What is 1/3 of full value of commuted pension? 10 lakhs into 1/3. 10 lakhs into 1/3. 3,33,333 rupees. Right? Mistake. Blunder mistake. Why? What is the statement? What is that point given by the lawmaker? What is the wording used by the lawmaker here? 1/3 of full value of commuted pension. You need to apply this. Pay attention, you need to apply this 1/3 on full value. My question, 10 lakhs is full value of CP na? No. 10 lakhs is part value of the CP because 10 lakhs received by commuting 50%. That means the 10 lakh is representing 50% But on which amount we need to apply that 1/3? On full value. That means that 10 lakh 50% must be converted into 100%. Then that will become full value of commuted pension. On that we need to apply 1/3. Very important. So convert 10 lakhs into 100%, 50% into 100%. How much it is? 20 lakhs. The 20 lakhs will be treated as full value of commuted pension. On 20 lakhs you need to apply 1/3. Don't try to apply directly on 10 lakh rupees. That is representing part of the CP. But we need to apply on full value of CP. Only to explain this point, I am explaining this illustration. Pay attention. Then on which amount we need to apply? 20 lakhs full value. 1/3 into 20 lakhs into, that's it, 20 lakhs. How much 6,66,667. Okay. 667. Then what is taxable value of CP? 3,33,333. Okay. Next, he is a non-government employee not in receipt of gratuity. Let's verify. Determination of taxable value of pension, same as above. UCP chargeable to tax, working note 1, 1,80,000. Working note 1, same reference. TV of CP, working note 3, working note 4. Keep it empty. Then you will get taxable value of pension. Working note 4, determination of taxable value of CP. How to determine taxable value of CP? Please tell me. How to determine? CP actually received less exemption under section 10 subsection 10A. Then you will get TV of CP. Then how to determine exemption under section 10 subsection 10A? Tell me. He is not in receipt of gratuity, right? Then what is the statement? Half of the full value of commuted pension. Now what is full value? 20 lakhs. Good. Half into 20 lakhs into, that is 20 lakhs. How much 10 lakhs. So out of 10 lakhs, entire 10 lakhs will be provided as exemption. Then what is the taxable value of CP? 0. Then what is the total taxable value of pension? 1,80,000. Only UCP. Good. That is regarding pension. That is regarding pension. So 2 retirement benefits we successfully completed. What is the first retirement benefit we completed? Gratuity, dealing section 10 subsection 10. Next one, pension, dealing section 10 subsection 10A. Next, leave salary. What is the section providing exemption for leave salary? Section 10 subsection 10 AA. Just add one additional A. Are you following? 10, 10A, 10 AA. Yes. Leave salary section 10 subsection 10 AA. What is leave salary? Before getting into that, I will explain the what is that background. Every organization will provide a fixed number of leaves to their employees on per annum basis in addition to the holidays, festival holidays, Sundays, casual leaves. In addition to the festival holidays, Sundays, casual leaves, a fixed period of leaves shall be provided to the employees. Say for example, 25 days, assume. Every year, 25 days of fixed number of leaves has been provided to the employee by the organization. These 25 days leaves are in addition to the Sundays, festival holidays and casual leaves. Now, what employee could do with these 25 days leaves available with him per year, every year? Either he can grab those leaves, he can take the leaves, he can utilize the leaves, or he can work in the organization. He may work in the organization. No one will deny that. In case the employee says that, sir, I don't want to take the leaves, I will work in the organization, then employer will say yes, obviously, because he's asking for the, what is that, working in the organization. Are you following? There is no problem to the employer here. It is up to the employee whether to utilize or not to utilize. So say for example, out of 25 days, 10 days utilized by the employee, but 15 days worked in the organization. 10 days utilized in that year, but 15 days worked in the organization. Then that 15 days will be treated as unused leaves. Come again, that 15 days shall be treated as unused leaves. 25 days shall be treated as available leaves. 10 days will be treated as utilized leaves. 15 days shall be treated as unutilized leaves or unused leaves. Now those 15 days unused leaves or unutilized leaves, what is the treatment given by the employer? What is the treatment given by the employer for such unused leaves of 15 days? I am going to explain. The treatment for that unused leaves of 15 days is completely depends upon the policy of the organization. Depending upon the policy of the organization. First policy, there is no encashment facility and there is no carry forwarding system. What do you mean by there is no encashment facility? For those unused leaves of 15 days, the employer is not making the payment of any amount for that 15 days. That means no encashment. And at least whether the employer is allowing to carry forward to the next year, that is also not there. No encashment, there is no carry forwarding facility. Are you following? Worst policy given by the company. Understood? Now the point is, if at all there is no encashment facility, there is no question of receipt of leave salary amount. If at all there is no receipt of leave salary amount, there is no question of, what is that? Providing exemption under section 10 subsection 10 AA. Because when we have to provide exemption under section 10 subsection 10 AA, only when you receive the leave salary amount. Here there is no encashment facility, hence no need to apply 10 subsection 10 AA. Second policy, there is no encashment facility, but there is a carry forwarding system. What do you mean by carry forwarding system? These 15 days will be carry forward to the next year, and in the next year, that year related 25 days plus carry forwarded 15 days put together 40 days he can utilize. That is what you mean by carry forwarding system. Are you following? So here under policy 2 also no encashment. That means again there is no question of what is that applying the provisions of section 10 subsection 10 AA. Then policy 3. There is no carry forwarding facility, but there is encashment facility. There is no carry forwarding system, but there is encashment system. Are you following? If at all there is encashment facility is there, that means the employer is paying in monetary terms relating to those unused leaves. Now you need to verify section 10 subsection 10 AA to provide exemption. Now the point is, the encashment facility is there. Then when the employee can encash, it is up to the employee. What do you mean by up to the employee? the employee can encash year to year basis. What do you mean by year to year basis? Every year for unused leaves, he is getting the monetary amount. He is getting the monetary benefit. He is receiving the leave salary amount every year at the end of every year for the unused leaves. This is what we mean by year to year basis encashment. Second situation ma, he is accumulating those unused leaves and he is receiving lump sum amount, leave salary amount in lump sum at the time of retirement or leaving the job. He is not receiving year by year, but he is accumulating and receiving at the time of retirement or leaving the job. Are you following? It is up to the employee whether to receive year to year basis or at the time of retirement or leaving the job. Let's verify. Encashment on year to year basis. Second one, accumulation of unused leaves during the period of service, and encashment at the time of retirement or leaving the job. Very good. Next ma, let's verify. Amount received by the employee from employer by converting unused leaves into cash leave salary. That means he received the amount with respect to the unused leaves. First case ma, leave salary received during the time of employment. When we can say it is received during the time of employment? Whenever the employee is encashing the unused leaves year to year basis. That means he is receiving during the time of employment. Second one ma, receiving leave salary amount at the time of retirement or leaving the job. First of all, let's verify the tax treatment if at all it is received during the time of employment. The tax treatment is, it is fully chargeable to tax. It is what ma? Fully chargeable to tax in the hands of both government employees as well as non-government employees without providing any exemption under section 10 subsection 10 AA. Why? Because the lawmakers considering leave salary as a retirement benefit. That means you need to, if you want to claim exemption under section 10 subsection 10 AA, you need to receive retirement benefit as a retirement benefit. That means it must be received at the time of retirement or leaving the job, but not during the time of employment. If you receive during the time of employment, the lawmaker says it will be fully taxable in the hands of both government employees as well as non-government employees. What if it is received at the time of retirement or leaving the job ma? Again, depending upon the status of the employee, received by the government employees, received by the non-government employees. If it is received by the government employees, same as gratuity, same as committed pension ma. Fully exempt from tax under section 10 subsection 10 AA in the what is that, in recognition of the past public services provided by those government employees. What if it is received by the non-government employee ma? Partly taxable and partly exempt. Then what is the format to determine taxable value of gratuity ma? Sorry, taxable value of leave salary. Leave salary actually received less exemption under section 10 subsection 10 AA. Then you will get a taxable value of leave salary. Then what is exemption under section 10 subsection 10A ma? List of the following. 4 things we need to consider. Pay attention ma. 4 things you need to consider. You need to remember. First one, statutory limit 3 lakhs. Second one, leave salary actually received. Third one, 10 into 10 months average salary. Fourth one, cash equivalent to leave. Come again. First one, statutory limit 3 lakhs. Second one, leave salary actually received. Third one, 10 into 10 months average salary. Fourth one, cash equivalent to leave. What we need to discuss? How to determine 10 months average salary and how to determine cash equivalent to leave. Let's verify. 10 months average salary. For that, before getting into that, let's verify 10 months period ma. What do you mean by 10 months period? 10 months, a period of 10 months immediately preceding to the date of retirement here. There, gratuity not covered case, immediately preceding to the month of retirement. There we need to ignore the month of retirement. Here we need to ignore date of retirement preceding to the 10 months period we need to consider. Chalo, very easy. Period of 10 months immediately preceding to the date of retirement. Example 1. Date of retirement is 16th January 2022 ma. That means you need to ignore 16th date. Then up to 15th January you need to consider for the purpose of determination of 10 months period. Then what is 10 months period here? 15th March 21 to 15th January 22. Are you following? Example 2. Date of retirement 1st December 2021. Then ignore 1st December and you need to consider up to 30th November. Are you following? So 1st February 2021 to 30th November 2021. That is how to determine 10 months period. Once we determine 10 months period, it is very easy to determine 10 months average salary. So what is the salary definition? Same as gratuity not covered. Salary definition for leave salary is same as gratuity not covered. Please tell me. Basic plus DR2RB plus commission as a percentage of turnover. Very good. Basic plus DR2RB plus commission as a percentage of turnover. Fixed commission you need to ignore, you know. Then how to determine 10 months average salary? 10 months into per month salary definition. Basic plus DR2RB plus commission as a percentage of turnover divided by 10 months. Sorry, divided by 10. Then you will get 10 months average salary. We successfully completed the discussion relating to 10 months average salary. Next, let's verify cash equivalent to leave. How to determine cash equivalent to leave? Let's verify the procedure. For the purpose of determination of cash equivalent to leave, we need to work out 4 steps. How many? We need to work out 4 steps. And if we worked out 4 steps, in the last step, that is in step 4, you will be in a position to determine cash equivalent to leave. Let's verify what are those 4 steps. Step 1. Determine total number of completed years of service. Determine total number of completed years of service. What do you mean by completed years of service? Fully completed years. Fully completed years. 365 days. Out of 365 days, 365 days must be completed. Then only you can say that completed years of service. So what is step 1? Determine total number of completed years of service. Step 2. What is step 2? Determine total number of leaves available during the period of service. Simply say leaves available during the period of service. Statutory prohibition maximum 30 days per annum. Statutory prohibition maximum 30 days per annum. What is the discussion relating to that maximum prohibition? Statutory prohibition. Say for example, total number of completed years of service is 30 years. Assume total number of completed years of service is 30 years. Organization is giving 35 days every year. Organization is giving 35 days per annum leaves to the employees. Then how to determine total number of leaves available in step 2? Is it possible for us to multiply 30 years with 35 days which is given by the organization? No. What it says? Statutory prohibition of maximum 30 days. That means 35 days don't consider. That must be reduced to 30 days. And you need to multiply 30 days into 30 years. That 900 days will be treated as a total number of leaves available. Are you following? In case 20 days given by the organization per annum. 20 days means within the statutory prohibition. Is it possible? We need to increase to 30 days? No. Don't increase to 30 days. Multiply the 20 days into 30 years. 600 days will become total number of leaves available. That means in case the organization is giving exceeding 30 days, that must be restricted to the 30 days. In case it is giving less than 30 days, such a lesser days must be multiplied with the total number of completed years of service. Are you following the discussion? Next step 3. What is step 3? Determine total number of leaves available or used by the employee during the time of employment. In step 2, we determine available. In step 3, we are determining availed or used. Used leaves by the employee during the time of employment. Then step 4. What is step 4? Step 2 minus step 3. What do you mean by step 2 minus step 3? Available minus used. Step 2 is available minus step 3 is used. Then what you would get? Unused leaves. Simply step 2 minus step 3 means unused leaves. Divided by 30 days. Those unused leaves which are in days will be converted into months. By dividing with 30 days, we are converting into months into 10 months average salary. Just now we verified how to determine 10 months average salary. So multiply with 10 months average salary, then you will get the cash equivalent to leave. Are you following? So tell me, what is the procedure to determine cash equivalent to leave? 4 steps. Step 1. Determine total number of completed years of service. Good. Step 2. Determine total number of leaves available during the period of service. Statutory prohibition maximum 30 days per annum. Step 3. Determine total number of leaves availed or used by the employee during the time of service. Then step 4. Step 2 minus step 3 divided by 30 days into 10 months average salary. That means simply say unused leaves, unused days divided by 30 days. That means converted into months into 10 months average salary. Remember, in case in the examination, they have directly given the information relating to unused leaves. directly given the information relating to unused leaves. That means they have given information relating to step 2 and step 3. Are you following? In the step 4, then no need to go through first 3 steps ma. Why we are going through first 3 steps? To get into the step 4. But in the examination, directly information relating to step 4 has been given. Then no need to work out this much steps ma, these many steps. Directly consider those unused leaves divided by 30 days into 10 months average salary. You will get cash equivalent to leave. Remember this point to save some time in the examination. Next month, statutory limit discussion, same as gratuity. What do you mean by same as gratuity? The statutory limit of rupees 3 lakhs is the maximum amount available to the employee during his lifetime. That means in case any exemption has been claimed by the employee under section 10 subsection 10 AA in the earlier previous years, then the exemption already claimed shall be reduced from the statutory limit of rupees 3 lakhs, and we need to determine revised or reduced statutory limit, and that shall be considered for the purpose of determination of present exemption under section 10 subsection 10 AA. That's it. Next ma, voluntary retirement. Okay, before getting into that, let's verify problem. Let's verify problem ma. Problem on leave salary for your better understanding ma. Mr. Gupta retired on 1/12/2021 after 20 years of service and received leave salary of rupees 5 lakhs ma. What is leave salary received? 5 lakhs. Other details of his salary income are basic salary 5,000 per month. What is basic salary? 5,000 per month. 1,000 was increased with effect from 1/4/2021. Tell me, what is his basic salary at the time of retirement ma? 5,000. Then 1,000 was increased with effect from 1/4/2021 means before that increment of 1,000, that means before 1/4/2021, what was his basic salary ma? 4,000. His basic salary before increment was 4,000. After increment is 5,000. And what is the date of increment? 1/4/2021. This is very important while determining 10 months average salary ma. There we need to consider 10 months period. That 10 months period, out of the 10 months period, any period falls before 1/4/2021, then consider 4,000 per month as basic salary. Any period falls after 1/4/21, consider 5,000 per month as a basic salary. That is very important. DNS allowance 3,000 per month, 60% is for retirement benefit, R2 RB 1,800 per month. Commission 500 per month ma, fixed commission it is. 500 per month means fixed commission. We need to consider percentage of turnover ma. Commission as a percentage of turnover. Fixed commission must be ignored. Here there is no percentage of turnover commission. That means here commission as a percentage of turnover will be 0. Next ma, bonus 1,000 per month. Okay, leave availed during the service 480 days. Availed ma, information provided relating to used leaves. That means step 3. Step 3 information has been given. Unused leaves has not been given directly. Step 3 used leaves information given. That means we need to work out 4 steps. No way out. No other way out. He was entitled to 30 days leave every year. Okay, it is within the limit of statutory prohibition. No adjustment is required. Multiply these 30 days into total number of completed years of service to determine total number of leaves available during the service in step 2. You are required to compute his taxable leave salary assuming he is a government employee. Second one, he is a non-government employee. Tell me ma, if at all he is a government employee, what is the treatment? Fully exempt from tax under section 10 subsection 10 AA because he is receiving at the time of retirement. In recognition of the past public services provided by them, the lawmakers are providing full exemption. What if it is received by the non-government employee ma? Partly taxable and partly exempt. We need to work out. Let's verify. Come on. Illustration 5. Determination of taxable value of leave salary in the hands of Mr. Gupta for the previous year 21-22. He is a government employee. Since he is a government employee and receiving leave salary at the time of retirement, hence it is fully exempt from tax. Next, he is a non-government employee. What is the treatment if at all he is a non-government employee? Partly taxable and partly exempt. Format leave salary actually received 5 lakhs less exemption under section 10 subsection 10 AA. Working note 1. Then you will get, keep it empty, then you will get taxable value of leave salary. Let's go for working note 1. Exemption under section 10 subsection 10A is up to the list of the following 4 things we need to consider. First one, statutory limit 3 lakhs. Next one, leave salary actually received. How much 5 lakh. Then 10 months average salary. 10 into 10 months average salary, keep it empty. Then cash equivalent to leave, keep it empty. So now we need to determine 10 months average salary. Then it is very easy for us to go for cash equivalent to leave. Chalo. Let's determine 10 months average salary. 10 months into salary definition, basic plus DR2RB plus commission as a percentage of turnover divided by 10. 10 months into basic salary. What is the 10 months period we need to consider, What is the date of retirement? Tell me. What is the date of retirement? 1/12/2021. Then what is the 10 months period we need to consider? February to November. February to November means February and March month he will be receiving 4,000. From April to November, remaining 8 months he will be receiving 5,000. That is very important. I have directly given the workings here. 4,000 into 2 months plus 5,000 into 8 months. That is the basic salary plus DAR2RB 1,800 into 10 months. Commission as a percentage of turnover, we don't have 0 because it is given fixed commission. We are not going to consider. Divided by 10. How much 6,600. Is it possible for us to go for determination of C part? What is C part? 10 into 10 months average salary. That means 10 into 6,600. That means 66,000. Next, let's go for determination of cash equivalent to leave. Step 1, determine total number of determine total number of completed years of service. How many completed years of service? 20. Step 2, determine total number of leaves available during the period of service. That means 20 years into 30 days. How much 600 days. Step 3, determine total number of leaves utilized or used during the period of service given in the question, 480 days. Then step 4, step 2 minus step 3 divided by 30 days into 10 months average salary. What is step 2 available 600 minus used 480. That means you will get unused. That must be divided by 30 days, means converted into months into 10 months average salary. 6,600. Then what is that much? 26,400. So least means statutory limit 3 lakhs, actually received 5 lakh. Then 10 into 10 months average salary 66,000 and cash equivalent to leave 26,400. Least means 26,400 will be provided as exemption under section 10 subsection 10 AA. Then balance will be chargeable to tax. Understood? What is the balance? 4,73,600. That is the discussion relating to leave salary. We successfully completed regarding discussion relating to gratuity, pension, leave salary. What are pending? Retrenchment compensation, VRS compensation and provident fund. Then we can conclude with the salary chapter, salary head of income. Okay. Chalo next let's verify retrenchment compensation. What is the next retirement benefit? Retrenchment compensation. What is the section dealing with providing exemption for retrenchment compensation? Section 10 subsection 10B. Come again. 10 subsection 10B. Tell me, why retrenchment compensation is paid by the employer to the employee? Why the employer is making the payment of retrenchment compensation to the employee? A payment made by the employer to the employee at the time of removing the employee from the organization without any mistake from the part of the employee, but in the process of cost reduction. What happened, The organization is suffering from losses, for the past 2 or 3 years. Now they have to reduce their cost. Whenever they want to reduce their cost, what they will do? They will reduce the number of employees because huge cost will be concentrated on HR, human resources. Therefore, the employer is removing some of the employees even though there is no mistake from the part of them, but in the process of cost reduction, there is no other way out to that employer, hence he is removing. In such a case, he cannot remove like that. He has to pay something as a compensation to the employee who he is removing. That compensation will be technically treated as retrenchment compensation. What is the tax treatment for the retrenchment compensation? It is partly taxable and partly exempt under section 10 subsection 10b. Let's verify. What is the format to determine taxable value of retrenchment compensation? RC received less exemption under section 10 subsection 10b, then you will get a taxable value of retrenchment compensation. Very easy. Now, how to determine exemption under section 10 subsection 10b? Up to the list of the following three things we need to consider. First one, statutory limit 5 lakhs. How much? Statutory limit 5 lakhs. Second one, retrenchment compensation actually received. Third one, 15/26 into 3 months average salary into number of years of service. You know what do you mean by number of years of service? Number of full completed years of service plus part of the year in excess of 6 months shall be treated as one full year. That is what you mean by number of years of service. Already we discussed. Then let's verify how to determine 3 months average salary. For that salary definition, we need to verify. Salary definition is basic plus DA, any DA. The definition is same as gratuity covered case. Remember, retrenchment compensation salary definition is same as gratuity covered case, basic plus DA, any DA. Then 3 months average salary, how to determine? 3 months into basic plus DA, any DA divided by 3. Then you will get 3 months average salary. In case the retrenchment compensation is received by the employee as per the guidelines framed by the government, then the RC received will be fully exempt from tax under section 10 subsection 10b. Are you following? In case that organization removed the employees as per the policy framed by the, what is that? No, organization has been received the employees because of their financial, what is that, losses, but the payment of retrenchment compensation has been made as per the, what is that, guidelines framed by the central government. In such a case, central government or state government, in such a case, it will be fully exempt from tax under section 10 subsection 10b. Let's verify illustration on retrenchment compensation. Mr. Garg received retrenchment compensation of rupees 10 lakhs after 30 years 4 months of service. At the time of retrenchment, he was drawing basic salary 20,000 per month, DNS allowance 5,000 per month. Compute his taxable retrenchment compensation. What is the treatment for the 10 lakh rupees retrenchment compensation received? Partly taxable and partly exempt. Let's verify. Determination of taxable value of retrenchment compensation in the hands of Mr. Garg for the previous year 21-22. What is the format? Retrenchment compensation actually received 10 lakhs less exemption under section 10 subsection 10b. Then you will get taxable value of RC. Then how to determine exemption under section 10 subsection 10b? Up to the list of the following three things we need to consider. First one, statutory limit. How much? 5 lakhs. Then actually received, RC actually received 10 lakhs. Then C part, computation part, 15/26 into 3 months average salary into number of years of service. 3 months average salary, 3 months into salary definition, basic plus DA, any DA divided by 3. That equal to 3 months into, what is the last drawn basic? 20,000, last drawn DA, 5,000 divided by 3. Then how much it is? 25,000. Successfully we determined 3 months average salary. Can we go for C part computation? Yes. 15/26 into 25,000 into number of years of service, 30 years. Then how much? 4,32,692. Least means 4,32,692 will be provided as exemption. Balance will be chargeable to tax. Next, let's verify. Voluntary retirement scheme compensation, VRS compensation. What is that, VRS compensation. What is the section providing exemption for VRS compensation? Section 10 subsection 10C, gratuity 1010, pension 1010A, leave salary 10 subsection 10AA, retrenchment compensation 10 subsection 10B, VRS compensation 10 subsection 10C. Remember, a payment made by the employer to the employee who is retiring voluntarily from the employment as per the VRS scheme framed by the organization will be regarded as VRS compensation. That means the employee is retiring voluntarily from the organization as per the scheme framed by the VRS scheme framed by the organization ma. In case the organization has not been framed any VRS scheme, but employee is retiring voluntarily because of his disinterest in the employment, in such a case he will not get the VRS compensation. When he will get VRS compensation ma? Only when he retired voluntarily as per the VRS scheme framed by the company ma, framed by the organization, then only it is possible to make the payment of VRS compensation. Otherwise they will not make the payment of VRS compensation. Why organizations normally frame such schemes ma? To reduce the existing number of employees. The overall object behind introduction of VRS scheme in any organization is to reduce the existing number of employees ma. Why they wants to reduce? To reduce the cost of human resource, because the company may be incurring losses, they wants to get out of from the losses, they wants to get into the profits ma. That's why they wants to retire the employees voluntarily through this particular scheme. That's why the companies normally, usually, generally introduce this type of schemes ma, to reduce the existing number of employees, which leads to the reduction in the cost of human resource. Chalo. Object behind framing VRS scheme. What is the object ma? Reduce the existing number of employees. The overall object is reduction in the number of employees. The following are the eligible employees to receive VRS compensation. Who are the eligible employees ma? Public sector employees, private sector employees, state government employees, central government employees, cooperative society employees, notified educational institutions like IIT and IIM employees, local authority employees. These are eligible to receive VRS compensation. Next ma, the following are the conditions specified under Rule 2BA for the purpose of making the payment of VRS compensation to the retiring employees must be satisfied cumulatively by the employer. That means if the employer wants to make the payment of VRS compensation to the employees, the conditions specified under Rule 2BA shall be satisfied cumulatively. What are those conditions? First condition, the employee should complete either 40 years of age or 10 years of service ma. Come again. The employee should complete either 40 years of age or 10 years of service who is retiring voluntarily ma. Then only he is eligible to get the VRS compensation. The company is allowed to make the payment of VRS compensation. First condition. Second condition, the retiring employee should not be the director of the company. Come again. The retiring employee should not be the director of the company. Third condition, the overall object should be reduction in the existing number of employees. What should be the object ma in making the payment of VRS compensation? Existing in the reduction in the existing number of employees. Fourth condition, very important condition, the retiring employee, the vacancy caused by the retirement of the existing employee should not be filled. The vacancy caused by the VRS should not be filled up, and the retiring employee not to be employed in any other organization belongs to the same management. In case he is retiring, voluntarily retiring from the holding company and is getting employment into the, what is that, subsidiary company ma, which are belongs to, two companies belongs to the same management. In such a case, there is no overall reduction in the existing number of employees. There is no overall reduction in the cost of the human resource ma. That's why they says that the vacancy caused by the VRS should not be filled up, and the retiring employee not to be employed in any organization belongs to the same management. That means he can get the employment in other companies which are not relating to this particular management ma. Those are the four conditions required to be satisfied cumulatively. Then only the company is eligible to make the payment of VRS compensation. These are the four conditions ma. Tax treatment. What is the tax treatment for VRS compensation received? Partly taxable and partly exempt under section 10 subsection 10C. Okay. Now what is the format to determine taxable value of VRS compensation ma? VRS compensation received less exemption under section 10 subsection 10C, then you will get taxable value of VRS compensation. Now how to determine exemption under section 10 subsection 10C? Let's verify. Up to the list of the following exemption under section 10 subsection 10C, four things we need to consider. First one, statutory limit ma 5 lakhs. Then VRS actually received, we need to consider. Then 3 into lost on salary into number of completed years of service. What is the C part ma? 3 into last drawn salary into, what do you mean by last drawn salary? I will explain the salary definition. For the time being, 3 into last drawn salary into number of completed years of service. What do you mean by completed years of service? Full completed years of service. That is C part. Then D part will be last drawn salary into number of pending months of service left. What is that? Number of pending months of service left. Now, out of C part as well as D part, whichever is higher we need to consider. Pay attention. Out of C part or D part, whichever is higher we need to consider. What is C part ma? 3 into last drawn salary into number of completed years of service. Or D part ma? Last drawn salary into number of pending months of service left. What do you mean by pending months of service left? Total number of period of service is 30 years, but is retiring at the end of 25th year. Then how many months of pending months of service is left ma? 5 years into 12 months. 60 months will become number of pending months of service left. Are you following? So out of C or D, whichever is higher we need to consider. That must be compared with A and B. That whichever is higher amount shall be compared with A and B. Overall, whichever is lower shall be allowed as exemption under section 10 subsection 10C. I hope you understood. What is the procedure ma? C or D, whichever is higher, consider, and this must be compared with A and B. Whichever is lower will be considered as exemption under section 10 subsection 10C. Last drawn salary definition ma, same as gratuity not covered, same as leave salary ma. What is that? Most popular definition. Basic plus DA R2RB plus commission as a percentage of turnover. That's it. So last drawn basic consider, last drawn DA R2RB consider, last drawn commission as a percentage of turnover need to be considered per month ma, per month. Illustration ma. Let's verify question first of all. Illustration 9. Mr. Dutta received voluntary retirement compensation of 7 lakhs after 30 years 4 months of service. He still has 6 years of service left. At the time of voluntary retirement, he was drawing basic salary 20,000 per month. Tell me how many years of service left ma? 6 years. Convert into months ma. 6 years into 12 months. 72 months is number of pending months of service left. Remember. And what was the salary at the time of retiring voluntarily ma? 20,000 per month. Dearness allowance ma, which is form part of pay. That means R2RB 5,000 per month. Compute is taxable voluntary retirement compensation, assuming he does not claim any relief under section 10 under section 89. Let's verify. Determination of taxable value of VRS in the hands of Mr. Dutta for the previous year 21-22. Particulars amount column. VRS actually received how much ma? 7 lakhs less exemption under section 10 subsection 10C. Working note 1. Keep it empty, then you will get taxable value of VRS. Then how to determine exemption under section 10 subsection 10C? It is up to the list of the following 4 things we need to consider. First one, statutory limit 5 lakhs. Next one, VRS actually received how much ma? 7 lakhs. C part 3 into last drawn salary into number of completed years of service, or D part last drawn salary into number of pending months of service left. If you want to determine C part and D part, we need to compute last drawn salary. Let's verify that. Last drawn salary, what is the salary definition ma? Basic plus DA R2RB plus commission as a percentage of turnover. What was the basic salary is drawing at the time of retirement? 20,000. DA R2RB 5,000. Commission 0. Then how much ma? 25,000. We successfully computed last drawn salary. Can we go for C and D part? Yes. 3 into last drawn salary 25,000 into number of completed years of service 30 years. How much ma it is? 22,50,000. Then LDS, that is 25,000 into number of pending months of service ma? 72 months. How much it is? 18 lakhs. Out of C and D, whichever is higher means 22.5 lakhs. That must be compared with statutory limit 5 lakhs and VRS actually received 7 lakh. Whichever is lower ma? List of those following. Then what we need to consider? 5 lakhs. That means exemption will be 5 lakhs under section 10 subsection 10C. Then balance 2 lakhs will be taxable value of VRS compensation. Understood? Yes. Next ma. Let's verify provident fund discussion ma. Very important from the viewpoint of examination. Pay attention. Provident fund. What are the sections providing exemption with respect to provident fund? 10 subsection 11 and 10 subsection 12. When we need to apply 10 11, when we need to apply 10 12, I will explain little bit later. For the time being, what are the relevant sections ma with respect to provident fund for providing exemption? 10 subsection 11 and 10 subsection 12. Background discussion, simple ma. The central government introduced the concept called provident fund for the purpose of savings to the employees and self-employed people. For the purpose of having savings to the employees as well as self-employed people. That is the background analysis for the purpose of introduction of the concept called provident fund. There are 4 types of provident fund ma. First one, statutory provident fund, then recognized provident fund, then unrecognized provident fund, and public provident fund. Come again, SPF, RPF, URPF, PPF. Next, let's verify one by one in detail ma. SPF, RPF, URPF, PPF. First of all, let's verify the definition. What do you mean by SPF ma? A provident fund which is created and maintained by the central government and which will run as per the enactment called SPF Act 1925. It is created and maintained by the central government ma. Enactment is there, SPF Act 1925. What about RPF ma? A provident fund which is created and maintained by the employer and which is recognized by the Commissioner of Income Tax and which will run as per the rules of the RPF Act 1952. It is created and maintained by the employer ma and got recognition from the Commissioner of Income Tax. When Commissioner of Income Tax will give recognition to that provident fund created by the employer only when it is genuine one. In case it is proved as genuine one, the Commissioner of Income Tax will provide the recognition, will give the recognition, then it will become recognized provident fund and it has to run as per the rules of the RPF Act 1952. Whereas what is unrecognized provident fund ma? You can say that based on RPF ma. What is unrecognized provident fund? A provident fund which was created and maintained by the employer and the same is not recognized by the Commissioner of Income Tax, it will be treated as URPF and it will run as per the rules of the employer. There is no enactment for URPF, it will run as per the rules of the employer. Why Commissioner of Income Tax has not given recognition? Because it is not genuine, it is not seems to be genuine, hence is not giving recognition. In such a case, it will be treated as URPF, it will run as per the rules of the employer. Next ma. Public provident fund, again it is a provident fund created and maintained by the central government and which will run as per the rules of the PPF Act 1968 ma. So already we are having statutory provident fund. Again, why central government introduced public provident fund ma? Because in case of SPF, who can contribute? Only the person who is having the status of employee. That means only employees alone allowed to contribute to the SPF ma, RPF, URPF. In case of self-employed persons, that means who are into the business or profession, they are self-employed people. For them, they should also have the savings ma. For them, the lawmakers, the central government introduced public provident fund. That means who can contribute to the public provident fund? Any person, any citizen of India. Are you following? Any person. That means employees as well as self-employed person. Nothing but general public can contribute to the public provident fund. Next ma. Contribution by whom ma? In case of statutory provident fund, employer will contribute and employee will contribute. Matching contribution will be done by the employer also out of his own pocket ma. So how many persons are contributing here? 2 persons. Employer contribution and employee contribution. What about recognized provident fund? Same, employer contribution and employee contribution. URPF ma, employer contribution and employee contribution. What about public provident fund? Please tell me. Public provident fund ma. Here there is no concept of employer and employee. General public are contributing. Hence we can say contributed by general public. Next ma. Employee own contribution. Employee is contributing right to the provident fund. That employee own contribution will be allowed as deduction under section 80C or not? That is the question here. Come again. The employee contribution to the provident fund will be allowed as deduction under section 80C or not? That is the question. In case of statutory provident fund, since it is statutory one, the employee contribution will be allowed as deduction under section 80C. RPF, recognized provident fund, since it is having recognition from Commissioner of Income Tax, hence deduction under section 80C shall be allowed. Unrecognized provident fund, since there is no recognition from the Commissioner of Income Tax, hence employee contribution shall not be allowed as a deduction under section 80C. Then public provident fund, again it is statutory one. It is encouraging the savings. To encourage such savings, the government, the department, the lawmakers are allowing deduction under section 80C. Next, employer's contribution. Whether employer's contribution in the name of employee taxable in the hands of employee under the head income from salary or not? That is the question. The employer's contribution is in addition to the salary. That in addition to the salary, employer's contribution is whether taxable in the hands of employee or not taxable? That is the question. In case of statutory provident fund, it is not taxable, exempt under section 10 subsection 11. Here it will come. In case of statutory provident fund, the employer contribution, even though it is in addition to the salary, it is making contribution, the employer is making contribution to the employee's provident fund, still it is exempt under section 10 subsection 11 because it is statutory one. RPF up to 12% of salary, the employer contribution which is equal to 12% of salary of the employee will be allowed as exemption, not chargeable to tax. In case employee contribution is exceeding 12% of salary, then in excess of 12% of salary will be chargeable to tax in the year of contribution. In the year of contribution, it will be chargeable to tax. How to determine 12% of salary? What is the salary definition? I will explain little bit later. Unrecognized provident fund not taxable yearly. What do you mean by not taxable yearly? That means not at all taxable. No, it will be taxable, but not taxable yearly. That means they are charging to tax in lump sum at the time of receiving lump sum amount from the URPF account at the time of retirement or leaving the job. They are not charging to tax every year. They are charging at the time of retirement or leaving the job. He is receiving lump sum amount from the URPF account. At that time, they are charging to tax. Hence, they say it's not taxable yearly. Next, public provident fund it is exempt under section 10 subsection. Sorry, there is no question of contribution by the employer, right? General public are contributing, not applicable. Good. Next are you following? Yes. Interest every year interest will be credited Interest on employer's contribution as well as interest on employee contribution will be credited. What is the treatment for that interest? Let's verify. That is our discussion. What is the treatment for the interest credited to the provident fund account If it is happen to be statutory provident fund, it is fully exempt under section 10 subsection 11 Interest credited to the SPF account will be fully exempt from tax under section 10 subsection 11. And what is exempt here? Interest on employer's contribution. What is that? Interest on employer's contribution Then what about interest on employee contribution? I will explain little bit later. So interest on employer's contribution will be exempt under section 10 subsection 11 in case of SPF. What about RPF up to 9.5% per annum. Interest rate up to 9.5% per annum will be exempt. In case in excess of 9.5% per annum has been credited to the RPF account, then it will be chargeable to tax, which is in excess of 9.5%. That is on employer's contribution, interest on employer's contribution. Say for example, interest on employer's contribution 13% per annum has been credited to the RPF account. Then what is exemption up to 9.5% per annum? Then 3.5% per annum will be chargeable to tax. That is the point. URPF not taxable yearly. What do you mean by not taxable yearly? Lump sum amount when you received from the URPF account at the time of retirement or leaving the job, at that time it will be chargeable to tax. Public provident fund fully exempt under section 10 subsection 11 because it is statutory one. Next lump sum amount received. What do you mean by lump sum amount received? At the time of retirement or leaving the job, lump sum amount is received by the employee from SPF, RPF, URPF and PPF. Then what is the tax treatment? If it is happened to be statutory provident fund, the lump sum amount received from the SPF account will be fully exempt from tax under section 10 subsection 11. Fully exempt. RPF account note 3 I will explain little bit later. There are conditions. If those conditions has been satisfied, then fully exempt under section 10 subsection 12. Otherwise, the treatment is same as URPF. The treatment is same as URPF, that I will explain in note 4. PPF the lump sum amount received from PPF account is fully exempt under section 10 subsection 11. Now let's verify. Tax treatment for lump sum amount received from the employee from the RPF account at the time of retirement or leaving the job. Whenever a lump sum amount is received by the retiring employee from the RPF account at the time of retirement or leaving the job, then you need to verify one fact. What is the fact? The employee retired or leaving the job after providing continuous service of 5 years. After providing continuous service of 5 years. First fact, first situation. Second situation, within 5 years. Within 5 years. In case he retired or leaving the job after providing continuous service of 5 years, then it will be fully exempt from tax. The lump sum amount received from RPF account will be fully exempt from tax under section 10 subsection 12. When? In case he retired or leaving the job after providing continuous service of 5 years. In case within 5 years, then we need to verify the reason. If it is happened to be retired or leaving the job within 5 years, then we have to verify the reason. There are two possible reasons. First one is positive reason, second one is negative reason. If it is happened to be positive reason, then even though he retired or left the job within 5 years, then it will be fully exempt under section 10 subsection 12. In case it is happened to be negative reason, then the treatment is same as URPF. That means chargeability will arise, and the chargeability is same as URPF. Now, what are the positive reasons and what is the negative reason? The positive reasons are the employee retired or leaving the job within 5 years of continuous service of period due to the ill health of the employee. What is that? Due to the ill health of the employee. First positive reason. Second positive reason, due to the discontinuance of business of employer. Employer discontinued his business. That's why he is getting out of the organization within 5 years of period. Third positive reason, due to the contraction of the business of the employer. What do you mean by contraction of the business of the employer? The employer is incurring losses. Hence, he removed this employee from the organization without any mistake from his part. This is third positive reason, due to the contraction of the business of the employer. Fourth one, due to any other reason which is beyond the control of the employee. Due to any other reason beyond the control, which is beyond the control of the employee. That means there is no mistake from the part of the employee, but still he is getting out of the organization. Then it is to be treated as, these are to be treated as positive reasons. Then exemption will be available under section 10 subsection 12. Negative reason, willfully is retiring or leaving the job within 5 years of period of service, continuous period of service, willfully. That means there is a mistake from the part of the employee. Then the treatment shall be, exemption is not available under section 10 subsection 12. The treatment is same as URPF. Now let's verify what is the treatment as in case of URPF. The lump sum amount received from the URPF account, there are four categories of income. Category 1, employee own contribution. Category 2, employer matching contribution. Category 3, interest on employee own contribution. Category 4, interest on employer contribution. Come again. Employee contribution, employer contribution, interest on employee contribution, interest on employer contribution. In case of employee own contribution, it is eligible for exemption under section 10 subsection 12. Employee own contribution not taxable, eligible for exemption under section 10 subsection 12. In case of interest on employee own contribution, it is taxable under the head IFOS, income from other sources. When it comes to employer's contribution, interest on employer's contribution, that is taxable under the head income from salary, because there is a relation of employer and employee, past relation. Next, salary definition for the purpose of determination of permitted contribution of employer to RPF account. We verified employer contribution to RPF will be eligible for exemption up to 12% of salary. In case it is exceeding 12% of salary, in excess of 12% of salary shall be chargeable to tax. We verified. Then how to determine 12% of salary? What is the salary definition? Same as gratuity not covered, same as leave salary, same as HRA, same as VRS compensation. Most popular definition, basic plus DA R2RB plus commission as a percentage of turnover. Most popular definition. Again and again it is repeating. You need to remember and consider that definition, multiply with 12 months during the period of service, whatever it may be, 12 months or during the period of service, and apply 12% on that. That will become permitted contribution. Then compare with the actual contribution minus permitted contribution. If it is positive, then that will be treated as in excess of 12% of salary, that will be chargeable to tax. Note 1 interest on employer's contribution in the SPF account, I explained, fully exempt under section 10 subsection 11, but interest relating to employee contribution, remember, interest relating to employee contribution which is in excess of 2,50,000 shall be taxable under the head IFOS in the year of accrual. Amendment brought out through Finance Act 2021, very important. Interest on employer's contribution to SPF account fully exempt, but interest on employee own contribution exempt up to rupees 2,50,000. In case 3 lakhs has been credited, 3 lakhs interest has been credited, then up to 250 provide exemption under section 10 subsection 11. Then 50,000 in excess of 250, 50,000 will be chargeable to tax under the head IFOS in the year of credit. Are you following? Next note 2, interest on employer's contribution to RPF account exempt up to 9.5% per annum. In excess will be chargeable to tax under the head income from salary. But when it comes to interest relating to employees' own contribution, it is also same, up to 2,50,000 will be eligible for exemption under section 10 subsection 12. In excess will be chargeable to tax under the head IFOS. Are you following? It is also amendment brought out through Finance Act 2021. Very important, possibility for appearing in the examination. That's it, That is the pura discussion relating to retirement benefits, gratuity, section 10 subsection 10, pension, section 10 subsection 10A, leave salary, section 10 subsection 10AA, then retrenchment compensation, 10 subsection 10B, then VRS compensation, 10 subsection 10C, then in case of SPF, PPF, 10 subsection 11, in case of RPF, are you following? In case of RPF, 10 subsection 12, URPF also 10 subsection 12. Next let's verify deductions under section 16. Last concept, pay attention. How many deductions we are having under section 16? 3 deductions. Class 1A, standard deduction up to 50,000 rupees. Class 2, entertainment allowance. Class 3, professional tax paid. Let's verify one by one. Class 1A, standard deduction. Deduction under section 16, class 1A shall be list of the following. Standard deduction 50,000. Amount of salary here. Amount of salary means gross salary. What is that? Gross salary. Compare gross salary with 50,000. List will be provided as deduction under section 16 class 1A. Balance will be chargeable to tax under the head income from salary. Finance Act 2019 has been increased to 50,000. Before Finance Act 2019 it was 40,000. It was introduced in the Finance Act 2018 itself. Are you following? In the year of introduction it was 40,000. Subsequently it has been increased to 50,000 through Finance Act 2019. Next this deduction shall be allowed from gross salary. Very good. Note 2, this deduction will be allowed to all employees. Very important point. It is allowed to government employees as well as non-government employees. Why specifically mentioned? Because in case of entertainment allowance, the deduction will be allowed under section 16 class 2 only for government employees. In case of non-government employees, deduction shall not be allowed. That's why the lawmaker specifically mentioned this deduction 16 class 1A standard deduction shall be allowed to all employees, that is both government as well as non-government employees. Next 16 class 2 entertainment allowance. What is the treatment in case of entertainment allowance received by the non-government employees? Deduction is not allowed under section 16 class 2 in case of non-government employees. If it is happen to be government employees, the deduction will be allowed. The deduction is list of the following. Deduction under section 16 class 2 towards entertainment allowance is list of the following. 3 things we need to consider. First one, entertainment allowance actually received. Second one, first one, statutory limit 5,000. How much? 5,000. Second one, actually received. Third one, 20% of salary. What do you mean by salary? Just basic salary. What is the salary definition here? Just basic salary. Consider basic salary. Apply 20%. That will be the third part. List will be provided as deduction. Balance will be chargeable to tax. So first what we need to do? We need to charge to tax entertainment allowance received fully under the heading called taxable value of allowances. First charge to tax. Subsequently allow it as a deduction under section 16 class 2, very important. Next ma, professional tax paid. This professional tax will be paid on employment and deduction will be available under section 16 class 3. Now the point is, the professional tax is paid by the employee from his own pocket. The professional tax has been paid by the employee from his own pocket ma, then directly allow it as deduction under section 16 class 3. Why directly allow it as a deduction? Because it was already included in the basic salary. Don't again add to the salary income. So directly you need to claim it as a deduction under section 16 class 3. Second case, the professional tax has been paid by the employer on behalf of employee. What happened here? The professional tax has been paid by the employer on behalf of employee ma. That means the professional tax paid by the employer on behalf of employee is additional benefit received by the employee in addition to salary. Additional benefit received by the employee in addition to salary ma. In such a case, what we need to do? That must be chargeable to tax ma. That must be chargeable to tax under the heading called perquisites. You need to include in the gross salary under the head perquisites ma. Thereafter, it will be allowed as a deduction under section 16 class 3. Very important. Simple analysis. If it is directly paid by the employee, you need to directly allow it as a deduction under section 16 class 3. What is paid, you need to claim it as a deduction. In case it is paid by the employer on behalf of employee, then it is additional benefit received by the employee from the employer in addition to the salary. In such a case, first of all, you need to include in the gross salary under the heading called taxable of perquisites. Subsequently, it will be allowed as a deduction under section 16 class 3. Very important, the treatment. Okay ma, last topic, summary of salary definitions. So many salary definitions we have verified. Let's verify all those definitions at one place for easy understanding. Chalo. How many types of salary definitions are there in total? 5 ma. Let's verify one by one. For gratuity, covered case and retrenchment compensation, what is the salary definition ma? Basic plus DA, any DA. For gratuity, covered case and retrenchment compensation, what is salary definition? Basic plus DA. Which DA? Any DA. Next, most popular definition, salary definition, gratuity not covered, leave salary, VRS and RPF, HRA. For 5 items, we need to apply this salary definition. Most popular, what is that? Salary equal to basic plus DA R2RB plus commission as a percentage of turnover. Third one, for determining the status of employee, whether specified or non-specified. I have already explained at the time of discussion of perquisites ma. What is the salary definition? Basic plus DA, any DA plus bonus plus commission, any commission plus taxable value of allowances plus taxable value of monetary perquisites minus standard deduction under section 16 class 1A minus entertainment allowance minus professional tax paid. What is not to be included here? Non-monetary perquisites. Because for the chargeability, deciding the chargeability of non-monetary perquisites, we are deciding the status of the employee, hence that shall not be included. I have already explained. Next ma, for determination of housing accommodation benefit and hotel accommodation benefit ma, what is the salary definition? Basic plus DAR to RB plus commission, any commission plus bonus plus taxable value of allowances. Next ma, in case of entertainment allowances, salary equal to basic salary. That's it. That's it. These are the 5 types of salary definitions relating to the salary ma, for various items. With this, we have successfully completed the discussion relating to income from salary. Okay then, next we need to discuss income from house property. Thank you and good day. Shall we start? Chalo ma. Let's verify income from house property head ma. We have successfully completed the discussion relating to income from salary. Now let's verify next head of income called income from house property. Here I am going to cover each and every concept ma. I don't miss any important topic here. I will try to cover each and every important point from the viewpoint of examination. Only one thing required from your side is you need to pay attention. Chalo. Tell me, what are the dealing sections with reference to income from house property ma? Section 22 to 27. Come again. What are the dealing sections? Section 22 to 27 dealt with income from house property head. And let's verify the analysis of those sections ma. As usual, section 22, first section of the head of income, always charging section. The section 22 deals with charging section, whereas section 23, 24, 25 deals with computation of income from house property or annual value. What is that? Computation of income from house property or annual value. Next ma, section 26 deals with co-ownership. What is that? Co-ownership. Section 27 deals with deemed ownership. What is that ma? Deemed ownership. So that is the analysis of these sections from section 22 to 27. Let's go further ma. Tell me, what is the role of the charging section? If you observe, we are having charging section for every head of income ma. When it comes to income from salary, what is the charging section ma? Section 15. What about house property? 22. PGBP 28. Capital gains 45. And in case of other sources, 56 is the charging section, we know. So every head of income, for every head of income, the lawmaker has been given a charging section, a separate charging section. So obviously it must be having some importance, having some significance ma. So what is the importance, what is the significance, and what is the role of the charging section? Tell me. The point is, every charging section will specify certain conditions ma. If any particular income satisfies the conditions specified under that charging section comprised under that particular head, then that income will goes to that particular head and it will not goes to any other head of income. I will explain in detail. In case any particular income has been satisfied the conditions specified under section 15 ma, then that income will be taxable under the head income from salary. It will not go to any other head of income. In the same way, if any particular income satisfies the conditions specified under section 56, then that income will goes to the head called income from other sources. It will not go to any other head of income. Next, in case any particular income satisfies the conditions specified under section 28, you know what is 28? Section 28, then that income will goes to the head called PGBP. It will not goes to any other head of income. That means, tell me, what is the role of the charging section here ma? What is your observation from our discussion? That means those charging sections are showing the way to the relevant head of income. They are showing the way to the relevant head of income for a particular income. Are you following? Okay, let's verify ma. Every charging section will specify certain conditions. If any particular income satisfies the conditions specified in a particular charging section under a particular head, then such income will be taxable under that particular head, but it will not go to any other head of income. Understood? Okay. Next ma. There are three conditions which are required to be satisfied cumulatively for an income to be taxable under the head income from house property ma. If these three conditions satisfied cumulatively, then you have to charge that particular income under the head income from house property. In case any one of those conditions or all of those conditions has not been satisfied, then you cannot charge under the head income from house property. You need to charge either under the head PGBP or under the head other sources. Are you following? Now let's verify what are the three conditions required to be satisfied cumulatively. First condition ma, the rental income must be received from letting out of building or land connected to the building. Come again. The rental income must be received from letting out of building or land connected to the building. What is the analysis of this condition? Say for example, car has been given on let out ma. We are verifying the first condition, pay attention. Car has been given on let out. Can we charge, and rental income has been received, can we charge that rental income under the head house property ma? Obviously no. Because car is not covered under the term building, and car is not covered under the another technical term called land connected to the building. Hence, you cannot charge under the head house property. You need to charge either under the head PGBP or under the head other sources. Are you following? Next example. Say for example, vacant site has been given on layout ma. Not land connected to the building, it is vacant site has been given on layout. Can we charge that rental income from letting out of vacant site under the head income from house property ma? Obviously no, because that vacant site is not covered under the term called land connected to the building. Could you please let me know what is the difference between land connected to the building and vacant site ma? What is the difference? In case the land is situated within the boundary wall or compound wall of the building. What is that ma? The land is situated within the boundary wall or compound wall of the building, then you need to treat it as a land connected to the building. Any rental income has been received from letting out of that particular land, then you need to charge under the head income from house property. And second case ma, in case the land is situated outside the boundary wall or compound wall of the building, then you cannot treat it as land connected to the building. You need to give the status of vacant site. What is that ma? Vacant site. Then that rental income you need to charge either under the head PGBP or under the head other sources, but you cannot charge under the head income from house property. Are you following? Then what do you mean by the term building ma? In case of residential houses, the term building includes residential houses, nothing but independent houses, flats in apartments, shops, commercial complex, buildings for offices, auditoriums, marriage function halls. These are the various things covered under the term called building ma. In case any one of these has been given on layout and receiving rental income, then you need to treat it as building, and that must be chargeable under the head income from house property, should not be taxable under any other head of income. So that is the explanation regarding first condition. So tell me, what is the first condition? The rental income must be received from letting out of building or land connected to the building. Very good. Second condition, the receiver of the rent must be the owner of such building or land connected to the building. Come again ma, what is the second condition? The receiver of the rent must be the owner of such building or land connected to the building which are given on layout. That means in case the person who is receiving the rent is not the owner ma, he is not the owner, then you cannot charge under the head house property. It will goes to either under the head PGBP or under the head other sources. So what is the second condition? The recipient of the rent must be the owner. Third condition ma, the owner should not use such building for his own business or profession. That means he should not carry on his business or profession in the premises of that building. What happens in case the person, the owner, carrying his business or profession in that premises ma, own premises ma, you cannot come, you cannot charge under the head house property. You need to go to the head called PGBP. Under the head PGBP, you need to claim depreciation under section 32. That's why the third condition says the owner should not use such a building for his own business or profession. Are you following? So these are the three conditions which are required to be satisfied cumulatively for an income to be taxable under the head income from house property. So tell me, what are the three conditions required to be satisfied cumulatively ma? The rental income must be received from letting out of building or land connected to the building. Second condition, the recipient of the rent, the receiver of the rent must be the owner of such building or land connected to the building which are given on layout. Third condition ma, the owner should not use such a building for his own business or profession. That means it must be given on layout. Then you need to charge that rental income under the head income from house property. Very good. Next ma, let's verify section 145 subsection 1. If you remember, please tell me what section 145 subsection 1 says. It is relating to method of accounting. Come again. It is relating to method of accounting. Tell me, what is the method of accounting applicable for income from salary? We have already verified. What is the applicable method of accounting for income from salary ma? Due or receipt whichever is earlier. Come again. Due or receipt whichever is earlier. That is specified by the income tax department and must and should followed by the assessee. You don't have any option. Then what is the method of accounting applicable for income from house property, ma? The head which we are discussing now. What is the applicable method of accounting? Please tell me. It is accrual basis. What do you mean by accrual basis, ma? Receivable basis. So what is the applicable method of accounting for income from house property? Receivable basis, ma, not received basis. It is receivable basis. It is also specified by the income tax department, and you need to follow on a mandatory basis. You don't have any other option. Next, ma, what is the applicable method of accounting for income from capital gain? Same as house property, accrual basis, nothing but receivable basis. It is also specified by the income tax department and must and should followed by the assessee. Next, ma, what about in case of PGBP? What is the applicable method of accounting in case of PGBP? Either mercantile system of accounting or cash system of accounting, whichever is followed by the assessee at his option. The assessee can follow either mercantile system of accounting or cash system of accounting at his option, but it must be followed regularly. Are you following? What do you mean by regularly? 1 year you want to apply mercantile system of accounting, another year you want to shift to cash system of accounting, again you want to come to mercantile system of accounting, not possible. Once you want to go for mercantile system of accounting, then it must be applied continuously, regularly. That is what you mean by must be applied regularly. Are you following? So what is the applicable method of accounting for PGBP? Either mercantile system of accounting or cash system of accounting at the option of the assessee, but it must be followed regularly. And next, in case of other sources, same as PGBP, either mercantile system or cash system, whichever is followed by the assessee at his option, but it must be followed regularly. Now, after completion of method of accounting discussion for 5 heads of income, tell me for how many heads the assessee is having option, for how many heads assessee don't have any option, ma, please tell me. For 3 heads of income, assessee don't have any option. He needs to follow the specification made by the income tax department, ma. What are those heads of income? For income from salary, income from house property, income from capital gains, we don't have any option. We need to follow the specification made by the income tax department. But when it comes to remaining 2 heads of income, PGBP and other sources, assessee is having option. He can go for either mercantile system or cash system, but it must be followed regularly. Okay, ma, that is a discussion relating to method of accounting specified under section 145 subsection 1. I hope you understood. Let's verify the next concept, ma. What is the role of method of accounting? Please tell me. Because every head of income is having method of accounting, right? So lawmaker for certain heads they specified method of accounting. For remaining heads they have given option to the assessee to choose either mercantile system or cash system. So tell me, what is the importance, what is the role, what is the significance of the method of accounting, ma? The importance, the role is the method of accounting will decides or determines how much income shall be taxable in a particular previous year. Come again. The method of accounting will decides or determines how much income shall be taxable in a particular previous year, ma. How? I will explain with the help of 2 examples. Pay attention. Say for example, the owner has been given house property on let-out basis for 12 months, ma. During the previous year 21-22, pura 12 months has been given on let-out. If at all the tenant occupied for 12 months during the previous year 21-22, then the tenant is liable to pay rent to the owner for 12 months. But what happened here? He paid only for 9 months. 3 months he did not pay. He requested the owner, sir, please accept 9 months rent. 3 months rent I will pay in the next year. Now my financial condition is not that much good. Please accept my request. He requested. Now the owner accepted because of by seeing the bad financial condition of the tenant, he accepted, ma, and he received only 9 months rent. If at all he received 9 months rent out of 12 months which is given on let out, tell me what is the number of months rent taxable in the previous year 21-22 under the head income from house property, ma? For that you need to verify method of accounting specified under section 145 subsection 1. Tell me what is the applicable method of accounting for income from house property ma? Accrual basis. What do you mean by accrual basis? In simple terms, receivable basis. Tell me how many months rent receivable to the owner here? 12 months. But what is actually received by the owner? 9 months. Now tell me, by considering the method of accounting specified under section 145 subsection 1, how many months rent we need to charge under the head income from house property ma? Receivable basis we need to charge, right? That means 12 months rent we need to charge under the head house property, even though the owner is received 9 months rent. That means here the method of accounting decides you need to charge 12 months but not 9 months. Are you following? Second example, 12 months the owner given on let out ma. The tenant also occupied for 12 months, but he paid 15 months rent ma. How it is possible? 12 months relating to previous year 21-22 and 3 months advance rent relating to previous year 22-23 also paid by the tenant to the owner. Total 15 months rent received by the owner here. If it all 15 months rent received by the owner, tell me how many months rent shall be taxable under the head income from house property in the previous year 21-22 ma? Again, we need to verify method of accounting specified under section 145 subsection 1. So tell me what method of accounting says ma? Accrual basis means receivable basis. Tell me out of 15 months rent, how many months rent became receivable by the owner ma? Only 12 months. Because the period for which it is occupied by the tenant alone is receivable by the owner, right? So how many months he occupied? Only 12 months. That means only 12 months rent is receivable by the owner, but 3 months is not yet receivable. Not receivable yet. Why? Because it will become receivable once the tenant occupied the property. When he can occupy the property? In the next previous year 22-23. Are you following? That means not yet occupied, hence it is not receivable 3 months rent, even though he received 3 months rent, even though it is in the pocket of the owner, but we need to charge only 12 months, which is receivable. Again, we decided 12 months out of 15 months by following method of accounting specified under section 145 subsection 1. This is how the method of accounting decides or determines how much income shall be taxable in a particular previous year. In our first example, it decided 12 months needs to be chargeable to tax under the head house property, even though 9 months rent is actually received. Second case, my second example, 12 months rent, again 12 months rent shall be chargeable to tax under the head income from house property, even though the owner received 15 months rent, that is 3 months rent in advance. Still, we are charging 12 months under the head income from house property. That is the role of the method of accounting. Are you following? Chalo, next ma. The method of accounting will decides or determines how much income must be taxable in a particular previous year. Very good. Next ma. Let's verify the format for determination of income from house property. Every head of income is having format to determine income under that particular head of income. Income from salary is having format, capital gains is having format, PGBP having format, other sources having format, house property also having format to determine income from house property. So let's verify what that format says. Particulars, inner column, outer column. First, we need to consider gross annual value. What is that ma? Gross annual value we need to consider. From gross annual value, you need to reduce municipal taxes paid. If you reduce municipal taxes paid from the gross annual value, then you will get a net annual value. What is that ma? Net annual value. From net annual value, you need to reduce deductions under section 24. Very important. How many deductions we are having under section 24 ma? 2 deductions. What are those 2 deductions? Class A, SD at the rate 30% of NAV. Class B, interest on borrowed capital. Come again. Class A, 30% of transaction at the rate 30% of NAV. Class B, interest on borrowed capital. If you reduce these 2 things from net annual value, then you will get income from house property or annual value. Technically, annual value. In general term, we can say income from house property. Understood ma? So this is the format to determine income from house property or annual value. Tell me, the rent receivable is chargeable to tax ma? No. Gross annual value chargeable to tax? No. Net annual value chargeable to tax? No. Then what is chargeable to tax? Annual value or income from house property. And this is the procedure to determine that annual value or income from house property. So please tell me, what is the format to determine income from house property or annual value, ma? Come on. Gross annual value less municipal taxes paid, then you will get NAV less deductions under section 24. Then class A, SD at the rate 30% of NAV, class B, interest on borrowed capital, then you will get income from house property or annual value. Very good. Now we need to discuss each and every technical term comprised in that format in detail, ma. What do you mean by gross annual value? How to determine such a gross annual value we need to discuss. And what is the discussion relating to municipal taxes we need to discuss. And what about standard deduction at the rate 30% of NAV? Why department is allowing that standard deduction, and what is the discussion relating to that we need to analyze. Then interest on borrowed capital, very important discussion we need to go through. Are you following? Chalo ma, let's verify one by one starting from gross annual value. Let's verify the procedure for determination of gross annual value, ma. Tell me how to determine gross annual value. To determine gross annual value, you need to follow 4 steps, ma. How many steps? 4 steps you need to follow. Step 1, step 2, step 3, step 4 to determine gross annual value. Then if you go through these 4 steps, finally in step 4 you will get gross annual value. Let's verify one by one. What are those 4 steps? Step 1, pay attention, ma. Municipal value or pay rent or similar property rent, whichever is higher, shall be treated as expected rent, ma. Come again. Municipal value or pay rent or similar property rent, whichever is higher, shall be treated as expected rent. I will explain what is municipal value. Municipal value means the rent capacity, the rent earning capacity of the property as per municipality. Come again. The rent earning capacity of the property as per municipality shall be treated as municipal value. Whereas what do you mean by pay rent or similar property rent? Both are one and the same. Pay rent or similar property rent, both are one and the same. What do you mean by pay rent or similar property rent? The rent amount which would fetch by the similar property in the same area. Come again. The rent amount which would fetch by the similar property in the same area, technically treated as pay rent or similar property rent. Compare municipal value with pay rent or similar property rent. Consider whichever is higher, that will become expected rent. Are you following? Good. Next, ma, step 2. What is step 2? Expected rent determined in step 1 or standard rent, whichever is lower, again shall be treated as expected rent. There is no discussion regarding expected rent, ma, because in step 1 we have already discussed regarding expected rent. Then what about standard rent? What do you mean by standard rent? The rent amount which is fixed by the Rent to Control Act. Come again. The rent amount which is fixed by the Rent to Control Act shall be treated as standard rent, ma. To safeguard the interest of the tenants, the lawmakers introduced the enactment called, what is that? Rent to Control Act, ma, to safeguard the interest of the tenants. Are you following? Now, what happened here? That expected rent you need to compare. You need to compare with the standard rent, and that expected rent should not exceed the standard rent. That's why the lawmaker says whichever is lower shall be treated as expected rent. Expected rent means nothing but the expectation of the department regarding the property relating to rent. What is that? Expectation of the department relating to the rent amount from that property shall be treated as expected rent. That department expectation should not be more than the standard rent fixed by the Rent to Control Act. That's why the lawmaker says expected rent or standard rent, whichever is lower, shall be again treated as expected rent. Are you following? Next, ma, step 3. What do you mean by step 3? Actual rent. How to determine actual rent? There is a formula for determination of actual rent. You need to remember. What is the formula for determination of actual rent, ma? Rent for 12 months period minus rent for vacant period minus unrealized rent. Come again. Rent for 12 months period minus rent for vacant period minus unrealized rent. That means from 12 months rent, you need to reduce rent for vacant period. Why we are reducing rent for vacant period? If at all the property been vacant for few months, then you are not going to receive any rent ma. Therefore, from 12 months rent, 12 months period of rent, we need to reduce vacant period rent. Are you following? Because it is not actually reached the pocket of the owner. Understood the point? Then again we need to reduce unrealized rent. What is the discussion relating to unrealized rent? I will explain little bit later, but for the time being, if there is any unrealized rent, that means the rent which is not realized by the owner, you need to reduce while determining the actual rent, because it is not realized, it is not reached the pocket of the owner, hence you should not consider while determining actual rent. So tell me the formula for determination of actual rent ma. Rent for 12 months period minus rent for vacant period minus unrealized rent. Very simple. Next ma, step 4. What is step 4? Actual rent determined in step 3 or expected rent determined in step 2, whichever is higher in general treated as gross annual value. Come again ma. Actual rent determined in step 3. Expected rent means expectation of the department determined in step 2, whichever is higher in general treated as, what is that? Gross annual value. Next ma, let's go for further discussion. What is the note point says? Please tell me. Whenever the actual rent is less than expected rent. Come again. The actual rent is less than expected rent. That means the rent amount declared by the owner, the rent amount declared by the SSC, which is received by the SSC into his pocket, is less than the expectation of the department. Then we need to verify the reason on a mandatory basis. In each and every case, when actual rent is less than expected rent, then we need to verify the reason on a mandatory basis. Let's verify the reason ma. When you verify the reason, there are two possible outputs ma. What are the two possible outputs? First one is positive reason, second one is negative reason. First one is positive reason, second one is negative reason. If it is happen to be positive reason, then actual rent, even though it is less than the expected rent, that is expectation of the department, still that lesser amount, that is actual rent, shall be treated as gross annual value. When ma? If it is happen to be positive reason. Next, if it is happen to be negative reason, then actual rent which is less than the expected rent shall not be treated as gross annual value, but the expectation of the department, that is expected rent, shall be treated as gross annual value. Are you following? Say for example, actual rent is 3 lakhs ma. Expected rent, that is expectation of the department, is 5 lakhs. 3 lakhs actual rent, 5 lakhs expected rent. If it is happen to be positive reason, tell me what shall be taken as GAV? Actual rent of 3 lakhs shall be taken as GAV. Department will not, ask you to consider 5 lakhs as a GAV, because it is happen to be a positive reason. Then they will ask you to go for 3 lakhs, which is actually declared by you. In case it is happen to be negative reason, then actual and 3 lakhs will not be considered by the department. They will consider expected rent of 5 lakhs as a gross annual value. Understood the point ma? Chalo. Positive reason, negative reason. If it is happen to be positive reason, actual rent is less than expected rent. What is the positive reason? I will explain. Actual rent is less than expected rent due to the reason of vacancy. Come again ma. The actual rent is less than expected rent, 3 lakh, less than 5 lakh. Why? Due to the reason of vacancy. In case there is no vacancy, the actual rent would have been more than the expected rent, or at least equal to the expected rent. But why the actual rent is less than expected rent? Why it is 3 lakhs? Why it is not 5 lakhs? Due to the reason of vacancy. Then it will be treated as positive reason. You need to consider actual rent of 3 lakhs as a gross annual value. Next ma, when you need to treat it as negative reason, Actual rent is less than expected rent, not due to the reason of vacancy, but due to any other reason. Come again, not due to the reason of vacancy, but due to any other reason. Then department will not consider actual rent 3 lakhs as GAV, because you are trying to deceive the department. You entered into some fraudulent activity to escape the income from the assessment. Then the lawmaker, the department will consider 5 lakhs, expectation of the department, expected rent of 5 lakhs as a gross annual value. Chalo. AR is less than ER due to the reason of vacancy, then AR shall be taken as GAV. I hope you understood, ma. In such a case, GAV equal to actual rent. Next, ma, negative reason. AR is less than ER. Why? Not due to the reason of vacancy, but due to any other reason. Then ER shall be taken as GAV. Department will not consider actual rent declared by you, because you are trying to enter into the fraudulent activity to income. We escape the income from the assessment. I don't consider your actual rent. I will consider expected rent of 5 lakhs as a GAV. That is the point here. Okay, ma. That is the discussion relating to gross annual value. Next, ma. Let's verify municipal taxes. Tell me, what is the treatment for municipal taxes payment, ma? It will be allowed as deduction from gross annual value, right? When that municipal tax payment will be allowed as deduction from gross annual value? Two conditions specified relating to municipal taxes, ma. In case those two conditions satisfied cumulatively, then only such municipal taxes will be allowed as deduction from gross annual value. In case any one of those conditions or both the conditions not satisfied, then such municipal taxes shall not be allowed as a deduction from the gross annual value. Now let's verify what are the conditions specified relating to allowing the municipal taxes as a deduction. Municipal taxes will be allowed as deduction from GAV provided the following two conditions has been satisfied cumulatively. First condition, ma, municipal taxes shall be actually paid during the current previous year. Very, very important. What is the first condition, ma? Municipal taxes shall be actually paid during the current previous year. Nothing but cash basis allowed as deduction. If you want to claim municipal tax as a deduction in a particular previous year, then in that previous year, what you need to do? You have to actually, you need to pay the municipal tax to the department, that municipal authority, then only it will be allowed as a deduction, ma. Second condition, such municipal taxes shall be paid by the owner. Very, very, very important. Such municipal taxes shall be paid by the owner. That means in case the municipal tax is paid by the tenant, ma, allowed as deduction, not allowed as deduction, not allowed as deduction, because the second condition says it must be paid by the owner. So tell me, what are the two conditions, ma? First condition, actually paid during the current previous year, cash basis, and that must be second condition, that must be paid by the owner. If these two conditions satisfied cumulatively, we can claim it as a deduction from the gross annual value. Are you following? Yes. In the examination, they will give municipal taxes paid by the tenant. Can we claim it as a deduction, ma? Obviously no, because it must be paid by the owner. Second case, municipal taxes payable 10,000. They said payable, ma. That means not actually paid. You cannot claim it as a deduction. Are you following? Yes. Next, ma. Gross annual value completed, less municipal taxes paid, then you will get net annual value. So discussion is over. Next, ma, from net annual value, we need to claim deductions under section 24. Under section 24, how many deductions we are having, ma? Two deductions. First one, class A, SD at the rate 30% of NAV. Class B, interest on borrowed capital. Now let's verify class A, SD at the rate 30% of NAV. The point is, why lawmakers are allowing standard deduction, ma, at the rate 30% of NAV? The lawmakers allowing 30% of NAV as standard deduction towards painting expenditure, repairs expenditure of the house property, insurance payment of the house property, any other house property related expenditure. Are you following? the standard deduction at the rate 30% of NAV, the lawmakers are allowing towards painting expenditures, repair expenditures, insurance expenditure of the property, any other expenditure relating to house property. So towards those expenditures, they're allowing standard deduction at the rate 30% of NAV. That means this deduction will be allowed, the standard deduction will be allowed irrespective of actual expenditure incurred by the SSE. Come again, ma? With respect to actual expenditure, irrespective of the actual expenditure, irrespective of the actual expenditure incurred by the SSE, standard deduction at the rate 30% of NAV shall be allowed as deduction. What do you mean by irrespective of the actual expenditure incurred by the SSE, ma? During particular previous year, no expenditure has been incurred by the owner, ma, relating to the house property. Any repairs no repair expenditure, no insurance expenditure, assume, and no painting expenditure, no other expenditure. Can we claim it as a deduction? Yes, still we can claim it as a deduction because it is standard deduction irrespective of actual expenditure. Second case, ma, tenant incurred some repair expenditure to the property. Is it possible for the owner to claim it as a deduction? Obviously, because it is a standard deduction. Huge expenditure actually incurred by the SSE, ma. What is that? Huge expenditure relating to repairs incurred by the SSE. Can we claim that huge expenditure? No. 30% of NAV as a standard deduction. Are you following? That means huge expenditure incurred, less expenditure incurred, no expenditure incurred, or expenditure incurred by the tenant. In all cases, irrespective of the fact, irrespective of the expenditure, a standard deduction at the rate 30% of NAV shall be allowed as a deduction. Are you following? Yes. Let's verify, ma, very important. A standard deduction at the rate 30% of NAV will be allowed as deduction under section 24 clause A. This standard deduction will be allowed to the SSE towards repair expenditure of those property, painting, insurance and other house property related expenses. This standard deduction will be allowed to the SSE irrespective of the actual expenditure incurred by him. That is, there is no relevance for the actual expenditure incurred by the SSE. In the examination, they will give repair expenditure 30,000, painting expenditure 20,000, insurance 10,000. What you need to do? Don't give any relevance to that actual expenditure, ma. Why? There is no relevance to the actual expenditure. Don't consider. To mislead the students, they are giving that information. Don't consider that information. Irrespective of that information, you need to claim 30% of NAV as a standard deduction, remember. Next, ma, that means whether the SSE incurred huge expenditure or less expenditure or nil expenditure or expenditure incurred by the tenant. In all these cases, a SD at the rate 30% of NAV shall be allowed as a deduction. Understood? That is the discussion relating to municipal tax. Sorry, standard deduction at the rate 30% of NAV. Next, ma. Very, very, very important discussion we are going to discuss. Pay attention. Interest on borrowed capital. What is that, ma? Interest on borrowed capital. Very important. Let's verify one by one. First point we are going to verify. What are the purposes for which loan amount should be borrowed? What is the question, ma? What are the purposes for which the loan amount should be borrowed? I will explain. Say for example, the SSE borrowed the loan for purchase of car, assume. He borrowed the loan amount for purchase of car and he is paying interest. He is paying what, ma? Interest. Can we claim that interest expenditure as deduction under section 24 clause B? Obviously no. Department don't allow that interest expenditure under section 24 clause B. Strictly prohibited. Second case, SSE borrowed the loan amount for the purpose of foreign tour. What is the purpose? Foreign tour. And interest paid. Can we claim that interest payment as deduction under section 24 clause B, ma? Again, obviously not allowed. That means there are certain purposes for which the loan amount should be borrowed, then only it will be allowed as deduction. Otherwise, it is not allowed as deduction, ma. So let's verify what are the purposes for which the loan amount should be borrowed. There are 5 eligible purposes for which you need to borrow the loan amount to claim it as a deduction under section 24 clause B. What are the 5 eligible purposes, ma? For purchase of house property, for construction of house property, for renovation of house property, for reconstruction of house property. Are you following? For repairs of house property. Let's verify one by one. The following are the 5 purposes for which the loan amount should be borrowed by the assessee: for purchase of the house property, for construction of the house property, for repairs of the house property, for renovation of the house property, for reconstruction of the house property. These are the 5 eligible purposes for which the loan amount should be borrowed in case the assessee borrowed for any other purpose. Borrowed for any other purpose other than these 5, then that interest payment shall not be allowed as a deduction under section 24 class B. Understood? Yes. So tell me, what are the 5 eligible purposes, ma? Purchase, construction, repairs, renovation, reconstruction. These are the 5 eligible purposes. Next, ma. The person from whom loan amount should be borrowed. Second question. From whom you need to borrow the loan amount to claim it as a deduction under section 24 class B? That is the question. Tell me, from whom you need to borrow the loan amount, ma? See, there is a restriction. What is that? There is a restriction on the purpose for which the loan amount should be borrowed, but there is no restriction from whom you should borrow the loan amount. That means there is a restriction on purpose, but there is no restriction on lender. What do you mean by there is no restriction on lender, ma? You can borrow from any person, ma. You can borrow from banks, financial institutions, money lenders, friends, relatives, even from non-residents you can borrow. There is no restriction. You can borrow from any person. There is no restriction. Department will allow it as a deduction under section 24 class B. Let's verify. There is a restriction on purpose, but there is no restriction on lender. We can borrow the loan amount from banks, financial institutions, money lenders, relatives, friends, and even from non-residents. Very important point. Third point, ma, very important. We are going to discuss. Pay attention. Interest shall be allowed as deduction under section 24 class B on payable basis. Very, very important. Come again. Interest under section 24 class B shall be allowed as deduction on payable basis, that is due basis. What is the relevance of that statement, ma? Say for example, in the examination they have given that interest payable 30,000, actually paid 25,000. Payable 30, paid during the current previous year 25,000 actually paid. Then what is allowed as deduction under section 24 class B, ma? 30,000, because interest shall be allowed on payable basis. That means 0 rupees you actually paid, nothing has been paid. Still 30,000 rupees shall be allowed as deduction because 24 class B is allowing on payable basis. What is the difference between municipal taxes and interest, ma? When it comes to municipal taxes, it will be allowed as deduction on cash basis, actual payment basis. But when it comes to interest, ma, it will be allowed on payable basis. In the examination, they have given that payable 30,000, paid 25,000. What you need to allow it as deduction, ma? 30,000, because 24 class be allowing on payable basis. Very important point. Remember. Next, ma, interest. There are 2 types of interest, ma. How many? There are 2 types of interest. First one is pre-construction period interest. Second one is current year interest. What are those? Pre-construction period interest, current year interest. Why the lawmakers bifurcated interest into 2 categories like pre-construction period interest and current year interest, ma? Tell me why they have bifurcated like that? Because the tax treatment is different. The tax treatment is different for pre-construction period interest and current year interest. Not same treatment we are giving. We are giving different treatment. That's why we need to bifurcate out of total interest what is PCPI and what is CYI. And the respective treatment we have to give. Are you following? Now, let's verify what you mean by pre-construction period interest, ma. Interest relating to the pre-construction period shall be treated as PCPI. Simple. What is that? Interest relating to pre-construction period. You paid interest for pre-construction period, ma, then it will be regarded as pre-construction period interest. Whereas what do you mean by current year interest? Interest relating to current year period shall be treated as current year interest. Now let's verify what is pre-construction period, what is current year period. Then only you will get to know what is PCP and what is CYI. So let's verify what is pre-construction period. The previous years in which the house property is not in existence shall be treated as pre-construction period. Ma. What is that? The previous years in which house property is not in existence. Then you need to treat those previous years as pre-construction period. Then interest relating to that pre-construction period shall be treated as pre-construction period interest. Are you following? Then what do you mean by current year period, ma? Pay attention. What do you mean by current year period? The previous year or previous years in which the house property came into the existence or in existence shall be treated as current year period. Come again. The previous year or previous years in which the house property came into the existence. Ma. What do you mean by came into the existence? The construction has been completed. Then you can call it as came into the existence. That means the previous year in which the construction has been completed will be treated as the year in which the property came into the existence. Then that year will be treated as current year period. Or the house property in existence. Ma. Once the house property came into the existence means in all subsequent years, what is the status of that house property? Ma? In existence, then that period also treated as current year period. Are you following? That means from which previous year current year period will start? Current year period will start from the previous year in which the house property came into the existence, nothing but the previous year in which the property construction of the property has been completed. From that previous year, you need to treat it as current year period. Are you following? The interest relating to that current year period shall be treated as current year interest. Ma. Next. Now there is a formula. There is a simple formula to determine pre-construction period. Ma. In case in the examination, if you apply this formula, it is very easy to determine pre-construction period. Once you determine the pre-construction period, then it is very easy to determine pre-construction period interest. So let's verify what is the formula for determination of pre-construction period. Pre-construction period starts from date of taking loan. Start from date of taking loan. Start from date of taking loan. Ends with 31st March immediately preceding to the date of completion of construction. That means consider what is the date of completion of construction. Immediately preceding to that, consider 31st March. Now that is the end date for the pre-construction period. Then if you apply this formula in the examination, it is very easy for you to determine pre-construction period. Ma. Then what is the formula for determination of current year period? Current year period start from date immediately next to the, what is that, pre-construction period or first day of the current previous year. Ma. Come again. The date immediately next to the pre-construction period or first day of the current previous year, whichever is later. Ma. Whichever is later. Ends with date of repayment of loan or last day of the current previous year, whichever is earlier. In simple terms, our current previous year will become current year period. Ma. Come again. Our current previous year will become current year period. What is our current previous year? 21-22. That will become current year period. Are you following? Because from beginning date, in case of beginning, starts from what is the one of the thing in that formula? Ma? First day of the current previous year. Ends with the last day of the current previous year. Are you following? Simply say current previous year will be treated as current year period. Next, ma. Now let's verify the tax treatment for pre-construction period interest. What is the tax treatment for pre-construction period interest, ma? Pre-construction period interest will be allowed as deduction in 5 equal annual installments starting from the previous year in which the house property came into the existence. Tell me whether lawmakers allowing fully or 5 equal annual installments. 5 equal annual installments. From which previous year you need to start that installment allowance, ma? From the previous year in which the house property came into the existence. Why? because without having existence of those property, you cannot claim related expenditure as a deduction. That's why the lawmaker is allowing from the previous year in which the house property came into the existence 5 equal annual installments. Understood? Then what is the tax treatment for current year interest? Current year interest will be fully allowed as deduction in the respect to previous year. What is that? Fully allowed as deduction in the respect to current previous year itself. Now tell me, why PCPI lawmakers allowing in 5 equal annual installments, and when it comes to current year interest, why they're allowing fully, ma? The reason is the pre-construction period may be less than 1 year, equal to 1 year, or even more than 1 year, ma. Any limit for more than 1 year? No. That may be 2 years, or 5 years, or 10 years, or 20 years. Are you following? There is no limit for more than 1 year. Say for example, the pre-construction period is 10 years, ma, assume. That means the assessee took 10 years to construct the house property. Then what is the pre-construction period here? 10 years. Are you following? Then 10 years, every year 10 lakh rupees interest has been paid. That means what is the total interest for 10 years period? 1 crore. If lawmakers are allowing entire 10 years interest in one single previous year, entire 1 crore in one single previous year, then it will be obviously resulted into loss under the head income from house property. If it is resulted into loss, then the assessee will try to adjust against other heads of income or income under the same head. Then what happens to the department? They will lose the revenue loss to the department, because huge expenditure they are allowing in the single previous year. For that they are not ready, ma. Hence they says, I will allow in 5 equal annual installments but not in single year, because the pre-construction period may be any number of years. There is no limit. That's why they are allowing in 5 equal annual installments. When it comes to current year interest, they are allowing fully in the current previous year itself. Why? Because the current year period is either less than 1 year or equal to 1 year. It is not possible to have more than 1 year. Either less than 1 year or equal to 1 year. When it will become less than 1 year, say for example, 31st December, you repaid entire loan amount along with interest. On 31st December, you repaid entire loan amount along with the interest. Then only 9 months you need to pay the interest to the bank. In such a case, it is less than 1 year. Second case, say for example, in the current previous year, there was no repayment made to the bank, still outstanding at the end of the current previous year. If the loan amount is still outstanding, then total 12 months, pura 12 months you are paying interest, then it will be equal to 1 year. That means either it is less than 1 year if you repaid before 31st March. If you have not repaid, equal to 12 months. Not possible to have more than 12 months, ma. That's why they're allowing fully, because 1 year interest they are allowing fully. Any problem to the department here? No problem for allowing 1 year interest in the same year. Are you following? So that is the reason for allowing PCPA in 5 equal annual installments and current year interest fully, ma. Next. Next concept, maximum amount of interest allowed as deduction under section 24 clause B. What is the maximum amount of interest allowed as deduction? We need to discuss. In case of self-occupied property or unoccupied property, pay attention, ma. Come again. In case of self-occupied property or unoccupied property, the maximum interest allowed as deduction is either 2 lakhs or 30,000. Up to either 2 lakhs or 30,000. When 2 lakhs, when 30,000. There are 3 conditions specified under section 24 clause B. In case those 3 conditions has been satisfied cumulatively, then the interest deduction in case of self-occupied property or unoccupied property is up to rupees 2 lakhs. In case any one of those conditions or all of those conditions has not been satisfied, then maximum up to 30,000 allowed as a deduction. When, ma? This restriction, these conditions will come only when the status of the house property is self-occupied property or unoccupied property. In case of any other property status, ma, like deemed let-out property or let-out property, part of the house property self-occupied, part of the house property given on let-out, house property is self-occupied for part of the year and given on let out for part of the year. In case of this status, there is no restriction, there is no limit. Unlimited interest will be allowed as deduction without any restrictions or conditions. So when we need to apply these restrictions, these conditions, only when the status of those properties SOP or UOP. What is SOP? Self-occupied. What is UOP? Unoccupied. Let's verify. In case of self-occupied property, unoccupied property, maximum amount of interest allowed as deduction under section 24 class B is up to rupees 2 lakhs, provided the following three conditions are satisfied cumulatively. Any one of them or all of them are not satisfied, it is not 2 lakhs, it is up to 30,000. What about in case of any other property like LOP, DLOP, etc.? Unlimited interest will be allowed as deduction without any conditions or restrictions. You need to remember. Now let's verify what are the three conditions specified in case of SOP or UOP. First condition, the capital amount should be borrowed for the purpose of purchase or construction and it must be borrowed on or after 1/4/1999. Come again, the capital amount should be borrowed for the purpose of purchase or construction. That means if you borrowed for repairs, renovation, reconstruction, first condition will not be satisfied, then 2 lakhs shall not be allowed. Up to 30,000 alone allowed as deduction. That means the purpose must be either purchase or construction. That too when you need to borrow on or after 1/4/1999. That means say for example you borrowed for the purpose of purchase or construction, but it has been borrowed before 1/4/1999. Then can we claim to up to 2 lakhs as deduction? No, up to 30,000 only. That means this first condition comprises two subconditions. What is subcondition 1? It must be borrowed for purchase or construction. Subcondition 2 must be borrowed on or after 1/4/1999. Then only you can say that first condition has been satisfied. Next, second condition, the construction of the property must be completed within 5 years from the end of the financial year in which the loan amount has been borrowed. Come again. The construction of the property must be completed within 5 years from the end of the financial year in which the loan amount has been borrowed. Say for example, financial year 21-22, you borrowed the loan amount. What is the financial year in which you borrowed the loan amount? 21-22. What is the end of that financial year? 31st March 2022. From there within 5 years. What do you mean by from there within 5 years? 31st March 22. From there within 5 years means 23, 24, 25, 26, 27. That means you need to complete the construction of your property on or before 31st March 2027. In case after 31st March 2027, you completed the construction, second condition will not be satisfied. Up to 2 lakhs shall not be eligible. You are eligible only up to 30,000. That is the analysis. Next, a certificate should be obtained by the owner from the lender specifying that the loan amount has been utilized for the purpose of purchase or construction. Come again, a certificate should be obtained by the SSC from the lender specifying that the loan amount has been utilized for the purpose of purchase or construction, because that is a proof, documentary evidence regarding you have applied for the purpose of purchase or construction, you have not applied for any other purpose. Who has to give that certificate? Lender. See, in the examination, in that question, first two conditions has been satisfied, but there is no information relating to the third condition. There is no information relating to the third condition. Then what you have to do? You need to take assumption regarding third condition. What is the assumption you need to take? Being a chartered accountant, you need to give maximum benefit to your client. That means what is the assumption you need to consider here? Assuming that the SSC has been obtained certificate from the lender specifying that the loan amount has been utilized for the purpose of purchase or construction of the property. Hence, three conditions has been satisfied. Therefore, up to 2 lakhs shall be allowed as a deduction. Like this, you have to take the assumption when first two conditions has been satisfied, but there is no information regarding third condition that is relating to certificate. You can take the positive assumption and you can give up to 2 lakhs as a deduction limit. Next, If any of the above or all of the above conditions are not satisfied, then the maximum amount of interest allowed as deduction under section 24 class B is 30,000. Very important. Next ma. Types of properties. What are the various types of properties? First one, self-occupied property. Second one, let-out property. Third one, deemed let-out property. Fourth one, unoccupied property. Fifth one, part of those property given on let-out, part of those property self-occupied. Sixth one, house properties let-out for part of the year and self-occupied for part of the year. These are the 6 types of properties ma, and each type is having its own tax treatment, its own procedure to determine income from house property. Are you following? Each type is having its own procedure to determine income from house property. What are those? We will discuss. So tell me how many types are total, how many types we are having here? 6 types. What are those? Self-occupied property, let-out property, deemed let-out property, unoccupied property, house part of those property self-occupied, part of those property given on let-out. Sixth one ma, house property self-occupied for part of the year and given on let-out for part of the year. Yes. Next ma, let's verify the first status. What is the first status ma? Self-occupied property. Now let's verify the definition for self-occupied property. What do you mean by self-occupied property? In case the house property is used by the owner for his own residential purpose throughout the year, that means without letting out even for one day, then such property shall be treated as self-occupied property. Come again ma. The house property owned, used by the owner for his own residential purpose throughout the year, that means without letting out even for one day, then we can give the status of self-occupied property. What is that? Out of 365 days, entire 365 days you need to use that property for your own residential purpose. Then only you can give the status of self-occupied property. Are you following? Say for example, out of 365 days, some 300 days has been used for own residential purpose, 65 days has been given on let-out. Can we call it as self-occupied property? Obviously no. Why? Because to give the status of self-occupied property, it must be used by the owner throughout the year ma. That means out of 365 days, entire 365 days must be used by the owner for his own residential purpose. In case any part of the year given on let-out, then that will be treated as house property self-occupied for part of the year, let-out for part of the year. 6 status we need to give. Are you following? We cannot give the status of SOP. Okay ma. 6th status will come. Then condition wise, let's verify condition wise ma. The property must be used by the owner for his own residential purpose. Okay. And it must be used throughout the year. Then you can give the status of self-occupied property provided these 2 conditions has been satisfied cumulatively. Okay. Next ma. What is the maximum interest allowed as deduction? Either 30,000 or 2 lakhs. Already we discussed. Format. Let's verify the format for computation of income from house property ma, in case of self-occupied property. My question, can we apply the standard format we verified earlier? What is the standard format? GAV, less municipal taxes paid, NAV, less deductions under section 24 class A, SDT rate 30% of NAV, class B, interest on borrowed capital, then you will get income from house property. That is standard format. Can we apply that standard format in case of SOP? Obviously no. Here the applicable format is from NAV as 0. What is that ma? NAV as 0, not from GAV. You need to consider from NAV as 0. Why? If you apply from GAV standard format in case of self-occupied property, entire income you determined as income from house property will become notional income. The entire income you determined as income from house property is notional income. And it is obviously not fair from the part of the department to charge entire notional income in case of SSC who is using that property for his own residential purpose. To avoid the chargeability of notional income, the lawmaker says you no need to start from GAV, you can start from NAV as 0. So by starting from NAV as 0, we are avoiding the chargeability of the notional income. That is very important point. Particular inner column, outer column, from where we need to start? NAV as 0. Good. Less deductions under section 24 class A, SD at the rate 30% of NAV, class B interest on borrowed capital, then you will get what? Income from house property. And obviously standard deduction at the rate 30% of NAV will also be 0. Because NAV is 0, then 30% of that will always be 0. Then interest on borrowed capital, you need to allow up to 30,000 or 2 lakhs depending upon the satisfaction of the conditions. Then it will be resulted into loss. It will be resulted into loss. What is the maximum possible loss here? Either 30,000 or 2 lakhs. If 3 conditions satisfied cumulatively, the possible maximum loss is 2 lakhs up to. In case not satisfied, up to 30,000. Understood the point? So tell me, what is the only one deduction allowed in case of self-occupied property? Interest on borrowed capital. That's it. Then what about municipal tax payment? Tell me, what is the treatment for municipal tax payment? Shall be ignored. Why? You can claim municipal tax only when you started from GAV, because municipal tax allowed as deduction from GAV. Are you following? Here from where you started the procedure for computation of income from house property, NAV as 0. That means there is no discussion relating to municipal tax payment. In case any municipal tax has been paid, that must be ignored. That you can claim as deduction when you started from GAV. Are you following? So in case of SOP, any municipal tax payment given in the question, you need to ignore. Next, okay. In case the SSC has been paid any municipal tax in the current previous year, then such municipal tax paid shall be ignored. Yes. Reason, since municipal tax are allowed as deduction from GAV, but here we are starting from NAV as 0, right? Good point. Next, amendment brought out through Finance Act 2019. What that amendment says? Before this amendment, maximum one house property you can consider as self-occupied property. But after this amendment, 2 house properties you can get the status of SOP. How many? 2 house properties. Earlier, the lawmakers allowed maximum 1 property as SOP. Now, after amendment, the SSC can opt maximum 2 properties as SOP. But for 2 self-occupied properties, the maximum interest deduction is either 30,000 or 2 lakhs. For 2 properties put together, not each property separately. The lawmakers are not allowing each property separately deduction of 30,000 or 2 lakhs. They are allowing 2 properties together. 2 properties together, SOPs together, maximum you can claim up to 30,000 or 2 lakhs. Very important point. Interest deduction. The maximum deduction of rupees 30,000 or 2 lakhs towards interest under section 24 class B shall be allowed for 2 SOPs together, but not separately to each property. Very important point you need to remember. Next, laid-out property. Yeah. What is the definition for laid-out property? In case the house property is given on let-out during the current previous year, even though it is vacant for few months, still you need to give the status of let-out property. What happened? The house property has been given on let-out during the current previous year, and some period, some few months, it is been vacant. Still, you need to give the status of let-out property. In case the house property is given on let-out by the owner, even it is vacant for few months, then such house property shall be treated as LOP. Note, even the property is vacant for some months or few months in the current previous year, still it will be treated as LOP. That means the LOP status will be given to the property. My question, during the current previous year 21-22, 9 months the property given on let out, 3 months self-occupied, 3 months not been vacant, 3 months self-occupied. 9 months let out, 3 months self-occupied. Can we give the status of LOP to that property? No. Why? If you want to give the status of LOP, either pura 12 months must be given on let out, or part of the year given on let out, or part of the year it is vacant. Then only you can give the status of LOP. In case part of the year given on let out, part of the year self-occupied, then you cannot give the status of LOP. You need to give the last status, sixth status. What is that? House property self-occupied for part of the year, given on let out for part of the year. Then the procedure will be different to determine income from house property. Remember. Are you following? So, what are the possible two cases to give the status of let out property? Case 1, property given on let out for throughout the year. Okay, out of 12 months, total 12 months given on let out. What is the status? LOP only. Case 2, property given on let out for part of the year and remaining part of the year is vacant. 9 months given on let out, 3 months it is been vacant. Then what is the status? LOP only. Are you following? So these are the possible two cases where you can give the status of LOP to a particular house property. Good. Interest, please tell me what is the maximum interest allowed as deduction in case of LOP? Any restrictions applicable? Any conditions applicable? No. No restrictions, no conditions. The restrictions, conditions will come in case of self-occupied property or unoccupied property. In case of let out property, unlimited interest will be allowed as deduction without any conditions or restrictions. Very important, you need to remember. What is that, unlimited interest allowed as deduction. Relating to interest concept, one important point I forgot to explain. One important point, sorry for that. What is that point, Interest on interest shall not be allowed as deduction. Again, I am explaining. Interest on interest shall not be allowed as deduction. What do you mean by that sentence? Say, for example, there is a delay in payment of interest amount to the banker, assume. There is a delay in payment of interest amount to the banker, 3 months delay. Total interest payable 1 lakh and 1 lakh has been delayed for 3 months. Are you following? Then for the 3 months delay in respect of payment of interest amount of 1 lakh, some 5,000 they levied as interest on interest for 3 months period. Total 1 lakh 5,000 they recovered from you. Sorry. Then what is the status for 1 lakh and what is the name for that 5,000? 1 lakh will be treated as interest on borrowed capital allowed as deduction under section 24 class B. When it comes to 5,000, that is not interest on capital, that is interest on interest. That 5,000 that shall not be allowed as deduction because 24 class B dealt with interest on borrowed capital but not interest on interest. In case in the examination they have given that any interest on interest paid, then don't allow it as a deduction because 24 class B not dealing with interest on interest but it is dealing with interest on borrowed capital. Remember. Next, format for computation of income from house property in case of LOP. LOP means given on let out. You are receiving rental income. Then what is the format we need to apply here? Standard format. What is that? Standard format we need to apply. What is the standard format? Start from GAV, less municipal taxes paid, NAV, less deductions under section 24, class A, SD at rate 30% of NAV, class B interest on borrowed capital. Then you will get income from house property. Are you following? Standard format we need to apply. Okay. Okay. Next, URR discussion, If you remember, while determining gross annual value, what is step 3, determination of actual rent. Do you remember that? What is the formula for determination of actual rent? Rent for 12 months period minus rent for vacant period minus unrealized rent. This one, unrealized rent. What is the treatment we are giving in case of unrealized rent? It will be allowed as deduction while determining actual rent. My question, in all cases unrealized rent will be allowed as deduction. In all cases we need to allow unrealized rent as deduction. The question is no. We have to allow unrealized rent as deduction while determining actual rent only when it is a genuine unrealized rent. Only when it is genuine. In case it is a fraudulent one, don't allow it as a deduction. It will lead to the loss of revenue to the department if you allow fraudulent URR as deduction. Then how to find out, how to discover, how to assess whether particular unrealized rent is genuine or fraudulent? By going through rule 4 conditions. By going through rule 4 conditions, rule 4 specified 4 conditions ma. In case those 4 conditions satisfied cumulatively, then you can say that that URR is genuine. You need to allow it as deduction while determining actual rent. In case any one of those 4 conditions or all of the 4 conditions specified under rule 4 has been not satisfied, then you can say that it is a fraudulent URR. It shall not be allowed as a deduction. Are you following? Yes. So what are those rule 4 conditions? We are going to verify. Before getting into that, let's define what do you mean by unrealized rent. What is the meaning of unrealized rent? Let's verify. The rent amount definition we are discussing, pay attention. The rent amount which was previously accepted by the tenant but subsequently the same has not been paid by him shall be treated as unrealized rent. Simple. Previously accepted, at the time of entering into the agreement he accepted, but subsequently not paid, then that shall be treated as unrealized rent. In short, accepted but not paid. Simple. Come again. Accepted but not paid shall be treated as unrealized rent. What is the treatment for unrealized rent? It will be allowed as deduction while determining actual rent. Let's verify. Tax treatment for URR. The unrealized rent will be allowed as deduction while computing actual rent. This deduction will be allowed only when the condition specified under rule 4 has been satisfied cumulatively. Of course, only when those conditions satisfied cumulatively we can treat that URR as genuine. Otherwise, fraudulent. Now let's verify what are the rule 4 conditions. Total how many conditions comprised under rule 4? 4 conditions. Rule 4, 4 conditions. Easy to remember. First condition, the tenancy must be bona fide. That means the owner and tenant must be entered into an agreement in writing, because there should be some proof for acceptance of rent by the tenant, right? So that means we should have a written agreement between the owner and tenant. That is the first condition. Second condition, the defaulted tenant has been vacated the property or steps have been taken to compel him to vacate the property. What is the second condition, The defaulted tenant has been vacated the property or steps have been taken to compel him to vacate the property. That is the second condition. Third condition, the defaulted tenant is not in occupation of any other property belongs to the same owner. In case the defaulted tenant has been occupied any other property belongs to the same owner, then you need to treat it as fraudulent URR, not a genuine URR. Then it shall not be allowed as a deduction while determining actual rent. So that is the third condition. The default tenant should not occupy any other property belongs to the same owner. Next, my fourth condition. The owner has been instituted all legal proceedings and the assessing officer to realize such rent, and the assessing officer is satisfied that those legal proceedings would be useless. What do you mean by that sentence? That means the owner has been filed a case against the defaulted tenant, but the judgment is yet to come. It is pending before the court. That means in the current previous year, there is no recovery of unrealized rent because of filing the suit against the defaulted tenant. For the time being, there is no realization of URR. That is what we mean by fourth condition. If these 4 conditions has been satisfied cumulatively, then we need to treat that URR as a genuine URR. Then it shall be allowed as a deduction while determining actual rent. Any one of them or all of those conditions are not satisfied, which are specified under rule 4, then we need to treat it as a fraudulent URR. It shall not be allowed as a deduction while determining actual rent. So please tell me what are the 4 conditions required to be satisfied cumulatively, which are specified under rule 4. Maybe possible for appearing in the examination as a theoretical question. Tell me what are the 4 conditions required to be satisfied cumulatively. The tenancy must be bona fide. That means the owner and tenant must be entered into an agreement in writing. Second condition, the default tenant has been vacated the property or steps have been taken to compel him to vacate the property. Third condition, the default tenant is not in occupation of any other property, belongs to the same owner. Fourth condition, the owner has been instituted all legal proceedings to release such rent and the assessing officer is satisfied that those legal proceedings would be useless. Understood? Good. Next, deemed layout property. Before getting into deemed layout property, I will explain one illustration relating to LOP. I will explain one illustration relating to LOP. Let's verify. Illustration 5 in ISA material. Pay attention, ma. Ganesh has a property whose municipal valuation is 2,50,000 per annum. The fair rent is 2 lakhs per annum and the standard rent fixed by the Rent Control Act is 2,10,000 per annum. Very good. The property was let out for a rent of 20,000 per month. What is actual rent, ma? 20,000 per month. However, the tenant vacated the property on 31st January 2022. If at all the tenant vacated the property on 31st January 2022, tell me how many months the property been vacant during the current previous year 21-22 ma? 2 months, February and March. 2 months it is been vacant. Then what is the rent for vacant period? 20,000 into 2 months, 40,000. Unrealized rent was 20,000 and all the conditions prescribed by Rule 4 are satisfied. Since Rule 4 conditions has been satisfied, all the conditions, that unrealized rent of 20,000 shall be allowed as a deduction while determining actual rent. If you remember, he paid municipal taxes at the rate 8% of municipal valuation. Okay, very good. Actually paid during the current previous year and paid by the owner himself, hence allowed as a deduction while determining what is that? Income from house property. From where we need to allow it as a deduction, gross annual value. Interest on borrowed capital was 65,000 for that year. What do you mean by for that year? That means relating to previous year 21-22. Tell me what is the status of the house property in the previous year 21-22 The house property is in existence. If at all house property is in existence, then 21-22 previous year shall be treated as current year period. If at all current year 21-22 is regarded as current year period, then 65,000 interest relating to that current year period will be treated as current year interest. What is the treatment for current year interest? Fully allowed as deduction in the respective current previous year itself. That means entire 65,000 shall be allowed as deduction under section 24 class B while computing income from house property. What is the dealing section? 24 class B. Compute the income of Ganesh for the previous year 21-22 or assessment year 22-23. Let's verify. Come on, pay attention. Solution. Presentation is very important to grab maximum marks in the examination. Concentrate on the presentation. Determination of income from house property of Mr. Ganesh for the previous year 21-22 or assessment year 22-23. Determination of income from house property of Mr. Ganesh for the previous year 21-22 or assessment year 22-23. Tell me what is the status of the property as LOP, right? Layout property. If at all the status is LOP, from where we need to start? GAV. Let's verify. Particulars, inner column, outer column, gross annual value, working note 1, keep it empty. We will determine later. Less municipal taxes paid. Tell me, is there any payment of municipal taxes during the current previous year 21-22 by the owner? Yes, it is there. 8% of municipal valuation has been paid during the current previous year by Mr. Ganesh. It is given in the question. How much 20,000 allowed as deduction. Then you will get NAV, keep it empty. Less deductions under section 24. Two deductions we are having. Class A SD at rate 30% of NAV. keep it empty. Class B, interest on borrowed capital. How much my interest on borrowed capital? Already we discussed 65,000. Entire 65,000 is current year interest because it is relating to current year period. Hence it will be fully allowed as deduction. Entire 65,000. Then you will get income from house property. Are you following? Yes. Next ma. Now what we need to do? We need to work out gross annual value. Let us go for working note 1. Working note 1, computation of gross annual value. How many steps we need to follow ma? 4 steps. Let's verify step 1. What is step 1? MV or FR, whichever is higher, shall be treated as ER. What is municipal value? 2.5 lakhs. Fair rent ma? 2 lakhs. Whichever is higher means 2.5 lakhs. Then step 2, expected rent in step 1 or standard rent, whichever is lower, again treated as expected rent. What is ER in step 1 ma? 2.5 lakh. What is standard rent fixed by Rent Control Act? 2.1 lakh. The expected rent, that means expectation of the department, should not exceed rent fixed by the Rent Control Act. That's why we need to consider whichever is lower ma. So whichever is lower means 2.1 lakh will be treated as expected rent. Then step 3, what is step 3 ma? Determination of actual rent. Tell me what is the formula for determination of actual rent? Rent for 12 months period minus rent for vacant period minus unrealized rent. What is rent for 12 months period ma? 20,000 per month into 12 months, 2,40,000 minus rent for vacant period. How many months the property been vacant during the previous year 21-22? 2 months into 20,000, 40,000 minus, do we have any URR ma? Yes, it is there, 20,000, and rule for conditions are satisfied, hence allowed as a deduction. Then what is actual rent ma? 1,80,000. How much? 1,80,000. Then step 4, what is step 4? AR determined in step 3 or ER determined in step 2, whichever is higher, in general treated as GAV. What is AR in step 3 ma? 1,80,000. What is ER in step 2? 2,10,000. Whichever is higher means in general 2.1 lakh shall be treated as GAV in general. But what happened here? AR is less than ER. Actual rent is less than expected rent. That means the actual rent declared by the SSE is less than the expectation of the department. Whenever it is less than the expectation of the department, the actual rent, then department will ask you for the reason. We need to verify for the reason. If the reason is happen to be positive, then actual rent 1.8 lakh shall be taken as GAV, even though it is less than the expectation of the department. In case the reason is happen to be negative, then 2.1 lakh, the expectation of the department shall be treated as GAV. What is positive reason? What is negative reason ma? Due to the reason of vacancy, the actual rent is less than expected rent. Then it will be treated as positive reason. 1.8 lakh shall be taken as GAV. In case not due to the reason of vacancy, but due to any other reason, AR is less than ER, then ER of 2.1 lakh shall be taken as GAV. Are you following? Chalo, let's verify ma. Only for this concept I am explaining this illustration ma. Pay attention. In the present case, AR is less than ER, hence verify the reason. While verifying the reason, we need to take one assumption ma. Very important, pay attention. While verifying the reason, we need to take one assumption. What is that assumption? Determination of actual rent as if there is no vacancy. That means we need to determine actual rent assuming that there is no vacancy. Let's verify. What is the formula for determination of actual rent ma? Rent for 12 months period minus rent for vacant period minus unrealized rent. Tell me what is rent for 12 months period? 2,40,000 minus rent for vacant period. Very, very important. Tell me what is rent for vacant period here? What is the assumption taken by us here? Determination of actual rent as if there is no vacancy. If at all there is no vacancy, then what is the rent for vacant period ma? 0. Because we have taken the assumption of no vacancy. Remember, in reason verification, always rent for vacant period should be 0 because we are taking the assumption of no vacancy. Are you following? Next, minus URR, it is there 20,000 allow. Then what is actual rent ma? 2,20,000. That means in case if there is no vacancy, then SSE would have been declared 2,20,000, which is more than the expectation of the department 2,10,000. If there is no vacancy, I'm repeating, if there is no vacancy, SSC would have been declared 2,20,000, which is more than the expectation of the department, that is expected rent of 2,10,000. But why the SSC declared 1,80,000 ma? Due to the reason of vacancy for 2 months. That means the reason is due to the reason of vacancy, means positive reason. In such a case, AR of 1,80,000 shall be taken as GAV. Are you following? To explain this concept, I am discussing this illustration. I hope you understood. Chalo. Here AR is less than AR due to the reason of vacancy, hence AR shall be taken as GAV. Then consider GAV 1,80,000 ma. Then less municipal taxes paid. Then you will get NAV, claim 30% of that as standard deduction, then claim interest on borrowed capital 65,000, then you will get income from house property. Understood? Substitute this value in the earlier format, then you will get income from house property. That is the discussion relating to illustration 5 on LOP, let out property, and here we have also covered verification of reason concept also. Understood? Okay. Now let's go further, ma. Next status, deemed let out property. What is the next status we are discussing, ma? Deemed let out property, DLOP. What do you mean by deemed let out property? Actually, it is not given on let out, but department wants to give the status of LOP. Hence, they added the word called deemed. Understood? It does not have the status of LOP. Why? Because it is not given on let out actually. But department wants to treat it as let out property, hence added the word deemed. Are you following? Now, why this concept is arising? Why lawmakers introduced the concept called DLOP? Tell me, any restriction on SOP, ma? Any restriction on giving the status of SOP? Yes. Maximum 2 properties you can declare it as a SOP. That too through Finance Act 2019, they increased it to 2 SOPs, ma. Before amendment, before Finance Act 2019, maximum 1 property can be declared as SOP by the SSC. Then with effect from Finance Act 2019 through Finance Act 2019, with effect from 1/4/2019, the SSC is having possibility to declare 2 properties as SOP, ma, because of amendment. Tell me, in case there is no restriction on SOP status, what happens to the revenue of the department? Please tell me. The question is, in case there is no restriction on SOP status, then what happens, ma? Then every property held by the SSC shall be declared as SOP. Mr. A is having 3 house properties and he will declare all 3 house properties as SOPs and he will start from NAV as 0. Then it will be resulted into 0 or loss, ma. No interest expenditure is there, it will be 0. In case interest expenditure is there, it will be resulted into maximum loss of 30,000 or 2 lakh. Another person, Mr. B is having 5 house properties. All 5 house properties he will declare as SOP. Then he will start from NAV, then loss of revenue to the department. That's why there is a maximum cap restriction on declaring number of house properties as a SOP, ma. So, in case the SSC is having more than 2 house properties and all the properties declared as SOP, then department will give the status of SOP to maximum 2 house properties, then remaining properties shall be treated as DLOPs. That is the reason why the lawmakers introduced the concept called DLOP, ma. Are you following? Chalo, let's verify. There are 2 possible situations in case of DLOP. Let's verify one by one. Situation 1. What is situation 1? SSC is owner of 2 or more properties. 2 properties are used by the owner for his own residential purpose. Remaining properties are used by the family members for their residential purpose. In such a case, the 2 properties which are used by the owner for his own residential purpose shall be treated as SOPs, and the family members, the properties which are used by the family members shall be regarded as DLOPs. This is situation 1. Whereas what is situation 2, ma? SSC is the owner of 2 or more properties and all the properties are used by the owner for his own residential purpose. Then at the option of the SSC, any 2 house properties shall be treated as SOP. All remaining properties shall be regarded as DLOPs. Are you following? Tell me where the SSC is having option, ma? Under situation 2. Under situation 1, directly the house properties which are used by the owner for his own residential purpose, 2 house properties shall be regarded as SOP. Remaining the house properties which are used by the family members shall be regarded as DLOP. But when it comes to situation 2, assessee is having option. At his option, any 2 properties can be declared as SOP. Remaining shall be regarded as DLOP. Chalo, next ma. This option can be changed year after year in a manner beneficial to the assessee. That means in case of situation 2, whenever the assessee is having option, then depending upon the, what is that, municipal taxes payment and interest expenditure, he can change SOP status from one house property to another house property. That means 1 year house property 1 has been declared as SOP. Next year, if it is beneficial to the assessee, that can be declared as DLOP. There is no restriction over what is that, opting SOP status for the house properties. So assessee can go for most beneficial option. There is no restriction. The freedom has been given by the lawmakers. As per the amendment brought out through Finance Act 2019, the individual or HF can claim maximum 2 properties as SOP. We have already discussed it. Treatment ma. If at all SOP status has been given, what is the tax treatment ma? We have already discussed. We need to start from NAV as 0. Then what is the only one deduction allowed? Interest under section 24 class B, maximum 30,000 or 2 lakhs up to, depending upon the satisfaction of the conditions. What about DLOP status ma? In case of DLOP, deemed let out property status, the treatment is same as LOP. Pay attention. The treatment is same as LOP except one change. What is the one change? First of all, tell me what you mean by treatment is same as LOP ma? That means we need to start from GAV. Standard format we need to apply. Then what is the one change here? While determining gross annual value, what is step 3 ma? Determination of actual rent. Here it is not actually given on let out, but department is deemed to be given on let out. Hence there is no actual rent received by the assessee. Hence no need to determine actual rent in step 3. Because it is not actually given on let out, it is deemed to be given on let out. Hence no need to determine actual rent. If at all no need to determine actual rent, no need to verify the reason also. Understood the point? First point, no need to determine actual rent. Second point, no need to verify the reason. That means expected rent shall be treated as gross annual value directly. ER shall be treated as gross annual value. Very important point. Actually, DLOP is much easiest than the LOP status. Very easy. Because no need to determine actual rent, no need to verify the reason. Chalo. The procedure is same as LOP, but there is one change in step 3. No need to determine actual rent as the property is not actually given on let out, and no need to verify the reason also. Very good. Next ma. Example. Mr. X, owner of 3 houses, house 1 and 2 located at Vijayawada, used by Mr. X for his residence. House property 3 located at Hyderabad, used by Mrs. X and their children, and children for their residence. In such a case, house 1 and 2 which are used by the owner for his own residential purpose shall be treated as SOP. Then house 3 shall be treated as DLOP. Example 2 ma. He is the owner of 3 houses, and all the 3 houses used by the Mr. X for his own residential purpose. Then at the option of the assessee, any 2 house property shall be treated as SOPs, and remaining 1 property must be regarded as DLOP. That means whenever option is available to you, listen to me carefully ma. Whenever option is available to you, then verify whether other things are same or not. What do you mean by other things ma? Municipal tax payment and interest expenditure. These are the other things. In case other things are same, then the properties which are having highest GAV shall be treated as SOP. Why ma? The property having highest GAV shall be treated as SOP. If you treated highest GAV properties as SOP, then you need to start directly NAV as 0. Then the highest GAV has been reduced to 0. Then any interest expenditure is there, it will be resulted into loss, maximum up to 30,000 or 2 lakhs. In case no interest expenditure is there, the income from that house property in case of SOP status will be 0. And the property which is having lowest GAV shall be declared as DLOP to minimize the income of the assessee. When we can go for directly opting the properties as SOP and DLOP ma? If other things are same, that is interest and municipal taxes, then the properties which are having highest GAV shall be taken as SOPs, and the property having lowest GAV must be regarded as DLOP to minimize the income of the SSC. In case other things are not same, municipal taxes are not same, and interest expenditure is not same for these three house properties, in such a case, you need to work out three options ma. You need to work out three options and consider three options, determine income from house property under each and every option, and consider least option as a most beneficial one. And least will be taken as a SSC, taken by the SSC. Chalo. Option 1. What is option 1 ma? House 1 SOP, house 2 SOP, house 3 DLOP. Determine income from house property. Then option 2, house 1 SOP, house 2 DLOP, house 3 SOP. Compute income from house property. Then option 3 ma, house 1 DLOP, house 2 SOP, house 3 SOP. Compute income from house property. And verify where the income from house property is lowest. And that will be opted by the SSC. That is most beneficial option. Are you following? Next ma. Yeah, I have already explained. Just take a look. I have already explained ma. Just verify. Next. Unoccupied property, my next status. Unoccupied property. What do you mean by unoccupied property? The property is not occupied by the owner due to the reason of employment at other place, employment or business at other place, and the SSC is residing at such other place in a building which is not belonging to him. Come again. The house property is not occupied by the owner due to the reason of employment or business at such other place, and at such other place is residing in a building which is not belonging to him. Then the property which is not occupied by the SSC shall be treated as unoccupied property. Are you following? Say for example, SSC is having house property at Vijayawada, assume, and he is doing employment at Hyderabad. Now he has to reside at Hyderabad because his place of employment is Hyderabad. Now the property located at Vijayawada has been locked up. It is not given on layout. It is not self-occupied. Simply the status is unoccupied. Why it is unoccupied? Due to the reason of employment at Hyderabad. And at Hyderabad, he is residing in rented premises. He is residing in rented premises. In such a case, then the property at Vijayawada which is not occupied by the owner shall be treated as unoccupied property. That is the point. Understood? Chalo. In case a house property is not occupied by the owner due to the reason of employment or business at such other place, and such SSC is residing at such other place in a building which is not belonging to him, then the property which is not occupied by him will be treated as unoccupied property. And the treatment is, what is the tax treatment in case of unoccupied property? Same as SOP. Same as SOP means you need to start from NAV as 0. Then what is the only one deduction? Interest expenditure up to maximum 30,000 or 2 lakhs. If all the three conditions satisfied, up to 2 lakhs, any one of them, all of them are not satisfied, then up to 30,000. What are the three conditions, ma? The loan amount should be borrowed for the purpose of purchase or construction of those property, and it must be borrowed on or after 1/4/1999. Second condition, the construction of the property must be completed within 5 years from the end of the financial year in which the loan amount has been borrowed. Third condition, the owner, the SSC, has been obtained a certificate from the lender stating that the loan amount has been utilized for the purpose of purchase or construction of those property. Are you following? If all these three conditions satisfied cumulatively, then up to 2 lakh, otherwise up to 30,000. That is regarding UOP. Condition wise, the property should not be occupied by the SSC due to the reason of employment or business at such other place, and he must reside at such other place in a building which is not belonging to him. He must reside in a rented premises. That's it, ma. Next, part of those property laid out and part of those property self-occupied. I will explain with the help of example. The property is having 2 floors, ground floor and first floor. Ground floor is occupied by the owner using for his own residential purpose, and when it comes to the first floor given on let out, then what is the status of that house property ma? Part of the house property self-occupied and part of the house property given on let out. If at all the property is having that status, how to compute income from house property? We need to verify the procedure. Then the treatment is, consider the property is having two separate units ma. Consider the property is having two separate units, and the property which is self-occupied by the unit which is self-occupied by the owner shall be getting the status of SOP. The unit which is self-occupied by the owner shall be getting the status of SOP. We need to start from NAV as 0, then less deductions under section 24 SD 0, and class B interest on borrowed capital, then claim proportionately ma. If the interest expenditure is relating to total house property, consider proportionate interest amount depending upon the floor area. Say for example 50% equal space, then half of the interest consider proportionate interest, then out of that proportionate interest up to 30,000 or up to 2 lakh depending upon the satisfaction of the conditions allowed as deduction. Are you following? Then when it comes to the LOP unit, we need to give the status of LOP. That means we need to start from GAV. While determining GAV, MVF or SR, we need to consider proportionately depending upon the floor area. In case the MVF or SR values are given for full house property, entire house property, consider proportionate values, accordingly determine GAV. Then less municipal taxes, proportionate municipal taxes, claim as deduction. Then you will get NAV, claim 30% of NAV as standard deduction, and proportionate interest expenditure will be allowed as deduction. Are you following? That is the point. Let's verify ma. In case part of those property is self-occupied by the owner and part of those property given on let out, then the treatment is as follows. We have to give the treatment for the above property as if the property is having two separate units. Very good. For self-occupied unit, we have to give the treatment of SOP. For let out property, we have to give the treatment of LOP, and we have to determine GAV by following 4 steps. While determining GAV, we have to consider proportionate values for MV, FR and SR. Municipal taxes and interest shall be apportioned between 2 units on the basis of the floor area. That floor area will be given in the question itself. For LOP unit, unlimited interest will be allowed as deduction. For SOP unit, maximum interest allowed as deduction is 2 lakhs or 30,000. Are you following? Okay. Next ma. House property self-occupied for part of the year and given on let out for part of the year. What is the situation? Single house property is there. Assume 9 months given on let out ma, 3 months self-occupied. 9 months given on let out, 3 months self-occupied. Then what is the status of that house property? Part of the year let out, part of the year self-occupied. In such a case, how to determine income from house property is our discussion. Now tell me, what is the treatment in case of that status ma? Is it possible for us to give the status of self-occupied property for such property? Can we give? We can't give ma. Why? If you want to give the status of self-occupied property, what is the condition? It must be used by the owner for residential purpose, own residential purpose throughout the year without letting out even for 1 day. But 9 months given on let out, right, in our example, hence you cannot give the status of SOP. Then what is the status we need to give? Obviously LOP. So what is the status we have to give in case of this status ma? If at all the house property is self-occupied for part of the year and given on let out for part of the year, we cannot give the status of SOP. Therefore, we need to give the status of LOP. If at all you are giving the status of LOP, means we need to start from GAV. Standard format is applicable. GAV less municipal taxes paid, NAV less deductions under section 24, class A, SD at rate 30% of NAV, class B interest on borrowed capital, then you will get income from house property. That means everything is same as LOP except one change. What is the one change? While determining GAV in step 3, we need to determine actual rent ma, if you remember. What is the formula for determination of actual rent in case of pure LOP? Actual rent equal to rent for 12 months period minus rent for vacant period minus unrealized rent. This is the formula in case of pure LOP. But it is not pure LOP, part of their self-occupied. Then the actual rent formula will be getting changed. What is the revised formula? Actual rent equal to rent for let out period we need to consider. This is the only change ma. Come again. Instead of rent for 12 months period, consider rent for let out period minus rent for vacant period as usual minus unrealized rent. You will get actual rent. That is the only change. Everything is same. So tell me what we need to consider for let out period. Only actual rent ma. But municipal value, remember municipal value, fair rent, standard rent must be considered for whole year, for full year. The actual rent alone we need to determine for let out period. That is the only change. Let's verify. Then the treatment is as follows. For the property, we cannot give the status of SOP as it is not occupied by the owner throughout the year. Hence, we have to give the status of LOP. The treatment is same as LOP except the following change in the determination of actual rent. Formula for determination of actual rent will be changed as follows. Actual rent equal to rent for let out period minus rent for vacant period minus URR. That is the only change. Note, here we need to consider let out period for the purpose of determination of actual rent alone. That means MVFR SR values must be considered for full year but not for let out period. This is very important. Are you following? So this is the tax treatment to determine income from house property in case the house property is self-occupied for part of the year and given on let out for part of the year. Let's verify illustration 8 ma. Illustration 8 relating to DLOP status, important from the viewpoint of examination. So many times appeared in the examination my DLOP problem. That's why I'm explaining. Pay attention. Ganesh has 3 houses, all of which are self-occupied. So if at all 3 houses has been self-occupied, then what we need to do? Maximum 2 properties shall be treated as SOP. Remaining property must be regarded as DLOP, right? The particulars of the house for the previous year 21-22 are as under. Okay. Particulars: house 1, house 2, house 3. Municipal valuation per annum 3 lakhs, 3.6 lakh, 3.3 lakh. Fair rent per annum 3.75 lakh, 2.75 lakh, 3.8 lakh. Standard rent per annum 3.5 lakh, 3.7 lakh, 3.75 lakh. Then date of completion of construction ma 31st March 1999. House 1 ma. Remember this point. In case any interest expenditure is there for house 1, then maximum how much we need to allow? 30,000 up to 30,000. 2 lakhs eligibility will not be there for house property 1 ma. Why? Because the date of completion of construction is 31st March 1999. It is evident from the date of completion of construction that the loan has been borrowed before 1/4/1999. Then first condition will not be satisfied. Hence, up to 30,000 alone allowed as a deduction under section 24 class B in case of interest expenditure, if you remember. Then house 2 ma 31st March 2002 and house 3 1/4/2005. Okay. Municipal taxes paid during the year 12%, 8%, 6%. See, if at all they have given percentages, that must be applied on municipal values ma. That must be applied on municipal values whether they have specified or not. So it is actually paid by the owner during the current previous year. Hence, wherever eligible, we need to claim it as a deduction. Why I said wherever eligible ma? Because in case of SOP, it is not possible for you to claim municipal tax as deduction. It is possible only when the property is having the status of DLOP, right? Then only we have to start from GAV. Okay. Next, my interest on money borrowed for repairs of property during the current year. House 1 nothing. For house 2 55,000 and house 3 nothing ma. Interest for current year on money borrowed in July 14, 2015 for purchase of property. House 1, house 2 nothing. For house 3 1,75,000. If you observe, for house 2 ma, what is the purpose of borrowing ma? Repair of the property. If at all the purpose is repair of the property, then first condition will not be satisfied. What is the first condition? For allowing up to 2 lakhs ma, maximum deduction. Then the capital amount must be borrowed for the purpose of purchase or construction, and it must be borrowed on or after 1/4/1999. What is the purpose of borrowing here? Repair. That means first condition will not be satisfied. That means out of 55,000, we need to allow maximum 30,000 when? In case the house property 2 is having the status of SOP. In case that house property 2 is having the status of DLOP, without any conditions, without any restrictions, enter 55,000 shall be allowed as a deduction under section 24 class B. You need to remember this point. Next ma. Compute Ganesh income from house property for the previous year 21-22 or assessment year 22-23 and suggest which house should be opted by Ganesh to be assessed as self-occupied so that his tax liability is minimum. So what is that? His tax liability is minimum. Chalo. Here we need to work out three options ma. Let's go for workings. In the present case, Mr. Ganesh is the owner of 3 properties and all the properties are used by him for his own residential purpose. Hence, at the option of the SSC, 2 properties will be taken as SOP, that is amendment brought out through Finance Act 2019, and another property shall be treated as DLOP. Very good. Option 1, computation of income from house property of Mr. Ganesh under option 1. It is a time-consuming problem. When it is time-consuming, when you don't have grip on the solution. If you are having grip on the solution, it is matter of 10 to 12 minutes. Remember that point. Computation of verify the presentation ma. Verify the procedure. Easiest procedure I am giving here. Try to understand the procedure. Don't mug up. Try to understand the procedure. Then it is very easy for you to reproduce in the examination without any hurdles. Chalo. Particulars amount column. Income from house 1, SOP status we have given, working note 1 we will determine. Income from house 2, SOP status we have given, working note 2, keep it empty. Income from house property 3, DLOP status, working note 3, assume, working note 3. Then you will get income from house property. Let's go for working notes one by one. Working note 1, computation of income from house property of Mr. Ganesh under option 1 for house 1, that is SOP. In case of SOP, from where we need to start my NAV as 0. Less deductions under section 24. Class A, SD at rate 30% of NAV, obviously 0. Class B, interest on borrowed capital. Any interest expenditure is there for house property 1 ma? No interest expenditure 0. Then what is income from house property? Under option 1 for house 1, in case of SOP ma 0. Next, working note 2, computation of income from house property of Mr. Ganesh under option 1 for house 2, that is SOP. Particulars inner column, outer column. From where we need to start, NAV as 0. Less deductions under section 24. Class A, SD at rate 30% of NAV, 0. Class B, interest on borrowed capital. Pay attention. What is the interest expenditure given in the question ma? 55,000. And the purpose of borrowing is repair. That means first condition is not satisfied. In such a case, eligibility is up to 30,000, but not 2 lakhs, up to 2 lakhs. In case eligibility is up to 2 lakhs, enter 55,000. 55,000 we can claim as a deduction. But first condition is not satisfied. Hence, out of 55,000, maximum 30,000 we need to allow it as a deduction because the status is SOP, right? Then 30,000. Then you will get income from house property, loss of rupees 30,000 from house 2 ma. This you have to give in the note point ma. The center explanation why you have allowed 30,000 instead of 55,000 must be explained through note point. Then only the examiner, the valuationer will get the point that you are having the knowledge, conceptual knowledge. Chalo. Note 1. In the present case, the interest on capital amount is borrowed for the purpose of repairs is 55,000. Since the capital amount is borrowed for the purpose of repairs and the status of the property is SOP, hence the maximum amount of interest deduction under section 24 class B is 30,000. Very important to put up the note point. Next ma, working note 3, actually 3. Computation of income from house property of Mr. Ganesh under option 1 for house 3. Tell me what is the status we have given for house 3 ma? DLOP under option 1. Tell me in case of DLOP from where we need to start ma? GAV. Standard format is applicable, same as LOP ma, except one change. What is one change? No need to determine actual rent and no need to verify the reason. Actually very simple. DLOP status. Gross annual value, working note 4, keep it empty. Okay, working note 3, keep it empty. Less municipal taxes paid, how much ma? 3.3 lakhs into 6%, claim 19,800. Then you will get NAV, keep it empty. Less deductions under section 24, class A, SD at rate 30% of NAV, keep it empty. Class B, interest on borrowed capital. What is the interest amount ma? 1,75,000. I hope so, I think so. Then what is the status of the property? DLOP. That means in case of other than SOP, UOP, what is the maximum interest allowed as deduction? Unlimited, without any conditions or restrictions. That means entire 1,75,000 shall be allowed as deduction. You will get income from house property. What we need to work out here, ma? Working note 3, determination of GAV. Step 1, MV or FR, whichever is higher, shall be treated as ER. What is MV, ma? 3.3 lakh. FR, 3.8 lakh. Whichever is higher means 3.8 lakh shall be treated as expected rent. What is step 2? ER in step 1 or SR, whichever is lower, shall be again regarded as ER. That is 3.8 lakhs or 3.75 lakh. Whichever is lower means 3.75 lakh shall be treated as expected rent. Step 3, actual rent. No need to determine actual rent, ma. Step 4, AR in step 3 or ER in step 2, whichever is higher shall be treated as GAV. AR nothing, ER 3.75 lakh. That means GAV will be 3.75 lakh. Substitute this 3.75 lakhs in the earlier format, then you will get income from house property. Are you following? Then if you add up 3 houses, income and loss, adjust the losses from this income, then you will get income from house property under option 1. Next, ma, computation of income from house property of Mr. Ganesh under option 2. Under option 2, house 1 SOP, house 2 DLOP, house 3 SOP. Are you following? Chalo. That is the procedure. Now let's go for workings one by one. Working note 5, determination of income from house property of Mr. Ganesh under option 2 for house 1. Status is SOP. Same as above, ma. Same as above. 0. 0. We have already worked out. Next, this is important. Working note 6, computation of income from house property of Mr. Ganesh under option 2 for house 2. DLOP status, ma. From where we need to start GAV. Keep it empty. Then less municipal taxes paid. Claim 3.6 lakhs into 8%. 28,800. Then NAV. Less deductions under section 24. Class A, SDA rate 30% of NAV. Keep it empty. Class B, interest on borrowed capital. How much we need to allow, ma? Out of 55,000, enter 55,000 we need to allow because the status is DLOP. In case of DLOP, unlimited interest will be allowed as deduction without any conditions or restrictions. For that, you need to have conceptual knowledge, ma. Chalo. Then you will get income from house property. Let's go for working note 8, computation of GAV. Step 1, MV or FR, whichever is higher, shall be treated as ER. 3.6 lakhs, 2.75 lakh, whichever is higher means 3.6 lakh, ma. Step 2, ER in step 1 or SR, whichever is lower, shall be again regarded as ER. 3.6 lakhs, 3.70 lakhs, whichever is lower means 3.6 lakhs, ma. Step 3, actual rent, no need to determine. Then step 4, AR in step 3 or ER in step 2, whichever is higher, shall be treated as GAV. That means high 1, ER, ma, 3.6 lakhs, whichever is higher means 3.6 lakhs. Substitute this amount, you will get income from house property. Next, ma, let's go for house 3 under option 2. SOP status, from where we need to start NAV as 0. Less deductions under section 24. Class A, SDR rate 30% of NAV 0. Class B, interest on borrowed capital. Wait a minute. What is the interest expenditure in case of house 3, ma? 1,75,000. And verify first condition, that is borrowed for the purpose of purchase. They specified in the question, and that too borrowed on or after 1/4/1999. And construction also completed within 5 years from the end of the financial year in which the loan amount has been borrowed. First 2 conditions are satisfied, but there is no information regarding third condition, that is certificate. Now we can take the assumption, positive assumption, assuming that the assessee has been obtained a certificate from the lender stating that the loan amount has been utilized for the purpose of purchase. In such a case, all 3 conditions will be satisfied. Then up to 2 lakhs eligibility will come for maximum amount of deduction. Then entire 1,75,000 will be allowed as a deduction. We have to give note point for that. Note 2. I have given. Go through that. You will get it. What I explained orally is there in the written form. Go through that. You will get it. Computation of income from house property of Mr. Ganesh under option 3. Under option 3, now house property 1 DLOP, house 2 SOP, house 3 SOP. Let's go for house 1 computation, ma. DLOP status, from where we need to start? GAV. Less municipal taxes paid, 3 lakhs into 12%. How much? 36,000. NAV, keep it empty. Less deductions under section 24. Class A, SDA rate 30% of NAV, keep it empty. Class B, interest on borrowed capital, nothing. 0 expenditure towards interest. Then you will get income from house property, ma. Then working note 12. What is working note 12? Determination of GAV. Step 1, MV or FR, whichever is higher, shall be treated as ER. 3 lakhs or 3.75 lakh, whichever is higher means 3.75 lakh shall be treated as ER. Step 2, ER in step 1 or SR, whichever is lower, shall be treated as expected rent again. 3.75 lakhs or 3.5 lakhs, whichever is lower means 3.5 lakh. No need to determine actual rent. Step 4, AR or ER, whichever is higher, shall be treated as GAV. Hyphen 3.5 lakhs, whichever is higher means 3.5 lakhs. Substitute this 3.5 lakhs, you will get income from house property. Next ma, working note 10, computation of income from house property of Mr. Ganesh under option 3 for house 2 SOP status ma. From where we need to start, NAV as 0, less deductions under section 24, class A, SD at rate 30% of NAV, nothing. Class B, interest on borrowed capital for house 2, how much expenditure is there towards interest ma? 55,000. But the purpose is repairs ma, borrowing purpose is repairs, hence 30,000 alone shall be allowed, then loss will be 30,000. For that I have given the note point here. Okay. Then house 3 ma, SOP. And what is the maximum interest allowed? Up to 2 lakhs eligibility will come, because we have taken the assumption of certificate has been obtained. Then 1,75,000 will be allowed as deduction. Then loss under the head house property from SOP from house property 3 is 1,75,000 ma. Note point has been given. And consider 3 options ma. Consider 3 options. Verify under which option we are having lowest income from house property, then that will be opted by the SSC. I have given as per the amendment brought out through Finance Act 2019. Wait ma. From house to what is the maximum deduction given there? 30,000, right, out of 55,000. Then house 3, what is the interest expenditure deduction given? 1,75,000. Put together how much ma? 2,05,000, right? 2,05,000 or 2,15,000? 1,75,000 plus 30, 2,05,000. Then out of 2,05,000, what is maximum allowed? 2 lakhs. Because 2 SOPs together, the limit is applicable. 2 SOPs together, the limit is applicable. That means out of 2,05,000, what is maximum allowed as deduction? 2 lakh ma. Note point has been given. As per the amendment brought out through Finance Act 2019, the maximum interest deduction for 2 SOPs is 2 lakhs. Hence, we need to allow maximum 2 lakhs out of 2,05,000. Very important. Conclusion, in the present case, it is beneficial for the SSC to opt for the option 2. Since under option 2, the house property income is lower than the option 1 and 3. That means house 1 and 3 are SOPs and house 2 is DLOP. Then his income under the head house property would be 1,480 rupees. That is the solution. Detailed solution regarding what is the DLOP illustration. Understood ma? Good. Next ma. Date of completion of construction 30th June 2021 and given on layout from 1/7/2021. Municipal value given ma 6 lakhs per annum. Fair rent 5 lakhs per annum. Standard rent 5.5 lakhs per annum. Actual rent is 40,000 per month. Vacant period nil. Unrealized rent nil. Determine gross annual value. That is the question. Try to determine gross annual value from the given information ma. Tell me what is your observation from this illustration. Come on, tell me your observation. What is the date of completion of construction ma? 30th June 2021. That means the house property came into the existence during the current previous year 21-22. If at all the house property came into the existence during the current previous year 21-22, whether it is in existence throughout the year ma or part of the year, verify and tell me whether the house property is in existence for throughout the year during the previous year 21-22 or part of the year. Only part of the year. What is the date from which it is given on layout ma? 1/7/2021. That means the house property is in existence only for 10 months during the previous year. 10 or 9? 4, 5, 6, 9 months ma. So April, May, June, the property is not in existence. It is in existence only for 9 months during the current previous year 21-22. If at all the property is in existence for part of the year, that is 9 months, whereas the municipal value, fair rent, standard rent has been given for per annum basis, in such a case, Is it correct to consider full values of MV, FR and SR to determine gross annual value, ma? Obviously no, because those values has been given on per annum basis, whereas the house property is in existence for part of the year, that is 9 months. In such a case, what we need to do, those values MV, FR, SR must be converted into for the period for which the property is in existence. That means how to determine municipal value for 9 months, ma? 6 lakhs into 9 by 12. Pay rent for 9 months, 5 lakhs into 9 by 12. Standard rent 5.5 lakhs into 9 by 12. Because those values has been given on per annum basis, must be converted into the period for which the property is in existence. Thereafter, you can determine the gross annual value by considering actual rent of 40,000 per month for 9 months. Are you following? So what is your analysis from this illustration? In case the house property is in existence only for part of the year during the current previous year, and the MV, FR, SR values has been given on per annum basis, then we need to consider proportionate values for MV, FR and SR to determine gross annual value. And those proportionate values must be determined for the period for which the house property is in existence. Understood? Good. Next, ma. Date of completion of construction 30th June 2021. Given on lettered from 1/7/2021, same as above illustration, ma. Municipal value 6 lakhs per period, pay rent 5 lakhs per period, standard rent 5.5 lakh per period, actual rent 40,000 per month, vacant period nil, URR nil. Determine the GAV. Now tell me, the fact is same as above. The property is in existence only for 9 months. Part of the year it is in existence. Whereas MV, FR, SR values has been given per period basis, ma. What do you mean by per period basis? For the period for which the house property is in existence. That means these values has been given for 9 months, ma. In such a case, no need to determine proportionate values. We have to consider full values to determine gross annual value, because in that illustration they have used the word called per period. Per period means for the period for which the house property is in existence. Then again, no need to convert into the proportionate values, ma. Are you following? So what is your analysis regarding this illustration? In case the house property is in existence for part of the year during the current previous year, and MV, FR, SR values has been given per period basis, that means those values has been given for the period for which the property is in existence. In such a case, those values directly we need to consider to determine gross annual value. Again, no need to consider proportionate values, because these values has been given on per period basis. Understood? Good. Next, ma. Date of completion of construction 30th June 2021. Given on lettered from 1/7/21. The fact is same. Municipal value 6 lakhs, fair rent 5 lakhs, standard rent of 5.5 lakhs, actual rent of 40,000 per month, vacant period nil, URR nil. Determine the GAV. Now what is your observation from this illustration, ma? Here the property is in existence only for part of the year, that is for 9 months, whereas MV, FR, SR values has been given without any specification. That is very important to understand. MV, FR, SR values has been given without any specification, ma. That means they have not mentioned either as per annum basis or per period basis. Without any specification, simply they have given the values. In such a case, we need to take the assumption. If we assumed that those values has been given per annum basis, then we need to determine proportionate MV, proportionate FR, proportionate standard rent, and based on those proportionate values, we need to determine gross annual value. In case we assumed that those values has been given on per period basis, then full values we need to consider while determining the GAV. Are you following? So the answer will be changed depending upon the assumption taken by us. Now what is the reasonable assumption, ma? What is the assumption we need to take here? As a chartered accountant, we need to minimize, we need to reduce to the extent possible our client's revenue, our client's income. If you want to reduce the income under the head house property, then the gross annual value must be reduced. If you want to reduce the gross annual value, the MVFR/SR values must be reduced. In such a case, what is the reasonable assumption here? You need to assume that those values has been given on per annum basis. Then we need to convert into the per period. That means 6 lakhs into 9 by 12, 5 lakhs into 9 by 12, 5.5 lakhs into 9 by 12. That is proportionate values we need to consider. Accordingly, the GAV will be reduced and income from house property will be reduced, beneficial to the SSC. Are you following? So that is how we need to analyze depending upon the facts available in the question. Are you following? So that is the discussion relating to the property which is came into the existence during the current previous year and the treatment of the same. Understood, ma? Good. Next. Just we discussed, ma. Theory has been provided there. Our discussion we have already discussed. Next. Date of completion of construction 1/4/2021 given on lettered from 1/4/2021. Municipal value not provided. Fair rent not available. Standard rent not available. Actual rent 40,000 per month. Vacant period nil. URR nil. Determine the GAV. What is your observation from this illustration, ma? Here MVFR/SR values are not available. Only actual rent alone is available, ma. What is the point? MVFR/SR values are not available. Actual rent alone is available. In such a case, how to determine gross annual value? If you want to determine GAV, at least one value must be available out of those three values, ma. At least one value must be available. But three values are not available, all the three values. Then how to handle this situation? Tell me how to handle. In such a case, let's verify, can we determine municipal value on our own, ma? Is it possible to determine municipal value on our own? What is the definition of the municipal value? The value of the property as per municipality. That means the rent capacity, the rent earning capacity of the property as per municipality. That means it is a statutory value. If at all it is happen to be statutory value, is it possible to determine statutory value on our own? Obviously no. What about standard rent, ma? What is the definition of the standard rent? Rent fixed by the Rent Control Act. Again, it is a statutory value. In such a case, we cannot determine those statutory values on our own. That means MV and SR are statutory values. Therefore, it is not possible for us to determine on our own. Then what about fair rent, ma? Could you please tell me the definition of the fair rent? The rent which would fetch by the similar property in the same area. The rent amount which would fetch by the similar property in the same area. That means it is a general value, not a statutory value. If at all it is happen to be a general value, the fair rent, then it is possible for us to determine the fair rent. Here we are determining the fair rent by following actual rent given in the question. Are you following? One line summary, whenever three values are not available, then MV and SR we cannot determine because those are statutory values, but we can determine fair rent because it is a general value. Here we are determining the fair rent by using actual rent. Then what is the formula to determine fair rent by using actual rent, ma? Fair rent equal to actual rent per month into period for which the property is in existence. Come again. Fair rent equal to actual rent per month into period for which the property is in existence. Then based on that we can determine gross annual value. Are you following? Compare that fair rent with actual rent and do the computation. You can determine gross annual value. Next, ma. Treatment when there is no information regarding MV, FR and SR. We have already discussed. Let's verify. If there is no information regarding those values, then we cannot determine MV and SR since those are statutory values, but we can determine FR by using actual rent. Formula for determination of fair rent. Fair rent equal to actual rent per month into period for which the property is in existence. In case the property is in existence for throughout the year, then actual rent per month into 12 months. In case it is in existence only for 9 months, then actual rent per month into 9 months. Then you will get a fair rent. Understood? So this is how to handle if three values are not available in the question. Are you following? Good. Next section 25. Let's verify section 25. Section 25 deals with deduction of TDS with respect to the interest payment made to the non-resident. I will explain. Tell me, is there any restriction on lender? We have already discussed at the time of discussion of interest on capital borrowed under section 24 class B. Is there any restriction on lender? There is a restriction on purpose, but there is no restriction on lender. That means you can borrow from banks, financial institutions, money lenders, friends, relatives, even from non-residents. Even from non-residents you can borrow, and interest paid to that non-resident will be allowed as deduction under section 24 class B, but subject to section 25. So this section 25 will comes into the picture only when you are liable to pay interest to the non-resident. That means in some cases, that means while you are paying interest to the non-resident, that interest allowance under section 24 class B is read with section 25. Read with section 25 means 25 allows it as deduction, then 24 class B allows it as a deduction. 25 denies the deduction, then 24 class B denies the deduction. When only when the interest is payable to the non-resident. What section 25 says? Whenever the assessee is liable to pay interest to the non-resident with respect to the capital amount borrowed for the house property, then it shall be allowed as deduction under section 24 class B only when the TDS has been deducted as per section 25. Only when TDS has been deducted as per section 25, then 25 allows, then 24 class B admits it as a deduction. Understood? In case TDS has not been deducted while making payment to the non-resident, then 25 will not allow it as deduction, then 24 class B denies the deduction. Understood? So in some cases we need to consider 24 class B read with section 25. Let's verify. Simple concept. Deduction of TDS from interest payment made to the non-residents. There is no restriction on lender. That means assessee can borrow the capital amount from any person, includes banks, financial institutions, money lenders, friends, relatives, and even from non-resident. If the assessee borrowed the capital amount from the non-resident and interest has been paid, then we should verify the following and needs to apply section 25. What we need to verify? Deduction of TDS. Next, very important topic I am going to explain. Pay attention, Section 25A. Very important. So many times appeared in the examination. You have to concentrate. Come on. Section 25A deals with tax treatment for recovery of unrealized rent and receipt of arrears of rent. Come again. Recovery of unrealized rent and receipt of arrears of rent. Tax treatment when we recovered unrealized rent and received arrears of rent. There we need to apply section 25A for the purpose of tax treatment to determine income under the head house property. Let's verify. Tax treatment for recovery of unrealized rent URR and treatment for arrears of rent received ARR. URR and ARR. URR means arrears of unrealized rent. ARR means arrears of rent. I think we have already discussed relating to unrealized rent. Could you please tell me what is the definition for unrealized rent? The rent amount which was previously accepted by the tenant but subsequently the same has not been paid by him shall be treated as unrealized rent. In short, accepted but not paid. What is the treatment for the unrealized rent, ma? It will be allowed as deduction while determining actual rent, provided rule for conditions has been satisfied cumulatively. What are the rule for conditions? Please tell me. The tenancy must be bona fide. That means the tenant and owner must be entered into an agreement in writing. Second condition, the default tenant has been vacated the property, or steps have been taken to compel him to vacate the property. Third condition, ma, the default tenant is not in occupation of any other property, belongs to the same owner. Fourth condition, the owner has been instituted all legal proceedings to realize such rent, and the assessing officer is satisfied that those legal proceedings would be useless. If these rule for conditions has been satisfied cumulatively, then that unrealized rent will be allowed as a deduction while determining actual rent. Now we are not discussing treatment for unrealized rent, ma. We are discussing treatment for recovery of unrealized rent. What is the fourth condition under rule 4, ma? The owner has been instituted all legal proceedings to realize such rent, and the assessing officer has been satisfied that those legal proceedings would be useless. At that time, those were useless, ma. But subsequently, the judgment has came in favor of the owner, and the court has been directed the default tenant to pay the unrealized rent to the owner, ma. Are you following? Because of the court judgment, now the owner is recovering. What is that? Unrealized rent. Then what is the tax treatment for such a recovery of unrealized rent? We are discussing under section 25A. So the recovery of unrealized rent will be chargeable to tax under the head house property only under section 25A subsection 1. You need to remember subsection also here to grab the maximum marks. Easy to remember. So what is the dealing section for charging recovery of URR, ma? 25A subsection 1. Now while charging that recovery of unrealized rent, we need to allow 30% of such realized URR as standard deduction under section 25A subsection 2. Under section 25A subsection 2, and balance 70% will be chargeable to tax, that will be treated as taxable value of recovery of unrealized rent under the head, taxable under the head income from house property. Are you following? So tell me, what is the format for determination of taxable value of recovery of URR, ma? URR recovered under section 25A subsection 1 less deduction, standard deduction at the rate 30% of recovery of URR under section 25A subsection 2. Then taxable value of recovery of URR. 70% will be chargeable to tax. So only one deduction will be allowed. What is that? Standard deduction at the rate 30% under section 25A subsection 2. Understood, ma? Now my question, say for example, in the year of recovery of such unrealized rent, the SS is not the owner of the house property, ma, because this URR is relating to some 5 years back rent, ma, assume. After 5 years he is recovering. Today he is not the owner of the property because 2 years back he transferred the house property to some other person. So in the year of recovery he is not the owner of that house property. In such a case, whether that URR recovered will be chargeable to tax or not chargeable to tax, ma? Please tell me. That means for the purpose of charging the recovery of URR to tax under the head income from house property in the hands of the recipient must be the owner of such house property, na? Not required. Think and tell me. The lawmaker says to charge such recovery of URR, there is no relevance for the ownership, ma. Why? In case the lawmaker has given relevance to the ownership, that means the recipient must be the owner for the purpose of charging the recovery of URR. In such a case, only in some cases the chargeability will arise. What are those some cases, ma? Only when the recipient is the owner. In case the recipient is not the owner, then it cannot be charged to tax in the hands of the recipient. There is a loss of revenue to the department. Therefore, to charge such recovery of URR, in all cases, they have not given any relevance to the ownership. That means even though the recipient is not the owner of that property in the year of recovery, still it will be taxable in the hands of recipient under the head income from house property. Are you following? So one line summary. For the purpose of charging recovery of URR, there is no relevance to the, what is that? Ownership. Even though he is not the owner, still it will be chargeable to tax under section 25A. You need to remember in the examination, they will give that the property has been transferred 2 years back. Now he received the URR. Decide whether it is chargeable to tax or not. What should be your answer, ma? It is chargeable to tax under section 25A because there is no relevance for the ownership. Good. Next, ma. Let's verify. Definition we have already verified. In short, accepted but not paid. Tax treatment allowed as deduction while determining actual rent and subject to satisfaction of rule 4 conditions. We have already discussed. Treatment for recovery of URR. Let's verify treatment, ma. That is important, right? In case such unrealized rent is recovered by the SSC in the current previous year as per the code direction, then such URR recovered shall be chargeable to tax under the head income from house property under section 25A subsection 1, while charging such URR recovered to tax under section 25A subsection 1. A standard deduction at the rate 30% of the URR recovered shall be allowed under section 25A subsection 2. That is 70% of URR recovered shall be chargeable to tax. Very good. For the purpose of charging URR recovered to tax in the hands of SSC in the current previous year, there is no relevance for the ownership. Very important point you have to remember. Why they have given this statement, ma? Lawmakers, to charge the recovery of URR in all cases. They don't want to lose any revenue. That's why in all cases they are charging by giving the statement of there is no relevance to the ownership. Okay, ma. Next. That is irrespective of the fact that whether the SSC is owner or not, the URR recovered is always chargeable tax in the hands of the SSC. So that is the treatment for recovery of URR. Next, ma. Let's verify the tax treatment relating to the arrears of rent received, ARR. That was URR, this is ARR. Tell me, what is arrears of rent, ma? Please tell me what is the short definition of URR? Short definition of URR, I'm asking. Accepted but not paid. Based on that short definition, could you please tell me what is the short definition of ARR, ma? Not accepted, not paid. That's it. Come again. Not accepted, not paid. What is that? I will explain. Owner and tenant has been agreed upon some amount, some rental amount per month basis, ma. Say for example, owner and tenant accepted, agreed upon 20,000 per month, assume. Then after 3 months, all of a sudden the owner has been increased the rent from 20,000 to 30,000, which was not there in the agreement, ma. Lease agreement. Even though the provision was not there in the lease agreement, but still the owner has been increased the rent amount from 20,000 to 30,000, assume, because the property, the location of the property has been declared as capital city, assume. Therefore, the owner has been increased the rental amount from 20 to 30,000. Now, this incremental rent was not accepted by the tenant, ma, because it was not there in agreement, not accepted by the tenant and not paid by him. Understood? Now he filed a case against the default tenant saying that, sir, at the time of entering into agreement, the city was not declared as capital city. Now it is declared as capital city. Every person is increasing their rent. Hence, I have also increased the rent, but it is not accepted by the tenant. So please get me the incremental rent through your judgment. He filed a suit against the tenant, ma. Now the judgment came and the court says, sir, you cannot increase 10,000 at a time. You can increase 2,000 per month. Are you following? So the court has been given the judgment like 2,000 you can increase from 20 to 22,000. So for 9 months, I assume he is recovering that ARR, ma. 9 months into 2,000, 18,000 is recovering as a ARR. Arrears of rent has been recovered. Then what is the treatment for this 18,000 ARR recovered or ARR received? It will be chargeable to tax under the head income from house property under section 25A subsection 1, same as URR, ma. And while charging to tax, a standard deduction at the rate 30% shall be allowed under section 25A subsection 2. Then balance 70% shall be chargeable to tax. Understood? The treatment is same as unrealized rent, but the definition is different. Are you following? What is the definition of arrears of rent? There was an increment in the rental amount by the owner, but the same has not been accepted by the tenant and not paid by him. Subsequently recovered as per the court direction shall be treated as arrears of rent. Understood? Not accepted, not paid. In short, let's verify. There was an increase in the rent amount by the owner, but the same has not been accepted by the tenant and not paid by him shall be treated as arrears of rent. Not accepted and not paid. Good. Treatment of arrears of rent. The incremental rent done by the SSC owner in respect of those property shall not be chargeable to tax in the hands of SSC owner, since it was never accepted by the tenant. If it was not accepted by the tenant, then it will not become receivable to the SSC, that is owner. If it is not become receivable to the SSC, then it is not chargeable to tax. That means ARR has not been charged in the past. Therefore, in the year of recovery, it will be chargeable to tax. Why it was not charged to tax in the past, ma? Because it is not became receivable by the owner. Why it is not became receivable? Because it was never accepted by the tenant. That is what I have explained here. Next, ma, treatment of receipt of ARR taxable. In case arrears of rent is received by the SSC in the current previous year, as per the code direction, then such ARR received shall be chargeable to tax under the head income from house property under section 25A subsection 1 in the hands of SSC in the year of receipt. Tell me what is the year of chargeability for URR and ARR, ma? Unrealized rent and arrears of rent in the year of receipt. Very simple. While charging such ARR received to tax under section under the head income from house property under section 25A subsection 1, a standard deduction at the rate 30% of ARR received shall be allowed under section 25A subsection 2. That is 70% of ARR received shall be chargeable to tax. Already discussed. And again, any relevance to the ownership for the purpose of charging ARR received, ma? Same, no relevance, ma. There is no relevance for the ownership for the purpose of charging ARR received to tax in the year of receipt under the head income from house property. That means irrespective of the fact whether the recipient is owner or not, that ARR received is chargeable to tax. That I have explained there. That's it, ma. That is, there is no relevance for the ownership for charging ARR received to tax. Okay, that is a discussion. Let's verify the format for determination of taxable value of URR recovered or ARR received. Very simple, ma. URR recovered or ARR received under section 25A subsection 1, consider less SD at the rate. SD means standard deduction at the rate 30% of URR recovered or ARR received under section 25A subsection 2. Then you will get a taxable value of URR recovered or ARR received. Are you following? 70%, that is chargeable to tax. Next, ma, the only one deduction allowed is SD at the rate 30% of URR recovered or ARR received. Yes. Year of chargeability for recovery of URR and ARR received already discussed. What is year of chargeability? My year of receipt. As per section 25A, the URR recovered or ARR received shall be chargeable to tax in the year of receipt. That's it. Next, ma, section 26 we are going to discuss. What is that, ma? Co-ownership. Come again? Co-ownership. What do you mean by co-ownership? Tell me, what do you mean by co-ownership, ma? In case a single house property is having 2 or more owners, then we can say that those persons are having co-ownership over the property. Are you following? That means the house property owned by 2 or more persons. Then we can say that those persons are having co-ownership over the property. In such a case, we need to apply section 26 to determine income from house property from such property. Are you following? Yes. So tell me how to determine income from house property in case of co-ownership, ma? The tax treatment is completely depends upon the tax treatment is completely depends upon the factor whether it is given on let out or whether it is self-occupied by the co-owners. depends upon the fact called whether the status is SOP or LOP. In case the status is SOP, means self-occupied property, that means it is used by the co-owners for their own residential purpose, then we need to determine income from house property for each co-owner separately. Remember, if the status is self-occupied, then we need to determine income from house property for each co-owner separately, because each co-owner is eligible to claim deduction under section 24 class B relating to interest on borrowed capital up to rupees 30,000 or 2 lakhs ma. That is not per house property 24 class B. 24 class B is per SSC ma. That means each co-owner is eligible the deduction up to rupees 30,000 or 2 lakhs. Therefore, we need to give separate tax treatment in case of co-ownership, because each co-owner is eligible to claim deduction under section 24 class B separately up to rupees 30,000 or 2 lakhs. Are you following? In case it is happened to be let out property ma, it is happened to be let out property, then how to determine income from house property? What is the tax treatment? In such a case, we need to assume that that property is owned by the single person. Consider it as owned by the single person. Determine income from house property, and the resulted income from house property shall be apportioned between the co-owners depending upon their share over the property. Are you following? To avoid the double work ma, no need to go for separate tax treatment ma in case of LOP. In case if you go for separate tax treatment, it will leads to double work, because MV, FR, SR you need to apportion, municipal taxes you need to apportion, interest you need to apportion. Are you following? Double work, separate formats, double work. So considering the property is having single owner, determine income from house property, and the resulted income from house property shall be apportioned between the co-owners depending upon their share. That is the tax treatment. So one line summary: if it is the status is happen to be SOP, we need to give separate treatment, since each co-owner is eligible for claiming deduction under section 24 class B up to rupees 30,000 or 2 lakhs. Second case, if it is happen to be LOP, then we need to treat the property is having single owner, determine income from house property, and the resulting house property income shall be apportioned between the co-owners depending upon their share to avoid the double work. That's it. And one more important point ma, in case of self-occupied property, each co-owner is eligible for up to 30,000 or 2 lakhs, right? Then this will be along with the other self-occupied property owned by used by the co-owner separately for his own residential purpose. I will explain. Say for example, this co-owner is having another property that is also used by him for his own residential purpose, then that house property and this co-owned property put together, maximum 30,000 or 2 lakhs shall be allowed as a deduction. You need to remember that. Definition: where a house property is owned by the 2 or more persons, then we can say that those persons are having co-ownership on such property. Treatment in case of co-ownership is purely depends upon the status of the property. If such property is self-occupied by the co-owners, then we need to determine income from house property for each co-owner separately, since each co-owner is allowed to claim maximum interest as deduction up to rupees 2 lakhs or 30,000. In case the house property is let out by the co-owners, then we need to determine income from house property, assuming the property is having single owner, and the resulting house property income will be simply apportioned between co-owner as per their share in the property to avoid the double work. Note: since each co-owner is eligible for deduction towards interest under section 24 class B is up to rupees 2 lakhs or 30,000, however, the aggregate deduction of interest to each co-owner in respect of interest payable on loan taken for co-owned house property and interest, if any, payable on loan taken for another self-occupied property owned by him cannot exceed 30,000 or 2 lakhs as the case may be. Remember, very important point. Next ma, treatment for a house property which is situated outside India. We will discuss. Next ma, treatment for a house property which is situated outside India. Tell me, what are the possible cases where the income from a house property which is situated outside India is chargeable to tax in India under the head income from house property ma? What are the possible cases? Two possible cases. First one, the assessee is resident and ordinarily resident. What is that, ma? Assessee is resident and ordinarily resident. If at all the assessee residential status is ROR, then global income will be chargeable to tax, ma. What do you mean by global income? Indian income as well as foreign income. That means even though the house property located outside India, that means the place of accrual is outside India and place of receipt is outside India. Hence, it will be treated as foreign income. Even though it is foreign income, still we need to charge to tax in the hands of individual, in the hands of assessee under the head income from house property in India, if at all his residential status is ROR. Next, ma, second case. The assessee's residential status is that individual's residential status is non-resident or resident but not ordinarily resident, ma. Non-resident or resident but not ordinarily resident. In such a case, when that income from such house property is chargeable to tax in India, ma, only when the rent amount is received in India. Only when the rent amount is received in India. What happens if at all the rent amount is received in India, ma, it will become Indian income. Because either place of accrual or place of receipt is in India, it is enough to give the status of Indian income, ma. That means if the house property which is located outside India and the rental income from such house property is received in India, then we need to treat such income as Indian income and chargeable to tax in the hands of every person irrespective of residential status. Are you following? That means even the individual status is non-resident or resident but not ordinarily resident, still it will be taxable in India because the place of receipt is in India, hence the status is Indian income. So these are the two possible cases where the income from house property located outside India is chargeable to tax in India. So what is the dealing head for that rental income? Same, obviously, income from house property. And what are the dealing provisions? Same as normal rental income from house property located in India. We need to treat same as the property is. We need to give the same treatment which we are giving to the property located in India. That means from section 22 to 27 we need to apply, and we need to charge under the head income from house property. All provisions we need to apply. Then what about municipal taxes paid outside India, ma? Because the location of the property is outside India, therefore the assessee paid municipal taxes outside India. Can we claim it as deduction in India? Obviously yes. If at all you are charging such income to tax in India, then related expenditure must be allowed as a deduction in India. So assuming the property is located in India, we need to give tax treatment by applying provisions of section 22 to 27. That means municipal taxes paid outside India shall be allowed as deduction in India while computing income under the head house property. Let's verify. Income from house property situated outside India is chargeable to tax in India only in the following two cases. Case 1, the person receiving such rental income is ROR. Second case, the person receiving such rental income is NR or R but NOR and it is received in India, then it is Indian income taxable in the hands of all persons. Hence, we have to determine annual value, that is income from house property, from such house property by applying provisions of section 20 to 27 as if the property is situated in India. Hence, municipal taxes paid outside India shall be allowed as deduction from GAV. Are you following? Next, ma. So that is the discussion relating to what? House property situated outside India, successfully completed, ma. Now last concept we are going to discuss, what is that? Section 27. What is section 27, ma? Deemed ownership. What is that? Deemed ownership. Please tell me what are the three conditions required to be satisfied cumulatively for an income to be taxable under the head income from house property, if you remember. We have already verified three conditions. Rental income must be received from letting out of building or land connected to the building. Second condition, the receiver of the rent must be the owner of such building, that is owner of such building or land connected to the building which are given on let out. And the owner should not use such building for his own business or profession. There, what is the second condition, ma? The recipient of the rent shall be the owner of such building or land connected to the building which are given on let out. That means if you want to charge rental income under the head income from house property, the recipient should have the status of owner. There are two types of owner. First one legal owner, second one deemed owner. Who is legal owner? Very simple. The person on whose name the property is registered will be treated as legal owner. Whereas who is deemed owner? Very simple. As per section 27, the person who specified under section 27 will become the deemed owner, and he will be getting the status of owner. Then second condition will be satisfied. It will be taxable under the head income from house property. So we are having two types of ownerships. First one is legal ownership. Second one is deemed ownership. The deemed ownership is specified under section 27 through 6 cases. How many cases? 6 cases. Let's verify one by one in detail. Chalo. Case 1. Let's verify case 1. What is case 1? Where an individual transfers the house property to his or her spouse either without consideration or with inadequate consideration, then the transferor individual shall be treated as deemed owner as per section 27, and income from such property shall be clubbed and taxable in the hands of the transferor even though it is received by the transferee. Are you following? Why this case has been introduced through section 27 under the concept called deemed owner? To avoid the tax evasion practices. What do you mean by tax evasion practice? Before introduction of section 27, the concept called deemed owner, the individuals who are under highest tax bracket transferring their house properties to their spouse without consideration or with inadequate consideration, and shifting the income from highest tax bracket to lowest tax bracket, and which resulted into loss of revenue to the department. To avoid these type of tax evasion practices, the lawmakers introduced section 27, and again they are clubbing that income in the hands of the transferor individual, and again it is charging to tax under highest tax bracket. Therefore successfully they avoided the loss of revenue to the department, the lawmakers. Understood, ma? So why they introduced the case 1? To avoid the tax evasion practice. Let's verify. Where an individual transfers the house property to his or her spouse either without consideration or with inadequate consideration, then the transferor individual will be treated as deemed owner as per section 27, and income from such house property will be taxable in the hands of the transferor individual even though it is received by the transferee. This is how they closed the loophole by introducing section 27 and the concept called deemed owner. Now let's verify exceptions. What do you mean by exceptions? We are having two exceptions under section 27 under case 1. That means in these two exceptions, we cannot treat it as tax evasion transfer. We need to treat it as genuine transfer. If at all it is happened to be genuine transfer, then section 27 is not applicable. Then it is not to be clubbed in the hands of the transferor individual, but chargeable to tax in the hands of transferee only, because it is not tax evasion transfer, it is a genuine transfer. First exception, the house property transferred by the individual to his or her spouse with adequate consideration. What is that, ma? With adequate consideration. If at all it is transferred with adequate consideration, then you need to treat it as a genuine transfer. Then 27 is not applicable. The rental income shall be taxable in the hands of the transferee only, should not be clubbed in the hands of the transferor, because transferor will not get the status of deemed owner. Second exception, the house property transferred in connection with an agreement to live apart. What do you mean by in connection with an agreement to live apart? Divorce case. So the individual transferring the house property to his or her spouse through court judgment, as per the court judgment in case of divorce. In such a case, you need to treat it as a genuine transfer. You should not treat it as tax evasion transfer. Therefore, section 27 is not applicable. The transferor shall not be treated as deemed owner. Therefore, that income shall be taxable in the hands of the transferee only. Are you following? So what are the two exceptions, ma? The house property transferred with adequate consideration. Second exception, transferred in connection with an agreement to live apart. Okay. Take a look. Those are the two exceptions we need to consider. Next, ma, case 2. What is case 2? Under case 1, the property has been transferred to the spouse Under case 2, it is transferred to the minor child. Transferred to the minor child. What is the provision says? Where an individual transfers the house property to his or her minor child. That means father transferring the property to the minor child or mother transferring the property to the minor child. That is what you mean by transferred by the individual to his or her minor child without consideration or with inadequate consideration. Then the transferor individual shall be treated as deemed owner as per section 27. Are you following? And income from such property shall be clubbed and taxable in the hands of the transferor individual even though it is received by the transferee minor child. Again, it is a tax evasion transfer. Why they are transferring to the minor child, ma? If at all they attain the majority, they are transferring means it is a genuine one. But even though they are minors, still they are transferring the house properties to their minor children means they are entering into the tax evasion transfer. To avoid such transfers, they introduced case 2 under the concept called deemed owner under section called 27. Are you following? Good. Let's verify. Where an individual transfers the house property to his or her minor child, either without consideration or with inadequate consideration, then the transferor individual will be treated as deemed owner as per section 27, and income from such house property will be taxable in the hands of transferor individual even though it is received by the transferee. Good. Exceptions, ma. Here also we are having 2 exceptions. That means under these 2 exceptions we need to treat it as a genuine transfer. We should not apply section 27. You cannot treat transferor as a deemed owner and you cannot charge in the hands of the transferor, but it is taxable in the hands of the transferee. First exception, the house property transferred with the adequate consideration. The minor child paid adequate consideration out of his earnings, then you cannot treat it as a taxation transfer. You need to treat it as a genuine transfer and it will be accessible to tax in the hands of the minor child. Are you following? And again we need to consider clubbing of minor income. Are you following? 64 subsection 1A we need to consider at the time of assessing to tax. Next, ma. Second exception, the house property transferred to the minor married daughter. The house property transferred to the minor married daughter, again it will be treated as genuine transfer. It is not to be clubbed in the hands of the transferor but accessible to tax in the hands of the minor married daughter. Those are the 2 exceptions, ma. That is regarding discussion relating to case 1 and case 2. Next, ma. Case 3. What case 3 says? The buyer of the house property shall be treated as deemed owner as per section 27, and income from such property shall be clubbed and taxable in the hands of the buyer, provided the conditions specified under section 53 of Transfer of Property Act has been satisfied cumulatively. Come again, ma. The buyer shall be treated as deemed owner as per section 27, and that rental income shall be chargeable to tax in the hands of the buyer under the head income from house property but not under the head PGBP or IFOS, provided that buyer has been satisfied all conditions specified under section 53 of Transfer of Property Act. My question here, lawmakers are specifying the person in whose hands it must be taxable, ma, or they are specifying the head under which it must be taxable. They are particular regarding the head of income. They are not particular regarding the person, because obviously it will be taxable in the hands of the buyer only. But they are very particular regarding head of income. They are saying that it must be taxable under the head income from house property but should not be taxable under PGBP or IFOS. Are you following? I will explain in detail. Pay attention. What happened here? Buyer and seller both has been entered into an agreement in writing relating to transfer of house property. The buyer and seller has been entered into an agreement in writing, and the buyer has been paid part or full consideration or ready to pay the consideration. Either he has been paid part or full consideration or ready to pay consideration. What do you mean by ready to pay? On demand he will pay the consideration to the seller. And third one, the seller has been given the possession of the property to the buyer. What do you mean by given the possession of the property? Usage right, keys has been handed over to the buyer. That means all transactions has been completed to get the status of effective transfer except one ma. What is that? Transferring the property, registering the property in the name of the buyer. Registering the property in the name of the buyer, that is the only transaction left, except that all other transactions has been completed. That is the only one transaction pending. If at all the documents are not registered yet in the name of the buyer, then the buyer will not get the ownership. He cannot be treated as legal owner. But he is having the possession, but he is having the usage right. With that right, he has been given on let out. Whenever he given on let out, he is receiving the rental income. Now decide what is the dealing head for that rental income. Can we charge under the head income from house property? Obviously you cannot charge. Why you cannot charge? Because second condition is not satisfying. What is the second condition? The recipient should be the owner. He don't have the legal ownership because the documents are not yet registered in the name of the buyer. Still it is in the name of the seller. If at all the legal ownership is not with the buyer, second condition is not satisfied, you cannot charge under the head income from house property. Then you need to charge under the head PGBP or IFOS. But lawmakers don't want to charge under the head PGBP or IFOS. They want to charge under the head house property. For that they need to satisfy second condition. But legal ownership is not with the buyer. Hence they are treating the buyer as a deemed owner. Since legal ownership is not with the buyer, hence they are giving the status of deemed owner to the buyer. Whenever deemed ownership status has been given to that buyer as per section 27, then the second condition has been satisfied automatically. Then all three conditions will be satisfied. Then it will be taxable under the head income from house property comfortably. So my question here, the lawmakers are very particular regarding the persona, or they are very particular regarding head of income. They are very particular regarding head of income, not person. Because obviously it will be taxable in the hands of the buyer only, the rental income. But charging under the head PGBP or IFOS. But lawmakers don't want to charge under those heads. They want to avoid those heads. They want to charge under the head house property. That's why they introduced the section called 27. Case 3 has been introduced under that section 27. Are you following? So what is the problem to the lawmakers to charge under the head PGBP or IFOS? Because under the head PGBP or IFOS, what is the speciality of those heads of income? Actual expenditure is allowed as deduction there. Under the head PGBP, under the head other sources, actual expenditure will be allowed as deduction. But when it comes to house property, irrespective of actual expenditure, 30% of NAV will be allowed as standard deduction under section 24 clause A. This is the reason for them to bring under the head house property rather than PGBP or IFOS. Are you following? That means by charging under the head house property, they're allowing less expenditure as deduction. Then the income from house property is increasing. Therefore, the revenue to the department has been increased. That means what is the intention of the lawmaker for introducing case 3 under section called 27 to increase the revenue to the department. For the first two cases, what is the intention of the lawmaker? To avoid the tax evasion practice. But remaining 4 cases, case 3 to case 6, remaining 4 cases, the intention of the lawmaker is not to avoid the tax evasion practice, but to increase the revenue to the department by charging under the head house property rather than charging under the head PGBP or IFOS. Are you following? Yes. But if you want to treat buyer as deemed owner, then what is the requirement? 3 conditions specified under section 53 of Transfer of Property Act must be satisfied. What are the 3 conditions? First condition, buyer and seller must be entered into an agreement in writing relating to transfer of that property. Second condition, the buyer has been paid part or full consideration or ready to pay the consideration. Third condition, the seller has been given the possession of the property to the buyer. Then the buyer shall be treated as deemed owner as per section 27, and income from such property shall be accessible to tax under the head house property but not under the head PGBP or IFOS. Next I hope you understood well. Next, case 4. I just explained with the help of example. Just take a look. Just take a look. Next I explained what is the income if it is charged to tax under the head PGBP or IFOS, and what is the income if at all they charge you to tax under the head house property. Okay, I will explain, pay attention. What is rental income? 5 lakhs. Expenses 4 lakhs. Actual expenditure incurred 4 lakhs, whereas rental income received is 5 lakhs. Under the head PGBP or IFOS, what is the speciality of those heads of income? Actual expenditure is allowed as deduction. What about house property head? Standard deduction will be allowed at the rate 30% irrespective of actual expenditure. Now, let's determine income under the head PGBP or IFOS. Rental income 5 lakhs, actual expenditure 4 lakhs. Then what is the profit? 1 lakh. If at all the tax rate is 30%, assume tax rate at the rate 30%. What is revenue to the department? 30,000. That means if at all they charge you to tax under the head income from PGBP or IFOS, what is the revenue to the department? 30,000. In case they charge it under the head house property, what is the revenue? Let's verify. Rental income 5 lakhs. Here actual expenditure is not allowed, but standard deduction will be allowed at the rate 30%. How much? 1.5 lakh. Then what is the profit? 3.5 lakh. If at all we applied same rate 30% on that profit of 3.5 lakh, what is the revenue to the department? 1,05,000. That means by shifting the income from PGBP or IFOS to house property, their revenue has been increased from 30,000 to 1,05,000. What is the incremental revenue received by the department here? 75,000 ma. For that incremental revenue, they are charging under the head income from house property rather than charging under the head PGBP or IFOS. Are you following? So what is the intention of the lawmaker for charging, for introducing case 3 under section 27 to increase the revenue to the department? For first 2 cases, to avoid the tax evasion practice. That is the very important point. Next okay. Case 4. The holder of the impartible estate shall be treated as deemed owner as per section 27, and income from such impartible estate shall be accessible to tax under the head house property but not under the head PGBP or IFOS. Here also the intention is to increase the revenue to the department. Are you following? So what do you mean by impartible estate? A property which cannot be apportioned among the family members, because that is family property that cannot be apportioned to the family members, but one person will be given the legal managing rights. One person will be given the managing rights to manage the property, like payment of insurance, giving the property on lease, entering into the lease agreement. For that, managing rights will be given to the one person of one family member, but legal ownership will be in the name of the family. In such a case, the person who is managing the property is receiving the rental income, but he is not having the legal ownership. Hence, we cannot call him as a legal owner. If at all we cannot give the status of legal owner but receiving rental income, then second condition will not be satisfied. Then it will go to the PGBP or IFOS. So to avoid the chargeability under the head PGBP or IFOS, the lawmakers giving the status of deemed owner to this holder of that impartible estate. Tell me, who is the holder of that impartible estate? The person who is having the managing rights over the impartible estate will be treated as holder of impartible estate. So that holder of impartible estate not having the legal ownership, hence the lawmakers giving the status of deemed owner by introducing case 4 under section 27. Whenever he is getting the status of deemed owner, then second condition will be satisfied. Out of 3 conditions, then all the 3 conditions will be satisfied. Then comfortably we can charge under the head income from house property. Are you following? So again, case 4 also introduced to increase the revenue to the department. Next case 5. The member of the housing cooperative society shall be treated as deemed owner for the property which is allotted by the housing cooperative society to the member, and income from such property shall be accessible to tax under the head house property but not under the head PGBP or IFOS. I will explain. There is a cooperative housing cooperative society, it is having certain number of members. Now what is the activity, what is the service of that housing cooperative society? It is allotting properties to the members upon receipt of some down payment, part of the amount as a down payment. Say for example, the house property value, the cost of those property is 1 crore, and it is allotting 1 crore worth of house property to the members on receipt of down payment of just 20 lakhs then remaining 80 lakhs will be paid by the member to the housing cooperative society along with the interest over a period of 30 years on installment basis. If at all the property has been allotted to the member by the housing cooperative society by receiving just 20 lakhs out of total amount of 1 crore, is it possible for the society to transfer the legal ownership to the member They will not transfer legal ownership to the member upon receipt of just 20 lakhs because in case they transfer the legal ownership, then the member will get the resale right. Whenever he is getting the resale right, he will resell the property and he will recover, he will collect 1 crore and he will abscond. Then it is a loss of revenue to the cooperative society. That's why the society is not transferring the legal ownership. It is just giving the possession. It is giving the usage right to the member. That means member can use for his own residential purpose or he can give on let out basis but they will not transfer the legal ownership. When they will transfer the legal ownership? After completion of, after making the payment of last installment. When it will be made by the member after 30 years. That means in these 30 years the property will be in the name of the society only. The legal ownership will be in the name of the society only. The member is not getting the legal ownership but is receiving the rental income. If at all is receiving rental income, not having the legal ownership, then second condition will not be satisfied. Then we cannot charge under the head house property. We need to go for PGBP or IFOS. But lawmakers don't want to charge under those heads of income. They want to charge under the head house property. Hence, they are giving the status of deemed owner as per section 27 to that member. And in these 30 years, the member will be treated as deemed owner. Once he paid the last installment, he will be getting the legal ownership. Then he will be treated as legal owner. Are you following? So for these 30 years, he will be having the status of deemed owner. Then second condition will be satisfied. All the three conditions will be satisfied. Then the rental income will be taxable under the head income from house property. That is what do you mean by case 5. Next case 6. Are you following? Case 6. What is case 6 The lessee shall be treated as deemed owner for the house property which is taken on lease basis provided the lease period is greater than or equal to 12 years. In case of lease agreement, two parties will be there, lessor and lessee. Who is lessor? The person who is giving the property on lease basis will be treated as lessor. The person who is taking the property on lease basis will be treated as lessee. And the lessor is having legal ownership. If at all you are giving a property on lease basis, whether the lessor will transfer legal ownership also to the lessee? No. The legal ownership will be with the lessor only. Only the usage right has been given to the lessee. In such a case, the lessee shall be treated as deemed owner as per section 27. And if in case the lessee has been given on let out and receiving any rental income, then that rental income will be taxable under the head income from house property because that lessee is having the status of deemed owner as per section 27. Are you following? Then it shall not be taxable under the head PGBP or IFOS. Understood provided the lease period is minimum 12 years. That means equal to 12 years or more than 12 years. What if the lease period is 5 years Then the lessee will not be getting the status of deemed owner. Then what is the dealing head for those 5 years? Either PGBP or IFOS to charge the rental income from such leased property in the hands of the lessee. So when we need to apply section 27, provisions of section 27, only when the lease period is minimum 12 years, that is greater than or equal to 12 years. So these are the 6 cases covered under section 27. For these 6 cases, first 2 cases, the intention of the lawmaker is to avoid the tax evasion practice. Remaining 4 cases, the intention is increasing the revenue to the department. That's it. Chalo. Intention of the lawmaker for introduction of section 27, the concept of deemed owner. For the first 2 cases, the intention of the lawmaker is to restrict or avoid the tax evasion practice. For the remaining 4 cases, the intention of lawmaker is to increase the revenue to the department. Understood? That is the pura discussion relating to section 27. With this, we have successfully completed the discussion relating to house property. I hope you understood. Well, okay then. In the next session, I will explain. I will start PGBP head. Very important from the viewpoint of examination. Okay then. Thank you. Shall we start? Chalo Let's start with very important head of income. What is that? PGBP. What do you mean by PGBP, ma? Profits and gains of business or profession. Very important from the viewpoint of examination. The PGBP problem that can be given in the examination as a total income problem, or they can give it as a separate problem on PGBP. So whatever it may be, it's very important from the viewpoint of examination. Pay attention, ma. Here it is not possible, obviously not possible, to explain each and every concept under the head PGBP within 3 hours, ma. In this marathon class, it is not possible, but I will explain the pro forma for determination of income under the head PGBP. What is that? Pro forma for determination of income under the head PGBP. In that pro forma, we have to do various adjustments, ma, and I will try to explain each and every adjustment which is having possibility for appearing in the examination. So if you listen to this 3 hours class, it is very easy for you to handle the problem in the PGBP problem in the examination. Chalo, let's verify. Pay attention, ma. Very important. The following are the two possible questions that may be asked in the examination. What are the possible questions, ma? They can give P&L account or income and expenditure account, and they will ask you to determine income under the head PGBP. First possible question. Second possible question, they will give receipts and payments account. In case they have given receipts and payments account in the examination, then it is very easy to determine income under the head PGBP, ma. How? From that information, you need to pick up the receipts or income which are relating to the business or profession, and you need to sum up those receipts from business or profession. From those receipts, you need to reduce expenditure relating to the business or profession. Then you will get income under the head PGBP. Are you following? It is very easy if at all they have given receipts and payments account in the examination. In case they have given P&L account or income and expenditure account, that P&L account, that income and expenditure account has been prepared as per the Companies Act 2013, ma. But income tax department don't allow that net profit which is arrived as per Companies Act. Income tax department will not allow for the purpose of payment of tax. Therefore, we need to determine income under the head PGBP starting from the net profit which is determined as per Companies Act. To that net profit, we need to do various adjustments. We need to reduce, we need to add back. So multiple adjustments we have to do, and we need to determine income under the head PGBP, and that is the income under the head PGBP as per the Income Tax Act 1961. Are you following? So now I will explain the pro forma along with the various adjustments which are having possibility for appearing in the examination. So if you listen to this 3 hours class, it is very, very easy, and you will be very confident regarding what is that answering the question in the examination. Chalo, let's start, ma. If P&L account or income and expenditure account given in the examination, then what is the procedure to determine income under the head PGBP? Let's verify, ma. First of all, we need to start as per net profit determined as per Companies Act, ma. What is that? We need to start net profit determined as per Companies Act. So what is the starting point? Net profit as per P&L account or income and expenditure account which is determined, which is prepared as per the Companies Act. That is the first point we need to consider. So to that net profit, what we have to do, ma? First thing, we need to add back. What we need to add back? Inadmissible expenses or expenses debited to the P&L account but not allowed as deduction. What do you mean by this statement? While preparing that P&L account, while preparing that income and expenditure account, they have been debited various expenses to that P&L account and income and expenditure account as per the Companies Act, ma. They have debited various expenses to that P&L account as per Companies Act. Out of those various expenses, certain expenses are not allowed as per Income Tax Act. Come again. They have debited various expenses to that P&L account as per Companies Act. out of those expenses, certain expenses are not allowed as per Income Tax Act 1961. Therefore, we need to add back the expenses which are not allowed as per Income Tax Act 1961. What do you mean by disallow? We need to add back to the net profit. That is the first adjustment we need to do. What is the first adjustment? Add back inadmissible expenses or expenses debited to the P&L account but not allowed as a deduction. Second adjustment, we need to less. What we need to less? Admissible expenses or expenses allowable as per Income Tax Act but not claimed by the SSC. What is happened here? Certain expenses, those expenses are allowed as deduction, but those expenses has not been claimed by the SSC as per, because he followed the Companies Act while preparing that P&L account. As per Companies Act, that expenditure is not allowed, hence he has not claimed. Or because of the ignorance of the SSC, that expenditure has not been claimed. But that expenditure is allowed as deduction as per Income Tax Act 1961. Then what we have to do? We need to reduce that eligible expenditure, admissible expenditure from the net profit. That is the second adjustment we have to do. Next, third adjustment. Less income taxable under other heads of income or exempted income credited to the P&L account. What do you mean by the statement, That P&L account has been prepared by following Companies Act. As per Companies Act, there is no difference between PGBP income, house property income, capital gains income, other sources income. By following Companies Act, they have prepared the P&L account. Since there is no heads of income under Companies Act, therefore every income has been credited to the P&L account. Capital gains credited to the P&L account. Rent from house property credited to the P&L account. Interest income credited to the P&L account. Dividend income credited to the P&L account. Exempted income also credited. Agricultural income from a land situated in India, even exempted income also credited to the P&L account. But all those incomes are not taxable under the head PGBP. Either those are taxable under other heads of income, or those incomes are exempt from tax as per Income Tax Act 1961. Since they have prepared that P&L account as per Companies Act, since there is no difference between taxable income and exempted income, and there is no difference between PGBP income and other heads of income, therefore they have been credited all these incomes to the P&L account and they determine the net profit. Therefore, what we have to do? Those incomes we need to less from the net profit, and those exempted incomes we have to reduce from the net profit, and the other heads of income need to be considered under other relevant head, and exempted income shall be excluded from the net profit since those are not chargeable to tax. So that is the adjustment, third adjustment we have to do to the net profit. What is the third adjustment, Less. What we have to less? Incomes taxable under other heads of income are exempted income but credited to the P&L account, that must be reduced from the net profit. Last one, fourth adjustment. What is the fourth adjustment? Add or less other adjustments. That means the adjustments which are not covered in the above three adjustments will be covered here. That means we can say that it is a residuary adjustments. Here we need to add certain adjustments, we need to less certain adjustments. Are you following? So finally, if you do all these adjustments, finally you will get income under the head PGBP, which is determined as per Income Tax Act 1961, and this will be considered by the department for the purpose of determination of tax liability. Are you following, So that is the procedure to determine income under the head PGBP as per Income Tax Act from net profit of the P&L account, which is prepared as per the Companies Act 2013. So tell me, what are the various heads of adjustment we have to do, First, we need to start from net profit as per P&L account or income and expenditure account, which is prepared as per Companies Act 2013. To that, what is the first adjustment, Add back. What we need to add back? Inadmissible expenses or expenses debited to the P&L account but not allowed as deduction. We need to add back. Then second adjustment, less admissible expenses. That means expenses which are allowed as deduction but not claimed by the SSC. we need to less from the net profit. Third adjustment ma, we need to less incomes taxable under other heads of income or exempted income which are credited to the P&L account. We need to reduce that. Then other adjustments ma, certain items we need to add, certain items we need to less. That means residuary head for adjustments to the net profit. Are you following? So now let's verify one by one each and every adjustment one by one in detail ma. Chalo. Let's go for first adjustment. What is the first adjustment ma? Pay attention. Income tax or advance tax ma. They have debited income tax or advance tax or self-assessment tax to the P&L account and claimed as deduction. As per Companies Act, they have debited. But tell me, as per Income Tax Act 1961, whether advance tax payment or self-assessment tax payment or income tax payment will be allowed as deduction ma? Can we claim income tax payment as a deduction under Income Tax Act 1961 while determining income under the head PGBP? It is not allowed as deduction. What is the relevant section ma for disallowing income tax payment or advance tax payment or self-assessment tax payment? Section 40 class A subclass 2. Remember along with the class number. So try to reproduce in the examination, then it is very easy to grab maximum marks. What is the section dealing with disallowance of income tax payment? Section 40 class A subclass 2. My question, why they are disallowing income tax payment, advance tax payment or self-assessment tax payment under section 40 class A subclass 2 ma? Because it is a personal expenditure. We have discussed in the introduction to tax discussion ma. While explaining that introduction to tax chapter, I have explained that income tax payment is a personal expenditure. It is a personal liability. It is a personal expenditure. It shall not be allowed as a deduction as a business expenditure ma. Are you following? So it is a personal liability. It is a personal expenditure. Since personal expenditure having no space to allow it as a deduction under the head PGBP or under Income Tax Act 1961, therefore we need to disallow under section 40 class A subclass 2. But when it comes to indirect taxes ma, that means GST, sales tax, VAT, excise duty, customs duty, those are business expenditure. Those are not personal expenditure. Those are business expenditure. Those will be allowed as a deduction, no problem. But when it comes to direct taxes ma, especially income tax, it shall not be allowed as a deduction because it is a purely personal in nature. So tell me, what is the section for disallowing that income tax payment ma? Section 40 class A subclass 2. Let's verify that concept. Section 40 class A subclass 2, disallowance in the hands of all assessees ma. In the hands of all assessees, income tax payment, self-assessment tax payment, any advance tax payment made and debited to the P&L account, it shall be disallowed. Any expenditure has been incurred by the assessee by way of payment of income tax or advance tax or self-assessment tax will not be allowed as deduction as per section 40 class A subclass 2. Why ma? In case the assessee has been debited income tax payment or advance tax or self-assessment tax to the P&L account and claim it as deduction, it should be disallowed under section 40 class A subclass 2. That means added back to the net profit. Reason ma, income tax will be treated as personal liability but not a business liability or business expenditure, therefore not allowed as a deduction. Since all direct taxes are personal expenditures, not allowed as deduction, but very important point, but all indirect taxes are business expenditure, allowed as a deduction. That is the discussion relating to first adjustment ma. What is the first adjustment? Income tax or advance tax or self-assessment tax that shall be disallowed under section 40 class A subclass 2. Next ma, first adjustment is done. Next, unreasonable or excessive expenditure shall be disallowed under section 40A subsection 2. What is that? Unreasonable or excessive expenditure. I will explain. The assessee engaged in the business or profession and he purchased the goods or received the services from the related party. What happened? The person, the SSC has been engaged in the business or profession and purchased the goods or received the services from the related parties ma, and the payment has been made, and the payment made by the SSC is exceeding the fair market value. What happened to the payment made by the SSC ma? The payment made has been exceeded the fair market value. Then in excess of the fair market value shall be treated as unreasonable or excessive expenditure that shall be disallowed under section 40A subsection 2. Come again ma. In case the SSC has been engaged in the business or profession and made purchases or received services from the related party, and payment has been made by the SSC and the payment is exceeding the fair market value, then in excess of fair market value or in excess of fair market value shall be treated as unreasonable or excessive expenditure, then it shall be disallowed under section 40A subsection 2. Very important, so many times appeared in the examination. Let's verify ma. Section 40A subsection 2. Pay attention. Disallowance of unreasonable or excessive expenditure. The following are the conditions which are required to be satisfied cumulatively for the purpose of invoking section 40A subsection 2 and disallowing the unreasonable or excessive expenditure. What are the conditions required to be satisfied ma? SSC should engage in the business or profession. Good. SSC must enter into the transaction with the related party, and the transaction should be related to purchases or services received, and the consideration paid by the SSC must exceed fair market value. What if it is not exceeded fair market value ma? Then it will be treated as genuine transaction, no fraudulent transaction. Hence there is no question of invoking provisions of section 40A subsection 2. When we have to invoke? Only when it is exceeding fair market value and the above three conditions also satisfied. Then the difference between consideration paid minus fair market value, nothing but in excess of fair market value ma, shall be treated as unreasonable or excessive expenditure, and it should be disallowed under section 40A subsection 2. Very important. Remember along with the section number. Unreasonable or excessive expenditure shall be disallowed under section 40A subsection 2. That means added back to the net profit under this section in the current previous year. Good. Example ma. Let's verify. X Limited is there. Mr. A, Mr. B, Mr. C are the directors of the X Limited ma, and this X Limited purchased goods from Mr. Y. Who is Mr. Y here? Son of Mr. A. That means he is the son of the one of the director of X Limited ma. That means that company purchased the goods from related party. Next, consideration has been paid. How much consideration has been paid ma? 20,000. Whereas we need to verify fair market value to consider to find out what is to be disallowed. And what is the fair market value ma? 12,000. The fair market value is 12,000, but the payment made by the company to son of director of that company is 20,000. Since all the conditions has been satisfied cumulatively, therefore we need to invoke the provisions of section 40A subsection 2 ma. So what is to be disallowed? The difference between consideration paid minus fair market value. What is consideration paid ma? 20,000 minus fair market value 12,000. What is excessive expenditure or unreasonable expenditure ma? 8,000 shall be disallowed under section 40A subsection 2. That means we need to add back 8,000 to the net profit. Are you following? That is the discussion relating to 40A subsection 2 ma. Next. Second point also completed. Next method adjustment. Very important. Very, very important. Pay attention. Cash payments or bearer check payment or crossed check payment exceeding 10,000 rupees. What happened here? You incurred some revenue expenditure ma, or you incurred capital expenditure, or you purchased goods for the purpose of meant for resale in the ordinary course of business, and you made the payment to the same person on the same date in respect of a particular invoice, and the payment has been exceeded 10,000, and the payment has been made by way of cash or bearer check or crossed check. In such a case, we need to invoke the provisions of section 40A subsection 3. Then the entire payment, entire expenditure shall be disallowed under section 48 subsection 3 and it must be added back to the net profit. Very important. Then to avoid this disallowance, what you have to do, you need to make the payment other than these three modes. You need to make the payment other than these three modes. Let's verify the provision in detail. Chalo. Section 48 subsection 3, disallowance of cash payments or bearer check payments or crossed check payments exceeding rupees 10,000. The following are the 5 conditions required to be satisfied cumulatively for the purpose of invoking the provisions of section 48 subsection 3 and disallowing the expenditure in the current previous year. The assessee shall make the payment to the same person. Such payment must be made on the same date. Such payment shall be made in respect of an expenditure. That means with reference to a particular bill or invoice. Particular means it is relating to a single bill or single invoice, not multiple. Such a payment should exceed 10,000 and such a payment has been made by way of cash or bearer check or crossed check. If all these conditions has been satisfied cumulatively, then section 48 subsection 3 will be applicable and the entire expenditure will be disallowed. This provision has been introduced to, why they have introduced, to discourage the cash payments, bearer check payments or crossed check payments which leads to the generation of the black money. To avoid the accumulation of black income, black money, they have introduced the provisions of section 48 subsection 3. In case if you allow the payment by these modes, obviously the assessee will try to escape the income from the assessment which is resulted into generation of black money. Are you following? To avoid such generation of black money, the lawmakers introduced and strictly they are following section 48 subsection 3. Chalo, they are implementing very strictly. That is added back to the net profit under this section in the current previous year. Very good. Observation 1. If the assessee's transaction is covered under the above said situation, then he should make such a payment by way of, what do you mean by above situation, the payment has been made to the same person on the same date in respect of an expenditure and the payment has been exceeding 10,000 rupees, then that payment shall be made by way of either account pay check or account pay demand draft or electronic clearing system through bank or through such other prescribed electronic modes. What are the other prescribed electronic modes, Credit card, debit card, net banking, IMPS, immediate payment service, UPI. What do you mean by UPI, Google Pay, Phone Pay, RTGS, NEFT, Bheem, Aadhaar Pay. What happens if at all you made the payment through any of these modes, it will be recorded in the bank. The transaction will be recorded in the bank. If at all it is recorded in the bank, then it is very easy for the department to find out those transactions, and in case any black money generated, it is very easy for them to find it out. Are you following? Yes. To avoid the disallowance under section 48 subsection 3, if at all you covered in the above said situation, then you have to make the payment through these modes, then there is no question of invoking 48 subsection 3 and there is no disallowance of that expenditure. Observation 2, if the payment made by the assessee to the same person on the same date and in respect of an expenditure does not exceed 10,000, that means 5,000 you are making, 8,000 you are making, or even 10,000 equal to 10,000 you are making, that means does not exceed 10,000, then such assessee can make the payment by any mode including cash, then there is no problem. There is no problem. Next, applicability of section 48 subsection 3 or nature of expenditure covered under section 48 subsection 3, for which type of expenditure we need to invoke provisions of section 48 subsection 3 is the discussion. It is applicable to revenue expenditure. It is applicable to the expenditure made for the purpose of purchase of material which is meant for resale, and it is applicable to even capital expenditure also. One line summary, it is applicable to all types of expenditures. It is applicable to all types of expenditures. Let's verify. Section 48 subsection 3 will be applicable for the following 3 expenditures: revenue expenditure, expenditure incurred for the purpose of purchase of asset meant for sale in the ordinary course of business, capital expenditure inserted through Finance Act 2017 ma, applicable with effect from 1/4/17. Before 1/4/17, it was not applied to capital expenditure, but with effect from 1/4/17, because of that amendment, now it is applicable to the capital expenditure also. That means you purchased a plant and machinery for your factory ma, and that payment has been made by cash. 1 crore rupees cost of the plant and machinery, entire 1 crore you paid by way of cash. Then entire 1 crore shall be disallowed. You are not eligible to claim depreciation under section 32 because it is applicable to capital expenditure also. Next ma. One line summary. This section is applicable to all categories of expenditure involving payment for goods or services which are deductible in computing in taxable income. That means it is applicable to each and every expenditure which is eligible for claiming as a deduction under Income Tax Act from taxable income. Next ma. That is regarding 40A subsection 3. Very important. I hope you understood. Next ma. Fourth one. Depreciation they have debited to the P&L account. The depreciation has been determined as per Companies Act. Come again. The depreciation which has been debited to the P&L account is determined as per Companies Act 2013, but it is not allowed as deduction under Income Tax Act. To allow it as deduction under Income Tax Act, you need to determine depreciation as per Income Tax Act 1961 by following provisions of section 32. Are you following? Therefore, the depreciation which is debited to the P&L account, which is determined as per Companies Act, we need to add back. And subsequently, we need to reduce, we need to less depreciation as per Income Tax Act. That will come little bit later. For the time being, what we have to do? We need to add back ma. Every PGBP problem, every total income problem will be comprising depreciation debited to the P&L account as per Companies Act. What you have to do? You need to add back. That is the point. Depreciation as per Companies Act debited in the P&L account. You need to add back ma. Fourth one. Fifth one ma. Fifth adjustment. Municipal taxes paid in respect of house property. They have debited the municipal tax payment relating to the house property to the P&L account ma. Why? Because the rental income they credited to the P&L account. As per Companies Act, there is no difference between PGBP income and house property income. That's why the rental income has been credited to the P&L account. Therefore, the debited related expenditure as a deduction and claim it as a deduction. So what is the treatment for municipal tax payment ma? It is allowed as deduction from gross annual value under the head income from house property. But it is not allowed as a deduction under the head PGBP. Then what we have to do with that municipal tax which is debited to the P&L account? You need to add back. You need to add back. Next ma. Municipal tax paid in respect of house property needed to be add back and disallowed since it is to be considered under the head house property. Good. Next ma. Sixth one. Are you following? Chalo. What is the sixth one? Interest on own capital. Tell me what is the section allowing interest expenditure as deduction ma? Under which section we can claim interest expenses as deduction ma? Under section 36 subsection 1 class 3. Come again. It will be allowed as deduction. Interest expenditure shall be allowed as deduction under section 36 subsection 1 class 3. What are the conditions required to be satisfied to claim any interest expenditure as deduction ma? Under section 36 subsection 1 class 3. First condition, it should be paid to some other person. First and very important condition, the interest payment must be made to some other person. Second condition, such interest expenditure should be incurred during the current previous year. Third condition, the amount should be borrowed for the purpose of business or profession. If these three conditions satisfied cumulatively, then you can claim that interest expenditure as deduction under section 36 subsection 1 class 3. In certain cases, it will be subject to section 43B. What is 43B? I will explain little bit later. that is actual payment basis in certain cases. Generally, normally, usually it will be allowed depending upon the method of accounting and allowed as deduction under section 36 subsection 1 class 3. So what is the first condition there, ma? Specified under 36 subsection 1 class 3, it must be paid to some other person. But what happened here? Interest on own capital. That means the proprietor is making the payment of interest on own capital to himself, ma. That means the interest payment has been made to the other persona, same persona, same person. Then first condition is not satisfied. What is the first condition? Must be made the payment to the other person. Since first condition itself is not satisfied, it shall not be allowed as a deduction. It shall be disallowed. Are you following? In case in the examination they have given that interest on own capital debited to the P&L account, what you have to do? It shall not be allowed as deduction. You need to add back. You need to do what? Add back. Interest on own capital disallowed since not paid to the other person. Good. Next, ma. Next, ma. Seventh one. Bonus to the employees not paid within the due date. And eighth one also we can discuss. Government dues like GST, sales tax, railway payment not paid within the due date specified under section 43B. These two adjustments relating to very important section 43B, ma. The payments, the expenditures which are covered under section 43B will be allowed as deduction only on actual payment basis irrespective of the method of accounting followed by the SSC. Very important point. Come again. There are certain payments covered under section 43B. Those certain payments will be allowed as deduction only when the actual payment has been made within the due date specified under section 43B. In case those payments which are covered under section 43B has not been paid within the due date specified under section 43B, then in the current previous year, those expenditures shall be debited, has been debited to the P&L account, then we need to disallow, add back to the net profit. And it will be allowed as deduction in the subsequent previous years in which the payment has been actually made. That means disallowed means it will be disallowed forever, ma. Subsequently we are allowing. Subsequently we are allowing when the payment is actually made. Are you following? So let's verify. Very important discussion, very important section 43B. Let's verify, ma. Section 43B. Certain payments are allowed as deduction only on actual payment basis irrespective of method of accounting followed by the SSC. What do you mean by that statement, ma? You are following mercantile system of accounting. If at all you are following mercantile system of accounting, you are having right to claim expenditure as deduction on payable basis. Because you are following mercantile system, you are having the every right to claim any expenditure as deduction on payable basis, but not the payments or expenditures which are covered under 43B. It is superseding method of accounting provision 145 subsection 1, ma. Section 43B superseding the provisions of section 145 subsection 1. That means whenever the comparison comes between 145 subsection B and section 43B, which one will prevail, ma? 43B will prevail because it is having superseding effect. It is a superseding provision. Are you following? Yes. So irrespective of the method of accounting followed by you, in case that payment is covered under section 43B, then that shall be allowed as deduction only when it is actually paid within the due date. Now what we need to verify? What are the payments covered under section 43B and what is the due date for making those payments? Are you following? Chalo. Total 3 categories ma. All those payments has been bifurcated into 3 categories for easy remembrance. Pay attention. Category 1, Category 2, Category 3. Under Category 1, government dues has been covered. Under Category 2, bank dues has been covered. Under Category 3, employees dues has been covered. So for your easy remembrance, I have bifurcated those expenses, those payments with respect to the, what is that? 3 categories with respect to government dues, bank dues and employees dues for easy remembrance. Chalo. First of all, let's verify what are the payments covered under government dues ma. Sales tax, VAT, all indirect taxes ma. Sales tax, VAT, excess duty, customs duty, CST, we don't have service tax. Instead of service tax, consider GST. And municipal taxes ma, to the local authority. And payments to the Indian Railways for use of railway assets inserted through Finance Act 2016. That payment to the railways has been inserted through Finance Act 2016 ma. These payments will be allowed as deduction only when it is actually paid within the due date. In case it is not actually paid within the due date but debited to the P&L account, what you have to do, you have to disallow, means you need to add back to the net profit. What are the payments covered here? Tell me. Sales tax, VAT, excess duty, customs duty, GST, CST, and payments to the railways, municipal taxes, municipal tax payment to the local authorities. Note point is there, pay attention. In case state government providing incentives, what do you mean by state government providing incentives? Say for example, we are liable to pay VAT to the state government, assume. We are liable to pay value added tax, VAT to the state government. But state government says, no need to pay entire VAT liability. You can pay on installment basis. This year, you are allowed to pay 40%, next year 40%, third year 20%. Like this, the state government allowing on installment basis to recover the VAT amount from the particular traders, assume. In such a case, he paid only 40% of the VAT amount in the current previous year because of the incentive given by the state government. In such a case, can we treat it as a default made by the SSC here? No, he made 40% because of the incentive. In such a case, entire 100% of that VAT liability shall be allowed as deduction because it will be treated as deemed to have been actually paid. Because it is not the default of the SSC, it is because of the, what is that, incentive given by the state government. That's why we are not disallowing, even though he made the payment of 40% of VAT liability in that year, we need to allow entire 100% of VAT liability as deduction by treating remaining 60% as deemed to have been already paid. In case state government providing incentives allowed as deduction on deemed to have been paid basis, section 43B is not applicable. Good. Next bank dues Bank dues means nothing but interest liability, interest payment to the bankers. Are you following? Chalo. Assessee who is into the business or profession is liable to pay interest on loan or advance to the public financial institution, state financial corporation, state industrial investment corporation, schedule bank or cooperative bank other than primary agricultural credit society, primary cooperative agricultural and rural development bank. You are liable to pay interest to these persons, then that interest expenditure will be allowed as deduction under section 36 subsection 1 class 3 ready with section 43B. What do you mean by ready with section 43B? Only when the interest payment to these persons has been paid within the due date. In case you have not paid within the due date, it shall not be allowed as deduction, but you debited to the P&L account shall be disallowed under section 43B. Are you following? Chalo. Issue 1 let's verify. Assessee, he is following mercantile system of accounting during the current previous year 21-22. Loan has been obtained. How much loan has been obtained? 10 lakh rupees at the rate 10% from Mr. B, who is an individual. Tell me who is lender here, Mr. B, individual. Interest payable 1 lakh, not paid in the current previous year 21-22. Then tell me, can we claim it as a deduction under section 36 subsection 1 class 3? Can we debit to the P&L account the interest liability of 1 lakh rupee, ma? Please tell me. It is not actually paid in the current previous year. Can we claim it as a deduction under section 36 subsection class 3 or not? That is my question. That means for this interest expenditure, whether provisions of section 43B is applicable or not applicable. That's my question, ma. That is my question. Section 43B is not applicable to this payment. Why? Because here the lender is Mr. B, individual. He is not covered in the persons who are specified under 43B. Individuals are not covered there. Are you following? That means we need to apply provisions of section 43B only when the interest amount is payable to the persons who are covered under section 43B. Since Mr. B is not covered, individual is not covered, provisions of section 43B is not applicable. Comfortably you can claim that 1 lakh as a deduction based upon the by following method of accounting. Since he is following mercantile system, hence on payable basis he can debit to the P&L account. Are you following? Yes. Comfortably, we can comfortably claim as a deduction, ma. Since not covered under section 43B. Good. Next, ma. Issue 2. X Limited obtained loan of 1 crore 2 years back from Schedule Bank, ma. Remember, Schedule Bank is covered in the persons list specified under 43B. 2 years back obtained a loan amount of 1 crore. Accumulated interest payable 20 lakhs, ma. Accumulated interest payable 20 lakhs. It is not actually paid by the X Limited. Now in the current previous year 21-22, X Limited entered into an agreement with the bank, ma. What is the agreement concept? What is that agreement says? That unpaid interest of 20 lakhs has been converted into loan. What happened, ma? The interest has been converted into loan. And out of that entire conversion of interest into loan 20 lakhs, 5 lakhs has been paid in the current previous year as per agreement. Remaining 15 lakhs will be paid in on installments basis, ma. What happened here? Unpaid interest is 20 lakhs that has been converted into loan, and out of the 20 lakhs converted loan, 5 lakhs has been paid as a part of first installment. Remaining will be paid in the remaining 3 installments in the next previous year. Now, what is allowed as deduction, ma? What is to be allowed as deduction under section 36 subsection 1 class 3 read with section 43B? Tell me. Only 5 lakhs. Only 5 lakhs. That means actual payment alone will be allowed as deduction, because conversion of interest into loan shall not be treated as actual payment. Very important. Conversion of interest into loan shall not be treated as actual payment. Therefore, 20 lakhs shall not be allowed, but 5 lakhs which is actually paid in the current previous year 21-22 shall alone will be allowed as a deduction. Very important. Rupees 5 lakhs will be allowed as deduction. Note point, ma. Conversion of accumulated interest into loan will not be treated as actual payment. Very good. Next, ma. Category 3 employees dues, ma. Contribution to the recognized provident fund. How many persons will contribute to the RPF account, ma? 2 persons. Employee will contribute, employer also will do the matching contribution. If you remember our discussion from income from salary head, I explained there. Now what happened? Employer is deducting that employee part of contribution to the RPF account from the salary of the employee, ma. Say for example, the employee salary is 50,000 rupees per month. How much? Employee salary 50,000 rupees per month. Now what happened? Out of 50,000 rupees per month, 5,000 has been deducted, 45,000 has been paid to the employee. Why he retained 5,000, ma? This 5,000 has been retained towards contribution, employee contribution to the RPF account. Now this 5,000 is in the pocket of the employer, ma. What he has to do with this 5,000, ma? He should not apply for his business or profession. It has to be contributed to the RPF account in the name of employee contribution. Therefore, in case that employer has not been paid this 5,000 within the due date to the RPF account, but debited to the P&L account, it will be disallowed. It will be added back to the net profit. On that, the employer shall pay the tax, ma. I will explain in detail, pay attention. At the time of deduction of this 5,000 from the employee's salary, it will be treated as income in the hands of employer ma. This 5,000 will be treated as income in the hands of employer. It will be added to the profits of the employer. Now, when this 5,000 will be allowed as deduction, only when it is actually made the payment within the due date. In case it is actually paid within the due date, then he can debit to the P&L account. He can claim it as a deduction. But without making the payment of actual payment to the RPF account, he debited to the P&L account but not paid within the due date, then it shall be disallowed under section 43B. Even the employer contribution ma, employer is making 5,000 matching contribution, he debited to the P&L account, claimed as a expenditure, claimed as a deduction but not paid within the due date, still it is in the pocket of the employer, then it shall not be allowed as deduction, it shall be added back to the net profit. Employee contribution as well as employer contribution. Next ma, contribution to superannuation fund ma. Here also employer contribution and employee contribution debited to the P&L account but not paid within the due date, then what you have to do? You need to add back under section 43B. Bonus ma, they are liable to, employer is liable to make the payment of bonus to the employees, but without making actual payment, he debited to the P&L account, claim it as a deduction. What you have to do? You need to add back under section 43B. Same with commission. Then leave encashment ma, we have already discussed at the time of discussion of income from salary. Then contribution to any other staff welfare program, employee contribution, employer contribution, debited to the P&L account but not paid within the due date, then what you have to do? You need to add back under section 43B. So these are the payments covered under employees dues ma. Chalo. Next, those certain payments, what we have to do? Actually paid within the due date, first case. Second case, not paid within the due date. In case those category 1, category 2, category 3 payments has been actually made within the due date specified under section 43B, then it will be allowed as deduction, no need to add back, 43B will not be applicable. In case it is not actually paid within the due date specified under section 43B but debited to the P&L account, what you shall do? You need to add back. Are you following? What is the due date? Let's verify. Actually paid within the due date, allowed as deduction in the current previous year. Not paid within the due date, not allowed as deduction in the current previous year. Very good. But allowed as deduction in the year of payment. In the current previous year not allowed, but subsequently the assessee paid. After the due date he paid actually. Then in the year of payment it will be allowed as a deduction. That means disallowed under section 43B means it will be disallowed forever ma? No. It will be disallowed temporarily. In case subsequently if we paid actually in the subsequent previous years, then in the year of payment it will be allowed as a deduction. Very important point. What is the due date ma? Pay attention. What is the due date? Earlier of due date for filing return of income specified under section 139 subsection 1 or actual date of filing, whichever is earlier. Tell me, in case tax audit is not applicable, what is the due date ma? 31st July. Are you following? In case tax audit is not applicable, the due date is 31st July of the relevant assessment year. Now, for the previous year 21-22, what is the due date ma if tax audit is not applicable? 31st July 2022 is the due date. Now, in case the assessee has been filed the return of income before this due date ma, that means on 15th July 2022 he filed the return of income. Then what is the cutoff date for making those payments ma covered under category 1, category 2, category 3? Please tell me. Then what is the due date? Follow the principle here. What is the due date? 31st July 2022. What is actual date of filing? 15th July 2022. Then whichever is earlier ma, 15th July 2022 is the earliest date. Then that is the cutoff date. 15th July 2022 is the cutoff date for you to make the above payments. Are you following? In case you made the payment after 15th July, that shall not be allowed as a deduction. In case you debited to the P&L account, that shall be disallowed under section 43B. Next ma, second example. Tax audit is not applicable. Your due date is 31st July 2022. Okay. You filed the return of income 15th August 22. When you have filed belated return, you have filed under section 139 subsection 4. When you have filed 15th August 2022. In such a case, what is the cutoff date for making those above payments Due date specified under section 139 subsection 1. What is that? 31st July 2022. What is actual date 15th August 2022. Whichever is earlier. 31st July 2022 is the cutoff date for making the payment to claim it as a deduction not to attract the provisions of section 43B. Are you following? Next illustration. For your better understanding, I have given two illustrations. Pay attention. Illustration 1. Mr. X provides the following information. Sales tax payable for the previous year 21-22 2.5 lakh. What is the sales tax payable 2.5 lakh. Mr. X paid sales tax as follows on 15th December 21 50,000, on 16th June 22 75,000, on 30th July 22 30,000, and 15th August 2022 40,000. Very good. On 12th December 22 55,000. Due date for filing return of income under section 139 subsection 1 is 31st July 2022. Okay. Actual date of filing of return of income is 16th August 2022. Whichever is earlier 31st July or 16th August, whichever is earlier. 31st July is earliest date, hence that will be treated as cut-off date for making the sales tax payment. Are you following? So tell me, what is the sales tax amount allowed as deduction in the current previous year 21-22? For that, we need to consider cut-off date. What is cut-off date 31st July 2022. Verify the payments made on or before 31st July 22, that will be allowed as deduction, and the payments made after 31st July 22 shall be disallowed under section 43B, but allowed in the previous year 22-23, that is in the year of payment. Chalo, let's verify. 50,000 when it is paid 15th December within the due date, allowed. 16th June 75,000 paid, allowed. 30th July 22 30,000 has been paid, allowed. 15th August 22 40 not allowed, not within the due date. 12th December 22 55 not allowed, not within the due date. That means 50 75 30 allowed as deduction. 40 plus 55 95,000 shall be disallowed under section 43B, but allowed as deduction the previous year 22-23, which is year of payment. Chalo. Due date 31st July 22. Very good. Allowed in the current previous year 21-22 1,55,000. Disallowed under section 43B in the current previous year 21-22 95,000, but allowed in the previous year 22-23. No problem. Next, my illustration 2. Mr. X provides the following information for the previous year 21-22. Sales tax paid on 15th March 22 45,000. Bonus paid to the employees on 27-10-22 1,10,000. Excess duty paid on 15-6-21 75,000. Interest on loan taken from Mr. A paid on 15 December 22 35,000. Interest on loan taken from SBI paid on 15-7-22 85,000. Electricity charges paid on 18 November 22 85,000. Commission paid to the employees on 25-10-22 1,05,000. Due date for filing return of income is 31st October. Actual date of filing is 15th October. Note, Mr. X is following mercantile system of accounting. Determine what is allowed and what is disallowed under section 43B. Just take a look and let me know what is to be allowed and what is to be disallowed. First of all, while disallowing under section 43B, what is the first point we need to consider? Whether that expenditure is covered under provisions of section 43B or not. In case that expenditure is not covered under 43B, are you following? The given expenditure is not covered under section 43B, then 43B is not applicable. That expenditure will be allowed as deduction depending upon the method of accounting followed by the SSC. In case is allowing mercantile system, that expenditure will be allowed on payable basis. In case is following cash system, that will be allowed as deduction on payment basis. Are you following? Second point. In case the expenditure given is covered under section 43B, then only we have to verify whether it is paid within the due date or not paid. In case it is paid within the due date, then allow it as a deduction. Not paid within the due date, don't allow it as deduction, but debited to the P&L account, disallowed under section 43B. Are you following? Now let's verify the illustration, ma. I hope you understood. Now let's verify the illustration. Sales tax covered under 43B or not, ma? Yes, it is covered. Then whether it is paid within the due date or not paid, ma? What is the due date? First of all, tell me. Whichever is earlier, 31st October or 15th October, whichever is earlier, ma. 15th October is earlier. That is the cut-off date to make the payment, the expenditures which are covered under 43B. Chalo. Sales tax covered under 43B. What is the date of payment, ma? 15th March. That means within the due date, allowed as deduction. Bonus, ma, covered under 43B. What is the actual date of payment? 27 October 22. That means paid after the due date. Covered under 43B. Bonus category 3 employees dues, ma, covered under 43B, and payment is made after the due date. Hence that shall be disallowed in the current previous year. 21-22 1,10,000 shall be disallowed. Next, ma, excess duty covered under 43B under category 2 government dues, ma. 15th June 21 within the due date, allowed as a deduction 75,000. 43B is not applicable. No need to disallow. Interest on loan taken from Mr. A. Interest on loan taken from Mr. A, ma, whether it is covered under 43B? No. That means it will be allowed as deduction on payable basis because it is following mercantile system of accounting. Irrespective of the within the due date or after the due date payment, it shall be allowed as deduction on payable basis. So 35,000 shall be allowed based on the method of accounting. Next, ma, interest on loan taken from SBI. Yes, it is a scheduled bank covered under 43B, bank dues category 2. What is the date of payment? 15th July within the due date, allowed as a deduction. Electricity charges not covered under 43B. You need to allow depending upon the method of accounting followed. Hence, it will be allowed on payable basis because they are following mercantile system. Commission, ma, covered under 43B. Employees dues, ma, what is the date of payment? 25th October. It is paid after the due date. 1,05,000 shall be disallowed under section 43B in the current previous year 21-22, but allowed as reduction in the year of payment, that is previous year 22-23. Chalo. Allowed 3,25,000, disallowed under section 43B in the current previous year 2,15,000, but allowed in the previous year 22-23. Are you following? Good. That is the pura discussion relating to section 43B, ma. I hope you understood. 7th item completed, 8th item completed. Next, ma, 9th item. Let's verify 9th one. What is the 9th one, ma? Personal expenses like medical expenses or personal car expenses that shall be disallowed under section 38 subsection 2 or 37 subsection 1. Simple, ma. Any personal expenditure incurred by the SSC and that has been debited to the P&L account and claimed as deduction, then that shall be disallowed because no personal expenditure is allowed as deduction under the head PGBP. Only business expenditure, profession related expenditure alone shall be allowed as deduction. For better understanding, I will explain section 30, section 31 and section 38 subsection 2 and section 37 subsection 1. Section 30 deals with the expenses relating to the building which is using for business or profession. Section 31 deals with expenses relating to plant and machinery which is using for business or profession. Section 38 subsection 2 deals with the disallowance of personal expenditure relating to the building and plant and machinery. Section 37 subsection 1 deals with residuary section for allowing other business or professional expenditure as a deduction. I will explain these 4 sections for your better understanding. Pay attention. Section 30 ma allows deduction for expenses in respect of building using for business or profession. If at all building is using by the SSC for his business or profession, In what status he can occupy such building, ma? Tell me. In what status he can occupy such building? First possible status, he occupied the building in the status of owner. Second possible status, he occupied the building in the status of tenant. If at all he occupied in the status of owner, what are the various expenditures incurred by the SSC and what is the treatment for those expenditures? In case the SSC occupied in the status of tenant, then what are the various expenditures he is incurring and what is the treatment for those expenditures? Let's verify. Owner, tenant. First owner, ma. First one, repairs expenditure has been incurred. That may be current repairs or capital repairs, ma. He is occupying the building in the status of owner. He owned that building and repair expenditure has been incurred. First one is current repairs. Second one is capital repairs. If it is happen to be current repairs, it is entire current repairs will be allowed as a deduction in one time in single year under section 30. In case it is happen to be capital repairs, ma, deduction shall not be allowed. Depreciation shall be allowed under section 32. Tell me what is the difference between current repairs and capital repairs, ma? Please tell me the difference. The expenditure, repairs expenditure incurred by the SSC to bring the building to its original condition, to get the building to its original condition will be treated as current repairs. In case because of incurring the expenditure, the building is into the advanced condition, ma. He is bringing the building into the advanced condition, not to the original condition, but to the advanced condition. Then it shall be treated as capital expenditure, capital repairs. Deduction shall not be allowed. Depreciation shall be allowed. Are you following? Say for example, it is a 2 floors building. Some small patchwork is going on. There is no advanced condition. He is not bringing the building into advanced condition, but he is bringing the building to its original condition. Patchwork, some repairs he is doing. Then it will be treated as current repairs. Deduction shall be allowed under section 30. Whereas third floor has been constructed, ma. Third floor has been constructed means the expenditure incurred by the SSC to bring the building to its advanced condition, not original condition, advanced condition. Then that will be treated as capital expenditure. Deduction shall not be allowed. Depreciation shall be allowed under section 32. Next, ma. Municipal tax or land revenue paid, then it shall be allowed as a deduction under section 30, but subject to section 43B. Just now we verified. If it is paid within the due date, allowed, but not paid, not allowed. Insurance, ma, building insurance has been paid, allowed as a revenue expenditure under section 30. Next, ma, you occupied the building in the status of tenant. In the status of what? Tenant. Then rent payment has been made, allowed as a deduction under section 30. Repairs, ma, current repairs, deduction will be allowed under section 30. Capital repairs, is it possible for the SSC to incur capital repairs on leased property? Obviously, yes. The SSC, the tenant is having requirement of additional floor, but the owner is not in a position to construct additional floor. Therefore, the tenant constructed the additional floor on his own. Are you following? And he will use it for 10 years. And at the time of leaving the property, it will be leaving to the owner, ma. That is the agreement. So with his own expenditure, he constructed the additional floor. That cannot be treated as current repairs. You have to treat it as a capital repairs. On the construction cost of that additional floor, you need to treat it as capital repairs. You need to claim the depreciation under section 32. Very important. Municipal tax, land revenue has been paid by the tenant as per the agreement, ma, allowed as a deduction under section 30, subject to section 43B. Insurance paid as per agreement, allowed as a deduction under section 30. Good. Next, ma, 31. Allows deduction for expenses in respect of machinery, plant, furniture used by the SSC for his business or profession. Machinery, plant or furniture used in the status of owner. Second one, used in the status of tenant. If at all the status is owner, repair expenditure is incurred. Current repairs, ma, eligible for deduction under section 31. Capital repairs, ma, advanced condition. You are bringing that machinery into advanced condition. You need to claim depreciation under section 32. What is original condition? What is advanced condition, ma? The original capacity of the plant and machinery is producing 10,000 units per annum. That is original condition. Now, because of usage for the several years, the capacity has been reduced to 8,000 per annum. Now the SSC is incurring the expenditure and increased that capacity, production capacity to 10,000. That means he brought the machinery into its original condition. Then that repair expenditure shall be treated as current repairs. What if because of that repairs expenditure, the production capacity has been increased from 8,000 to 12,000 per annum? In such a case, it will be treated as capital expenditure because you are bringing that asset into the advanced condition. Because the original condition is 10,000 units, but it is now, what is that, producing 12,000 units per annum. That will be treated as advanced condition. That expenditure shall be treated as capital expenditure. You are eligible to claim depreciation under section 32, but not deduction under section 31. Remember, insurance has been paid, allowed as deduction under section 31 . Next, tenant. You are using that plant and machinery or furniture in the status of tenant. Rent has been paid. Remember that rent payment of plant and machinery or furniture shall not be allowed under section 31. It shall be allowed under residuary section 37 subsection 1. Under residuary section 37 subsection 1. Very important. Then repairs expenditure same current repairs eligible for deduction under section 31. Capital repairs depreciation under section 32. Insurance paid as per agreement eligible for deduction under section 31. Next now we need to discuss section 38 subsection 2 read with along with section 30 and 31. What is the point? The building, the plant, the machinery, the furniture used by the SSC for business or profession purpose as well as personal purpose building, say for example, the building is comprising 2 floors ground floor as well as first floor. Ground floor used for business, first floor using for personal purpose. Are you following? That means the building used by the SSC for business purpose as well as personal purpose. Now repair expenditure has been incurred for entire building and the total repair expenditure is 1 lakh rupee. Now that entire 1 lakh rupee relating to business expenditure no, certain amount is belongs to the personal expenditure also, because first floor is using for personal purpose. In such a case, you need to determine proportionate expenditure which is relating to the ground floor. It is 70,000, assume. Then the 70,000 proportionate expenditure which is relating to the ground floor, which is using for business purpose alone, allowed as deduction under section 30 if it is happen to be building. In case plant and machinery 31, and the remaining remaining 30,000 proportionate expenditure relating to the first floor which is using for personal purpose will be regarded as personal expenditure, and that will be disallowed under section 38 subsection 2. That shall be disallowed under section 38 subsection 2. In case 1 lakh has been debited, then you need to add back 30,000 personal related under section 38 subsection 2. Are you following? Chalo. Section 38 subsection 2 read with along section 30 and 31. In case SSC is using building or machinery or furniture plant for both business or professional purpose and personal purpose, and any expenditure is incurred by the SSC for such building or furniture or plant and machinery, then the entire expenditure has been claimed as deduction by debiting to the P&L account under section 30 and 31. In such a case, section 38 subsection 2 will be applicable. As per section 38 subsection 2, the proportionate expenditure which is having relation with the business or profession alone will be allowed as deduction, and the proportion of such expenditure which is relating to the personal purpose will be disallowed. That means added back to the net profit. That is regarding section 38 subsection 1. Next let's verify section 37 subsection 1 residuary section. Very important. The lawmaker specified various expenditures under section 30 to 36 various expenditures has been covered from section 30 to 36. All possible expenditures they have specified, but that is not end of the list. So many other expenditures which are not covered from section 30 to 36 may be incurred by the SSC. Now those expenditures shall be allowed under residuary section 37 subsection 1. Are you following? So to allow any business expenditure, any professional expenditure under section 37 subsection 1, there are certain conditions which are required to be satisfied cumulatively. First condition, it should not be a personal expenditure, because personal expenditure not allowed as deduction. Second one, it should not be a capital expenditure, because in case of capital expenditure you cannot claim deduction, you need to claim depreciation under section 32. Then third condition, it should not be covered under section 30 to 36. Why ma? In case it is covered under section 30 to 36, you need to claim under those relevant sections. There is no relevance for the, there is no, what is that, possibility to get under section 37 subsection. There is no use. Are you following? There is no need. Next, if the expenditure should be incurred during the current previous year, that must be incurred during the current previous year. Fifth condition, the expenditure must be incurred wholly and exclusively for the purpose of business or profession. If these 5 conditions satisfied cumulatively, then such expenditure will be allowed as deduction under section 37 subsection 1, which is a residuary section. So tell me, what are the 5 conditions ma? Should not be a personal expenditure, should not be a capital expenditure, should not be covered under section 30 to 36, should be incurred during the current previous year, and should be incurred wholly and exclusively for the purpose of business or profession. Next ma, explanation 1 to section 37 subsection 1, very important. What that explanation says, let's verify. Expenditure incurred by the SSC for the purpose which is offence or prohibited under any law for the time being in force. That means some illegal expenditure has been incurred by the SSC ma. What is that? Illegal expenditure has been incurred by the SSC and debited to the P&L account. What you have to do? You need to disallow that illegal expenditure. You need to add back as per explanation 1 to section 37 subsection 1. Why? Because illegal expenditure is not allowed as deduction. What is the point here? Illegal income is taxable ma. We verified at the time of discussion of introduction to tax. Illegal income is taxable, but illegal expenditure is not allowed as a deduction. Next, penalty you have been paid ma. Penalty paid by the SSC and debited to the P&L account claimed as a deduction. Tell me whether that penalty payment is allowed as deduction ma. Whether explanation 1 to section 37 subsection 1 is applicable, whether we need to disallow or not. That is the question. It is depends upon the nature of the penalty. It is depends upon the nature of the penalty. In case the penalty is compensatory in nature, the penalty is compensatory in nature, allowed as deduction. Explanation 1 to section 37 subsection 1 is not applicable. In case the penalty is penal in nature, what is that ma? Penal in nature, punishing, for the purpose of punishing the SSC, they levied the penalty. Then explanation 1 to section 37 subsection 1 will be applicable. It shall be disallowed. Are you following? Chalo. Compensatory in nature, penal in nature. If it is happen to be compensatory, allowed as deduction under section 37 subsection 1, explanation 1 is not applicable. Next, if it is penal in nature, not allowed as deduction under section 37 subsection 1 ma. Next, explanation 2 to section 37 subsection 1. Any corporate social responsibility expenditure incurred by the SSC, then it shall not be allowed as deduction because it is not relating to business or profession. It shall be disallowed. When it comes to the CSR expenditure which is specified under Income Tax Act ma. In case that CSR expenditure is specified under Income Tax Act under section 30 to 36, it is covered, then that will be allowed as a deduction. That is the point. Note, any CSR expenditure is incurred by the SSC which is within the ambit of provisions of section 30 to 36, then it shall be allowed as a deduction. Next, very important ma, section 37 subsection 2b. What section 37 subsection 2b says? Any expenditure incurred by the SSC towards advertisement in a brochure or pamphlet or souvenir or magazine published by the political party, then it shall not be allowed as a deduction. In case it is debited to the P&L account, it shall be disallowed under section 37 subsection 2b. Why? Because that will be treated as indirect contribution to the political party. What is that ma? Indirect contribution to the political party. Hence, it shall not be allowed as a deduction as a business expenditure under the head PGBP. But it is allowed as deduction under chapter 6A ma. It is allowed as deduction under chapter 6A. Remember, 80 GGB. Next ma. Okay. That is regarding 30, 31, 38 subsection 2 and 37 subsection 1. Next ma, non-deduction of TDS on payments made to the resident, 30% disallowed under section 40 class A subclass A. Next, 11th item, non-deduction of TDS on payments made to the non-resident, 100% shall be disallowed under section 40 class A subclass 1. For that, we need to verify the provisions of section 40 class A, subclass 1, subclass 1A, subclass 3. I will explain. Next, let's verify the provisions of section 40 class A, subclass 1, subclass 1A, subclass 3 relating to disallowance with respect to violation of TDS provisions. Very important from the viewpoint of examination. Pay attention. Section 40 class A, subclass 1, subclass 1A, subclass 3 deals with disallowance pursuant to violation of TDS provisions. Very important. What is the responsibility of the assessee? If at all he is liable to deduct the TDS, first responsibility, he has to deduct the TDS within the due date. Second responsibility, such deducted TDS must be paid to the credit of the central government within the due date. In case he has not done any one of these things, then it will be treated as violation of TDS. Then disallowance will be attracted under section 40 class A, subclass 1, subclass 1A and subclass 3. Let's verify in detail. Tax deducted at source specified under chapter 17B. Yes. Next, let's discuss regarding provisions of section 40 class A, subclass 1. It is deals with payments made to the non-resident. Payments made to the non-resident. Subclass 1A deals with the payments made to the resident, and subclass 3 deals with the salary payment made to the non-resident. Chalo. Assessee who is into the business or profession is making payment relating to interest, royalty, fee for technical services, any other sum chargeable to tax, except salary payment to the non-resident, because the salary payment to the non-resident is covered under 40 class A, subclass 3. Except salary payment, any other payment made by the assessee who is into the business or profession to the non-resident, then paid or payable outside India, any person in India who is a foreign company or non-corporate non-resident. Simply say they are making the payment to the non-residents. Then what are the possible defaults with respect to the making the payment to the non-residents? First possible default, the TDS is liable to be deducted, but the assessee has not been deducted the TDS within the due date. Second possible default, TDS has been deducted, but such deducted TDS has not been paid to the credit of the central government. Let's verify. Default 1, default 2. The assessee has not been deducted the TDS amount in the current previous year in which the above said expenditure is incurred. That means, what is the due date for deduction of TDS while making the payment to the non-resident? In the previous year in which the expenditure is incurred will become the due date. That means last date of that current previous year. That means 31st March of the current previous year will become the cutoff date for you to deduct the TDS while making the above payments to the non-resident. In case you have not deducted TDS on or before 31st March of the current previous year, then it will comes under default 1. Second default, or TDS has been deducted in the current previous year, TDS deducted, but it is not remitted to the credit of the central government within the due date for filing return of income specified under section 139 subsection 1. If at all you have deducted the TDS on or before 31st March of the current previous year, then what is your responsibility? You should not keep that amount because that amount belongs to the central government tax amount. Are you following? So that must be credited, that must be paid to the credit of the central government on or before the due date for filing return of income specified under section 139 subsection 1. In case it is not paid within the date, then it will be comes under default 2. It will comes under default 2. Then provisions of section 40 class A subclass 1 will be attracted. Let's verify. Consequences, if at all provisions of section 40 class A subclass 1 has been attracted, what are the consequences? Simple. 100% of such expenditure shall be disallowed in the current to previous year under section 40 class A subclass 1. 1 lakh rupee interest has been paid to the non-resident without deduction of TDS, or TDS has been deducted but not paid to the credit of the central government within the due date specified under section 139 subsection 1. Then what are the consequences? 1 lakh into 100%. Entire 1 lakh will be disallowed under section 40 class A subclass 1 in the current previous year. Next ma. Remedy. What is the remedy? In the current previous year, it has been disallowed. Then how to claim it as a deduction again ma? Once it is disallowed means forever it will be disallowed or no? Whenever you rectified the default, then in the year of rectification, that 1 lakh rupee, 1 lakh interest expenditure, 100% which was disallowed will be allowed as a deduction. For that, what is the remedy you have to do? For first default, for non-deduction of TDS, you have to deduct the TDS. That is the remedy. Second default, not paid to the credit of the central government within the due date. Now you have to pay to the central government. Then in the year of making the payment of that TDS amount, tax amount to the credit of the central government, in that year, that 100% interest expenditure which was disallowed in the earlier previous year will be now allowed as a deduction as per proviso to section 40 class A subclass 1. Very important. Proviso to section 40 class A subclass 1. 100% of such disallowed expenses disallowed in the earlier previous year will be allowed as deduction in the previous year in which such TDS is paid to the credit of central government, provided TDS has been deducted in the subsequent previous year, or the TDS deducted has been paid to the credit of the central government within the due date specified under section 139 subsection 1. Simply say, one line summary ma. In simple, such expenditure will be allowed as deduction in the previous year in which such TDS is paid to the credit of the central government. As per the provisions of section 40 class A subclass 1, it will be dissolved in the current previous year ma. But if you rectified in the subsequent years, then in the year of making the payment of the TDS to the credit of the central government, it will be allowed as a deduction as per proviso to section 40 class A subclass 1. Very important. Next ma, 40 class A subclass 1A dealt with payments made to the residents. Dealt with payments made to the residents ma. Assessee who is into the business or profession making any sum to the resident, any nature of payment he is making to the resident, then paid or payable, TDS has to be deducted if at all provisions are applicable. TDS has to be deducted. Then possible defaults must same as above. TDS has not been deducted in the current previous year, or TDS has been deducted but not paid to the credit of the central government within the due date specified under section 139 subsection 1. Then what are the consequences ma? In case of making the payments to the non-residents, 100% of such expenditure shall be disallowed ma. But when it comes to the making the payments to the residents, not 100%, 30% of such expenditure shall be disallowed. Remember, very important. 30% of such expenditure shall be disallowed under section 40 class A subclass 1A. That means 70% of that expenditure will be allowed as deduction. I will explain with the help of example. Say for example, 1 lakh interest paid to the resident ma, but TDS has not been deducted, default has been made. Then what are the consequences? And 1 lakh debited to the P&L account ma, 1 lakh has been debited to the P&L account. Then what we need to do? Whether we need to disallow entire 1 lakh ma? No, 30% shall be disallowed. What do you mean by 30% ma? 30,000 shall be added back under section 40 class A subclass 1A. That means 70% shall be allowed as a deduction. Very important. 30% of such expenditure will be disallowed under section 40 class A subclass 1 in the current previous year. That means 70% of such expenditure is allowed as a deduction. Very good. Remedy ma, specified under proviso 1 to section 40 class A subclass 1A. Under 40 class A subclass 1, we are having only one proviso, hence there is no number given for that, just to proviso to section 40 class A subclass 1. But when it comes to 40 class A subclass 1A, we are having two provisos ma, therefore numbering has been given. We are discussing proviso 1, subsequently we are going to discuss proviso 2. Pay attention. What proviso 1 to section 40 class A subclass 1A says? In case TDS has been deducted in the subsequent previous year and that has been paid to the credit of the central government within the due date specified under section 139 subsection 1, then that 30% of expenditure which was disallowed in the earlier previous year will be now allowed as deduction in the previous year in which such TDS has been paid to the credit of the central government as per proviso 1 to section 40 class A subclass 1A. Very simple. Take a look. Very simple. Next ma, proviso 2 will come here. Proviso 2, what Proviso 2 says? The SSC has not rectified the default ma. What do you mean by not rectified the default? In subsequent previous years, he has not been deducted the TDS and he has not been paid to the credit of the central government. That means it is not rectified by the SSC. Are you following? If at all it is not rectified by the SSC, therefore you cannot claim the benefit of provision 1 to section 40 class A subclass 1A ma. Are you following? You cannot get the benefit from proviso 1. Then for you proviso 2 is applicable provided the condition specified under proviso 2 has been satisfied. What is that? The SSC has not been rectified the default, but the payee means the resident to whom you made the payment, the resident, the payee, the receiver, recipient of your payment has been declared this income, this interest income in his return of income. Even though TDS has not been deducted, but still without entering into the tax evasion practice, he has been genuinely declared that 1 lakh rupee interest income in his return of income, and tax has been paid to the department and return has been filed to the department by that resident ma. That means here the rectification is done by the payee. The payer not rectified, hence proviso 1 benefit will not come. The payee has been rectified ma. Are you following? In such a case, by specifying all these facts, you need to get a certificate from the chartered accountant, and that certificate shall be submitted along with the return of income, and you need to file that return of income. In such a case, in the previous year in which that income has been declared by the payee and tax has been paid by the payee to the department and return has been filed by that payee, that 30% shall be allowed as deduction to the payer, the SSC, under proviso 2 to section 40 class A subclass 1A ma. Proviso 1 rectification made by the payer, SSC. Proviso 2 rectification made by the done by the payee. Next ma, 40 class A subclass 3 ma. It is dealt with salary payment to the non-resident. What is that? Salary payment to the non-resident. SSC who is into the business or profession is making the payment of salary to the non-resident outside India or in India. Then he has been paid, then TDS has to be deducted. Then failure to deduct the TDS, 100% of such a salary expenditure shall be disallowed under section 40 class A subclass 3. 100% shall be disallowed. Here there is no proviso 1, there is no proviso 2. That means once it is disallowed, it will be disallowed forever, no remedy. Remember, once disallowed, it will be forever disallowed. No remedy, disallowed forever. Very good. Next ma, that is regarding 40 class A subclass 1, subclass 1A, subclass 3. Chalo, now let's verify. 10th point ma, non-deduction of TDS on payments made to the resident, 40 class A subclass 1A, non-deduction of disallowance of non-deduction of TDS on payment made to the non-resident, 40 class A subclass 1, and you can consider 40 class A subclass 3 also. Salary payment made to the non-resident without deduction of TDS. You can consider that also, but not always appeared in the examination. Only these two has been appeared, hence I specified only these two ma. If you want, you can add. What is that? 40 class A subclass 3, salary payment to the non-resident without deduction of TDS. Next ma, any amount has been transferred to the general reserve, don't allow it as a deduction because that is not an expenditure. That is not an expenditure. In case they debited any amount transferred to the general reserve and that has been debited to the P&L account, you need to disallow. Very important. Next ma, losses under other heads ma, that may be house property loss or short-term capital loss, long-term capital loss. They have been debited to the P&L account because that P&L account has been prepared as per Companies Act. For them, there is no difference between salary income, there is no difference between house property income and what? Long-term capital gain or short-term capital gain or other sources or PGBP, right? That's why they have debited these losses. Then what we have to do ma? We should not consider, we should not allow these losses under the head PGBP. We need to allow under respective heads of income. If it is happen to be house property loss, you need to consider under the head house property. If it is happen to be short-term capital loss or long-term capital loss, that must be considered under the head capital gain, but debited to the P&L account, we need to add back. That is what you mean by losses under other heads, you need to add back in case debited to the P&L account. Next, expenditure incurred. Expenditure incurred towards advertisement given in pamphlet or brochure or magazine published by the political party, that shall be disallowed under section 37 subsection 2 be already explained, because that will be treated as indirect contribution, indirect donation to the political parties. That is not a business expenditure. Your political interest is involved, hence not to be allowed as a deduction. In case it is debited to the P&L account, you need to add back under section 37 subsection will be disallowed. With this, we successfully completed the discussion relating to part of add inadmissible expenditure are expendited to the P&L account, but as a deduction. Successfully completed. Next, let's go for next part of adjustment. What is that? Less admissible expenses are expenses allowable as deduction but not claimed by the SRC. That means those expenditures given in the other information in the exam under other information, this information has then consider, and what is allowable you need to add as a deduction. That means we need to reduce from this less admissible expenses or expenditure deduction but not there. First and foremost, very important, depreciation as per income tax rule. As per income, if you remember, in the part 1 adjustment we have added back depreciation as deduction, where we have to elevate as a deduction in the part 2 depreciation as a relation. Concentrate section 32 depreciation allowance there are two which are required. If those two conditions satisfied cumulatively, can claim depreciation. Asset should be owned by the SSC. What is the condition? The asset must be owned by the SSC. That means SSC must be the owner of that asset. Second condition, the asset must be used for the business of condition the asset business or profession here. In case these two conditions has been satisfied, claiming depreciation. The first condition the SSC should be the owner. Good. The asset should be put to use by the SSC during the current previous year for use. What do you mean by put to use? It includes active use as well as passive use. Active, actual use of the asset. You are actually using that asset, treated as put to use. Section term exception to the first Let's verify issue 1 ma. Mr. X acquired generator on 1/4/2021. That means in the previous year 21-22. Installed in the factory on 1/5/2021. Very good. And there is a power cut in the factory. Hence SSC used the generator to run the production process. That means the generator has been actually used by the SSC in the current previous year ma. That means put to use condition has been satisfied or not? Yes, satisfied. It is actively used or actual use of the asset. Put to use condition has been satisfied. Hence, such asset is eligible for claiming the depreciation under section 32 in the previous year 21-22. Next ma. Issue 2. Mr. X acquired generator on 1/4/2021. Assume in the previous year 21-22. Installed in the factory on 1/5/2021. And there is no power cut in the factory in the previous year 21-22. That means there is no actual use of the asset ma. They have installed, but there is no actual use of the asset in the current previous year 21-22. Tell me whether that generator is eligible to claim depreciation under section 32 in the current previous year 21-22 ma. Yes, it is. Why? Because that generator has been installed in the factory premises ma. That means passive usage condition has been satisfied, kept ready for use, which comes under put to use term. Hence, it will be eligible for claiming depreciation under section 32. Hence, SSC not at all used the generator to run the production process in the previous year 21-22. Passive use or kept ready for use of the asset condition has been satisfied. Put to use. Such asset is eligible for claiming the depreciation under section 32 in the previous year 21-22. Next ma. Issue 3. Mr. X acquired generator on 1/4/2021, that is in the previous year 21-22, and installed in the factory on 1/1/2023 ma. That means what is the previous year in which the generator has been installed? Previous year 22-23, but acquired in the previous year 21-22. That means in the previous year 21-22 there is no passive usage and there is no actual usage ma. That means put to use condition has not been satisfied. That asset is not eligible for claiming depreciation in the previous year 21-22, but eligible to claim depreciation in the previous year 22-23. And used from the date. There is no active use and passive use of the asset in the previous year 21-22. Not put to use. Conditions not put to use. Condition not satisfied in the previous year 21-22. Such asset is not eligible for claiming the depreciation under section 32 in the previous year 21-22. Good. Next ma. But eligible for claiming the depreciation under section 32 in the previous year 22-23. Very good. Next ma. Next concept. For the purpose of claiming depreciation under section 32, assets has been classified into two categories ma. Category 1 tangible assets, category 2 intangible assets. Again under category 1, the tangible assets has been bifurcated into 4 classes. First one buildings, second one machinery, third one plant, fourth one furniture. And when it comes to intangible assets, patents, no rights, patents, copyrights, know-how shall be treated as intangible assets ma. Let's verify. Category 1 tangible, category 2 intangible. Further classified into 4 classes: buildings, plant, machinery, furniture. And what are intangible? Only one class in the intangible assets. What are those? Patents, trademarks, copyrights, franchisee, etc. Amendment brought out through Finance Act 2021. Very important, pay attention. The goodwill has been removed from the block of the assets concept, and goodwill is not eligible to claim depreciation under section 32. Amendment brought out through Finance Act 2021. Very important, verify. Goodwill of the business or profession will no longer be considered as an intangible asset. Goodwill of a business or profession will not be eligible to claim depreciation under section 32 ma. So before this amendment, before Finance Act 2021, goodwill has been treated as intangible asset and it is eligible for claiming depreciation under section 32 ma. That too purchased goodwill only. Self-generated goodwill always not eligible for claiming depreciation under section 32. But purchased goodwill has been allowed for claiming depreciation. But whenever this amendment came through Finance Act 2001, now it is not eligible. Even purchased goodwill also not eligible to claim depreciation under section 32. Remember. Important points ma. Land non-depreciable asset, very important point. Self-generated goodwill not eligible for depreciation after amendment. Even purchased goodwill also not eligible for claiming depreciation. Next ma, the term building includes roads, bridges, culverts, wells, tube wells, etc. You constructed bridge ma or culvert within the factory premises. You laid the roads within the factory premises. Approach road from main gate to the factory building. Approach road has been laid. Then you have to treat it as a building and you need to claim the rate of depreciation which is applicable for building ma. Next, the term plant includes vehicles, books, scientific apparatus, surgical equipments. All these shall be treated as plant and you need to consider the rate of depreciation applicable for plant and machinery. Then the term plant includes part of the plant. That means some engine of the vehicle has been destroyed. You replaced that engine. Then it will be treated as plant and you are eligible to claim depreciation. That is what we mean by the term plant includes part of the plant. And the term machinery includes part of the machinery. And the term building includes part of the building. Very good. What do you mean by that sentence? Must say, for example, additional floor has been constructed. That means part of the building has been constructed. You need to treat it as a building and that on that capital expenditure you have to apply the rate of depreciation which is applicable for building. That's it. For the purpose of claiming depreciation under section 32, there is no relevance to the method of accounting specified under section 145 subsection 1. What is the meaning of that sentence ma? For the purpose of claiming depreciation under section 32, there is no relevance for the method of accounting specified under section 145 subsection 1. What is the meaning? I will explain with the help of example. Pay attention. Mr. X, who is into the manufacturing business, he is following cash system of accounting ma. What do you mean by cash system of accounting? The expenditure will be allowed as deduction on actual payment basis, where income will be recognized on actual receipt basis. That is cash system of accounting. Received on paid basis. Good. Purchased plant and machinery for 50 lakhs ma on 1/5/2021 and using for business from the date. Purchased in the previous year 21-22 and immediately put to used. Amount will be settled in previous year 20-23. That is important. He purchased that plant and machinery and put to use in the same previous year, but the payment will be made in the next previous year ma. And is following mercantile system, cash system of accounting. That means expenditure will be allowed as deduction on actual payment basis, but here the payment has not been made in the current previous year. It will be paid in the next previous year. If that be the case, you tell me whether depreciation is allowable under section 32 on this plant and machinery. If at all payment is not actually made and is following cash system of accounting, please tell me ma. Tell me, for the purpose of claiming depreciation under section 32, what are the two conditions specified ma? First condition, asset must be owned by the SSC. Yes, satisfied. Second condition, that asset must be put to use by the SSC in the current previous year for his business or profession. Yes, satisfied. If at all those two conditions are satisfied, comfortably you can claim it as a depreciation on that under section 32. There is no relevance to the method of accounting ma. Are you following? Chalo. That is what that statement says. Not paid in the previous year 21-22. Still he can claim the depreciation the previous year 21-22 since two conditions has been satisfied, owned and put to use active usage. That means there is no relevance to the method of accounting specified under section 145 subsection 1 while claiming depreciation under section 32. Okay. Next ma, important topic, I am explaining depreciable assets and what are the assets eligible for block of assets and double DV method and what are the assets eligible for straight line method. Let's verify. Asset wise and straight line method. First tangible assets, next category intangible assets. Remember, intangible assets always comes under 32 subsection 1 class 2. What is 32 subsection 1 class 2 ma? Double DV and block of assets. You need to consider block of assets concept for intangible assets always, and you need to follow double DV, written down value. Chalo. Tangible assets, tangible depreciable assets ma, first let's verify. Used by undertaking engaged in electricity generation. So what is the business in which the SSC is engaged into ma? Electricity generation. Second one ma, used by others. If it is used by others, always section 32 subsection 1 class 2 will be applicable. That means block wise and double DV. Always ma. Used by others aithe, always there is no option. The option is available only to the electricity generating companies, SSEs, not available to others ma. For them always 32 subsection 1 class 2, very important section. Please remember full section. Section 32 subsection 1 class 2. They need to follow block wise and double DV. When it comes to electricity generation ma, acquired before 1/4/1997 and acquired on or after 1/4/1997. If it is acquired before 1/4/1997, section 32 subsection 1 class 2 is applicable. In case acquired on or after 1/4/1997, option exercised under rule 5 sub rule 1A, then 32 subsection 1 class 2 applicable. That means double DV and block wise. In case option is not exercised by default, they will comes under 32 subsection 1 class 1 ma. That is asset wise and straight line method. So electricity generating person, are you following? Acquired on or after 1/4/1999, then option is not exercised by default, they will be covered under 32 subsection 1 class 1, that is asset wise and straight line method. If they want to comes under double DV, they have to exercise the option specified under rule 5 sub rule 1A. Next ma. Intangible depreciable assets always eligible for claiming depreciation under section 32 subsection 1 class 2, that is double DV and block wise. Whether it is electricity company, electricity SSE or others ma. In case of intangible, always block wise and double DV. 32 subsection 1 class 2. Next ma. Block of assets. What is the definition of block of assets ma? Section 2 class 11 defining the term block of assets. Tell me what you mean by block of assets. Group of assets falling under same category, having a same class and having same rate of depreciation shall be treated as block of assets. Come again. Group of assets falling under same category, same class and having same rate of depreciation shall be treated as block of assets ma. That means category must be matched, class must be matched and rate of depreciation must be matched. If these three things matched, then you can treat it as a block, particular block, and all the assets covered under that block will be treated as block of assets. Let's verify. Group of assets falling under same category, same class and having same rate of depreciation will be regarded as block of assets. Rates of depreciation specified in the appendix 1 of the income tax rules 1962. Amendment brought out through Finance Act 2021 ma. Section 2 class 11 of the Income Tax Act, which defines the term block of assets, was amended to exclude goodwill of a business or profession from the purview of the block of asset, because goodwill is not eligible to claim depreciation under section 32 with effect from 1/4/2021. Amendment brought out through Finance Act 2021. Next ma. 43 subsection 6 method of computing depreciation under section 32 subsection 1 class 1 ma. What do you mean by 32 subsection 1 class 1? Asset wise and straight line method. Yes. First of all, determine actual cost of the asset ma. How to determine actual cost of the asset specified under section 43 subsection 1? I will explain little bit later. So we are verifying the method of computing depreciation under section 32 subsection 1 class 1, that is straight line method asset wise ma. This pro forma must be given for each and every asset separately, because asset wise and straight line method we are following. What is the section specifying the method? 43 subsection 6. Now first we need to consider actual cost of the asset. How to determine actual cost of the asset must specified under section 43 subsection 1. Then apply rate of depreciation on that, applicable rate of depreciation. Then you will get the depreciation amount. Every year you have to apply the rate of depreciation on actual cost only, not on reduced value, written down value, because we are not following double DV. We are following straight line method. Every year you have to apply this rate of depreciation on actual cost. Very important. And this pro forma must be applied for each and every asset which is using for business or profession. Chalo. That must be depreciable, of course. Note, in case the electricity company which is claiming depreciation under section 32 subsection 1 class 1 transferred any asset, then chargeability will arise. See, it is electricity SSC, that SSC is engaged into the electricity business, generation business, and he is claiming depreciation under section 32 subsection 1 class 1. Tell me, under straight line method, you will be in a position to claim highest depreciation or double DV method? Only under straight line method the SSC is eligible to claim increased depreciation than the double DV method, because under double DV method the rate will be applied on return on value, but when it comes to the straight line method the rate will always be applied on cost of the asset. That means same amount of depreciation will be allowed every year. That means the depreciation under straight line method is more than the depreciation under double DV method. If this much benefit has been given to the SSC is supposed to use that asset for his business or profession. In case without using for his business or profession, he has been transferred, then chargeability will arise to that SSC, who is claiming depreciation under section 32 subsection 1 class 1, claiming straight line method depreciation, transfer the asset, chargeability will arise. 3 sections will be applicable. First one, 32 subsection 1 class 3, you need to claim terminal depreciation. Then 41 subsection 2 deemed profits. Then section 50A capital gains. 3 sections we have to apply in case of transfer of asset by the electricity generating SSC and transfer the asset who is claiming depreciation under section 32 subsection 1 class 1. So what are the 3 sections applicable? 32 subsection 1 class 3, next one 41 subsection 2, next one 50A. What are those? I will explain little bit later. When we have to apply 32 subsection 1 class 3, when we have to apply 41 subsection 2, when we need to go for 50A, I will explain. Next sale of asset by power sector company covered under section 32 subsection 1 class 1. Now let's verify when those sections are applicable. Sale consideration or sale proceeds, 3 possible cases when you have transferred the asset covered under section 32 subsection 1 class 1, the sale proceeds are having 3 possible cases. Sale proceeds less than WDV, sale proceeds more than WDV, sale proceeds more than cost. I will explain, pay attention. Case 1, case 2, case 3. Case 1 sale value less than WDV. That means, say for example, actual cost of the asset is 10 lakhs. Rate of depreciation is 10%. Every year you are claiming 1 lakh as a depreciation. 2 years you claimed the depreciation. That means 2 lakhs has been claimed as a depreciation. Then what is the return on value? 8 lakhs that has been transferred for 5 lakhs. So what happened to the sale proceeds Sale proceeds are 5 lakhs which are less than the double DV of 8 lakhs. That means you are incurring the loss. You are incurring the loss. It is resulted into loss Second case, what is the, first of all, let's verify the treatment for that loss. What is the treatment for that loss Double DV 8 lakhs and you transferred for 5 lakhs. Then what is the loss 3 lakhs. What is the treatment for that loss of rupees 3 lakhs? It will be allowed as a terminal depreciation. What is that? It will be allowed as a terminal depreciation under section 32 subsection 1 class 3. You can debit to the P&L account. You can debit to the P&L account under section 32 subsection 1 class 3 Are you following? Allowed as terminal depreciation under section 32 subsection class 3 in the year of sale. In the year of sale itself. Until 3 lakhs you can debit to the P&L account. Next sale value more than double DV. That means double DV 8 lakhs. You transferred for 9 lakhs. Assume 8 lakhs double DV. You transferred for 9 lakhs. That means profit is there. How much profit? 1 lakh. That 1 lakh is taxable under the head PGBP. How? Let's verify. Profit Then income taxable under the head PGBP under section 41 subsection 2. How to determine income taxable under the head PGBP List of the following. 2 things we need to consider. First one, profit. How much profit? In our example, 1 lakh, assume. Next, second one, total depreciation allowed under section 32 subsection 1 class 1. In our example, what is the total depreciation allowed 2 lakhs. Profit 1 lakh. Total depreciation allowed under section 32 subsection class 1 2 lakhs. Least means that profit of 1 lakh will be taxable as deemed profit under section 41 subsection 2. Next taxable in the year of sale. Very good. Sale value more than cost. What is the cost of the asset 10 lakhs. You transferred for 12 lakhs ma. That means not only more than double DV, you have transferred more than cost. For 12 lakhs you have been transferred. In such a case, what is the profit ma? Huge profit, 4 lakhs. Then to the extent of cost, what is that? To the extent of cost, the chargeability will arise under the head PGBP. In excess of the cost, the chargeability will arise under the head capital gain. We need to invoke the provisions of section 50A. And when it comes to PGBP up to cost, we need to invoke the provisions of section 41 subsection 2. Let's verify. Profit ma, huge profit. Income taxable under the head PGBP, same formula. List of the following. Profit ma, what is the total profit in our example? 4 lakhs. Total depreciation allowed under section 32 subsection 1 class 1 2 lakhs. List means 2 lakh will be taxable under the head PGBP under section 41 subsection 2. Then ma, taxable under the head capital gain in excess of cost ma, very simple. Sale value 12 lakhs in our example minus cost of acquisition 10 lakhs in our example. Then 2 lakh will be chargeable to tax as a capital gain under section 50A. Under section 50A. Illustration ma, for your better understanding. Electricity company provides the following information. Cost of the asset 10 lakhs, date of purchase 1/4/2019, depreciation for the previous year 1920 and 2021 2 lakhs has been claimed. Then what is the double DV at the time of transfer ma? 8 lakhs. Now electricity company sold that asset in the previous year 21-22 for a consideration which is as follows. Case 1 5 lakhs, case 2 9 lakhs, case 3 12 lakhs. Same example just now I explained. Let's verify the treatment. Sale value 5 lakhs, double DV 8 lakhs ma, loss 3 lakhs. What is the treatment for that loss ma? Will be allowed as a terminal depreciation. Entire 3 lakhs shall be allowed as a terminal depreciation under section 32 subsection 1 class 3 in the year of sale. Then second case ma, sale value 9 lakhs. And what is the double DV? 8 lakhs. Profit how much? 1 lakh. Then chargeability will arise under the head PGBP under section 41 subsection 2. Then list of the following. What is the profit here? 1 lakh. And what is the total depreciation allowed under section 32 subsection class 1 ma? 2 lakhs. Then list means 1 lakh will be chargeable to tax under the head PGBP under section 41 subsection 2 in the year of sale. Next ma, case 3, sale value 12 lakhs, double DV 8 lakhs, use profit 4 lakhs. Then chargeability will arise under the head PGBP as well as capital gains. Let's verify PGBP first of all. List of the following. Profit 4 lakhs, depreciation claimed under section 32 subsection 1 class 1 2 lakhs ma. List means 2 lakhs will be taxable under the head PGBP under section 41 subsection 2 as the deemed profit ma. Then chargeability under the head capital gain. Sale value 12 lakhs, cost of acquisition 10 lakh, then 2 lakh will be treated as capital gain, taxable under the head PGBP, capital gain under section 50A. Next ma. Next section 43 subsection 6, method of computing depreciation under section 32 subsection 1 class 2. This is block of assets and written down value. Let's verify. Most popular ma. Let's verify. Opening double D we consider. Add additions, actual cost of additions made during the current previous year, applicable section 43 subsection 1. How to determine actual cost of the assets specified under section 43 subsection 1. I will explain little bit later. Add actual cost of additions into that block. Then less sale proceeds ma. Sale proceeds are sale consideration on transfer or compensation on destruction, demolish or discard of asset. You transfer the asset, you received the sale consideration, reduce, or the asset has been damaged, you received the compensation from insurance company, reduce. Then you will get value for claiming depreciation or depreciable value. Very important. You will get value for claiming depreciation or depreciable value. On that apply rate of depreciation. That means determine current year depreciation, reduce the current year depreciation. What do you mean by current year depreciation ma? It is comprising 3 things. Current year depreciation is comprising of 3 things. First one, normal depreciation. Second one, reduced depreciation. Third one, additional depreciation if eligible. All these 3 things will be put together, treated as current year depreciation. Reduce that current year depreciation ma. That is normal depreciation, reduced depreciation, additional depreciation. Then you will get closing double DV. Are you following? And this closing double DV will become opening double DV for the next year. So this is the procedure to determine depreciation and closing double DV under section 32 subsection 1 class 2 ma. So tell me, what is the procedure? Opening WDV, add actual cost of additions, less sale proceeds or compensation, then you will get a value for claiming depreciation or depreciable value, less current year depreciation includes normal depreciation, reduced depreciation, additional depreciation, then you will get closing WDV. Chalo. Next ma. Note. For claiming current year depreciation for any particular block of assets, the following two conditions must be satisfied cumulatively. If you want to claim depreciation for any block under section 32 subsection 1 class 2, there are two conditions which must be satisfied cumulatively. What are those two conditions, ma? First condition, there should be some value for the block. There should be some value. Value means positive value, ma. Depreciable value we have discussed, right? It should be some positive. Then only we can say that the block is having some value, ma, at the end of the current previous year. First condition, the block should have some positive value at the end of the current previous year. Second condition, the block should have some assets existing in that block, ma. Some assets must be existing in that block at the end of the current previous year. There should be a value, some assets must be existing. Then we can say that eligible for claiming depreciation, you can apply provisions of section 32 subsection 1 class 2. There must be some value for that block at the end of the current previous year. There must be some assets existing in the block at the current previous year. Then only you are eligible to claim depreciation. Otherwise what, ma? Section 50 will be applicable. You need to compute capital gain. Section 50 will be applicable. You need to compute capital gain. Procedure for determination of actual cost of the asset, ma, very important. Section 41 subsection 43 subsection 1, very important. Pay attention. How to determine actual cost of the asset? Cost incurred, nothing but purchase price. Add loading and unloading charges, ma. Add transportation charges. Add transit insurance. Then add interest amount and capital borrowed to purchase asset. Any interest amount has been borrowed for purchase of that asset, that interest must be capitalized. What is the interest element we need to capitalize by adding to the cost of the asset? In case of general borrowing means generally you obtain the loan amount. From that loan amount you purchased this asset. That is general borrowing. In case of general borrowing, the interest relating to the period starting from date of purchase of asset to date of put to use. The period start from date of purchase of asset to date of put to use. This period interest shall be added to the cost and must be capitalized. Then interest relating to the date subsequent to the put to use shall be allowed as a revenue expenditure under section 36 subsection 1 class 3. When it comes to the specific borrowing, what do you mean by specific borrowing, ma? That amount has been borrowed only for the purpose of purchase of that asset, ma. That is called specific borrowing. Then the period starting from date of borrowing and ends with date of put to use. That for that period, the interest expenditure shall be capitalized by adding to the cost of the asset. Then subsequent period interest shall be allowed as a revenue expenditure under section 36 subsection 1 class 3. Remember. Next, ma. Add amount paid to the experts to install the plant and machinery. Any installation charges has been incurred, you need to add. Then less subsidy or grant received from the government. Any subsidy paid by the government, reduce. Then you will get actual cost of the asset. So this is the procedure to determine what, ma? Actual cost of the asset. Note to the above said procedure must be applied for each and every asset before introducing into the block of assets and claiming the depreciation. Very good. Note 1. Second proviso to section 43 subsection 1. As per this proviso, in case SSC has been made same as provisions of section 48 subsection 3, cash payment exceeding 10,000, even it is applicable to capital expenditure, right? That is the point we are verifying. Second proviso to section 43 subsection 1. As per this proviso, in case SSC has been made the payment to the same person on the same date in respect of purchase of such asset or part thereof exceeding 10,000 by way of cash or bearer check or crossed check, then the purchase price shall be taken as 0 because you are not eligible to claim depreciation. Or nil, that means SSC is not eligible to claim the depreciation on such asset. Very good. Introduced through Finance Act 2017, applicable from previous year 17-18, the capital expenditure. We avoid second proviso to section 43 subsection 1, the payment exceeding 10,000 must be made by way of actual account pay check, account pay demand draft, electronic clearing system through bank, through such other prescribed electronic modes, and this is the list. I have already explained. Next ma, types of depreciation. Very important. Very important types of depreciation. If you listen to this concept, then it is very easy for you to determine the depreciation amount. Very easy. Let's verify. Normal depreciation, reduced depreciation, additional depreciation. We are reducing current year depreciation ma. What do you mean by current year depreciation? It is comprising of three things. First one, normal depreciation. Second one, reduced depreciation. Third one, additional depreciation. Let's verify when we have to claim normal, when we have to claim reduced, when additional. Chalo. Asset acquired in the earlier previous years ma, pay attention. Very important point I am explaining. In case asset acquired in the earlier previous years, then that asset is always eligible to claim normal depreciation. Full rate we need to apply. Second case, asset acquired in the current previous year but put to used more than or equal to 180 days in the current previous year ma. Asset acquired in the current previous year and put to used for a period of more than or equal to 180 days in the current previous year, then eligible for claiming normal depreciation. Tell me what are the two cases where you are eligible to claim normal depreciation ma? Asset acquired in the earlier previous years, then in the current previous year always eligible for claiming normal depreciation, whether you are put to used for less than 180 days or more than 180 days, no problem. But at least one day must be put to used to claim depreciation. Not even one day not been used by the SSC, not put to used, then you are not eligible to claim depreciation. So at least one day must be put to used to claim normal depreciation when the asset has been acquired in the earlier previous years. In case asset is acquired in the current previous year, then verify whether it is put to used for a period more than or equal to 180 days or not. If it is put to used more than or equal to 180 days, then you are eligible to claim normal depreciation. In case it is put to used less than 180 days, then you need to claim reduced depreciation. Are you following? Reduced depreciation means 50% of normal rate. That means 10% is normal rate of depreciation, then 10% is not allowed, only 5% is allowed in case of reduced depreciation. Chalo. Depreciation under section 32, subsection 1, class 2 or class 3 at normal rate specified in the appendix 1 of income tax rules 1962. Very good. Reduced depreciation ma. Tell me when we can claim reduced depreciation. Asset acquired in the current previous year and put to used less than 180 days in the current previous year. If these two conditions satisfied cumulatively, you are eligible to claim reduced depreciation. For claiming reduced depreciation, two conditions to be satisfied cumulatively. Asset should be acquired in the current previous year. Asset should be put to use less than 180 days in the current previous year. Then depreciation under section 32, subsection 1, class 2 or class 1 will be at 50% of normal rates applicable in the appendix 1 of income tax rules 1962. Very good. This restriction is applicable in the first year of acquisition ma. Very good. That is a valid point. Why? Because in the subsequent year, whether you put to use less than 180 days or more than 180 days, you are eligible to claim normal depreciation, full rate ma. Next, let's verify additional depreciation. Okay, examples, let's verify. Mr. X, who is into the manufacturing business, purchased plant and machinery on 1/5/2021. That means in the previous year 21-22. Put to used from 1/6/2021. That means put to used more than 180 days ma. That means eligible for normal depreciation. Good. It is acquired in the current previous year and put to used more than 180 days, eligible for normal depreciation. Example 2. Mr. X, who is into the manufacturing business, purchased plant and machinery on 1/5/21. That is in the previous year 21-22. Put to used from 1/1/2022 ma. That means in the previous year 21-22, how many days it is put to used? 91 days in the current previous year. That means less than 180 days. See, that asset has been purchased, acquired in the current previous year and put to used for a period less than 180 days in the current previous year. Both the conditions are satisfied. You are not eligible to go for normal depreciation. You have to claim reduced depreciation. Eligible for reduced depreciation. Very good. Next, my example 3. Mr. X, who is into the manufacturing business, purchased plant and machinery on 1/5/2021. That is in the previous year 21-22. Put to used from 1/1/2023 ma. That means in which previous year it is put to used from previous year 22 23. In such a case, in the previous year 21 22, not at all eligible for depreciation because not even one day it is put to used. Then in the previous year 22 23, 91 days put to used, less than 180 days, but still eligible for claiming normal depreciation because it was not acquired in the current year, it was acquired in the earlier previous years. Next, additional depreciation. Very important, pay attention. What is the dealing provision with respect to additional depreciation? Section 32, subsection 1, clause